aggregate profit reflecting a uniform rate of profit, as in Table 6.10. But the general problem is the same in both cases. No matter which set of prices we take to be fundamental, a different set of relative prices will result in aggregate profit different from fundamental profit. The three sets of prices circulate a given physical product at a given total money value, so that circulation as a whole neither creates nor destroys total value. Yet different relative prices appear to create or destroy profit. How can this be? In order to answer this question, we need to consider Stoyart's notion of relative profit in more detail. For aggregate profits and transfers of value, a general solution to the universal transformation problem. Let us start with the previously mentioned case in section 2 of the relation between commodity transfers and aggregate profit. Suppose a computer store sells two computer monitors, each worth $500, one to a household and the other to a business. Each transaction earns the computer store its usual profit. Suppose the monitor in the household is subsequently stolen and resold for $500. Then household wealth goes down by $500, while aggregate profit goes up by $500 even though no additional surplus product has been produced. We can see here that a wealth transfer from the circuit of revenue, households, to the circuit of capital, business, can give rise to an increase in aggregate profit independent of any change in physical production, Table 6.12. Suppose instead that the computer monitor worth $500 is stolen from the offices of one business and then resold by another business for the same amount. In this case, the first business will book the loss of the monitor, for which it paid $500, as a charge to its depreciation and depletion accounts, which would change its net profits by. On the other hand, the second business will book a net profit of $500 on the sale of the monitor. So this transfer within the circuit of capital, from one business to another, does not affect aggregate profit. A third possibility is that the monitor is stolen from the inventory of finished goods where it was waiting to be sold. Suppose the monitor cost $350 to produce. Then in the absence of the theft its sale for $500 would result in a profit on production of $150. But since the monitor has been stolen from the finished goods inventory and sold by another business, the business suffering the theft would involuntarily forego its sales revenue from this item while still having to account for its production cost. Its profit would therefore change by $350. On the other side, if there were no acquisition costs for the receiving business, it would book a net profit of $500 from its sale of the monitor. Aggregate profit would be the same as in the case of no theft, but its distribution would have changed. Of course, if the receiving business did have acquisition and selling costs associated with its fencing operations, then aggregate profit would be lower than previously by the amount of these costs. The foregoing basic rules are not altered in the least if there is a middleman in the story. In the case of the theft from households, if the burglar sold the monitor to a business for $200 which the business then resold for $500, the net gain in business profit is $300. This is exactly the counterpart of net change in household wealth, which is $500 for the household from which the monitor was taken and $200 for the household of the burglar. Once again, the net profit on vibration corresponds to the net wealth transferred from the circuit of revenue to the circuit of capital. In the case of theft of a monitor from a business office, i.e., of an item whose initial sale to this business had already realized the profit on its production, the first business still books a change in profits of $500 due to increased depletion allowances. But now, the second books a net profit of $300, which is the difference between its sales of $500 and its acquisition cost of $200 for the monitor, paid to the entrepreneurial burglar. Thus, aggregate profits have changed by $200, which is exactly balanced by the net change of $200 in the household wealth, via that of the burglar. Finally, if the monitor had been stolen from the inventory of finished goods of a business while waiting to be sold, this business would have lost its sale while still being on the hook for its cost of production of $350, so that it would book a profit of $350. The receiving business, on the other hand, would garner a sales revenue of $500, which after deduction for the acquisition cost of $200 paid to the thief, would result in a net profit of $300. The change in aggregate profit therefore amounts to $50, $350 for the first business plus $300 for the second. But we have already seen that the profit on production implicit in the commodity itself is $150. Thus, the net change in aggregate profit arising from these underhanded transactions is actually $200. And this is, of course, the direct counterpart of the increase in the household wealth of the burglar, the $200 he received for the service of redirecting sales and profits. This last situation serves to remind us that transfers between the two circuits can also decrease overall profits, as depicted in Table 6.15 and illustrated previously in Section 2 for the case of interest flows. A commodity acquired without payment is truly bought cheap and sold dear. But this happy coincidence of wants is not necessary. The real linchpin of all the transfer of wealth scenarios is the process of buying and selling at different prices, i.e., of engaging in unequal exchange. On the other hand, insofar as there is a pure transfer within the flow circuit of capital, as in Tables 6.13 and 6.14, no new profits arise but profits can fall if some part of the transfer is absorbed as costs. Finally, when there is a mixture of the two, as in Table 6.15, aggregate profit may rise above or fall below profit on production. In all cases, the sum of changes in household wealth and new business profit add up to zero, no new value is created or destroyed but such transfers. This, I believe, is exactly what Stoyart has in mind in his distinction between profit on vibration and profit on production, a distinction which Marx cites approvingly and incorporates into his own theoretical lexicon. 1. Transfers of value via changes in relative prices. In all the preceding cases, transfers of value took place through the physical transfer of a commodity or through transfers of profit or revenues. But value transfers can also occur solely through differences in the prices of commodities. It is this issue which is crucial to the generic transformation problem arising from a comparison between any two sets of relative prices, Marx's direct prices versus Bortkevich's, Sraffa prices versus a variety of monopoly prices, and any one of these prices versus an infinite range of market prices. Once we begin to compare alternate sets of prices, then we encounter the question, which price set represents fundamental value? In the case of Marx, it is direct prices, i.e., prices proportional to labor values. In the case of Sraffa, it is prices of production, i.e., prices embodying uniform rates of profit. For our present purpose, the designation of fundamental value only defines the base set of prices to which others are compared. Thus, if we begin from direct prices and move to prices of production, as Marx does, then the transfers are measured relative to direct prices. On the other hand, we could equally well view prices of production as the base set against which other prices, such as direct prices or monopoly prices, can be compared. The important point is that any pair of comparisons gives rise to a transformation problem. This is evident if we compare any pair of tables 6.9 to 6.11. To understand what is involved, it is useful to note that aggregate production profit is the price of the surplus product. Profit is the difference between the price of the total product and the price of the material and wage goods needed to produce it. But the difference in the commodity vector of total output and that of materials and wage goods is simply the surplus product. It follows that profit is the aggregate price of the surplus product. In all three of the preceding tables, the surplus product has been that shown in the last column of Table 6.5, 60 corn plus 15 iron, and aggregate profit has been the aggregate price of the surplus product. Table 6.16 summarizes this important point, which is derived more formally in Appendix 6.1. Comparison between the money value of the surplus product for any given price set taken from Table 6.8 and the corresponding total profit in the appropriate one of Tables 6.9 to 6.11 makes it clear that the two are the same. As shown in Appendix 4.1, at this level of abstraction, the surplus product can always be written as the sum of its uses consisting of two components, capitalist consumption and investment, in fixed capital and inventories of materials and work in process. In order to simplify the verbal exposition, I will assume that each of these two components is a distinct commodity, as shown in Table 6.17. Insofar as investment is positive, there is some kind of growth, although at this moment there is no assumption about growth being balanced. In Table 6.16, each successive set of prices happen to have a higher price of the capitalist consumption good, corn, and a lower price of the investment good, iron. These opposing movements in the prices of the components of the surplus product are due to the fact that the sum of the two output prices is being held constant in order to isolate the effects of changes in relative prices, Tables 6.9 to 6.11, so that any change in the price of one commodity must be attended by an opposite change in the overall price of all the others. We will see in the next section that this pattern gives rise to a powerful insight into the effects on overall profit. But for now, the opposing movements in the two prices are useful in terms of exposition because they allow us to separate out the opposing effects on aggregate profit of a change, increase, in the price of capitalist consumption goods and a change, decrease, in the price of investment goods. Recall that, like Bortkiewicz and Sraffa, we are concerned solely with the effects of price changes on aggregate profit for a given set of physical flows. An increase in the price of capitalist consumption goods will raise the profits of that sector. On the other side, it also will raise the expenditures required for a given level of capitalist consumption of corn, which means that capitalist households will end up with a concomitantly lower money balance. The increase in business profit is therefore the counterpart of a decrease in personal wealth of the capitalist households. The rise in the price of capitalist consumption goods has brought about a transfer of wealth from the circuit of revenue to the circuit of capital, which is why overall aggregate profit is raised. A different type of transfer comes into play with a change in the price of investment goods, iron. A lower price of iron lowers the profit in the iron sector. At the same time, it also lowers the costs of a given volume of investment. But by its nature, investment is a capital cost, not a current one. Hence, there is no current benefit to the decrease in the profit of the iron sector, so overall aggregate profit falls. This particular transfer of value seems to directly contradict the previous rule that transfers within the circuit of capital do not affect aggregate profit. But if we consider that capital costs are transferred to current costs as the capital assets are used up, then we can see that the rule is not really violated, it is merely stretched out in time. For instance, if the investment in iron was intended as additional materials needed for the expansion of production, then a lower price of iron will show up as decreased unit costs in the very next production period, with a concomitant increase in aggregate unit profits. Point 10 at the other extreme, if the investment in iron represents an addition to fixed capital, then its lowered price will show up as a reduction in depreciation charges over the useful life of the item, say over 10 production periods. In either case, the decrease in current profit brought about by the reduction in the price of investment goods is exactly offset by increased profit flows in future periods. Value is conserved across time here, just as it was previously conserved across space when it was transferred from the circuit of revenue to the circuit of capital. It follows that changes in aggregate profit due to changes in relative prices can be fully explained by two types of transfers of value: transfers between the circuit of revenue and the circuit of capital, and those particular transfers within the circuit of capital which change current profits at the expense or benefit of future profits. Since these two fundamental principles apply to any pair of relative price sets, they can account for the puzzles in both the Marxian and Sraffian transformation problems. It is striking that all of the elements of the solution are implicit in Marx's writings. His adoption of Steuart's distinction between profit on transfer and profit on production, Marx 1963, ch1, his own distinction between circuits of capital revenue and capital which provide the foundations of the general rules for transfers of value, Marx 1967a, ch4, and his detailed verbal exposition of the interactions of circuits within the schemes of reproduction which provides the links to stocks and flows of commodities and money, Marx 1967b, ch20, sector 3-5, and ch21. Many parts of Marx's voluminous notes remain to be translated, Hecker 2010, so we do not know if he himself managed to put all of these elements together as part of his further analysis of prices and profits. What we can say, however, is that the necessary tools have been there all along. 2. The influence of output proportions on transfers of value and aggregate profit. It will be noticed in Table 6.16 that a change in relative prices has offsetting effects on overall profit. Since we are holding the money value of total output, the sum of prices, constant in order to isolate the effect of changes in relative prices, Table 6.9 to 6.11, any change in the price of corn must be attended by an opposite change in the price of iron. In our ongoing illustration, the surplus product happens to consist of both commodities, so that the profit effect of an increase in the price of corn, the capitalist consumption good, is partially offset by the effect of a decrease in the price of iron, the investment good. This immediately alerts us to the fact that there would be no overall effect of relative prices on aggregate profit if the surplus product happened to have the same proportions as the total product, then aggregate profits would be entirely immune to changes in relative prices. This result is also prefigured in Marx's work. In his analysis of the schemes of expanding reproduction, i.e., of the balanced accumulation of capital, he establishes that the growth rate is equal to the profit rate times the degree to which the mass of surplus value is reinvested, Marx 1967 ch 21, 489. The upper limit of balanced accumulation is when all surplus value is reinvested, in which case the rate of growth of capital is equal to the rate of profit. 11. Then two things follow. First, there is no capitalist consumption out of surplus value, so that investment is the only component of the surplus product. Second, since balanced growth requires the production of each commodity to be growing at the same rate, in this case equal to the rate of profit, say 20%. It follows that each commodity in the surplus product must be 20% of the amount of this same commodity used as social inputs, materials or wage goods, in prior production. Since the total product is the sum of social input use and the surplus product, each element of total output must therefore be 120% of total inputs. It follows that when the system is in maximum expanded reproduction, MER, the surplus product vector will be proportional to the total output vector. Then when we hold the sum of output prices constant, we will necessarily hold the sum of profits constant, Shaikh 1973, 142 to 147. This is because the surplus product, which in MER is pure investment, will be composed of both corn and iron, since they both enter into the means of production in the same proportions in which they enter the total product. But if the money value of that product is held constant, then so will the money value of any given fraction of the total product, such as the surplus product in MER. With the total sum of prices held constant, a rise in the price of corn will create higher current profits at the expense of lower profits due to higher corn input costs in the future. Conversely, a lower price of iron will give rise to lower profits now but will portend higher profits in the future due to lower iron input costs. The two immediate effects will exactly cancel out in the aggregate, since surplus product is proportional to total product, whose total price is being held constant, which in turn means that the future aggregate profits are also unchanged. In MER, there is no aggregate transfer of value between the circuit of capital and the circuit of revenue, and there is also no aggregate transfer of value between flows and stocks within the circuit of capital. There is only production profit arising directly from surplus labor time. This analysis can be taken one step further by recognizing that the output proportions corresponding to maximum expanded reproduction can be viewed as riscaled levels of individual industries. These riscaling factors can be treated as weights attached to observed levels of industry production, so that the mere output vector can also be viewed as representing a composite industry composed of weighted levels of observed outputs. This is Marx's equivalent to SRAF's standard commodity, SRAF 1960, ch4. It is the center of gravity of the transformation problem, the special average industry in which the relation between surplus value and money profit is made entirely transparent, Shaikh 1984b, 60-61. Although Marx never formally derives this, in his discussion of the transformation from values to prices of production, he does speak of spheres of mean composition, whether these correspond exactly or only approximately to the social average whose profit rate is the one to which others adjust, Marx 1967 c. 273. To make our relative price comparisons complete, we now need to readjust price magnitudes, but not price ratios, to keep the sum of prices constant. The new output levels have been normalized to make the mere direct sum of prices the same as the actual direct sum of prices, $875, using the levels of direct prices in Table 6.8. But then the previous levels of prices of production and monopoly price, when applied to the new output vector, will yield sums of prices somewhat different from $875. The corresponding total profits would then be a result of a change in outputs and a rise or fall in the overall price level. To make the price level the same in all three relative price sets, we would therefore have to adjust the levels of the production and monopoly price sets to make their corresponding sums of prices also equal to $875 without, of course, changing the price ratios which define these sets of prices. Table 6.19 depicts the new prices levels for each type of price, which can be seen to represent exactly the same relative prices as in Table 6.8 previously: prices proportional to labor values, price set D, competitive prices incorporating a uniform rate of profit, price set C, and monopoly or market prices, price set M. In the composite industry depicted in Table 6.18, the ratio of corn to iron in industry output is, which is the same as the ratio of corn to iron in the surplus product, 102.18/6.24. In this case, any set of prices that hold the total money value of output constant will also hold the total money value of the surplus product, i.e., total profit, constant. Tables 6.20 to 6.22 depict the money flows associated with the Marxian composite industry. We now see that for any given price level, as exemplified by a given sum of prices, relative prices have no impact whatsoever on total profit, Shaikh 1984b, 60. V. Financial profits and profit on transfer. Financial profits raise the question of the impact of intersectoral transfers such as the net interest paid by the non-financial sector to the financial sector and the separate question of capital gains. On the former question, it was established in Section 2 that if the production sector pays some part, 80, of its surplus as interest to the financial sector, its change in profit, 80, will be only partially compensated by the increased profit of the financial sector, 30, the rest having been absorbed in financial sector costs, 50, so aggregate profit will fall by 50. On the other hand, if instead some portion of household income consisting of wages and dividends originating in production or finance is recirculated as net interest payments, 18, to banks, then aggregate profit will rise by 6 as the remainder, 12, is absorbed by bank costs. The sum of changes still add up to 0, but now the reduction in household income is within the circuit of revenue while the increase in bank costs gain and bank profit is within the circuit of capital. Capital gains add a further dimension to financial profits. Consider an asset such as a building, stock, or bond whose price has risen. The holder of the asset records an accounting capital gain. No money has changed hands and yet the total nominal asset value in the economy has increased. If this revalued asset is held by a household, then its higher price raises the nominal value of total household assets. If the asset was originally purchased for $100,000 but is now valued at $120,000, household nominal wealth has risen by $20,000 and this gain is booked in the wealth account of the original owner. If she then sells this asset to another household, she receives $120,000 in money for an asset for which she paid $100,000, thus converting her paper gain into actual income. At the same time, the buying household has exchanged $120,000 in money for an asset which purports to be worth $120,000. If the buyer's money was originally on hand, then wealth of the buying household is unchanged but its form has changed from money to the asset. Current money has been exchanged for an asset with a prospective gain. If some part of the money was acquired through new bank credit, then this part has been created by the bank on the promise that the borrower must pay this back with interest, i.e., on the condition of a future net reduction in money. Further treatment of the issue of the creation of purchasing power through bank credit and its reflux when the debts are paid will have to be postponed until chapters 13 to 14 in part 3 of this book. For the moment, it is important to recognize that while the capital gain has been realized for the first owner, it remains in latent form for the second, a latency which can prove to be a fantasy if the asset price should subsequently fall. A similar result obtains if the owner of the revalued asset is a financial firm. The rise in asset price raised the capital stock of the original firm and that of the business sector as a whole, but its subsequent sale has no further effect on either, since any transaction after that always involves an exchange of an asset worth $120,000 for the same amount in cash. Point 12. But in this case the cashing in of the capital gain is recorded as profit for the firm, and hence as additional profit for the economy as a whole. While this may seem like a new result, it is not. The increase in aggregate profit originates from the fact that the same commodity is bought at one price and sold for a higher one. We saw in Table 6.14 that a rise in selling prices above purchasing prices can increase nominal profit but not real profits. National accounts typically exclude capital gains and losses from their measure of national output and its components, including aggregate profit, precisely because they result from the revaluation and sale of existing assets rather than from current production, BEA 2006, 5 and 16. On the other hand, the state treats them as personal or business income and levies taxes on them accordingly, BEA 2006, 11 to 12. Founder's profit is a particularly striking example of realized capital gains. Consider a start-up company which is privately held and manages to convince the market that it will be profitable in the future. Then if the founders of the company decide to go public, they can sell a portion of their company to the public in the form of shares. In this process, they cash in on the latent capital gains in their holdings. The same result obtains if they manage to sell the company to another firm. Everything said so far applies equally well to capital losses, including founders' losses. Assets can also go down in value, and many companies do in fact fail altogether, even in good times. A characteristic pattern for new businesses is 25% fail by the first year, 50% by the fourth year, and 70% by the 10th year, Shane 2008. This brings us to a point which can only be addressed in passing here. In a capitalist economy, the prices of most assets are derived from the potential gains to be made from them. Thus, the price of land is based on the rent which it might afford, and as Ricardo long ago showed, this rent is itself based on the profit which might be made through the use of the land. Similarly, the price of equity is tied to the future profits of the issuing company. In this sense, assets such as these are the first derivatives of real capital, bets made by the buyer on its future outcomes. From this point of view, so-called financial derivatives are the second derivatives of capital. They are instruments whose value is based on the expected future price of some underlying asset or future outcome, such as the future price of some commodity or currency. These can take the form of insurance against undesired risk, or bets on future gains or losses. They can also be pyramided by making derivatives based on derivatives, i.e., third and fourth derivatives of capital, and so on. The calculus of finance has many moments. The end result is an inverted pyramid, with real profits at its base and a rapidly widening volume of financial assets stacked upon it. Futures, hedges, and various types of bets have been around for centuries. But in recent times, they have proliferated to an extraordinary degree despite the fact that they have become ever more complex bets on ever more improbable outcomes. It has been estimated that the global crisis which began in 2007 wiped out $34 trillion in asset value within 2 years. Yet even 3 years into the crisis, the stock of financial derivatives was estimated to be $1.40 quadrillion, 23 times the total value of world GDP. This notional value is based on unknown unknowns, not only because the details of many derivatives are proprietary but also because the present and future outcomes upon which their valuation rests are still highly improbable. There is much more to come in this history. 6 theories of aggregate profit in various schools. Stoiart's argument in 1767 was that profit had 2 sources, production and transfer. This insight was essentially lost to the literature once Smith's Wealth of Nations appeared a mere 9 years later. From then on the focus was almost exclusively on profit derived from production. Ricardo follows this line 4 decades after Smith. Marx, some 4 decades after Ricardo, comments favorably on the Stoiart's notion of profit on transfer, profit on alienation, and notes that it plays an important role in the distribution of surplus value among different categories such as profit, interest, and rent, Marx 1963, 42. This is exactly what the example of interest payments from production to finance is concerned with, and it seems obvious to me that Marx understood the issue well. But no corresponding discussion appears in the material Engels chose to include in volumes 2 and 3 of Capital, and the idea subsequently disappears from the Marxian lexicon. It is neoclassical economics, with its insistence on exchange as the appropriate starting point, which rediscovers the concept as a means of justifying pure trading profit. But this fleeting development is buried by the rise to prominence of the aggregate production function just as surely as Smith's focus on production profit buried Stoiart's insight about profit on vibration. We will see that despite their quarrels with neoclassicals on the determination of the level of production, Keynes and Kalecki stay firmly in the production camp when it comes to the explanation of aggregate profit. Post-Keynesian and other subsequent writers do not stray far from this well-trodden path. 2 things need to be emphasized before proceeding further. First, the concern here is with the origin of total profit, gross of its division into rent and interest, not with its justification. Lurking in the background is the point made in section 3 that there is no profit on production if there is no surplus labor, and an attendant surplus product price trickery will not serve here. From this point of view, it is interesting to trace how various schools explicitly or implicitly rely on the existence of a surplus product in their explanation of aggregate profit. The second point is that relative prices come into their own when the aggregate product is treated as a bundle of heterogeneous commodities, in which case aggregate profit can differ from its fundamental counterpart once relative prices differ from fundamental prices. It has been shown that this difference arises from transfers of value within the circuit of capital and/or between it and the circuit of revenue. As long as the whole product is sold, exchange does not create or destroy value, which is precisely why profit can differ from its fundamental level. Economic profit is production profit plus or minus transfers of value across the boundary of the current account of the circuit of capital. On the other hand, it is obvious that if some of the product is not sold, aggregate profit can fall below its fundamental level and may even be negative, as it was during the Great Depression. Finally, we saw that aggregate profit can fall below the money value of the production surplus if some of it is transferred out as rent and interest, and can rise above the production surplus if some revenue is paid out as rents and interest. Without the production surplus, all of these secondary forms of profit would collapse, for then there would be neither the business base nor the household revenue, itself derived from wages and dividends, to support the secondary flows. All that would remain would be the ancient form of profit, pure merchant profit arising from transfers between regions. Smith distinguishes between the production of the net product, which is the whole produce of labor, and its division into component parts. In particular, once capital is on the scene, the whole produce of labor does not always belong to the laborer. He must in most cases share it with the owner of the stock which employs him and to the landlords, who like all other men, love to reap where they have never sowed, and demand a rent. The laborer must then give up to the landlord. Smith 1937, ch. 6, 151-153. This is certainly consistent with the surplus product theory in the sense that the profit and rent come from the portion of the net product which does not go to labor. Marx 1963, 82-86, Dobb 1973, 45-46. Ricardo also argues that the proportion which might be paid for wages is of the utmost importance in the question of profits, for it must at once be seen that profits would be high or low, exactly in proportion as wages were low or high. The introduction of rent into Ricardo's analysis makes it clear that the same argument applies to the sum of profit and rent, with the added understanding that now the share of rent in the net product can also expand at the expense of profit, something upon which he builds his own analysis of the tendency of the rate of profit to fall over time. Ricardo 1951a, 27, 48-51, Sraffa 1962, XXXIII, Dobb 1973, 71-72. One of Marx's signal contributions was to make the length and intensity of the working day as important as the level of the real wage in the determination of the surplus product. His concern was to demonstrate that the surplus product is the material reflection of surplus labor time in all modes of production, and of surplus value in the capitalist mode. We have already analyzed this connection in some detail. Neoclassical theory actually has two different theories of profit. Its traditional starting point is the theory of pure exchange. On the positive side, because exchange can only take place between different goods, this necessarily incorporates the heterogeneity of commodities. On the negative side, since the goods in question must first exist before being exchanged, one would expect the analysis to begin with their prior production. But then their costs of production would have to enter the picture, which would destroy the spurious simplicity of the story of pure exchange. This problem is evaded by assuming that each individual involved in the exchange process begins with some positive initial endowment of goods. In their influential early post-war textbook, Alchin and Allen provide a particularly revealing illustration of the neoclassical derivation of profit on transfer. Their story, originally penned in 1964, begins in a camp where Cuban and Hungarian refugees are temporarily housed. Each guest receives a gift parcel every week consisting of 20 cigarettes and 20 chocolates. Also in this camp is a new refugee, for whom there are no gift parcels, arriving from an unknown country. This new refugee is clever and knowledgeable about human nature, and unlike the others, he is also entrepreneurial. He knows that reckless Hungarians would prefer to have more cigarettes while fun-loving Cubans would prefer more chocolates. The well-briefed newcomer therefore offers the Hungarians more cigarettes for some of their chocolates and the Cubans more chocolate for some of their cigarettes, and once mutually agreed terms have been arrived at, he faithfully fulfills his bargains. In this way, each nationality ends up with a bundle which is more satisfactory than their initial, foolishly egalitarian, allotments. Alchin and Allen point out the amazing fact that the enterprising middleman gets to keep 2 cigarettes for himself on each brokered transaction. Alchin and Allen 1969, 39-41. The Cubans and Hungarians are better off because they move to higher levels of satisfaction, while the middleman is better off because he makes a profit. Moreover, as long as the Hungarians and Cubans do not catch on, the middleman can continue to make a profit every week, fed by a steady flow of goods arriving at the camp. Of course, these goods have to be produced each week somewhere and sold to the shadowy operators of the camp at customary profits. Thus, the profit of the middleman adds to aggregate profit on production, through a pure transfer of wealth from the circuits of revenue of the camp guests to the circuit of capital of the entrepreneurial secret agent. The more familiar neoclassical derivation of aggregate profit is rooted in production and abstracts from the heterogeneity of individual commodities. It is supposed that there exists something called a well-behaved aggregate production function which links real net output, year, to inputs called capital, KR, and labor. To this must be added the accounting identity that real net output equals the sum of total real wages, WRWRL, where WR equals the real wage per unit labor, and total real profits, PRRKR, where R equals the rate of profit on capital year WRL plus RKR. Three further assumptions are then needed in order to ground the neoclassical argument. First, that the assumed production function is homogeneous of the first degree so that it satisfies the condition. Second, either the aggregate marginal product of labor equals the real wage, or the aggregate marginal product of capital equals the rate of profit. Only one of these conditions is necessary, since the conjunction of the accounting identity and the homogeneity assumption ensures that one implies the other. And third, that both marginal products are positive. This last requirement is actually crucial, and it is usually achieved by assuming that in equilibrium marginal products are equal to corresponding factor prices, and that these factor prices are themselves positive, Varian 1993, 331. In the accounting identity, there is no necessity that the aggregate rate of profit be positive. Indeed, during the Great Depression in 1932 to 1933, to which the accounting identity applied just as well, aggregate profit was actually negative. But once one requires that both marginal products are positive, then since KR and L are positive, the equality of marginal products with the respective factor prices implies that the real wage is below the average product of labor. Defining year equals year/L equals the average productivity of labor, and KR equals KR/L equals the real capital, labor ratio, we can divide the homogeneity condition by L to get, in which case the positivity of the marginal product of capital ensures that WRR. This is the general condition for the existence of surplus labor time, Appendix 6.1.I. Since it is consistent with a large range of possible production levels, a further step is required to identify any particular equilibrium level. So neoclassical theory further posits that a flexible real wage ensures the full employment of all available labor, which means that the equilibrium level of output is that level which ensures the full employment of labor, and the equilibrium level of profit is the full employment level of profit. Keynes was acutely aware that profit was the engine which drives enterprise, Keynes 1976, 148. So it is somewhat surprising that his formal apparatus in the general theory, GT, does not explicitly address the level of aggregate profit. Indeed, according to his eminent biographer Lord Skidelsky, Keynes did not even have a theory of what determines the rate of return on physical capital, even though his own theory of investment, which determines the equilibrium level of output through the multiplier process, depends precisely on this rate of return, Skidelsky 1992, 326. So in the end, Keynes implicitly assumes the conditions necessary for the existence of aggregate profit. Kalecki, who had developed his own theory of effective demand prior to the publication of the GT, seems to do better in this regard. He presents a theory of oligopoly in which each firm sets its selling price through a markup on its prime, materials and labor, costs, the size of this markup being determined by the firm's monopoly power. Then the industry price is a markup on the industry's prime cost, which translates at an aggregate level into a particular profit share and hence a particular wage share, Sawyer 1985, 27. It is implicitly assumed that the wage share is positive and less than 1, i.e., that WRR, in which case surplus labor time and a corresponding surplus product are implicit. The Kaleckian claim that markups determine the wage share rests on the notion that workers receive and accept a real wage below productivity as created through the pricing policies of firms. Workers are assumed to bargain for a money wage. Firms create prices essentially by adding monopoly markups on unit labor costs, since materials costs and depreciation are themselves prices of particular bundles of goods, and the resulting price level determines a real wage. Sawyer 1985, 15, 108 to 113. It follows that trade unions can only affect the real wage relative to productivity insofar as they can affect the degree of monopoly, 110 to 111. As a leading post-Keynesian notes, despite introducing class, Kalecki's approach makes no mention of class conflict in the form of labor struggle, Pali 2003, 183. In any case, once a positive profit share has been assumed, the level of profit is determined by the level of output. And here, Keynesians and post-Keynesians alike argue that it is the level of autonomous aggregate demand that determines a particular output and an employment level which may be less than full employment. In the end, as with neoclassical economics, post-Keynesian theory has two steps to its argument. The share of profit in the product of industry is determined by the level of gross margins, while the total flow of profits per annum depends upon the total level of output generated via the multiplier, the total flow of capitalists' expenditures on investment and consumption, Robinson 1977, 13-14. Circuit theory, which distinguishes itself from post-Keynesian theory by its emphasis on bank credit as the pure form of money, is no different with regard to the theory of profit. Wage bargains are assumed to be conducted in money terms. The profit share is determined by prices set via markups on costs, and the aggregate level of profit is given by the level of output determined by the autonomous components of aggregate demand. Realfonso 2003, 63-64, point 13. None of these stories work unless there is a surplus product. As noted in sections 2 and 3, when outputs equal aggregate inputs, then all sets of prices will yield a zero aggregate profit. Hence, if some sectors have positive profits, others must have negative profits, see Table 6.2 to 6.4. This tells us we are not free to specify all positive markups when there is no surplus product. Conversely, if we do so specify, then we are implicitly assuming a positive surplus product. In this regard, Bronfenbrenner long ago noted that as Kaleckian monopoly markups go to zero, aggregate profit also goes to zero, Sawyer 1985, 34-35. This either implies that competitive capitalism cannot generate profits, which would certainly be a novel claim, or that prime costs include a competitive rate of profit on capital advanced, whose existence would then require independent explanation. In any case, as previously shown during the analysis of the effects of relative prices on an existing surplus product, monopoly markups would largely serve to redistribute the existing total profit, not create it. Table 6.11. There is a version of aggregate profit theory associated with Kalecki and Calder which seems to escape these limits because it is advanced directly at the aggregate level. Aggregate demand, it is said, is the sum of worker and capitalist, personal consumption demand and business investment demand, while supply can be expressed as the sum of wages and profits. If workers consume all of their income, wages, while capitalist households consume only a part of their income, profit paid over as dividends, then in equilibrium the savings out of aggregate profit, S, must equal investment, I, where is the average propensity to save out of profit income. But since I can be determined by the deliberate decisions of businesses, and by rentiers, but P cannot, the direction of causation must run from I, and to P, Webster 2003, 299. If the conditions for a positive profit share have already been established, then this is simply an instance of the second step in the standard post-Keynesian argument that the level of demand determines a level of output which, in the face of a given profit share, determines the level of aggregate profit. On the other hand, if there is no profit, then this version of the Kaleckian-Caldorian story cannot hold because when there is no aggregate profit there is no aggregate savings, so that the equilibrium condition cannot obtain. It follows that there is only one story of equilibrium profits here, which is that of a positive profit share. But even when there is a zero surplus product, there can be disequilibrium aggregate profit. Suppose that workers have chosen to go on slowdown, so that their productivity is equal to their real wage WR equals year. then there is no surplus labor time and no surplus product. Moreover, since the real wage bill and the level of real output, then year equals WR and real aggregate profit PR equals 0. If workers consume all of their income, the aggregate net product will be absorbed by their consumption demand. But capitalists have to eat also, and firms have to invest, so these two additional sources of demand may also appear in the market, deficit financed due to the absence of current profits. With workers consuming the whole net product, this additional demand can only be met in two ways: a rise in selling prices and or sales from inventories. The former case has already been analyzed in Table 6.4, prices will rise above those at which inputs and labor power were purchased prior to production, so that nominal profits will be created. But when these are adjusted for the change in the current costs of inputs and in the general price level, real profits are still exactly 0. The other possibility is that excess demand is met through sales from inventories of final goods, then sales will higher than production, which means profit on sales will be higher than profit on production. Since the latter is 0, this implies that profit on sales will be positive precisely because the change in inventories is negative. Adding the two gives us profit on production, which would be 0. All of this serves to remind us that we should not confuse the national income accounting identity YC plus I, in which the investment term, I, includes unintended changes in inventories arising from the difference between demand and supply, with the equilibrium condition in which represents equilibrium output and represent equilibrium consumption and investment and inventory demand, respectively. Sraffa's profit theory is clearly in the classical mold. He begins by demonstrating that when a society produces just enough to maintain itself, i.e. has no surplus product, there cannot be any profit. He does this showing that the only price set which, if adopted by the market, restores the original distribution of the products and makes it possible for the process to be repeated, implies 0 profits in each sector, and hence 0 aggregate profit. Sraffa 1960, 3-5. We noted in the discussions of Tables 6.2 and 6.3 that these prices are proportional to labor values with 0 surplus labor time. But Sraffa's restriction to 0 profits in every sector is not necessary to establish 0 aggregate profit, since any set of prices will do the trick. If there is no surplus product, the sum of costs equals the sum of prices, so aggregate profit is 0 even when individual sectors have non-zero, positive and negative, profits. To put it differently, aggregate profit being the money value of the surplus product, the former is 0 when the latter is 0, section 3.1. Sraffa also establishes that a surplus product is a necessary condition for a positive uniform rate of profit, and hence for aggregate profit. Once again, this demonstration is restricted to prices of production. Two things are striking in this regard. First, emergence of a social surplus is made to seem to be a technological matter, in that it is presented as an output change with no change in inputs, Sraffa 1960, 7. By contrast, in Marx's argument, it is the socially determined extension of the working day beyond necessary labor time that gives rise to a social surplus. 14. By focusing solely on prices of production throughout the book, he avoids the transformation problem inherent in his own analysis. The average profit rate corresponding to any other set of prices will differ from the uniform rate of profit, and the total amount of profit at any given aggregate price level will differ from normal profit. See Table 6.9 to 6.11. It is Dobb who picks up on fact that Sraffa has shown that mere changes in relative prices may change the measure of the aggregate product. We are indebted, again, to Mr. Sraffa for revealing the true nature of Ricardo's problem. He has shown that what troubled Ricardo was that the size of the national product appears to change when the division of it between classes changes. Even though nothing has occurred to change the magnitude of the real product in the aggregate, there may be apparent changes due solely to a change in measurement, owing to the fact that measurement is in terms of money value, and relative values, i.e. relative prices, have been altered as a result of a change in the division between wages and profits. Dobb 1973, 84, quoting from Sraffa's Introduction to Works and Correspondence of David Ricardo. Dobbs' insightful comment seems to have been ignored in the neo-Ricardian literature. It is important not to confuse the explanation of aggregate profit with its justification. Smith explains profit and rent as a deduction from the net produce of labor, but does not dispute that the capitalist or the landlord have rights to these flows. Smith 1937, 151-153, Dobb 1973, 46. Ricardo obviously shares this sentiment. Marx says that profit is founded on the surplus labor time, but is clear that capitalists and landlords, like all ruling classes, have the right to extract this in their mode of production. Dobb 1973, 146, just as workers have the right to resist. None of this prevents these three great thinkers from speaking critically of the dominant classes. Smith speaks of masters who collude everywhere to hold down wages and raise prices, of landlords who love to reap where they have never sowed, and demand a rent that the laborer must then give up to the landlord, and of traders who have generally an interest to deceive and oppress the public. Smith 1937, ch. 6, 151-153, 232, 358-359. Ricardo specifically targets private property in land as the imminent cause of a falling rate of profit as capitalism develops, and the owners of land and receivers of tithes and taxes as the ultimate beneficiaries of this process leading to eventual stagnation. Dobb 1973, 88-89. And Marx speaks of the capitalist as capital personified. His soul is the soul of capital. Capital in turn is dead labor which, vampire-like, lives only by sucking living labor, and lives the more labor it sucks. Marx 1967a, ch. 10, 233. In neoclassical theory, the explanation of profit is often buried underneath the attempt to justify it. Contrast Smith's description of traders, in whose general interest it is to deceive and oppress the public, to that of Alchin and Allen's fully informed and scrupulously honest secret agent. Or again, Smith's warning that the interests of those who live by profit can be quite different from the interest of society, in contrast to the neoclassical vision of a passive and ever-accommodating capitalist whose profit is just reward for his marginal contribution to the social product. In this regard, Austrians are better because they portray capitalism as dynamic, competition as a process, and disequilibrium as the normal state of affairs. But in the end they are more concerned to portray profit as the just reward to abstinence and entrepreneurship. Machovec 1995, ch. 2, 14-49. 7. Critical review of the literature on the effects of relative prices on aggregate profit. Smith establishes the principle that prices are proportional to total labor times in the rude and early state, and notes that this pricing rule is not altered if money value added is shared out proportionately as wages, profits, and rents. He does not dwell on the impact of relative prices which deviate from this rule, although this concern may have been behind his subsequent reversion to an adding up theory of price formation, i.e., to the notion that prices are the sum of three primary components called wages, profits, and rents. Dobb 1973, 46-47. Ricardo also begins from the argument that prices remain proportional to labor times even when value added is shared out between the three classes. This allows him to make the crucial point that it is not the existence of capital or even of equalized profit rates which causes prices to deviate from this rule, but rather the existence of unequal capital-labor ratios. The focus is thereby narrowed to the impact of such inequalities on relative prices. As is well known, Ricardo argues that this impact will be small. Ricardo 1951b, 36. Such issues will be addressed in considerable theoretical and empirical detail in Chapter 9, where among other things we will see that Ricardo turns out to be right on this score. Marx shifts the focus from the profit rate and the effects of its equalization on relative prices to the determination of aggregate profit itself, in which surplus labor time plays the critical role. He also begins by first establishing that prices will be proportional to labor values when all money value added takes the form of labor income, selling prices are equalized by competition, and incomes per unit labor are equalized by the mobility of labor. In his case, this is an analytical first step which he calls simple commodity production, not a reference to some idealized past. Dobb 1973, 147 and 142 and 149 and 141. It allows him to introduce money, prices, competition, and the mobility of labor, and subsequently the existence of surplus labor, aggregate profit, unemployment in Volume 1 of Capital, turnover time, effective demand, and growth in Volume 2, and then equal profit rates and their impact on relative prices in Volume 3. The trouble here, as we know, is that Marx only lived to complete Volume 1, the other two being assembled by Engels from a mass of notes, partially finished and unfinished manuscripts. So while we have some idea of Marx's work on prices of production, we only have sketchy hints about how he would have proceeded beyond the material assembled by Engels. When prices are proportional to labor values, direct prices, and wage rates are equal, profit is proportional to the amount of labor in each sector. But since the rate of profit is the ratio of profit to capital advanced, this means that sectors with higher capital, labor ratios will have lower profit rates and sectors with lower capital, labor ratios will have higher profit rates, relative to the corresponding social averages. The first step in the formation of the equal profit rates would require the price of the first type of sector to fall below its direct price and that of the second type to rise above its direct price. As a consequence, the normal profit corresponding to equalized profit rates in the first type sector would be above the surplus value, direct profit, produced in the sector, while that the normal profit of the second type would be below its own surplus value. This implies that in general a sector's profit is the sum of surplus value produced in the sector and the value transferred into or out of it. Marx notes that the one exception would be the sector with the average capital-labor ratio, whose price of production would be under no obligation to change since its profit rate is the average rate of profit. Marx 1967 c. ch. 9, 154-159. Ch. 10, 173-175. We will return to the theoretical and empirical significance of the average sector in chapters 7 and 8. Marx's procedure up to this point involves changing the selling prices of commodities as outputs without changing the prices of these same commodities as inputs or as wage goods. He calls the latter cost prices and speaks of his procedure as the first transformation of surplus value into profit. Marx 1967 c. ch. 9, 169. He notes that this procedure is incomplete, because a fuller treatment would require that cost prices be similarly adjusted. 15 Then come these fateful words: our present analysis does not necessitate a closer examination of this point. Marx and Engels 1975, ch. 9, 165. Unfortunately, there is no subsequent examination of this point in the material that Engels selected for publication in Volume 3 of Capital. But we do know Marx saw the next task as having to analyze the changed outward form of the law of value and surplus value which were previously set forth and which are still valid after the transformation of value into price of production. Marx and Engels 1975, Letter to Engels, April 30, 1868. Marx keeps the total money value of gross output, the sum of prices, constant in order to focus on the effects of the redistribution of profits, and since costs are unchanged, the latter step does not change the sum of profits either. But once costs also reflect the new set of relative prices, as in the analytical move from direct prices in Table 6.9 to prices of production in Table 6.10, the sum of profits will also change. This phenomenon is the point of departure for the huge literature on the Marxian transformation problem. I have argued in this chapter that the problem is generic because it obtains in every school of thought which deals explicitly with the question of aggregate profit. The real issue is that there are two sources of aggregate profit, profit on production and profit on transfer, and it is their combination which accounts for this particular phenomenon, and for others which are almost never broached. This was Stoyart's crucial insight, which Marx explicitly incorporates into his plans to distinguish profit on surplus value from profit on alienation. This duality disappears from the literature, leaving behind what seems to be an intractable puzzle: the money value of aggregate profit, or indeed of aggregate net output, can vary with relative prices. With regard to Marx's own transformation problem, three sorts of reactions can be identified: completion, rejection, and revision. The completion school begins with Bortkiewicz, who was the first to weigh in on the transformation problem. It was he who first showed that one could treat the problem as a simultaneous solution for prices of production applied to both costs and outputs. But then if one holds the latter constant to keep the price level constant, the new sum of profits differs from the sum of direct profits. Bortkiewicz himself did not think that this contradicted the classical notion of aggregate profit as a subtraction from the product of labor. Sweezy 1942, ch. 7, 109-125, quote on 124. Morris Hima and Shaikh showed that Marx's first step could be taken to be just that, a first step in an iterative process which would converge to the full Bortkiewicz solution. Both also showed that the uniform rate of profit derived in the full transformation could be shown to be a function of the rate of surplus value, i.e., of the relative rate of surplus labor time. Morris Hima 1973, Shaikh 1973, 146-147, 1984b, 59-62. And, of course, Sraffa's analysis is founded on the notion that normal profit requires the existence of a surplus product. Sraffa 1960, chs 1-2, 3-11. Finally, Shaikh, 1984b, 52-56, develops the idea of transfers of value as the source, the variability of aggregate profits in the face of changes in relative prices, which becomes the foundation for section 4 of this chapter. The rejection school takes two forms. Coming from the right, Samuelson famously labels Marx a minor post-Ricardian, Samuelson 1957, 911. There is more than a bit of irony in this, given that Samuelson's subsequent effort to justify the neoclassical aggregate production function turned out to require a labor theory of value so simple that it would have been rejected out of hand by Ricardo, let alone Marx. Garagnani 1970. When this was pointed out, Samuelson abandoned his construct and retreated back into the thickets of general equilibrium. One can well imagine Marx's trenchant comments on the whole episode. Sraffa's work originally lent itself to an internal critique of neoclassical theory. Internality meant adopting the neoclassical notion of perfect competition, production without labor time, optimality criteria, effortless and costless switches among technologies, and continuous equilibrium. Shaikh 1973, 83-84. From this point of view, the distinguishing element of Sraffa's theory of price was the algebraic possibility that complex variations in relative prices of production served to undermine the inverse relation between the capital-labor ratio and the rate of profit. This relation was central to the notion of an aggregate production function because it seemed to support the notion of the rate of profit as a scarcity price, one which declined as capital becomes relatively more abundant. While this failed to impress the neoclassicals, it did occupy a great deal of the time of Sraffians, despite the mounting empirical evidence that the requisite price patterns were quite exceptional. Coming from the left, Steedman uses the Sraffian framework to reject Marx's theory of value. Steedman 1977, 48-49. Since I have discussed such matters in detail elsewhere, Shaikh 1981, 1982, 1984b, and will address the Sraffian theory of relative price in Chapter 7, I will focus here on the topic at hand, the effect of relative prices on aggregate profit. In this regard, Steedman emphasizes that the full transformation does not undermine the idea that exploitation is the source of profit, but rather shows that profit will be positive if and only if there is surplus value, i.e. capitalist exploitation, and makes clear that the determinants of the profit rate are precisely the determinants of the rate of surplus value, namely, the daily wage, the length of the working day and the conditions of production of wage commodities. On the question of how and why aggregate profit can change as relative prices change, he says only that equilibrium solutions are only the first step and that a theory of disequilibrium profits and prices needs to be developed. Steedman 1977, 33-35. So while Steedman excoriates obscurantist defenders of Marx for failing to adequately address the difference between surplus value and fully transformed profit, he himself sidesteps exactly the same issue when it arises in regard to differences between Sraffian profit and market or monopoly profit. The third type of reaction to the transformation problem is to revise Marx's theory of value so as to ensure the exact equality of aggregate profit and surplus value. Since aggregate profit is defined, this approach requires the redefinition of surplus value to make it equal to some existing profit. The literature on such attempts is very large and remarkably varied. Here I will focus on the so-called new interpretation, NI, of Dumenil and Foley because it has been designated by some as the most striking development in Marxist value theory during the past 2 decades, Fine, Lipovitz's, and Sodfio 2004, 3. In Marx, surplus labor time, that is, surplus value, S, is the excess of the total working day, L, over necessary labor time, the value of labor power V, the latter defined as the labor value of the bundle of goods in the socially and historically achieved standard of living of workers, all in units of labor hours. Aggregate profit, P, on the other hand, is the excess of the money value of the net product, Y, over the wage bill, all in money units. The first step in comparing them is to bring them into common units. If mu is some yet undefined variable in units of money per labor hour, then we can use it to translate money values into labor hours. Then we have two accounting identities, both in labor hours. Marx defines as the ratio of the sum of prices to the sum of labor values, that is, as the money value of the total product, gross output in the input-output sense, to the corresponding labor value. If this is used to deflate the money value of the total product to get total labor commanded in exchange, then the latter is equal to the total labor value created in production if the whole product is sold. This follows from the notion that successful circulation of the product merely transfers value. But then the labor represented by aggregate profit, i.e., money profit converted into labor units, is generally not equal to aggregate surplus value, which is the central issue in the transformation problem. The first step taken by the NI is to shift the focus from the whole product to the net product by redefining the money equivalent of labor time, MELT, to be the ratio of the money value of the net product to total living labor time, which is labor value added, and use this to rewrite the national accounting identity in equation 6.4. This gives us two different expressions for aggregate labor time, L as the sum of necessary and surplus labor time in equation 6.3, and as the sum of the net labor time represented in exchange by the money wage bill and actual profit in equation 6.6. Combining the two would give us a single accounting relation between two pairs of variables. Note that on Marx's definition of V as the labor value of workers' consumption, so that the redefinition of monetary equivalent of labor time makes the two sides equal, but does not make the individual components on one side equal to their counterparts on the other. But if one also redefines the value of labor power as the net labor time represented by the money wage bill, then one simultaneously redefines surplus labor time, surplus value, as the labor represented by actual profit, Shaikh and Tonak 1994, 178-179.16. Where and. This is a purely accounting solution to the transformation problem, which simply changes a standard national accounting identity into different units and then proceeds to relabel the components. The so-called value categories V, S are now merely reflexes of the corresponding money values. In Marx, surplus value is the foundation for profit. In the new interpretation, surplus value is merely a form of profit, Shaikh and Tonak 1994, 179. The identity holds for any theory of aggregate profit, and indeed for any levels of aggregate profit including the negative ones experienced in the Great Depression, which would then have to be read as an instance of negative surplus value. The universal question of the relation between profits associated with any set of fundamental prices, labor values or prices of production, and any other set such as market or monopoly prices is solved by abolishing the former. Point 17 for instance, in the comparison between competitive prices and monopoly prices, tables 6.17 and 6.18, respectively, one could define as the ratio of the two corresponding total money values, use it to rescale the second, and then redefine the second wage bill to be the market value of normal wages, thereby redefining normal profit as equal to monopoly profit. The preceding discussion has to do with theoretical debates about the effects of relative prices on aggregate profits. It may be useful in this regard to note that the empirical impact is actually very small. Ochoa 1984, 215, Shaikh 1984b, 57. Indeed, in his unpublished notes Sraffa himself says this: the propositions of Marx are based on the assumption that the composition of any large aggregate of commodities, wages, profits, constant capital, consists of a random selection, so that the ratio between their aggregates, rate of surplus value, rate of profit, is approximately the same whether measured at values or at the prices of production corresponding to any rate of surplus value. This is obviously true. 18, Bellofiore 2001, 369. I will return to this issue in Chapter 9 of this book. In the meantime, Appendix 6.1 provides formal derivations of the propositions illustrated here. Appendix 6.2 demonstrates that when the profit rate is calculated in terms of current prices, as in Table 6.7 in the present chapter, it is a real, i.e., inflation-adjusted, rate. Appendix 6.3 distinguishes between the business treatment of capital as gross stock and the neoclassical treatment of capital as net stock, and Appendix 6.4 shows that the treatment of fixed capital as a joint product has two distinct forms, one adopted by Marx and one adopted by Sraffa. It is shown that the two concepts of capital turn out to have different theoretical and empirical implications. 8. Measurement of profit and capital. The empirical measurement of profit and capital is every bit as complicated as the corresponding theory, but for different reasons. The discussion in this chapter established that general economic profit is the difference between the money value of the total product and the current cost of materials, depreciation, and labor, section 3.3. As established in Appendix 4.1 of Chapter 4, this quantity is known in national accounts as net operating surplus, NOS. A corollary of this accounting is that the corresponding measure of capital stock is the current cost of capital, not its historical cost. The economic rate of profit is then the ratio of current economic profit to the current cost of capital advanced. Calculated in this manner, it is also a real rate of profit because calculating numerator and denominator in terms of current prices automatically adjusts for inflation. This property is preserved if we deflate both numerator and denominator by the same price index. For example, if we deflated the current cost of capital by the capital goods price index to derive real capital stock, then we must deflate current profit by the same price index to achieve real profit expressed in terms of its purchasing power over capital goods. Appendix 6.2. The construction of plant and equipment capital stock, inventories will be addressed shortly, presents new challenges arising from the difficulties and pitfalls of the perpetual inventory method, PIM, through which investment flows in equipment and structures are cumulated into capital stocks. 19, Appendices 6.5. 2. We need to consider the meaning and impact of quality adjustments on price and quantity indexes and the important implications for the measurement of technical change. It is important to realize that ever since the quality adjustments were applied to capital stock measures, the quality-adjusted real output/real capital ratio has ceased to be an index of the trend technological change. This is because the official purpose of quality adjustments is to make the quantity of real capital proportion to real profit, the latter being is the essential quality of capital. In practice, real value added tends to takes the place of real profit, so that quality adjustment tends to make the real output/real capital ratio stationary. And since all methodological revisions are, of course, taken back as far as data permits, accounts published since the mid-1980s display very different trends from those published after then. Appendix 6.5.3, v. To interpret this change as representing a new stage of capitalism would be a gross error. This in turn brings us to the apparently intractable aggregation problems arising from use of chain-weighted indexes. Official capital stock measures are typically calculated at very detailed levels and then aggregated into subcategories. Earlier methodology used fixed-weight indexes, in which case aggregates follow the same PIM rules as individual measures. Then one could generate alternate aggregate measures by changing one of the underlying assumptions. Since modern methodology is based on chain-indexed measures whose resulting aggregates no longer obey PIM rules, it seems impossible to create alternate measures. For example, a crucial assumption in official methodology is that the rate of scrapping of a given type of capital good is impervious to economic events such as business cycles, oil shocks, and even Great Depressions, including, of course, the current Great Recession. Yet it is well known that booms and recessions do affect the scrapping of plant and equipment, and it is even possible to estimate the impact of such events on the average useful life of the aggregate capital stock. But since all modern capital stock measures rely on chain-weighted indexes, it does not seem possible to incorporate such information into the calculation new aggregate measures. The Gordian knot can be cut by asking a different question: even if aggregate chain-weighted index measures do not follow the PIM rule, is there some other rule that they do follow? I show that one can indeed derive a new set of generalized PIM rules that chain-weighted aggregate capital stocks do follow, which can then be utilized to provide corrected measures of the capital stock and hence of the rate of profit. Appendix 6.5.v. Capacity utilization poses yet another set of theoretical challenges because we know that actual capacity utilization will generally fluctuate around some normal level. I show that it is possible to generate new measures of capacity, and hence of capacity utilization, by treating real capacity as that component of real output which is generated by movements of the real capital stock and by technical change over the long run. Put this way, capacity is co-integrated with the capital stock subject to a time trend representing the path of the capacity, capital ratio. Appendix 6.6. Of particular importance is the fact that output and capital must be measured in the same units, so that real output and real capital must be derived by deflating the corresponding current price measures by some common price index. The capital stock price index is the appropriate deflator in the classical case because then real output represents purchasing power over capital goods and the ratio of real output so defined to real capital stock represents the maximum rate of profit. Appendix 6.2.2. The derived estimate of capacity allows us to construct a measure of capacity utilization, the ratio of real output to real capacity. The rate of profit can then be decomposed into two components: a structural one which represents the normal rate of profit obtaining at normal capacity utilization, and a cyclical one arising from fluctuations of actual output around capacity output, i.e., of actual utilization around a normal level. It is the normal profit rate which is the focus of theories of the long-run tendency of the rate of profit to fall in Smith, Ricardo, Mill, Marx, Walras, Jevons, Clark, Keynes, and Schumpeter among others. Dobb 1973, 52, 72, 89, 100, and 57 to 158, Solfidis 2010, 37 to 40, 100, and 18 to 120, 191, 252 to 256. The cyclical component, on the other hand, is a central concern in business cycle theories. By adjusting for fluctuations due to capacity utilization, we are able to assess the effect of technical change on the ratio of capacity to output, the current cost normal maximum rate of profit. For instance, Harrod-neutral technical change implies a stationary capacity, capital ratio, while capital-biased technical change implies a falling one. Michael 2002, 278. The latter is strongly evident in the post-war U.S. data. The theoretical determinants of technical change are addressed in Chapter 7, Section 7. Empirical measures of profit and capital come next, Appendix 6.7. The first step toward measuring profit is to distinguish within national income and product accounts, NIPA, between the domestic for-profit business sector and government, non-profit businesses, and a fictitious sector called owner-occupied housing, O, in which homeowners are treated as businesses renting their homes to themselves, Appendix 6.7.I.1. We then need to correct for the fact that in NIPA all of the income of unincorporated enterprises is treated as part of its operating surplus, rather than being split between the wage equivalent of proprietors and partners and their effective profit, Appendix 6.7.I.2. Once corrected for this oversight, corporate and non-corporate profit rates turn out to be very similar, Figure 6.1. This means we can use the corporate profit rate, which is simpler to calculate, since it does not require a wage equivalent as a proxy for the general rate of profit. Figure 6.1 Corporate and non-corporate profit rates. The final step on the profit side is to correct for the presence of fictitious imputed interest charges into national accounts. This is no simple task because the structure of these imputations is complex. In classical accounts, and indeed in some national accounts, net interest payments to banks are treated as transfers from net income of households and businesses. But NIPA insists on treating banks as producers of banking services, so it ends up adding various imputed interest quantities into the accounts of households, non-financial businesses, and banks. The imputations are constructed so as to leave NIPA measures of profit, which are net of actual net interest paid, unchanged, but they do affect the measures of value added and operating surplus. Removing the imputed quantities returns net operating surplus to being the sum of actual net monetary interest paid and NIPA profit, just as in classical and business accounts. This has a minimal impact on business and corporate measures of value added, raising them by about 1%, 2% in 2009, but a more substantial one on corresponding measures of operating surplus, raising them by about 10% in 2009. Taken by itself, the imputed interest correction raises the measured share of net operating surplus, NOS, in value added without substantially affecting the output, capital ratio. This is the only effect for the corporate sector, but in the non-corporate sector the previously discussed wage equivalent adjustment shifts the estimated wage equivalent of proprietors and partners into the wage bill and lowers the measured surplus by much more, so that the combined effect of both corrections is to lower total business operating surplus by about 30% in 2009. Once again, the corporate sector is a particularly useful focus because the only needed adjustment for imputed interest is easily made, Appendix 6.7.4 and Appendix Table June 7, 11. On the capital side, we need to measure the total stock, i.e., the plant, equipment, and inventories. In national accounts, data on these elements is only available for domestic businesses, i.e., those operating within the country whether domestic or foreign-owned. This is why the corresponding VA, NOS, and profit measures in the preceding sections focused on domestic businesses. Since any new estimates of chain-indexed capital stock must be done through the previously developed Generalized Perpetual Inventory, GPIM, rule, the first step is to demonstrate that this approximation technique is 99.5% accurate in generating proxies for existing capital stock aggregates, Appendix 6.7.v.1. With the GPIM in hand, we can assess the effects of different, 1925, initial starting points and different depreciation and retirement rules on alternate capital stock measures, Appendix 6.7.v.2, 3. The GPIM rule also allows us to adjust the corporate capital stock for the effects of the Great Depression on retirement rates, the effect being estimated through IRS data on corporate balance sheets. Correcting for this effect alone leads to current cost fixed capital starting out 28% lower than the official BEA measure in 1947 but ends up on more or less the same path by 1977, Appendix 6.7.v.4 and Appendix Table 6.8.2.4. Combining the Great Depression effect with previously derived measures of retirement and depreciation then yields final estimates of gross and net capital stocks of fixed capital, plant and equipment. In comparison to official BEA net fixed capital stock, KN Corp BEA, the new net stock measure, KN Corp, starts out lower in 1947 but then narrows the gap because it grows faster. The new gross stock measure, KG Corp, starts out higher than the official BEA net stock but also grows more rapidly than the official measure, Appendix 6.7.v.5. The remaining step on the capital stock side is to estimate corporate inventories. NEPA has industry data on private industries, NEPA Table 5.8.5, but it is not by legal form. The Federal Reserve Board, FRB, Flow of Funds has current cost data on corporate inventories and capital stock but only for non-financial corporations. Point 20. However, the IRS publishes corporate balance sheets beginning in 1926 and these contain data on inventories, and from 1990 to 2011 it has data on net historical capital stock. Since the IRS data is based on samples, we cannot apply it directly to the NEPA corporate sector. We must therefore proceed in two steps. First, estimate the ratio of inventories to historical cost fixed capital for the whole period from 1947 to 2011. Second, scale the implicit inventory levels to those of the corrected capital stocks in Appendix 6.7.v.5 by multiplying the preceding inventory by the ratio of adjusted historical to current cost fixed capital stock. Since IRS inventories are a mixture of historical cost, FIFO, and current costs, LIFO, valuations, adding them to current cost fixed capital, which is the goal, involves some degree of valuation error. However, since inventory turnover is quite rapid relative to that of fixed capital, in comparison to the latter even the oldest FIFO elements of inventories are valued at fairly recent prices so the aggregate inventory stock can be treated as being fairly current, Appendix 6.7.v.6. The end result of these peregrinations is an expanded measure of profit, net operating surplus, i.e., NEPA profit plus actual net monetary interest and transfers, and an expanded measure of capital, fixed capital plus inventories. The net expanded measure of profit is independent of the manner in which the total is shared out between businesses and their creditors, and corresponds to the business accounting measure called operating income or earnings before interest and taxes, EBIT, Brigham and Houston 1998, 76, Mead, Moulton and Petrick 2004, 3-4. It is the appropriate profit measure for both classical and Keynesian approaches because their investment theories rest on the difference between the rate of profit and the rate of interest, chapters 13 and 16, which requires that the former be defined prior to actual interest payments. By contrast, NEPA profits are net of actual interest payments and transfers. Then firms with higher net interest payments will appear less profitable and their profitability will appear to be declining if the interest charge component gets relatively larger as was the case beginning in the 1970s, Figure 6.2. NEPA profits are similar in spirit to business net earnings, although the two can differ substantially in the short run because the former reflects national economic accounting concepts while the latter reflects financial accounting ones, Hodge 2011. Equations, 6.8, 6.10, lay out the basic accounting relations involved in the corrected corporate measures. Let VA equals value added, NOS equals net operating surplus, P equals NEPA profit, NMINT equals net monetary interest paid, EC equals employee compensation, KGC equals gross current fixed capital, plant and equipment stock, INV equals inventories, KTC equals KGC plus INV equals total capital stock, R equals the maximum rate of profit, sigma P equals the expanded profit, NOS, share in value added, and R equals the average rate of profit. Then it is clear that the share of NOS in value added is the dual of the corresponding share of employee compensation, equation 6.9, while the share of NEPA profit also depends on the bite taken by net interest payments. Figure 6.2 displays new corporate profitability measures with value added and profit adjusted for imputed interest and with inventories included in the capital stock, along with the corresponding NEPA measures. At the top of the chart, we see that the corrected maximum profit rate, value added over total capital stock, falls more, and more steadily, than the NEPA one. Since the correction for imputed interest has only a small effect on value added, less than 2%, and since the ratio of inventories to the capital stock is fairly stable, this difference is primarily due to the new measures of gross fixed capital, Appendix 6.8.2.5. In the middle of the chart, we see that the corrected corporate profit, NOS, share is higher than its NEPA counterpart because the imputed interest adjustment has greater impact on net operating surplus, raising it by about 10%, than it does on value added. We also find that the corrected measure is far more stable, falling modestly in the golden era for labor until the early 1980s, and then rising modestly thereafter due to the onset of neoliberal policies. On the other hand, because NEPA profit is after net interest, the fall in the NEPA profit share by half from the mid-1960s to the early 1980s is largely due to the greater share of NOS absorbed by net interest as interest rates rise dramatically from 3% to 14%, while the post-1980s rise in the NEPA profit share is due to a fall in the net interest share portion of NOS because rising debt burdens in that period are more than offset by the dramatic fall in the interest rate from 14% to near zero. Chapter 16, Figure 16.6. We will see in Chapter 16 that the wage share also falls in the latter period, which raises the NOS share, sigma p equals Profschkorp, somewhat and further contributes to raising the NEPA profit share, Profschkor NEPA. Finally, both the corrected and NEPA profit rates fall substantially from 1974 to 1982. The corrected rate stabilizes thereafter because a decline in the wage share raises the NOS share, 6.9, while the NEPA rate rises a bit because of the previously discussed effects of falling interest rates on conventional profit share. The differences between corrected and conventional measures hinge on three factors: 1. The derivation of a new measure of gross fixed capital, KGC, 2. The inclusion of monetary net interest paid, NMINT, in overall profit, and 3. The inclusion of inventories, INV, in total capital. Let the NEPA profit rate. Then the corrected rate of profit, R, is related to the NEPA rate by three variables representing net monetary interest, inventory, and capital stock ratios, respectively. Actual profitability measures displayed in Figure 6.2 are a compound of short-run fluctuations and longer-run structural patterns obtaining at normal capacity utilization. Accordingly, Figure 6.4 displays the new capacity utilization measure alongside the Federal Reserve Board, FB, measure, the latter being only available from 1967, Appendices 6.7.vi and 6.8.2.7. The intuitive idea behind the new measures is that economic capacity may be treated as that aspect of output which is co-integrated with the capital stock over the long run, subject to an unknown time trend in the capital capacity ratio whose size and direction is estimated from the data. The new measure shows not only short-run fluctuations but also two distinct 25-year-long fluctuations. The profit rate can be decomposed into structural and cyclical factors. Let Yn represent normal capacity net output, the rate of capacity utilization whose normal level is 1, the capacity, capital ratio, which is the structural maximum rate of profit in the sense of SRAFA, and equals the normal profit share, i.e., its structural component. With this in mind, we can write the actual profit rate and normal profit rates as follows. Figure 6.5 displays the corrected maximum and average rates adjusted via the new capacity utilization measure, along with the corresponding NEPA/BEA measures adjusted via the FRB capacity utilization rate. The normal maximum profit rate falls steadily, strongly supporting the notion that technical change steadily reduces the output, capital ratio. In neoclassical terms, it reduces the average productivity of capital. In Marxian terms, it raises the monetary equivalent of the ratio of constant capital to living labor, Shaikh 1987a, and in Srafian terms, it reduces the maximum rate of profit, Srafa 1960, 16-17. The normal profit share, which is the smoothed version of the corrected profit share displayed previously in figure 6.2, falls modestly in the so-called golden age for labor, and then entirely makes up for lost ground in the succeeding neoliberal era. The normal average rate of profit, which is the product of the two foregoing measures, falls a bit faster than the normal maximum rate until the mid-1980s, after which it eventually flattens out as the wage share is substantially lowered in the face of successful attacks on labor and associated institutions, Chapter 14, Section 2, Chapter 16, Sections 2.2 #X 2013, 3. One might say that this was the whole point of those actions, as we will see in Chapters 14 and 16. Conventional NEPA measures behave quite differently, because the FRB capacity utilization rate is only available from 1967 onward. We can only say that the maximum normal falls from 1967 to 1982 and then stabilizes. The normal NEPA profit share falls sharply from the mid-1960s to the early 1980s due to a combination of a rising wage share and a greater proportion of net operating surplus absorbed by net interest payments. The capacity-adjusted NEPA profit rate therefore falls from 1967 to 1982 rapidly from the combined effects of falling maximum rate and a falling conventional profit rate, only to recover sharply in the subsequent era. Table 6.22 summarizes these patterns for 1947 to 82 and the subsequent neoliberal era of 1982 to 2011. The reader is reminded that the conventional measures are constructs based on neoclassical concepts of capital stock and imputed interest, Appendix 6.7. They are not what businesses experience. On the contrary, the corrected measures correspond more closely to business ones. The ultimate differences between the new profit rate measures and conventional ones can be partitioned into the influences of two sets of variables: new capital stock and capacity utilization measures that affect the trend and smoothness of the profit rates, and imputed interest and inventory adjustments whose ratio affects the fluctuations but not so much the trend, figure 6.3. The first set can always be constructed even at the industry level whenever we have information on capital stock and output, which is generally the case for industry data, OECD aggregate, and sectoral data. The second set is often unavailable in international comparisons, such as the OECD intersectoral database, and in sectoral account by industry, such as the BEA GDP by industry 21. Figure 6.6 shows that the first set of variables are the important ones. Recorpen and Recorpen represent measures corrected for both sets of variables, while Recorpen and Recorpen represent those corrected only for the first set. The corrected and proxy measures are fairly similar, which indicates that the capital stock and capacity utilization corrections are the crucial ones for long-run analysis. Some general lessons can be drawn. For the analysis of national trends in profit rates, we should work with at least corrected capital stock and capacity utilization measures, Chapter 16. For inter-industrial comparisons, these may not be so important insofar as all industries share common national trends, Chapters 7 and 9. That leaves one last question: how do these factors affect the rate on new capital investment, rather than on average capital? Since the equalization of profit rates between industries is affected by the inter-industrial mobility of capital, what matters is not the profit rate on average capital, which encompasses both obsolete and cutting-edge capitals, but rather the rate of return on new capitals. I will argue in Chapter 7, Section 6.5, that the rate of profit on new capital can be well approximated by the incremental rate of return on investment, defined as the ratio of the change in gross net operating surplus to current gross investment in fixed capital and inventories. 22 The numerator can be calculated by adding the change in current cost depreciation to the change in the previously calculated imputations adjusted net operating surplus, and the denominator can be calculated by adding the estimated inventory changes to BEA data on fixed capital gross investment. But then a further issue arises. As previously noted, if the average profit rate is calculated in current terms, i.e., as current cost profits adjusted to account for the effect of current prices on depreciation and inventories divided by the current cost capital stock, then it is a real rate that already reflects current prices, Table 6.7 and Appendix 6.2. Similarly, if we could directly measure the current profit on new capitals and their current capital value, then their ratio, which is the rate of profit on new capitals, would also be a real rate. But the incremental rate of profit used as proxy is different because a change in the current price level would affect the nominal change in gross profit in the numerator and the current cost equivalent of gross investment in the denominator. Hence, to make the incremental rate of profit comparable to the average profit rate and the unobserved profit rate on new capital, we must express its element in current terms. For this reason, I will refer to it as the current incremental rate of profit, with the understanding that it is numerically equivalent to a conventional real rate. Converting all variables to current year prices gives the same numerical result as converting them to base year prices, because the corresponding elements in two calculations differ only by a constant which cancels out in their ratio. Chapter 7, Section 6.5. The calculation of the incremental rate of profit so as to make it current is different from the neoclassical correction of the interest rate to make it real. We will see in Chapter 10 the equalization of profit rates between real and financial sectors implies that at any given profit rate, which itself varies over time, the monetary rate of interest will be proportional to the price level. The actual correspondence between the monetary interest rate and the price level has been so well documented, Chapter 10, Figure 10.6, that Keynes, 1976, 2:198, was moved to call it one of the most completely established empirical facts in economics. By contrast, neoclassical economics hypothesizes that the interest rate is tied to the expected rate of change of prices, expected inflation rate, for any given rate of profit. Under rational expectations, the expected and actual inflation rates are stochastically the same, and under the efficient market hypothesis the expected profit rate is constant through time, so we end up with the textbook hypothesis that the interest rate, I, mirrors the actual rate of inflation, pi, that is, the real rate of interest, I pi, is constant, Schiller 2001, 260 and 224. The classical and neoclassical hypotheses are at odds. Figure 6.7 makes two sets of comparison. The first panel compares the nominal corporate incremental rate of profit, IROPCorp, calculated using the ratio of the change in nominal corrected goes to the sum of nominal gross investment in fixed capital and the change in nominal inventories, with the equivalent NEPA measure, IROPCor NEPA, calculated as the ratio of change in nominal gross NEPA profit, change in the real sum of net profit and current cost depreciation, to nominal gross investment in fixed capital. This is a test of the effects of the corrections to the numerator and denominator, and it is of great interest to discover that the two measures are virtually the same. The corrected incremental rate of profit has essentially the same mean and somewhat lower standard deviation than the simpler NEPA measure. The second chart compares the corrected current, real, corporate incremental rate of profit, IROPCorp, calculated in the same manner as the nominal rate except with real variables, with the NEPA rate, IROPCor NEPA, also using real variables, Appendix 6.8.2.7. Here the corrected measure has a slightly higher mean but slightly lower standard deviation, Table 6.23. These findings are quite important because the NEPA measures are easily estimated across countries and through time. We will subsequently see that NEPA nominal and current incremental rates of U.S. corporations turn out to be very similar to the corresponding rates of return on U.S. corporate equities, a direct confirmation of classical expectations about intersectoral profit rate equalization and a validation of the importance accorded to corporate earnings by non-academic stock market analysts. Chapter 10. Part 2. Real competition. 7. The theory of real competition. Introduction. Capital is a particular social form of wealth driven by the profit motive. With this incentive comes a corresponding drive for expansion, for the conversion of capital into more capital, of profit into more profit. Each individual capital operates under this imperative, colliding with others trying to do the same, sometimes succeeding, sometimes just surviving, and sometimes failing altogether. This is real competition, antagonistic by nature and turbulent in operation. It is as different from so-called perfect competition as war is from ballet. The mobility of capital is inherent in its existence. Capital tied up in labor, plant, equipment, and inventories is fixated and must be used up or sold off before it can adopt a new incarnation. But fresh money capital, borrowed or garnered as profit, always looks over the available list of avatars before making its choice. The profit motive rules in all cases. Real competition is the central regulating mechanism of capitalism. Competition within an industry forces individual producers to set prices with an eye on the market, just as it forces them continually try to cut costs so that they can cut prices and expand market share. Cost cutting can take place through wage reduction, increases in the length or intensity of the working day, and through technical change. The latter becomes the central means over the long run. In this context, individual capitals make their decisions based on judgments in the face of an intrinsically indeterminate future, one that remains to be constructed. Competition pits seller against seller, seller against buyer, and buyer against buyer. It pits capital against capital, capital against labor, and labor against labor. It operates not only on prices and profits but also on wages and rents. Profit is the excess of price over operating costs, and no capital is assured of any profit at all, let alone the normal rate of profit. Indeed, all capitals face losses at some point, and a certain number drown in red ink in every given interval. It is therefore completely illegitimate to count normal profit as part of operating costs. It is equally improper to count interest as part of operating cost. The division between debt and equity determines the division of net operating surplus into interest and profit. The interest rate can also serve as a lower benchmark for the profit rate, as an indication of the difference between rewards to active and passive investment of funds. In either case, interest serves as a means of assessing the adequacy of profit, not of determining it unless, of course, the burden of interest becomes sufficiently onerous as to snuff out the flame of accumulation altogether. We will return to the subject of interest rates in Chapter 10 and to the significance of profit net of interest in Chapter 16. Real competition generates its own characteristic patterns. Prices set by different sellers are roughly equalized as each tries to gain an advantage over the other. Profit rates on new investments are also roughly equalized over somewhat longer periods. Both of these processes result in perpetual fluctuations around various moving centers of gravity. This is the classical notion of turbulent equilibration, very different from the conventional notion of equilibrium as a state of rest. Mueller 1986, 8, 1990, 1-3, Shaikh 1998b. Supply and demand are part of the story, but their roles are not decisive since both can change in response to profit opportunities. Sraffa 1926, 538-539. The notion of competition as a form of warfare has important implications. Tactics, strategy, and resulting prospects for growth are central concerns of the competitive firm. In turn, the relevant profit must be that which is defensible in the medium term, which is quite different from the notion of short-term maximum profit emphasized in neoclassical theory. In the battle of real competition, the mobility of capital is the movement from one terrain to another, the development and adoption of technology is the arms race, and the struggle for profit growth and market share is the battle itself. Shaikh 1979, 2. It is important to understand that price equalization due to competition between sellers, as well as profit rate equalization due to competition between investors, always give rise to unintended outcomes. Prices tend to equalize because buyers gravitate toward the lowest price, which forces other sellers to adjust their own prices. Similarly, profit rates tend to equalize because investors flock to higher rates of return. This accelerates supply relative to demand in the favored industries and drives down their prices and profits. The rush toward riches close the gaps that initially motivated the agents while opening up new gaps which feed new arbitrage movements. The turbulent equalizations of prices and profit rates are quintessential emergent properties. In what follows, Section 2 analyzes price equalization, Section 3 profit equalization, and Section 4 introduces the notion of regulating capital that unites the two moments of competition. Section V provides a detailed listing of the characteristic patterns associated with real competition. Section 6 starts with the evidence on the corresponding behavior of the firm, with particular emphasis on the findings of the Oxford Economic Research Group and the interpretations by Hall, Hitch, Andrews, Brunner, and Harrod. Section 6.2 investigates the relation between operating cost and plant size, as elaborated in Salter's classic study and in more recent work by others. Section 6.4 takes up the corresponding relations between profitability and plant size. This evidence is consistent with the theory of real competition, but quite unsupportive of the theory of perfect competition. Section 6.5 takes up the evidence on the profit rates of regulating capitals. New investment generally targets the best practice, i.e., the regulating conditions of production, and the incremental rate of profit is shown to be a good approximation to the rate of return on new investment. The incremental rates of return of various industries in the United States and in OECD countries exhibit substantial crisscrossing, as expected by the theory of real competition. Section 7 then takes up the all-important question of exactly how the regulating capital itself is itself selected in the competitive battle. First, actual decisions are in terms of market prices, not prices of production. While the former do gravitate around the latter, this does not imply that the two are close, so we cannot substitute the latter for the former. Second, in keeping with the price-setting and cost-cutting behavior of real competition, firms are forced to select the lowest cost conditions of production as determined by reproducible conditions involving technology, the length and intensity of the working day, and real wages costs being defined here in the usual business sense as the sum of unit depreciation, materials, and wage costs. It is shown that once we allow for fixed capital, the lowest unit cost technique may be different from the highest profit rate one, Shaikh 1978, 1980d. Moreover, given the fact that firms face fluctuating market prices and uncertain futures, all choices must be robust in the sense that they remain valid in the face of normal fluctuations in costs, prices, and profitability. Hence, the appropriate methodology for the choice of techniques is stochastic, not deterministic, Dumenil and Levy 1995a, 1999, Foley 1999, Park 2001. In this framework, when technological change is principally characterized by lower unit operating costs achieved through higher unit capital cost, capital-biased technical change, then the overall effect on the rate of profit depends on the underlying theory of competition. If competition is taken as equivalent to perfect competition, then the conventional, Ocasio, selection criterion is the highest profit rate, and this implies that the average profit rate falls only at sufficiently high wage shares. On the other hand, in the notion of real competition, the operative criterion is the lowest unit cost, in which case the rate of profit falls even at a given real wage. 2. Real competition within an industry. Firms within an industry fight to attract customers. Price is their weapon, advertising their propaganda, the local chamber of commerce their house of worship, and profit their supreme deity. Prices and propaganda serve two important functions: they attract customers away from other firms, and they attract new customers into the market as a whole. Cost cutting becomes a central concern because prices are ultimately limited by costs. Costs in turn depend on the length and intensity of the working day, the wage paid to workers, and the technology in use. Hence, struggles between capital and labor over wages and working conditions are imminent in the drive for profit, see Chapter 4. So too is never-ending technical change, whose principal purpose is to reduce costs. Firms set trial prices to attract customers and to harm their competitors. The diffusion of customers toward lower price sellers forces firms to keep their prices, adjusted for costs such as transportation and local taxes, within striking distance of each other. I will call this result the law of correlated prices, LCP, Shaikh 1980c, so as to distinguish it from the neoclassical notion of the law of one price, LOP, in which all prices are supposed to be exactly equal due to perfect competition within an industry. This will become significant when we discuss theories of imperfect competition and the empirical evidence on pricing. It is important to distinguish between the number of capitals, i.e., the number of plants in operation, and the number of firms, Harrod 1952, 144. The overall production capacity in an industry depends on the number of capitals, a number that can be altered through changes in the size of existing firms or through changes in the number of firms. The important point is that profit opportunities not only motivate new firms to enter an industry but also motivate existing firms to expand their capital. The distinction between firms and capitals is important because firms set prices but the operating conditions of capitals determine costs. At any given moment of time in any given industry, there exists a set of capitals in operation. Since technical change is ongoing, these capitals, plant and equipment, differ in their cost structure even if wages and working conditions are the same for all. New capitals are always being created, most often with new lower-cost methods of production. At the same time, older higher-cost capitals are being idled or scrapped because their profit margins are too low. Thus, there is always a spectrum of technologies and cost conditions in place. It follows that competition within an industry tends to disqualize profit margins and profit rates precisely because it tends to equalize selling prices. This is the second characteristic result of intra-industry competition. Table 7.1 illustrates the two principal results of competition within an industry. Capitals, plant and equipment, are listed in declining order of their unit operating costs at normal capacity. It will be recalled from Chapter 4, Section V, that economic capacity is defined as the minimum point of the average total cost curve. Selling prices are depicted as exactly equal in order to emphasize the point that price equalization leads to profit rate disequalization. Price differences due to more concrete factors will be addressed in Section 6.2. Lower cost plants are depicted as having larger scale, capacity, capital, and higher capital intensity, capital advanced per unit capacity, in keeping with the finding that it generally takes a larger scale of operation to achieve lower costs. Since the profit rate is the profit per unit output divided by the capital intensity, the inverse correlation between unit costs and capital intensity makes the dispersion of profit rates smaller than the dispersion of unit profits. 1 Indeed, in this particular example, the lowest cost method, D, has a lower profit rate than that of the second lowest cost method, C. Table 7.1 Competition within an industry equalizes prices and disqualizes profit rates. In the situation depicted in Table 7.1, conventional analysis says that method D will not be adopted because it offers a lower profit rate than method C at the going price of 100. This conclusion follows from the neoclassical assumption of perfect competition, in which all firms are assumed to be price takers. But in the theory of real competition, price setting and price cutting behavior are fundamental. A firm with lower unit costs can always drive out its competitors by cutting price to the point where their profit rates are lower than its own. For instance, as shown in Table 7.2, at the critical price of $89.50, Method D is as profitable as Method C. Any lower price would then make D the most profitable of all methods. In cutting its price, the firm utilizing Method D lowers its own profit rate for a period of time, but it reduces the profit rates of its competitors even more and makes it clear to them that they are doomed a considerable benefit in terms of future profits of the winning firm. Darlin 2006, C1. These are the operative principles of warfare. Attackers try to impose greater losses on the other side. We will see that such behavior is the norm in the business world. It follows that the highest profit that is sustainable in the face of price-cutting behavior is generally different from the price-passive profit assumed in theories of perfect and imperfect competition. Point 2. I will return to this issue during the discussion of actual business behavior in section V.1 of this chapter, and of the academic debates on the so-called choice of technique in section 7. In summary, individual firms set prices according to what they think they can get away with. But competition from other firms binds these prices together, subject to transportation costs, taxes, and search costs for customers. This creates an average price within each industry with a specific distribution around it. However, ongoing technical change means that individual plants have different costs in reflection of their different vintages. Thus, the same process which equalizes prices also disqualizes profit margins and profit rates. The advantage in this perpetual justing for market share goes to the firms with the lowest cost. Insofar as lower unit costs are associated with larger plant size, output, capital, and/or capital intensity, as illustrated in Table 7.1, price equalization within an industry will produce a positive correlation between profit margins, profits per unit output, and output, capital, and/or capital intensity. This is a necessary consequence of competition within an industry in the face of endogenously generated technical change. Yet we will see that in traditional theory such a correlation would be interpreted as evidence of the imperfection of competition. The culprit here is the ubiquitous notion of perfect competition, see Chapter 8, sections I.3 and I.4. 3. Real competition between industries. Competition within an industry creates an average price and a corresponding dispersion of profit rates across firms and across capitals. However, this aspect of competition does not tell us anything about the particular level of the industry average price or profit rate. For this, we need to turn to the other major principle of competitive analysis, the mobility of capital across industries and the consequent equalization of profit rates. One of the fundamental tenets of classical economics is that investors gravitate toward higher rates of return. In the present context, this implies that new investment flows more rapidly toward industries with higher rates of profit. Capitalism is generally growing, which means that there is already ongoing new investment in most industries in keeping with the corresponding growth of demand. So the mobility of capital implies that new investment will accelerate relative to demand in industries with higher rates of profit and decelerate relative to demand in industries with lower rates of profit. Point 3. The qualification that all this be relative to demand is important. In an industry with higher profit rates, if the increased inflow of investment does not cause supply to grow faster than demand, profit rates will rise even more, which will spur an even more rapid rate of entry of new capital. In the end, the relatively accelerated expansion of capitals in industries with higher rates of profit will raise supply relative to demand and drive down relative prices and profits. The opposite will take place in industries with lower profit rates. This does not require demand curves themselves to be fixed during this process, see the discussion of Andrews and Brunner in section 6.1. The entry and exit of capital in search of higher rates of return therefore serve to equalize profit rates on new investment. Note that it is the rate of return on new investment, not the average rate of profit on all vintages, which is relevant to the mobility of capital. Point 4. At this point, we run into a question: competition within an industry disqualizes profit rates because it equalizes selling prices, while competition between industries equalizes profit rates because it promotes entry and exit of capitals in response to profit rate differentials. How is it possible for both tendencies to coexist? The answer lies in the fact that only the profit rates of specific capitals within an industry will be targets of opportunity for new investment. Thus, competition within an industry differentiates profits rates of individual capitals, while competition between industries equalizes the profit rate of one particular set of capitals with those of similarly placed capitals in other industries. For real competition and the notion of regulating capitals. At any moment of time within any given industry, there are a set of capitals representing the best generally reproducible condition of production in that industry. I have called these the regulating conditions of production, the ones with the lowest reproducible, quality-adjusted, costs in the industry. Shaikh 1979, 3, Botwinick 1993, 152-153, Solfidis and Salaki 2005, 13. Reproducibility is important because new investment must be able to replicate the conditions of these particular capitals. The profit rates of these regulating capitals will be the focus of new investment. When these profit rates are higher than those of regulating capitals in other industries, new investment into the industry will accelerate, and when their profit rates are lower, new investment will decelerate. In this manner, through alternating cycles of fat and lean years, competition between industries will turbulently equalize regulating rates of profit. Marx 1967 c. 208, Mueller 1990, 1-3, Botwinick 1993, ch. 5, Shaikh 1998b. Regulating conditions can take a variety of forms. The simplest possibility is that the average conditions of production are the regulating ones. This could be because there is just one, or several roughly co-equal method of production, type A1, in use. Figure 7.1 depicts this case. The vertical axis displays unit costs of production, while the horizontal axis shows total production. In this regard, it is important to recall that the unit cost in question represents the minimum point of the average cost curve, as discussed previously in Chapter 4, particularly Section 3.3 and Figures 4.16 and 4.17. The dark center line represents the average unit cost, while the shaded band around this line serves to remind us that any given set of production conditions may give rise to a distribution of production costs around the average, depending on more concrete factors ranging from the vintage of the machines to luck and skill of the workers and bosses. The dotted line indicates the path of future expansion as long as these conditions of production obtain. This path is open because it is always possible to construct new plant and equipment. Another possibility is that the reproducible conditions of production are the highest cost ones in use, as in B3 in Figure 7.2. For instance, in agriculture or mining, the very best mines/lands might be fully exploited, as might be the second best ones, and so on. Moving up the ladder of cost, the margin of cultivation at any moment of time will be that set of mines or land whose output is necessary to satisfy total demand forthcoming at its particular price of production. The margin of cultivation will be the regulating condition of production in agriculture, the point of entry for new investment. Its price of production, defined by its costs and a normal rate of profit, will then act as the center of gravity for the market price of agricultural commodities. Three issues are important to note here. First, nothing in this argument implies that the regulating conditions are infinitesimal. On the contrary, extended production on lands or mines of a given quality is the general rule. Second, given that competition among producers will enforce a common price, lower cost producers will tend to have higher profit margins and higher profit rates, as previously depicted in Table 7.1. This means that better mines and lands will earn excess profit for their producers simply because their conditions are not reproducible. This excess profit is economic rent. It can remain in the pockets of the firms operating the land if they own it themselves. It can be shared between the firms and the actual landowners if the two are different entities, or can even be appropriated entirely by the latter if they have the power to rent their land to the highest bidder. Classical rent theory typically assumes that users and owners of land are different sets of individuals, and that the latter are capable of extracting all persistent excess profit as rent. Ricardo 1951b, ch. 2. Marx is careful to add that this is only true at a later stage of history in which landlords are merely land-owning capitalists. Marx 1967a, 643-647. Finally, the cost rankings of various types of land or mine rates can vary over time insofar as changes in input costs or the appearance of new technologies have differential impacts on operating costs. Marx and Engels 1975, 60-63, Marx to Engels, January 67, 1851. Figure 7.2 illustrates the case of agriculture or mine, industry B. B1 and B2 represent conditions of production fully utilized conditions, while B3 represents the margin of cultivation, the best reproducible, regulating, condition of production whose unit cost is the foundation for the regulating price of production in this particular industry. Finally, it may be that the regulating conditions are the lowest cost ones, as in industry C3 in figure 7.3. This might be because higher cost ones represent older methods which remain in operation but are no longer competitive. Although there is no technical limit to the reproduction of older types of capital, they are not competitive. Hence, capital of type C3 embodies the regulating conditions of production. 5. V. General phenomena of real competition. The first general effect of real competition is the differentiation of profit rates that arises from the equalization of selling prices due to competition within an industry, as depicted in figure 7.4. Each industry ends up with a spectrum of profit rates arrayed around some particular average rate. The spectra are different for different industries, and average rates need not be equal across industries. In real competition, firms set prices in light of market conditions and competitive consequences, cutting these prices in order to gain an advantage over their existing competitors and to keep potential ones at bay. Except for distress sales, price cuts are ultimately limited by costs, Andrews 1949, 87. However, luring more customers to your door with lower prices is of little benefit unless you can increase your normal level of production. The advantage therefore resides in the lowest cost reproducible conditions of production, i.e., in the regulating conditions. The regulating capitals are therefore also the price leaders in an industry. Their price becomes the benchmark for market prices. It follows that non-regulating capitals will be price followers, and since they must adapt their own selling prices to those of the price leaders, their profits are residuals. The profit margins and profit rates of non-regulating capitals depend on their own costs. These might be higher than the corresponding margins and rates of regulating capitals as in lands B1 and B2 in figure 7.2, or smaller as in firms C1 and C2 in figure 7.3. They are residuals nonetheless. The second result of real competition is that the mobility of capital leads to the equalization of the profit rates of capitals on the best reproducible conditions of production, regulating conditions, in each industry. These equalized regulating rates of profit are depicted in figure 7.5 as starred values. Industry A represents the case in which the average conditions are reproducible so that the average profit rate can also be the regulating rate of profit. Industry B the case in which the highest cost conditions are the regulating ones so that the rate of profit on lands/mines of type B3 is the regulating rate, and Industry C the case in which the regulating conditions are the lowest cost ones. The equalization process is turbulent, and ceaseless, it is gravitational process, not a state of equilibrium. Figure 7.5 depicts the average result of profit rate equalization among regulating capitals. It is important to recognize that the process in question is a turbulent one that operates over a cycle of fat and lean years, as depicted in figure 7.6. Hence, even regulating rates will be different in any given year, year by year. It is not their equality, but rather their crossings, which need to be considered. A corollary is that average profit rates are generally not equalized across industries, as is evident from the fact that in figure 7.6. Nor will profit rates generally be equal across nations. For instance, if the national location of capitals happens to be those indicated in figure 7.7, then it is obvious that profit rates would be persistently different across nations. Conversely, in order for the equalization of the profit rates of regulating capitals to lead to the equalization of national profit rates, it would be necessary for capital within a given industry to be exactly alike. There would be no distinction between any particular capital, the average capital, and the regulating capital. In that case, the inter-industrial equalization of regulating profit rates would also equalize the profit rates of all individual capitals. This is what standard economic theory explicitly assumes. Unfortunately, it is also what heterodox economic theory implicitly assumes, to its detriment. Shaikh 2008, 167-171. I return to these issues in sections 6.4 and 6.5 of this chapter. The equalization of regulating profit rates has two further implications. The rate of profit, which is the ratio of profit, P, to capital, K, can also be expressed as the ratio of the profit margin to the capital intensity, where X stands for total output. 7.1. The equalization of regulating rates of profit therefore implies that for regulating capitals, profit margins will be higher in industries with higher capital output ratios. Insofar as industry average variables are correlated with regulating ones, one would expect similar correlations for the former. This is a necessary consequence of real competition. Yet we will see that such patterns are often interpreted as evidence of imperfect competition, i.e., of monopoly power, simply because they are absent from the theory of perfect competition. Lastly, in real competition, industries with higher initial investment costs will have higher entry costs and higher exit costs, which will make both entry and exit relatively more sticky. This will mean that the firms already in these industries will tend to absorb more of their production fluctuations through changes in the utilization of existing capacity and less through price fluctuations driven by entry and exit. Thus, real competition between industries implies that large-scale industries will tend to have higher range of reserve capacity, higher range of normal reserves, and more stable prices. Yet within conventional analysis rooted in the theory of perfect competition, this is mistaken as evidence of monopoly or oligopoly power, Chapter 8, Section I.9. How then do we distinguish between competitive and monopolistic industries? The latter must have regulating rates of profit that are persistently higher than the average regulating rate. This, as we shall see, is a very different criterion for monopoly power than that derived from perfect competition. 6. Evidence on real competition. We now turn to the evidence on the actual behavior of firms and on costs, prices, and profits across plants within a given industry and across firms in general. Section 6.1 traces the development of the theory of the firm in real competition, whose key features can be credited to P.S.W. Andrews and, to a lesser extent, to Roy Harrod in his reconsideration of the theory of imperfect competition. The resulting vision of firm behavior is quite familiar to the business literature. Section 6.2 investigates the relation between operating cost, defined as actual expenditures for materials, wages, and amortization, and plant size. Salter is the key figure here. Section 6.3 considers the evidence on the relation of actual pricing behavior to the costs of the firms, and links this to the issue of the choice of technique. Once again, this evidence is consistent with the expectations of real competition. Section 6.4 takes up the corresponding relations between profitability and plant size. If the theory of perfect competition were empirically valid, all firms would have the same profit rates, firms within an industry would have the same profit rate, since they would be all the same, and competition between industries would equalize profit rates. The empirical evidence always contradicts these neoclassical expectations. On the other hand, this same evidence is quite consistent with the theory of real competition. Section 6.5 takes up the key issue, which has to do with the evidence on the profit rates of regulating capitals. From a theoretical point of view, competition between industries equalizes the rates of return on new investment, not those on average capital, which includes all older vintages. It is argued that the incremental rate of profit is a good approximation to the rate of return on new investment, and it is shown that this measure of profitability is indeed turbulently equalized across industries as expected by the theory of real competition. 1. The behavior of the firm. I. Oxford Economists Research Group, OERG, and Hall and Hitch. In the 1930s, the Oxford Economists Research Group, OERG, which included Roy Harrod and P.W.S. Andrews. 6. Systematically examined actual business practices. 7. Their extended studies revealed certain widespread patterns which came as a shock to many academic economists. Harrod 1952, 9. Hall and Hitch reported that firms set their prices with reference to what they considered to be full cost, the latter being defined as the sum of average costs, prime costs plus overhead, and some conventional net profit margin. 8. Individual firms had different operating costs but were forced by competition to keep their prices in line with those of the price leader. Hence, the net margins set of price followers were simply those which kept their own selling prices in line. Hall and Hitch, 1939, 33, also argued that prices based on full cost did not react much to moderate or temporary shifts in demand. But this did not prevent prices and profit margins from rising when demand substantially outran supply or from falling in the opposite case. 19. So it was only in the long run that businessmen believed that the market price would normally cover the full average costs with a fair net profit for a reasonably efficient firm. Andrews 1964, 34. All of this is quite different from arguing that net margins were fixed independently of competitive pressures and market conditions. A large majority of the entrepreneurs explained that they did actually charge the full cost price, a few admitting that they might charge more in periods of exceptionally high demand, and a greater number that they might charge less in periods of exceptionally depressed demand. What, then, was the effect of competition? In the main it seemed to be to induce firms to modify the margin for profits which could be added to direct costs and overheads so that approximately the same prices for similar products would rule within the group of competing producers. One common procedure was the setting of a price by a strong firm at its own full cost level, and the acceptance of this price by other firms in the group. Another was the reaching of a price by what was in effect an agreement, though an unconscious one, in which all the firms in the group, acting on the same principle of full cost, sought independently to reach a similar result. Hall and Hitch 1939, 19. Hall and Hitch found that price competition among firms meant that the net profit margins of price followers were endogenous, that the actual selling price of the price leader was contingent in the short run and that its benchmark, full cost, price would yield a fair net profit for the efficient firm only in the long run. Read in this manner, the Hall and Hitch concept of full cost pricing is simply evidence of real competition. Businesses set trial prices that they adjust according to demand and supply. Competition among firms keeps these prices in line with those of the price leaders. And over the long run, the market price conforms to a price which ensures a fair net profit on the conditions of production of a reasonably efficient firm, i.e., the price of production of the regulating capital. The OERG findings could therefore have served to restore a realistic theory of competition. But this was not to be. Theorists of perfect competition attacked the observed price-setting practices of firms as mere pricing rituals which contradicted the vision of a profit-maximizing firm. Under perfect competition, firms were supposed to take a common selling price as given by market supply and demand and choose their output according to the condition P equals MC. This price in turn was supposed to rise and fall with changes in market demand relative to market supply. Even under imperfect competition, firms were assumed to face downward sloping demand curves and the profit-maximizing output was determined by the condition. Each firm was then supposed to charge a particular price that allowed it to sell its particular profit-maximizing output, and this price was supposed to rise and fall with demand. The OERG findings were rejected as heresy by both sides, tantamount to a claim that firms were not interested in maximum profit. Brunner 1952a, 511. 2. Andrews and Brunner. Andrews and Brunner took up the cudgel by insisting that the OERG findings described the behavior of competitive, profit-driven firms. Brunner 1952a, 511. Businesses see themselves engaged in a competitive struggle. They understand that competition from existing producers constrains them to sell at a more or less common price. Their pricing is also constrained by the threat of incursions of rivals from the outside. Andrews 1949, 54, 82-89, 1951, 147, Brunner 1952a, 517 to 518, 1952b, 733, 741. They constantly jockey for room by cutting prices to enhance their market shares. 9 And since these maneuvers are ultimately limited by their costs, they constantly seek to create and adopt lower cost conditions of production. Brunner 1952b, 738. In the battle of competition, the price leader becomes the one with the lowest costs. Except for distress sales, price cuts are ultimately limited by costs. Andrews 1949, 87, 1951, 131, Brunner 1952a, 517 to 518, 1952b, 733, 741. The fact that competition within an industry forces each firm to charge roughly the same price as the price leader implies that the profit margins over costs of price followers are residuals of their own costs. Andrews 1951, 147 and N 129. On the other hand, the margins of the price leader itself will be determined in the long run by a normal profit on normal cost. This last statement has two parts: the definition of normal costs and the definition of normal profits. Andrews and Brunner argue that average cost, AC, declines with output because one of its components, average fixed cost, declines steadily with output, while the other, average materials and labor cost, tend to be constant. See Chapter 4, Section 4.3. Hence, the greater the output, the lower the average cost. But there is a definite limit to the output that the business can sustain, although it can exceed this in the short run through overtime work. 10 Businesses normally plan to produce just short of this limit in order to accommodate desired reserves needed to handle fluctuations in output. Andrews 1949, 56 to 65, 74, 81. Desired reserves in turn are very different from true excess reserves that come into existence only when output falls below its normal level. It follows that the normal operations of a plant will be on the declining part of its average cost curve, at a particular point somewhat short of the sustainable limit to production. This effective minimum average cost point defines both the normal average cost of a particular plant and its normal level of output, as shown in Figure 7.8. Andrews 1951, 146 to 147, point 11. This is essentially the same assumption as in the fixed coefficient representations of production in Figure 4.15 of Chapter 4. The industry market price is regulated by the price set by the price leader. Over the long run, this regulating price is the normal cost of the price leader plus a contingent profit margin. From a classical point of view, it would have been sensible to complete the story by saying that the entry and exit of capitals forces the profit margin of the price leader toward a level that yields the general, regulating, rate of profit. Indeed, Andrews does say so once or twice. But his primary mission generally leads him on to other issues. Andrews and Brunner were more concerned with combating standard theory than with completing their own. After Sraffa's 1926 attack on Marshall-Lien theory, it had come to be accepted that decreasing costs, in both the short and long-run senses, were a normal feature of many manufacturing industries analyzed by Marshall as competitive. Andrews 1951, 139, 142. Then the difficulty arose: what defines the normal output of the firm in the short and long runs? In order to rescue the traditional notion of a passive profit-maximizing firm, orthodox economics found it necessary to invent falling demand curves for each firm. Then the corresponding marginal revenue curve, MR, was downward sloping, so that even with constant direct costs and hence constant marginal costs, MC, it was possible to determine a particular profit-maximizing level of production at the point MR equals MC. The analysis was then extended to the long run by replacing short-run demand and cost curves by putative long-run ones. Andrews 1964, 21-25. Andrews and Brunner strongly reject this construction. Andrews notes that the hypothesized demand curve for an individual firm cannot be derived from traditional consumer preference theory, since that refers only to commodities in general. Utility theory says nothing about the allocation of consumer demand across firms within any given industry. Indeed, any firm's particular demand curve, which is its share of general industry demand, would be affected by its own supply as well as the supply of other firms. Then demand could not be taken to be independent of supply, which knocks down the traditional foundation of demand, supply analysis. The second objection is that even the market demand curve itself, from which the individual firm demand curves were supposedly derived, cannot be taken as given in the long run because consumer preferences and incomes will generally change over any such interval. Third, the entry of new plants, whether from existing firms or new ones, will not only shift any putative individual firm-level demand curves but will in general also change their shapes. Andrews 1964, 42, 56-57, 60, 68. Finally, any firm-level demand curve must also reflect the asymmetries inherent in any gap between the firm's current price and that of its myriad competitors. If its current price is higher than theirs, then its market share drops rapidly, whereas, if its price is lower, its market share rises rapidly. But then any such kink demand curve is only defined for each level of the firm's price in light of its departure from the prices of its competitors. Andrews 1951, 137, 144. Andrews's explicit goal was to provide a theory of a competitive firm which is consistent with the empirical evidence and not mired in the static equilibrium method of analysis which underpins theories of perfect, imperfect, and monopolistic competition. He cast his own work as an effort to reinstate the Marshall-Lian view of competition and to justify Marshall's ideas about abnormal price. Andrews 1949, quote from 54, Andrews 1951, 125.12. He opposed two key aspects of the theory of perfect competition. The assumption that firms face rising marginal costs is rejected on the grounds that unit prime costs and hence marginal costs are constant in the face of changes in output. And the assumption that a competitive firm can simply sell as much as it wants is rejected on the argument that the output it can sell will depend on the particular price it offers in relation to the prices offered by its competitors. Andrews 1964, 1-5. We have already noted that he also rejects the corresponding two key features of the theory of imperfect competition, that there exists stable downward sloping demand and marginal revenue curves at the level of an individual firm, and that different firms set different prices for the same product according to their own profit-maximizing needs. Andrews chooses to characterize price setting in terms of a gross profit margin added to prime, materials and labor, costs. Andrews 1964, 33. This step unfortunately moves him away from the full cost pricing principle of Hall and Hitch, which relies on a net profit margin on average costs. Average cost accounts for both prime and overhead costs, so that the net profit margin is directly related to the net profit rate. Then the link between long-run net margin of the efficient firm in an industry and the general rate of profit on regulating capitals in other industries becomes straightforward. But Andrews's motivation for focusing on prime cost, ABC, is his belief that the latter is constant over the relevant ranges of output, so that marginal cost is thereby also constant. This provides him with an important empirical point of attack against the foundations of neoclassical theory. Like Hall and Hitch, Andrews understands that competition binds the prices of most firms to the price set by the leading firm. Hence, for price followers, Andrews's own pricing rule provides an explanation of gross profit margins rather than selling prices. Andrews 1951, 147, 153. This leaves the gross profit margin of the price leader as the real issue. He serves notice that this too is contingent in the short run, since it could be raised and lowered in the light of industry demand and supply. So for Andrews's theory of price, the central question becomes, what determines the long-run gross margin of the price leader? Andrews is mostly content to state that the gross margin is determined by competition and that it tends to be stable in the long run. Andrews 1949, 85, 88. Brunner follows the same line when she says that competition works by directly limiting the size of the gross margin available to any business, Brunner 1952b, 733. But then in one place Andrews suddenly breaks into the clear. Experience, however, suggests that long-term forces do readjust the size of the margin. The tide of competition may leave little pools of abnormal profit behind it, but in the end they tend to disappear. In general, then, the experience of industry does suggest that the businessman is right when he sees his gross margin and his price as being competitively determined. The gross margin that he takes into his price will depend upon competition, and hence upon the level of the direct costs of the most efficient competitors, Andrews 1949, 88-89. This statement completes Andrews's theory of competition. The market price in any industry depends on the prime costs and gross margin of the most efficient producer. In the long run, competition eliminates any abnormal, net, profit from this gross margin, that is, reducing it to a level which essentially reflects the normal rate of profit on the efficient producer, Muda 2010, 42-43. The resulting normal price of the price leaders then determines the profit margins of the non-leaders in conjunction with their own particular costs. Indeed, in a subsequent exposition of his own theory to be used for teaching analysis, he considers an industry in terms of a single product sold at the same price by all producers and explicitly says his theory of the firm which has been discussed here may be used to provide a very fair parallel to the Marshall-Lien description of long-run equilibrium in an industry, Andrews 1951, 154-155. But we know that Marshall's long-period normal price is precisely one which corresponds to a normal rate of profit in each industry, Panico and Petrie 1987, 238-239. So here too Andrews seems to be saying, albeit less openly, that the long-run gross margin of the efficient producer is determined by the normal rate of profit. Despite his break though, Andrews himself focuses more on the stability of the gross margin than on its long-run level, because this allows him to claim that selling prices do not normally vary with output. The stability of competitive prices in the face of changes in output undermines the neoclassical notion of price as an index of scarcity and the corresponding claim that an increased supply of goods must be attended by an increased price. It follows that one cannot interpret the empirical stability of observed prices or profit margins as evidence of monopoly, Andrews 1949, 81, 88, 89. Nor can one use the difference between price and prime costs, i.e., the competitively determined gross margin, as an index of monopoly power. Finally, he also rejects the notion that the size of a firm is an index of its lack of competitiveness, Brunner 1952b, 741, as well as the claim that the degree of competition within an industry is inversely related to the number of firms. From his point of view, the proper definition of competitive industry is that it is open to the entry of new competition. Hence, even an industry with only one firm might qualify as competitive, Andrews 1964, 16. These are path-breaking insights that should have opened the way to a theory of real competition. 3. Harrod's revision of imperfect competition. One of the ways to incorporate the OERG findings was to view them as evidence of profit-maximizing behavior in imperfect or monopolistic competition, i.e., of pricing and output decisions according to the rule applied at the level of each firm. This retained the standard theory of a profit-maximizing firm and allowed for price setting by the individual firm, but not price cutting. Andrews was opposed to any such attempt, and his opposition took the form of an attack on the notion of a firm-level downward-sloping demand curve and its corresponding marginal revenue curve. Roy Harrod, another key member of the OERG group, the inventor of the marginal revenue curve, Eltis 1987, 595, and the author of a classic statement of the theory of imperfect competition, Harrod 1934, ended up taking the opposite tack in his attempt to incorporate the evidence into a revised version of the theory of monopolistic competition. He moves a step beyond Hall and Hitch, as well as Andrews and Brunner, by explaining how actual business behavior could be viewed as being consistent with long-run profit-maximizing behavior. But he falls back relative to the others on two fronts. He retains the neoclassical principle that cost includes a normal profit on capital advanced. And he adheres to the neoclassical vision of imperfect competition in which firms set prices according to a revised notion of the rule MR equals MC, but do not engage in cost-based price cutting, which is implicit in the distinction between price leaders and price followers. This distinction is moot in Harrod's case because he sticks to the conventional assumption that all firms have the same conditions of production. Classical economics and business practice define cost in terms of actual expenditures, prime costs, expenditures on materials and wages, and fixed costs, amortization of expenditure on fixed capital. But neoclassical theory also adds in normal profit, to which an entrepreneur is said to be entitled. Liebhofsky and Liebhofsky 1968, 266 to 267. This is generally calculated by applying some normal, economy-wide rate of profit in the business accounting sense to the stock of fixed capital, Varian 1993, 203. The allowance for normal profit is added into fixed cost on the claim that the normal rate of profit may be treated as a given opportunity cost to the firm. In other words, neoclassical economics assumes that average cost consists of prime cost plus a normal gross margin. This changes the neoclassical measures of total cost and average cost, but not of average variable, prime, cost or marginal cost, neither of which depend on fixed cost. The profit-inflated measure of average cost is the neoclassical equivalent of the classical price of production, since it incorporates a normal rate of profit on capital advanced. In Chapter 4, Section 3.1, I labeled this in order to distinguish this from the classical and business definition, AC. Neoclassical long-run equilibrium is then consistent with any point at which, even within neoclassical theory, there are two such points: the long-run equilibrium point in perfect competition, in which the free entry and exit of firms forces the horizontal demand curve of each firm to the point where it is tangent to the minimum the price of production curve, so, Varian 1993, 346 to 359, and the long-run equilibrium point in monopolistic competition in which individual firms face downward sloping demand curves, and free entry and exit leads to a lower output and higher price corresponding to the tangency of the long demand curve with the curve. The traditional justification for this latter outcome is that it yields the highest amount of profit to the firm, higher than the mass of profit associated with any other point on the curve including its minimum point, Varian 1993, 431. Harrod's insight was that this justification involved a major contradiction. A conventional average cost curve shows the average cost corresponding to any given level of output. The neoclassical average cost curve adds normal profit on top of this, so that it represents the price P** which yields the same normal rate of return at each level of output. Hence, both the tangency point Pm derived from the traditional theory of imperfect competition and the minimum point yield the same rate of profit. But the minimum point is lowest normal price of all, the one which undercuts all other normal prices, including the tangency point associated with the traditional theory of monopolistic competition. It follows that only is sustainable in the long run, the free entry and exit of firms would shift the demand curve of the average firm down to the point where it intersected. So now we have three disparate arguments: the perfect competition argument, in which the average firm's long-run demand curve is tangent to the price curve at the lowest possible price of production; the traditional monopolistic competition argument, in which the average firm's long-run demand curve is tangent to the price curve at some higher price PM; and Harrod's own long-run theory of competition, in which the average firm's demand curve intersects its price curve at. Figure 7.9 depicts the three alternatives. Point 13. In his theory of imperfect competition revised, Harrod begins by pointing to widespread evidence that firms set their prices, that they face downward sloping demand curves. 14, a situation which he labels imperfect competition, and yet also exhibit a lively fear of the possibility of the incursion of new entrants, should excessive prices be charged by those already producing a certain article, THIRD 1952, 144, 158 to 160. THIRD therefore proposes to analyze the logic of imperfect but free competition, that is, a condition in which price-setting firms face downward sloping demand curves under conditions of free entry and exit by others with the same technology, 187. Like Andrews, THIRD believes that conventional average total cost, AC, declines for an extended period until it finally rises at some point. It follows that profit-inflated average cost, i.e., price of production, exhibits the same general pattern except that the minimum point of comes at a higher output than the minimum point of true average cost, Chapter 4, Section 3.1. The effective minimum price point comes somewhat before the absolute minimum, some allowance having to be made for normal reserve capacity, THIRD 1952, 154, 165 text and N1, Muda 2010, 4-5. This defines the normal annual output of a plant over its expected lifetime when it is being planned, THIRD 1952, 150, and is the point at which firms can sustain their own market share because new entrants cannot achieve a lower normal price, with the same technology. Indeed, for an entrepreneur to count on operating at any higher normal price point, knowing that pressures from competitors would erode any resulting surplus profit in the long run, is surely a sign of schizophrenia, 149. THIRD therefore concludes that under conditions of free entry and exit, the desired, defensible, output of the firm is at the effective minimum normal price point rather than the unsustainable, maximum profit output defined by the traditional long-run tendency of the demand curve to the normal price curve, 150 to 151, 161 to 162. Firms set their selling prices in light of the defensible output and entry and exit of plants ensure that in the long run these selling prices conform to the minimum normal price yielding a normal rate of profit on new plant and equipment. THIRD makes an important distinction between entry and exit of plants and that of firms. As he notes, existing firms can enter by adding new plant and exit by scrapping older ones, THIRD 1952, 144. If the prices set by existing firms yield sales below the effective minimum average cost output, prices will be lowered and or some plant will be retired, shifting the average demand curve outward for the remaining capitals until sales matches sustainable output. Conversely, if sales exceed sustainable output, prices will be raised and or new plant from existing or new firms may enter the market, shifting the average demand curve inward to bring sales back in line with sustainable output and the market price back in line with the minimum normal price, 159 to 160, 162 to 163. Point 15. Note that it is the changes in capacity brought about by the entry and exit of capitals which shifts the demand curve of the average firm. THIRD emphasizes that all of this is accomplished through trial and error, since the entrepreneur will be hazy about demand and make the best guess he can, and only if the market proves him right will his net margin stand, 160 to 161. THIRD counterposes a notion of strategic profit maximizing to the standard assumption of myopic profit maximizing. According to THIRD, the difference does not lie in the condition MC equals MR but rather in the definitions of long period MC and MR, THIRD 1952, 179. From THIRD's point of view, long period marginal cost includes overhead and normal profit, since these two are variable over the long run. Hence, the long run marginal cost curve is the normal price curve P star. On the side of long run marginal revenue, he notes that it is contradictory to say that a firm invests in a new plant with its whole lifetime in mind, and then say that it determines the utilization rate of this plant without looking beyond the current short period, 149 to 152, 161 to 162. A strategic view of profit maximizing must take into account that if a price is charged that new competitors can undercut, the loss of potential revenue from the consequent loss of market must be subtracted from the immediate revenue yielded by the price charged, 150 to 151. The long period marginal revenue is therefore the same as the demand curve D. It follows that the long period profit maximizing point is where the demand curve of the average firm interests its normal price, profit inflated average cost, curve, just as in the third chart in figure 7.9. In regard to the adjustment process, it is useful to note that there are two instruments which define the condition of the average firm, its price and its share of market demand. There are also two relevant outcomes: capacity utilization at the normal rate and equalization of the industry's regulating rate of profit with the general rate. The entry and exit of capitals will change the share of market demand going to the regulating capital, and this will establish the industry's regulating rate of profit at some particular price. If this profit rate is persistently different from the time average of the general rate, prices and capacity in this industry will adjust in a rough and tumble manner until both normal capacity utilization and a normal rate of profit are obtained for the average capital in a given industry. This is Harrod's synthesis of full cost pricing, with the notion that the ruling long-run price in an industry must reflect the general rate of profit. Harrod 1952, 157 to 158, 179, 187. The notion of full cost adumbrated by Hall and Hitch referred to a benchmark price consisting of average costs, in the business sense, plus a conventional net profit margin, Muda 2010, 6-7. Only in the long run, and only for the efficient firm, is this margin regulated by the normal rate of profit. In Harrod's 1952, 150, hands, the margin is at the long-run equilibrium level, so that full costs is synonymous with prices of production from the start. Second, Hall and Hitch and Andrews and Brunner emphasize that firms not only set prices but also cut prices whenever they can. The theory of imperfect competition also assumes that firms set prices in the MR equals MC sense, and Harrod adopts this particular notion of price-setting behavior. But in his argument, firms do not cut prices as such. Rather, they compare the price they would like to charge with the one they will be forced to charge due to pressures arising from free entry and exit. This is an internal dialogue, so to speak. Should the firm happen to choose the myopic profit-maximizing price, the resulting excess profit will spur new entry that will expand supply and push the market price down to full cost, 144, 155 to 161, 174, 179. What is missing is any notion that firms might actively cut price to make room for themselves in the market, willingly incurring below normal profits or even losses in the process. 16 Yet price cutting of this sort is widespread in actual competition. For price cutting and entry in the business literature. Jaroski's 1990, 20-21, study of international profitability identifies several important patterns. Excess profit in an industry stimulates adoption of best practice methods by insiders as well as outsiders. It also stimulates new entry, and entrants are likely to undercut prices set by incumbents. Even the threat of entry may be sufficient to lead incumbents to expand their own capacity relative to demand, and all of these responses lead to downward price pressure that serves to eliminate excess profits. In a similar vein, in the New York Times business article entitled "Price Cutting Behavior is Characteristic of Competition When There Are Substantial Cost Differences," Darlin, 2006, C1, reports that Dell is sharply reducing prices on its computers. The tactic is classic: lower your prices. Profit margins will take a temporary hit, but the move would hurt competitors worse as you take market share and enjoy revenue growth for years to come. As the writer notes, this only works if you have a substantial cost advantage. Dell did it in 2000 and it worked beautifully. It is quite clear, firms with lower costs can cut prices and take market share from their competitors, knowing that if they are successful, the temporary hit in their own profit margins will be attended by revenue growth for years to come. Bryce and Dyer, 2007, conducted a 4-year study of the most profitable industries measured by incumbents' returns on assets between 1990 and 2000. Their conclusion is unambiguous. Our 4-year study left us with no doubt that money attracts money. In the decade we examined, the most profitable industries had almost 5 times as many entrants as did the average industry. By and large, fresh entrants in the most attractive markets earned returns that were 30% lower than those earned by newcomers in other industries. However, when entrants in the top industries were profitable, they won big. Their returns were nearly 7 times those of all entrants in the top industries and almost 4 times the returns of the profitable entrants in less attractive markets. Thus, in industries where the existing players' profits are consistently higher than those of enterprises in other industries, entrants are drawn to those markets like bees to a honey pot. Furthermore, almost without exception, the challengers take a page out of the military handbook. For instance, at Virgin Cola's U.S. launch, Virgin Group CEO Richard Branson drove a tank through a wall of cans in New York's Times Square to symbolize the war he wished to wage on rivals. Red Bull, by contrast, operated by stealth. It entered the U.S. soft drinks market in 1997 with a niche product, a carbonated energy drink retailing at $2 for an 8.3-ounce can, twice what you would pay for a Coke or a Pepsi. The company designed its cans as narrow, tall cylinders, so retailers could stack them in small spaces. It started by selling Red Bull through unconventional outlets such as bars, where bartenders mixed it with alcohol, and nightclubs, where 20-somethings gulped down the caffeine-rich drink so they could dance all night. After gaining a loyal following, Red Bull used the pull of high margins to elbow its way into the corner store, where it now sits in refrigerated bins within arm's length of Coke and Pepsi. In the United States, where Red Bull enjoyed a 65% share of the $650 million energy drink market in 2005, its sales are growing at about 35% a year. https://hbr.org/2007/05/strategies-to-crack-well-guarded-markets. And, of course, everyone but the economics orthodoxy knows that competition is merely war by other means. In this spirit, Jalad, 2009, promises to reveal various techniques of wargaming for which companies have previously had to pay large fees. The ad for his book tells us that in a global, complex, and competitive world, developing a plan without testing it against market reaction is like walking blind into a minefield. Wargaming is a metal detector for a company. Yet wargames run by the large consulting firms are kept secret and cost millions. For the first time, this book makes them accessible to every product and brand manager, every project leader, every marketing professional, and every planner, no matter how small or large the company. This book is your Bible of how to stay one step ahead of your competitors. Do not leave home without it. http://www.amazon.com/exec/obedo/acin/160160301/ossnet-20. 2 Empirical evidence on operating costs of plants, Salter. The theory of real competition implies that there will be systematic cost and profit differences among firms. In Chapter 4 we surveyed the empirical evidence on how fixed, variable, prime, and total average costs changed with the level of utilization of a given plant, and now we consider how operating costs vary in relation to plant size. Note that costs are defined here, as they generally are, in the business sense, actual expenditures for materials, wages, and amortization. Information on sources and methods and associated data tables are in Appendices 7.1 and 7.2, respectively. New investment is the principal vehicle for new technology, Salter 1969-65, and the continuous entrance and exit of capitals, plant and equipment and associated production conditions, serves to maintain an ongoing range of techniques within an industry. Since selling prices are constrained by competition, this spectrum of production conditions will be reflected in corresponding ranges of unit costs, profit margins, and profit rates. Insofar as newer plants are larger, unit costs will be negatively correlated with plant scale, while profit margins will be positively correlated. Note that the last proposition is not automatic, since if firms could set prices that offset their cost advantages, profit margins could be independent of, or even rise with, plant scale. Finally, to the extent that larger plants are more capital intensive, profit rates will rise less than profit margins and may even fall with scale. Indeed, we shall see shortly that most studies find that profit rate declines with firm size, the VUN 2001, 270N1. In his analysis of business patterns, Andrews noted that larger firms seem to have lower unit costs, there being fairly steep falls in average costs for increases in scale in the neighborhood of really small firms, with the rate of fall progressively slackening off with size relatively soon in terms of the stable structure of an industry, Andrews 1964, 82. This implies a relation of the sort depicted in Figure 7.10, which is compatible with an exponential relation of the form, i.e., with the relation, which is depicted by the dotted line. This simple form will be important when we undertake econometric analysis of the available data. The classic study of cost differences among firms is by Salter, 1969. His first conclusion is that there is always a spectrum of techniques within any given industry because new methods are always coming into operation and old ones are always being scrapped, 4 to 6, 48 to 49, 62 to 63, 95 to 99. Gross investment is the vehicle of new techniques, 65, and the plants in existence at any one time, are, in effect, a fossilized history of technology over the period spanned by their construction dates. The capital stock represents a petrified chronicle of the recent past, 52. Substantial productivity differences can arise even within a given technology simply because plants become less productive as they age. This is illustrated in Table 7.4 based on Salter's data on the U.S. beet sugar industry in 1933 to 1935 and the cement industry in 1938. Newer plants are from 35% to 66% more productive than the oldest ones. If aging were the only source of productivity difference among plants, no firm would have a persistent advantage because each would have to pass through the same life cycle. But plants also differ in the type of technology, the best practice ones being the most up-to-date techniques available at each date, Salter 1969, 6. This is the same thing as the regulating capital, if we read available to mean reproducible. Best practice techniques are embodied in newly constructed plants and generally have higher labor productivity, 25. Plants of older vintage embody superseded techniques of the past and are so unable to reach today's best practice standards of efficiency, 52. Salter shows that the best practice techniques in the U.S. blast furnace industry, 1911 to 1926, have roughly twice the labor productivity of the average, 6, and that in the shoe industry the labor requirements in the best practice method falls from over 15 hours per pair of medium-grade Goodyear Welt Oxford shoes in 1850 to less than 1 hour per pair in 1936. Average labor productivity is always lower and trails behind, 6, 25 to 26. Table 7.5 compares best practice and average methods in various stages of the U.S. cotton yarn and cloth industry in 1946. Salter, 1969, draws several theoretical conclusions from this. We must abandon the notion of technical changes as a once-over process in favor of ongoing change. As a corollary, there is no such thing as the traditional long-period equilibrium, because the requisite assumption of a single technique is inconsistent with the standing spectrum of technique produced by technical change, 6 to 7. Hence, as a state of existence, this long-term equilibrium is never reached, 59. Nonetheless, it remains important to distinguish between long-term decisions involving techniques, investments, and replacement, which being embodied in capital equipment, extend their influence over long periods of time, and short-term decisions involving variations in the utilization of capacity, 8. At the level of industry as a whole, Comparing 1924 to 1950 in the United Kingdom, Salter finds that large increases in productivity are associated with large increases in output and employment and substantial declines in relative prime costs and relative prices. He sees productivity growth as the driver. Relative wages do not vary much since wage rates are determined in general markets for labor, so that unit labor costs decline in accord with increases in labor productivity. At the same time, relative material costs move in parallel with unit labor costs. Hence, overall prime costs are systematically lower in industries with higher productivities. On the other hand, gross profit margins are not higher in industries with lower unit labor costs because cost reductions over time lead to corresponding price reductions. Salter 1969, 109-24, figures 14-16, 21. As a result, between 1924 and 1950 approximately 77% of changes in relative prices can be explained, in a purely statistical sense, by differential movements of labor productivity, 119-120, figure 17. Growth in labor productivity in turn seems to be largely driven by intrinsic technical change because factor substitutions in response to changes in relative price of labor to materials or of labor to capital do not seem to have much of an influence. 132, 144-145. Salter himself does not compare the changes in relative prices to those in relative unit labor costs, but the necessary information is available in his book for two other data sets, 164, Table 28, 197, Table 33, Point 17 figures 7.11 and 7.12 display the striking relationship for the United States comparing 1923 to 1950, and for the United Kingdom comparing 1954 to 1963, the latter in an addendum provided by W.B. Reddaway after Salter's untimely death in 1963. We will see in Chapter 9 that this pattern is an aspect of a powerful and more general property of relative prices. Despite his rejection of the conventional assumption of technological stasis, Salter, unlike Andrews, retains the traditional distinction between perfect and imperfect competition. Hence, he continues to see a competitive firm as a price taker, and a price-cutting firm as an oligopolist. Nonetheless, he makes the important point that a true monopolist will expand output until at the margin all his investments only earn the competition rate of return, so that the rate of profit on a marginal new plant will be the normal rate of return. 1969, 90 and 1, 91. He also argues that price-cutting behavior by a firm may lower its profit rate even on new capacity to below the normal rate, so that the oligopolist may decide that the cost of gaining control by direct aggression is too great. Rather he will attempt to grow relative to his competitors by capturing any increase in the market. Through his new capacity, 93. Salter later argues that the new capacity will expand supply relative to demand, which will drive down market price and presumably attract new customers to the market until the new capacity is absorbed and some old capacity as lowered prices render it unprofitable. 55. The fact that best practice plants have lower than average costs implies that at any common price they will also have higher profit margins. But if their capital costs are also higher, it is possible that they will have lower profit rates at the ruling market price, prior to price cutting. Salter himself has no data on industry capital stocks or unit capital costs. Hence, he is forced to infer the patterns of capital costs from data on gross profit margins. He is careful to point out that gross margin is a poor approximation to unit capital costs because the former includes not only unit depreciation, which is proportional to unit capital cost, but also unit net profits, rents and interest. Salter 1969, 131. Nonetheless, since he has already observed that gross margins are not higher in industries with lower unit labor costs, 117, figure 16, he is led to, tentatively, reject the hypothesis that unit capital costs are higher in more efficient plants. This part of his argument is muddy because he could just as well have speculated that gross margins were similar across plants because higher capital costs were associated with lower net margins. In any case, he turns to the neoclassical theoretical argument that any association of lower labor costs with higher capital costs must be due to factor substitution induced by a corresponding rise in wages relative to capital goods prices. Here, too, since he has no data on capital goods prices, he is forced to rely on the movements of material costs relative to labor costs instead. Since the two costs rise in line, he ends up rejecting the hypothesis of higher unit capital costs. We will come back to this issue shortly, when we analyze data in which capital costs are directly available. Finally, Salter states that a new method will be adopted only if it has the possibility of supernormal profits. The introduction of such plants by entrepreneurs from inside or outside the industry will then expand output in relation to demand conditions until the point where supernormal profits are eliminated, i.e., the rate of return of new plants is at the normal level. Hence, in the end best practice technique only yields normal profits, Salter 1969, 55. Three very important issues arise here. First, Salter, like Andrews and Brunner, endorses the classical notion that regulating capitals will only earn a normal rate of profit in the long run. Second, Salter claims that new methods will only be adopted if they have above normal profit rates. Third, he explains the fall in price arising from the introduction of a cheaper method of production through the rise in supply relative to demand. The latter two propositions are implicitly grounded in the neoclassical theory of perfect competition, in which a firm takes the market price as given in making its decision and the market price in turn only changes through supply and demand. Salter still sees price cutting as something outside of competition, i.e., as oligopolistic behavior. Andrews, on the other hand, insists that the competitive firm is a price-setting and price-cutting entity whose success in the battle of competition depends on its cost advantage. 3. Choice of technique under price-taking versus price-cutting. Table 7.1 at the beginning of this chapter presented a numerical example in which a method with a lower unit operating cost also had a higher unit capital cost. At any ruling price, the lower cost methods will always have the higher net profit margin. Since capital costs were assumed to be higher in more efficient plants, depreciation costs would also be higher, so gross margins would be higher still. Nonetheless, the profit rate on the most efficient plant, D, was lower than that of its closest competitor, C. According to Salter's orthodox criterion based on the notion that the market price is beyond the control of the firm, method D would not be adopted. But if we instead adopt the views of Andrews and Brunner, we see that the cost advantage of D gives it the power to lower its price and that competition among sellers then forces the others to follow suit. Table 7.2 showed that a mere 10% drop in price would make method D just as profitable as method C, and any price below that would make D the method with the highest rate of profit. The difference between the outcomes arises from the underlying difference in the visions of competition. Only the theory of real competition implies that a potential method which has the lower rate of profit at the ruling market prices will be the dominant method because of its cost advantage. Since it takes time for a new lower cost method to bring down the market price, only the theory of real competition implies that new, larger scale, methods may have lower profit rates. We will see shortly that an inverse correlation between profitability and firm size has been widely observed in the business literature. And we will see in section 7 that the opposition between these two underlying visions of competition is at the heart of the academic debate about the choice of technique, Shaikh 1978, 1980d. Price-cutting behavior in the face of cost differences gives rise to the further possibility that price differentials are related to cost differentials. When a new entrant with lower costs attempts to muscle its way into the market by offering a lower price for a given quality, the existing firms have to respond. If they choose to ignore the price drop, they will lose profits as their customers drift away. Alternately, if they match the new price, they will directly reduce their own profit margins. Firms with older plant may put more weight on the first choice because they already face a switchover in the near future, while firms with newer plants may fight harder by reducing their prices. Hence, the observed spectrum of cost differentials within each industry will be attended by a corresponding spectrum of price differentials. Among other things, this would imply that productivity differences among firms will be greater than revenue differences because higher productivity firms will tend to set lower prices. This is precisely what the evidence indicates. Productivity measures are often created by deflating sales revenue by an industry-wide price deflator. But such measures can be misleading because sales revenue reflects both physical productivity and price. In most industry studies, the variations in the product mix across firms make it difficult to directly observe price differentials. One indirect approach is to use revenue data to estimate firm-level production functions and then use the corresponding productivity estimates to infer price levels. Among other things, this requires a faith in the existence of firm-level neoclassical production functions, for which there is no real support, see Chapter 4, Section 2.2. A much more direct approach is to focus on businesses that produce a homogeneous product. Foster et al. Developed 17,669 establishment-level observations for producers of 11 distinct products over a 5-year time span. Foster, Haltiwanger, and Syverson 2005, 1, 17. Their findings add to the considerable body of evidence that, more productive businesses displace less productive ones. Lower-cost businesses grow faster and are more likely to survive, which points to a selection mechanism being at work. 1. But the link between survival and productivity is indirect, since the selection is on profitability, not productivity, and the latter is only one factor in the former. Within each industry, there are large and persistent differences in both physical productivity and revenue per worker. But the dispersion of the latter is smaller because young producers charge lower prices than incumbents firms. 1. The lower prices charged by firms with higher physical productivity can even offset productivity differences to such an extent that new firms and incumbents can have lower revenues per worker. Hence, physical productivity is negatively correlated with prices while revenue-based productivity is positively correlated with prices. Abstract. 1, 4. Taken by itself, low physical productivity is associated with high probability of exit. But so too is low price. This may seem puzzling at first, since low price is associated with new firms, and new firms have higher productivities. But if we recall that newcomers have a high attrition rate and a highly bifurcated distributions of losers and winners, and that weaker firms can have going out of business sales in order to dispose of their inventory, then the partial association between low prices and probability of exit makes sense. Andrews 1949, 87-88, Brunner 1952b, 738, Bryce and Dyer 2007. A revenue per worker is selling price times physical productivity, divided by a base year price assumed to equal 100. For empirical evidence on firm-level costs, capital intensity, and profits. If the theory of perfect competition was empirically valid, all firms within an industry would have roughly the same costs and profit rates, so that the average firm would be the regulating capital. The mobility of capital across industries would then equalize industry average rates of profit. Given that firms within an industry were alike, this would also equalize profit rates across firms. Then a pooled sample of firms from all industries might still exhibit variations in profit rates at any moment of time, but the time averages of firm-level profit rates would have to be the same. This is the expectation underlying most studies of firm-level profitability, and it is always falsified. The question is, why? Megna notes that the issue of profit rate differences is perhaps the fundamental issue in industrial organization. Early efforts to account for persistent profit rate differences adopted the viewpoint of imperfect competition, in which market power, collusion, and barriers to entry were the prime suspects. Subsequent studies also considered differences in efficiency. Still others try to attribute them to inadequate measures of profit and capital stock, particularly to a failure to measure intangible capital associated with advertising and R&D. But this latter effort was not successful. Megna and Mueller 1991, 631. Walton, 1987, x. 12, xx, studies the rate of profit of firms in four major sectors: manufacturing, wholesale, retail, and services. He finds that 50% of all businesses lie in the relatively narrow range of 29% to 45%, that within the 95% confidence limit the first three sectors have roughly the same average rate of profit, and that profitability decreases with asset size, so that small businesses are more profitable than large businesses. The latter result is quite general, for as the VUN, 2001, 270 and 271, notes, most studies find that profit rate declines with firm size, although a few do find the opposite. On the other hand, he points out that larger firms have also been found to have significantly lower levels of risk, higher survival rates, and cheaper access to capital markets. He undertakes to study this issue by using the CompuStat files maintained by Standard & Poor, consisting of 7,000 publicly traded firms on the U.S. stock exchanges for the period 1970 to 1989. His own sample is reduced to 935 because of his need for data on inventories and labor expense in order to construct a measure of value added. He converts the book values of assets to market values and then converts all variables into 1982 dollars using the GDP deflator. Finally, he divides the sample into small, medium, large, and extra-large groups of firms based on sample average asset ranges used in previous studies in the literature. Small firms are those whose average asset holdings, in real terms, are less than $25 million over their span in the data set. Medium firms are those with asset levels between $25 and $250 million. Large firms are between $250 million and $1 billion. Extra-large firms are those with assets over a $1 billion. 283. Table 7.7 lists his primary finding: the average profit rate falls with firm size, but so does risk and the failure rate. Indeed, when the average rate of profit is multiplied by the probability of survival, there is not much variation in the risk-adjusted profit rates. The VUN, 2001, 270 to 271, hypothesizes that the lower profit rates of larger firms are due to their lower labor productivity and uses estimated industry-level production functions to test his hypothesis. This aspect of his argument is curious on several grounds. First, as listed in the last column in Table 7.7, the VUN himself demonstrates that most of the variation in profit rates is explained by risk. Second, it is odd that he does not develop a similar table for cost margins, costs per unit sales, in relation to firm size, since it could have been easily calculated from his own database. Third, we have already seen that technical change tends to favor larger scales of production and that newer firms tend to have lower unit costs. This would suggest a hypothesis opposite to the VUN's: larger firms are more cost efficient, not less. But then their lower profit rates could only be explained by sufficiently higher capital intensities, which is something the VUN, like Salter earlier, does not investigate. It is possible to address all these questions directly. Standard & Poor's CompuStat segments file provides information on publicly traded companies in the United States for 1976 to 2009.18 data for total costs, sales, profit, sales, costs, and assets was compiled for companies in the United States, with all variables converted to 2005 constant dollars using the price index of capital goods. Company segments in each year in each nation were aggregated and assigned a unique ID number in order to construct a panel. Nonsensical entries with negative sales, costs, and assets were filtered out, and since the concern here is with the technology of viable firms, the sample was further restricted to positive profits, sales costs, and a single observation with a reported rate of return on assets, R, of 5,000% was removed. Finally, the financial sector was excluded due to the lack of an adequate measure of financial capital. 19 These steps reduced the sample size from 58,408 to 38,948. As in the VUN, 2001, firm size is defined by constant dollar asset size. Given the positivity of sales, costs, profits, and assets, it is convenient to utilize log-log regressions on these variables. The log form is consistent with Andrews's observations on the relation between costs and firm size, as illustrated in Figure 7.10, turns out to be generally superior to the levels form, and conveniently summarizes the elasticity of the variable with respect to firm size in a single estimated coefficient. Log-log regressions of sales, costs, and profits 20 versus assets were conducted in the panel data using cross-section fixed effects, a different intercept for every firm in a given nation, and the residuals were found to be 0.21. The regressions reported in Table 7.8 were then used to derive the corresponding elasticities of cost margins, cost/sales, capital margin, assets/sales, and profit rates, profit/assets, with respect to firm size, assets, as reported in Table July 9, 22. The elasticity estimates in Table 7.9 indicate that capital margins rise with firm size, but cost margins remain roughly constant. The latter result seems surprising at first because we have evidence that costs per unit output fall with plant scale, Andrews 1964, 82. Then if larger firms have larger plants, one would expect the same correlation across firms. However, we know that firms with lower costs tend to offer lower prices, so much so that costs per unit sales may be constant or even rise with firm size. Thus, the observed constancy of cost margins across firm size is quite consistent with larger firms having lower costs per unit output, as illustrated previously in Figure 7.6. Finally, profit rates fall with firm size, more or less in proportion to the extent which capital margins rise. Because of the likelihood that larger firms offer lower prices, we cannot separate out the effects of changes in capital intensity, capital per unit output, and selling price on the rate of profit or the cost and capital margins. We can nonetheless say that the ratio of capital intensity to unit costs rises with firm size. And this ratio rises unambiguously across firm size. This simple fact turns out to have profound implications for the path of the profit rate under price-cutting behavior, Section 7. The overall findings are very much in accord with the arguments in Andrews and Salter, and with Duvon's main findings on the rate of profit. 5. Empirical evidence on equalization of regulating rates of profit. The idea of profit rate equalization occupies a central place in all theories of competition. But the characterization of the underlying processes and of their outcomes differs substantially across theories. The theory of real competition conceives of profit rate equalization as a dynamic and turbulent process. Investment flows into an industry are motivated by the expected rates of return on the potential new investments that embody the reproducible best practice conditions of production, i.e., on regulating capitals, Cohen, Zinbarg, and Zeichel 1987, 387. Higher cost methods, most often represented by older technologies, are excluded because even though they are reproducible they are not competitive. On the other hand, conditions of production that rely on special locations and the like are also excluded because they are non-reproducible. Competition constantly weeds out the higher cost capitals, while technical change, which is one of the principal weapons of competition, constantly throws new ones into the fray. Shaikh 1978, 240-241. As Salter reminds us, individual capitals within an industry generally embody differing conditions of production. Salter 1969, 4-6, 48-49, 62-63, 95-99. Evaluations of potential profitability are undertaken by a heterogeneous set of investors. There is no single expected rate of return in any given industry, but rather a diverse set of expected returns continually revised in the light of actual outcomes. Point 23. Hence, classical economics typically focuses on the actual outcomes rather than on the various expectations that might have motivated them. In a growing economy, new capital flows are generally positive. However, if the regulating profit rates in a given industry are higher than the economy-wide average regulating rate, production in this industry will accelerate until the supply in the industry grows more rapidly than its demand. The rising excess supply will in turn drive down the industry's relative price, thereby reducing its regulating rate of profit. The latter may well fall below the general rate, which would then cause supply to grow less rapidly than demand, and so on. It should be noted that the changes in rate of growth of production which drive this process are brought about in the first instance by changes in the utilization of existing capacity and only later, if necessary, by changes in the rate of growth of capacity itself. The end result is the turbulent equalization of actual rates of profit on new investments, over some period of fat and lean years whose precise length depends on the industry in question. Mueller 1986, 8. 1990, 1-3, Botwinick 1993, ch. 5, Shaikh 1998b. It is only by tracking the movements of the regulating capitals over sufficiently long periods of time that we can assess whether or not these, risk-adjusted rates, are equalized in practice. Neoclassical theory operates within a static and perfectionist framework. Mueller 1990, 4. Free entry and exit is presumed to ensure that firms within any given industry all operate with the same, most efficient, method of production and all produce the same, homogeneous, product. Within any industry, over the short run competition leads to a single common price, and since these firms are identical, to a single common profit rate for each firm. On the other hand, over the long run, which like the short run is peculiarly timeless, competition between industries leads to a single common rate of profit in each industry. Since all firms within an industry have the same profit rate, and all industries have the same profit rate, all firms everywhere have the same profit rate. This is the fundamental neoclassical hypothesis about competition. Sraffian theory is quite similar in this respect because it typically makes three crucial assumptions. First, that all profit rates are exactly equal, which eliminates any profit rate differentials between industries. 24. Second, only one condition of production exists in any given industry, so that the regulating conditions are also the average ones. 25. This eliminates any profit rate differentials within an industry. The exception occurs in the theory of rent, where only the zero rent conditions of production are the regulating ones, i.e., the ones that participate in profit rate equalization. Ricardo 1951b, ch. 2, Sraffa 1960, ch. 11. The existence of more diverse types of privileged capitals may therefore be viewed as a generalization of the theory of rent. And third, the capital values assigned to older vintages are assumed to be such that their profit rates are exactly the same as that on the newest vintage. Even in neoclassical theory this is viewed as the ideal theoretical measure of the net capital stock. Gordon 1993, 103. Then under such conditions, all capitals have the same profit rate, so that the average profit rate on all capital in an industry is the same as the profit rate on its new capital. As in the case of neoclassical theory, we do not have to distinguish between firms and industries in assessing profit rate differences. Austrian theory takes a great step forward by emphasizing that competition is a process rather than some timeless state. A competitive process is viewed as one in which the forces of entry are strongly and rapidly attracted to excess profits, and in which they rapidly bid these profits away. Mueller 1986, 4. Implicit is the notion that this rapid process is also stable. Hence, whereas the neoclassical test is whether profit rates are more or less equal at any moment, the test of the Austrian theory of competition is whether markets are stable and quick. Jaroski 1990, 28. Schumpeterian economics emphasizes the constant creation, adoption, and displacement of technologies, much as Salter does. but the Schumpeterian approach tends to have little to say about intertemporal profit rate differentials. Evolutionary economics, with its similar emphasis on innovation and adaptation, also tends to suffer from the same lack of specificity. Mueller, 1990, 3-4, subsumes both of them under a general Austrian approach in which empirical analysis involves estimating the long-run centers of gravity of actual profit rates, testing for their risk-adjusted equality, and estimating their speed of adjustment. The generalized Austrian model of competition shares many features with the classical, Marxian one, except that it makes no distinction between regulating and non-regulating capitals. Thus, in the Austrian case, the null hypothesis is that all individual company profit rates converge to a single, competitive level, Mueller 1986, 13. As a result, empirically observed persistent differences in firm-level profit rates are viewed as prima facie evidence of non-competitive conditions, Mueller 1986, 9-12, 31-33, 130. This is quite different from the classical argument, in which profit rates are expected to always differ at any moment of time, with only regulating rates turbulently expected to be equalized over sufficient lengths of time. In actual practice, profit rates differ between industries, multiple methods of production coexist within any given industry, and vintages are seldom valued at the ideal level. Indeed, direct measures of capital stocks are not usually available, so they are constructed from observed gross investment flows on the basis of highly simplified assumptions about service lives and retirement patterns. Point 26. This introduces an unknown and possibly large error in the estimation of long-run levels of the rate of profit. Hence, if we are to consider the issue of profit rate equalization from a classical viewpoint, we must find a way to measure the rate of return on regulating capitals. Defining measures of average and regulating rates of profit. Even within a single firm, one must distinguish between the rate of profit on total capital and the rate of profit on more recent investment. The cost differences between older and newer capitals imply that they will have different profits margins, and if we evaluate their profit rates in terms of the initial capitals advanced for each type 27, appropriately adjusted for inflation, that is, in terms of their gross capital stock concept, OECD 2001, 31, their profit rates will also generally differ. This means that one cannot treat the average rate of profit in a firm as a proxy for its regulating rate. A similar problem exists at the level of an industry. Point 28. In both cases, the relevant measure for competition between industries is the rate of profit on recent investment. The rate of profit on total capital is the ratio of total profits to the current cost value of the capital stock. Using the current cost value of capital ensures that this is a real rate of return, i.e., inflation adjusted, since both the numerator and denominator are in current dollars, see Appendix 6.2.2. This is evident if we divide both numerator and denominator by a common price index. The rate of profit on total capital is itself the average of the current rates of profit on different types of capitals in the overall stock, including the profit rate on the newest types, i.e., on regulating capitals. The latter is the relevant rate because it represents the current rate of return on recent investment, the Keynesian marginal efficiency of capital, Calder 1957, 592. Let PIT equals the current profit on the most recent investment and the current cost of new capital. Then the rate of profit on new capital is. The problem now becomes one of approximating the current profit and current cost of new capital. At any moment of time, the current profit PT earned by a firm is the sum of the current profit on the most recent investment, and the current profit on all earlier vintages, the latter being the profit that would have accrued in the absence of recent investment. Notice that both the terms in equation 7.4 are in units of current currency. Let PT represent a common price index for the current and previous period. Then last period's profit as converted into current currency units is, so we can rewrite equation 7.4 to express the profits of new capital as the sum of the increment in total profits in current currency and an adjustment term that incorporates the effects of changes in prices, wages, efficiency, scale, and capacity utilization on the surviving elements of the previous year's capital, i.e., current older capital. Similarly, the current cost value of new capital is the past period's investment flow converted into current currency units. Then the rate of profit on new capital is where real profits and lagged real investment, and so on. The measurement of current profit on new capital therefore boils down to estimating the real profit of the current older stock of capital relative to the real profit of the same set of capital goods in the previous period, that is, of estimating the size of let represent real output, real wage, indirect business tax rate, employment, and productivity, respectively. As before, variables pertaining to older capital in the current period are denoted by, and so on. Let economic capacity and corresponding employment and productivity be denoted by, and so on, where capacity refers to the economically desirable point of production in a competitive long run, Coors 1986. Finally, let the capacity utilization rate. Since real profit is the difference between real value added net of indirect business taxes and the real wage bill, we can write the relative profit of older capital as the product of four distinct terms, the general contribution of each being expressed by the sign above it as discussed later. On the far right-hand side of equation 7.6, the first term is the ratio of the capacity utilization rates of older capitals in the current and previous year. If older and newer capitals in the current year have roughly similar utilization rates, this is the ratio of the gross rate of change of capacity utilization whose post-war average is a mere 1.002, Appendix 16.2, Data Tables.xlsx, sheet equals ch16 data. The middle term is the ratio of the current real capacity of older capitals to their own real capacity in the previous year, and since the average post-war retirement rate is about 0.04 per annum, Appendix 6.7.2.2.2 and Appendix 6.8.2.3, this ratio will be on the order of 0.96. Scrapping being induced by falling profit margins on aging capital, Appendix 6.4, the ratio of real profit margins represented by the last term in the expression is also likely to be on the same order, say 0.96. Then the product of the three terms is likely to be close to 1, so that and the expression for the rate of profit on new investment in equation 7.5 reduces to the ratio of the change in real profit to the last period's real investment, that is, to the real incremental rate of profit. In order to avoid well-known difficulties inherent in capital stock measures and hence in net investment, Appendix 6.5, I will use the directly observed measures of real gross investment, IGR, and real gross operating surplus, GOSR, for the corresponding net measures, the former adjusted to include the change in inventories and the latter expanded to include net monetary interest paid, Chapter 6, Section 8, and Figure 6.7, and Appendix 6.8.2.7. The incremental rate of profit has two major virtues. First of all, it is easily estimated because its two components, gross profit and gross investment, are widely available across countries and through time. Gross profit is defined as gross operating surplus, while gross investment is directly observed, unlike the laboriously constructed measures of the capital stock required to calculate the average rate of profit. Second, it has a direct interpretation as the marginal return on capital, Elton and Gruber 1991, 454, Damodran 2001, 695, provided one understands that like all real marginals, it is turbulent, spiky, and discontinuous as in the actual marginal cost curves of automobile plants displayed in figures 4.19 to 22 in Chapter 4, Section 4.3.29. It is, of course, true that aggregate capacity utilization undergoes substantial variations in shorter periods. This is less problematic in the present chapter because all of the various industry incremental rates under comparison will partake in this common aggregate fluctuation. The same is true in Chapter 10 when we compare the incremental rate of profit on new corporate capital to the stock market rate of return, since the latter is also an incremental rate, Shaikh 1998b, 397. However, when we compare the average rate of profit to the incremental rate as in Chapter 16, we encounter the difficulty that while the former is affected by the level of capacity utilization, the latter is affected by the change in capacity utilization. One solution is to smooth the level of real profit and real investment before calculating the incremental rate, as Christodolopoulos, 1995, does in this chapter. A simpler procedure that gives essentially identical results is to smooth the incremental rate of profit itself via the Hodrick, Prescott, HP, filter, as is done in Chapter 16. Before we turn to the empirical evidence, one last point requires mention. Chapter 6, Section 8, established that the appropriate measure of profit in both classical and Keynesian traditions was the net operating surplus, NOS, corrected for fictitious quantities of imputed interest, i.e., the sum of NEPA profit and monetary net interest paid. This is a measure of the overall efficiency of capital in its various uses, prior to its further division into net interest paid to creditors. It is what the business literature calls earnings before interest and taxes, EBIT. On the side of capital, the corresponding measure was the sum of fixed capital, plant and equipment, and inventories. Over 1947 to 2011, the correction for imputed interest adds about 10% to corporate NOS, which is the numerator of the rate of profit, Appendix Table 6.8.I.3, while the addition of inventories raises total corporate capital, which is the denominator of the rate of profit, by about 15%. The two corrections therefore offset each other to a great degree, so we can approximate the theoretically correct rate of profit by the ratio of NEPA corporate NOS to the new measure of gross corporate fixed capital stock as derived in Appendix 6.7.2 and Appendix Data Table 6.8.2.1, 7. For the analysis of trends in the aggregate rate of profit, the latter measure is indispensable, Chapter 6, Figures 6.2 and 6.5, but for intersectoral comparisons conventional net capital stock measures may suffice. Finally, it was shown that the theoretically appropriate measure of the incremental rate of profit was extremely well approximated by its NEPA equivalent, so here we may even dispense with both the imputed interest and inventory stock adjustments, Chapter 6, Figure 6.7. The studies discussed in the next section are compiled from a variety of available databases. Christodolopoulos, 1995, uses the 1994 International Sectoral Database, ISDB, of the OECD, which had data on industry goes, gross capital stock and gross investment. Shaikh, 2008, utilizes US NEPA sectoral data, focuses on for-profit industries, and is able to adjust for the wage equivalent of proprietors and partners and for industry inventories. Solfatis and Salaki, 2005, 14, use the change in gross profit over gross investment, whereas I used the change in goes over gross investment for the incremental profit rate data presented in Figure 7.21, Appendix 7.1. As we will see, despite such variations in the exact measures, the results are remarkably consistent. Incremental rate of profit are strongly equalized while average rates of profit are generally not. 2. Empirical evidence for OECD countries. The 1994 International Sectoral Database, ISDB, OECD 1994, contained annual data, now discontinued, from which it was possible to derive measures of gross profit, gross operating surplus, i.e., GDP minus indirect business taxes net of subsidies minus employee compensation, gross capital stock, and gross investment for various OECD countries. This was used by Christodolopoulos, 1995, to derive measures of average and incremental rates of profit by world industry. 30 In order to achieve comparability and consistency across countries and industries, the analysis was limited to the period 1970 to 1990 and focused on the profitability of 8 manufacturing industries: food, textiles, paper, chemicals, minerals, metals, and metal products, machinery and equipment, and other manufacturing products, across 8 countries, United States, Japan, Canada, Germany, France, Italy, Belgium, and Norway. World totals for gross profits, gross capital stock, and gross investment were calculated for each industry, using PPP exchange rates to make the translation into US dollars. This data was then used to calculate average and incremental profit rates for each industry at the developed world level. See Appendix 1 in Shaikh 2008. The first panel in Figure 7.13 displays average rates of profit on total capital for world manufacturing industries from 1970 to 1990, expressed as 3-year centered moving averages to smooth the data. As is often the case with average rates, most of them cluster around a common level, but some remain persistently above or below. Given the many problems associated with the capital stock measures, see Chapter 6, Section 8, and Appendix 6.5, it is not easy to distinguish between actual differences and statistical artifacts. The second panel displays the 3-year moving averages of the corresponding incremental rates of profit. We now see a very different pattern, with the rates crossing back and forth in exactly the manner anticipated by the classical theory of profit rate equalization. Data for more recent periods is derived from the U.S. National Income and Product Accounts, NIPA, for 1987 to 2005. 5 important innovations are introduced here. First of all, because gross operating surplus counts all the income of proprietors and partners as profit, a better measure of gross profit is derived by subtracting out the estimated wage equivalent, WEQ, of proprietors and partners. 31 This adjustment reduces the measured long-term profit rate in all sectors, the greatest effect being in industries with large numbers of self-employed people. For instance, in construction it reduces the measured profit rate from 90.5% to 20.7%. Second, for reasons previously discussed in Chapter 7, Section I remove the fictitious measures of gross profits, investment, and capital stock inserted by NIPA due to its treatment of homeowners as businesses renting their homes to themselves, Shaikh and Tonak 1994, 253 to 254, 267, Meyerhauser and Reinsdorf 2007. In the case of the real estate industry from 1988 to 2005, this imputed gross operating surplus amounts to 55.5%, and imputed capital stock amounts to fully 76%, of the corresponding industry totals. Third, where possible, estimated normal inventories were added to measures of fixed capital stock and estimated normal inventory investment added to fixed investment flows. These were based on NIPA data for manufacturing and wholesale/retail trade, on partial census data for the construction industry, and on flow of funds data for the insurance and banking industries in order to account for normal reserves, Panico 1983, 182. The inclusion of reserves raises the banking and finance industry capital stock by almost 50%, which in combination with the effect of the wage equivalent adjustment reduces the measured industry profit rate from 41.8% to 17.7%. Lastly, a particular effort was made to focus on industries that were composed largely of profit-driven enterprises and were deemed to be internationally competitive. This led to the exclusion of 31 the original 61 private industries on one of 3 grounds, because they were dominated by non-profit activities or enterprises as in arts, museums, educational services, and social services, because we lack sufficient data for an adequate measure of the wages of proprietors and partners as in legal, medical, and computer services, or because the industries in question were internationally non-competitive so that their rate of return on investments would not qualify as potential regulating rates, as was the case with textiles, mining, and domestic oil production, see Appendix 2 in Shaikh 2008. The first chart in Figure 7.15 presents the evidence on average profit rates from 1987 to 2005 for 30 U.S. industries. It is apparent that the previously noted patterns recur, rates of profit on total capital cluster around some central tendency, but a substantial number remain persistently above or below the average, defined by the overall profit rate of all included private industries. This is clearer in Figure 7.16, which displays the deviations of individual sectoral profit rates from the average rate of profit. Industries whose profit rates cross the average rate have deviations that change sign, as evidenced by the fact that these deviations cross the zero line shown on the corresponding charts. Of the 30 industries in this sample, 18 display this tendency, while 12 do not, 7 remain persistently above and 5 persistently below. It is instructive to note in industries whose deviations are highly trend, such as non-metallic minerals, machinery, printing, and rentals, their period average deviations can be bad proxies for their econometrically estimated long-term values even though their deviations do cross over at least once. Tzolfidis and Saliki get almost exactly the same results on the profitability of 20 Greek manufacturing industries. For average profit rates displayed in Figure 7.19, they find that visual inspection of the graphs does not provide strong support for the idea of the equalization over the 32-year span of their data, Tzolfidis and Saliki 2005, 19. On the other side, they find much stronger visual support for long-run equalization in the case of the incremental rates of profit displayed in Figure 7.20, 29. I will return shortly to their subsequent econometric investigations. Finally, more recent OECD data can be used to extend earlier investigations. Data on capital stock was too sparse to calculate average rates of profits for the OECD as a whole, but it was possible to calculate corresponding incremental rates of profit, Appendix 7.1. Figure 7.21 displays the deviations of incremental profit rates from their overall mean for various industries. The patterns are the same as in the previous case, incremental rates of profit cross back and forth a great deal. 3 econometric tests of profit rate equalization. The question of the profit rate equalization can also be addressed econometrically. On the side of average rates, the classic works are by Mueller, 1986, 1990. In the earlier work, he undertakes a study of the 1,000 largest manufacturing corporations of 1950, which represent the biggest firms in the most competitive market economy during 2 of the most prosperous decades that capitalism has ever produced, Mueller 1986, 2-3. His theoretical benchmark is the standard neoclassical model in which all firms within a given industry have the same rate of profit because they have the same technology and charge the same price, which the mobility of capital then equalizes across all industries. Hence, all firms are expected to have the same rate of profit over the long run. It follows that persistent differences in long-run profit rates are prima facie evidence of non-competitive conditions, Mueller 1986, 9-12. Mueller's ongoing objective is therefore to test this competitive environment hypothesis, that all individual company profit rates converge to a single, competitive level. Mueller's starting point is a long-run model which encompasses both competitive and non-competitive conditions. Let be the profit rate of the ith firm in year T and RT be the corresponding sample average. The general model posits that individual profit rates arrive at some long-run value equal to the economy-wide rate up plus some unknown structural premium. Let point 32 then the general model in equation, 7.8, says that should converge to 0 in the long run. Testing this hypothesis requires a model of the actual dynamic adjustment process, of which one simple possible example is. Running the preceding regression allows Mueller to identify 2 structural parameters for each industry, the speed of adjustment and which is the deviation of the long-run profit rate of the ith firm from the sample average. The standard competitive hypothesis is that each should be 0, which is soundly rejected, Mueller 1986, 13, 31-33, 130. This, in turn, implies that non-competitive conditions prevail, so Mueller goes on to examine the relation between his estimated long-run profit parameters and firm size, risk, growth, and various indices of monopoly power, 131-133, 138-141, 153. We will return to these issues in the next chapter. For now, it is important to recall that the average rate of profit of a firm is the average of the rates of return on its plants of different ages and technological vintages, whereas the regulating rate of profit is the return on its reproducible best practice plants. So it is not surprising that the equalization of regulating rates does not imply the equalization of average rates. In the neoclassical and Sraffian world of perfect competition, such differences disappear because the profit rate is only calculated on net capital stock. All older plants are valued in such a manner that they all earn the same rate of return as new plants. See Chapter 6, Appendices 6.3 and 6.4, and all firms are assumed to have effectively the same type of new plant, that is, they either have a single method of production or several which coexist in competitive equilibrium only because they have exactly the same rate of profit. Sraffa 1960, 38-39. Then, of course, all firms will earn the same rate of return in the long run. But in the real world the coexistence of non-equivalent methods of production is ubiquitous, so that there is no reason for long-run average and incremental rates to be equal. It follows that persistent disparities in long-run average profit rates discovered by Mueller do not contradict the equalization of regulating rates of profit. The latter needs to be addressed directly, graphically as well as econometrically. Tzolfidis and Salaki, 2005, 2011, undertake both tasks. Their charts for average and incremental rates of profit in Greek manufacturing were previously reproduced in figures 7.19 and 7.20. At the econometric level, they use a schema similar to Mueller's. 33 For average rates of profit, their findings lend some support for the notion of long-run profit rate equalization. 14 out of 20 industries have estimated long-run deviations of industry profit rates from the overall mean which are not statistically different from zero, while 4 have positive and 2 negative long-run deviations. On the other hand, for incremental rates of profit, all of the estimated long deviations are not statistically different from zero, which provides strong support for the equalization of regulating rates of profit. Tzolfidis and Salaki 2011, 20, 32, 33. Similar results are shown for Turkey in an equally excellent paper by Boss and Aries, 2012. 7. Debate on competition, choice of technique, and profit rate. We now return to the question of how the regulating capital itself is selected in competition. There are two key issues, the definition of costs and the determination of selling prices. The two are intrinsically connected because the competitive firm is a price cutter and the most successful competitive firm is the one with the lowest cost. Shaikh 1979, 1980d. I have emphasized throughout that classical economics, like business, is concerned with actual cost. On the other hand, neoclassical economics adds normal profit to actual costs on the grounds that firms are entitled to the surcharge, a claim which must surely come as a shock to the 25% of businesses who suffer losses each year. A similar divide exists on the matter of prices. Real competition treats the firm as an active price cutter. Neoclassical economics treats firms as price takers in the case of perfect competition, and as passive price setters in the case of imperfect competition. In either case, the firm passively seeks to satisfy the standard profit maximizing conditions. Andrews adopts the business notion of cost and price cutting, which puts him in the classical camp. But Harrod, despite his efforts to overturn the traditional theory of imperfect competition which he himself had helped found, remains mired in neoclassical notions of cost and pricing. Sraffa and his followers maintain a foot in each camp. They accept the classical and business notion of cost, yet they often treat the industry price of production, cost plus a normal profit, as something given to the individual firm just as in perfect competition. See Chapter 8, Section I.10. The question now is, what difference does it make to the selection of new methods whether firms are active price cutters or passive price takers? This issue has previously been raised in the discussion surrounding Tables 7.1 and 7.2 in Section I and is addressed in detail. We will now compare the current regulating capital C to two possible contenders D1 and D2, both of whom have lower unit costs at ruling input prices and wage rates, with D1 having a higher profit rate and D2 a lower one. Note that the differences in profit margins are robust, being on the order of 10%. In order to align the argument as closely as possible with the standard literature on the subject, I will assume that any price cut by one of the contenders is eventually adopted by the current regulating capital in order to stem losses in its market share. This implies that the total number of plants belonging to each type changes as market share flows from the old to the new plants. The implications of the price dispersion in the intermediate stages of such adjustments were previously discussed in Table 7.6 in Section 6.2. In Table 7.10, D1 has a lower unit cost and a higher profit rate at the ruling price of $100. Then under both price-taking or price-cutting behavior scenarios, D1 will be assumed to supplant C. In the standard price-taking scenario, it is supposed that firms will switch over to D1 in light of its higher profit rate at the ruling price, and that this higher profit rate would then attract more and more entrants until the increasing supply had driven the price down to a level consistent with the normal rate of profit, example the 16% previously enjoyed by C. In the price-cutting scenario, the firms employing D1 make room for themselves in the market by cutting prices. A price of $89.75 would make the profit rate in D1 equal to the general rate of 16% while reducing the profit rate in C to 15.1%, which would signal to C that it is doomed. But there is no reason to stop there. The whole point, after all, is to first gain market share, and sharply reducing prices is a central means. The tactic is classic: lower your prices. Profit margins will take a temporary hit, but the move would hurt competitors worse as you take market share and enjoy revenue growth for years to come. Darlin 2006, C1. Therefore, prices which lower the profit rate of D1 below the general rate are virtually certain, and introductory prices even below the costs of D1 are possible. The advantage in any such combat goes to the capital with the lowest cost. Of course, once the new regulating capital D1 has sidelined the old one, its price can be raised to make up for entry losses. A price above $98.375 would make its profit rate higher than the previous general rate, 16%. Actual or even a prospective new entry would sooner or later bring its price back down toward a level consistent with the general rate of profit, over cycles of fat and lean years. At this new average ruling price, D1 will have both the lower cost and the higher profit rate. So we can see that in the case of a capital such as D1, the two different notions of competition agree on the eventual outcome but differ sharply on the process and ensuing price paths. In the second case illustrated in Table 7.11, the two notions of competition differ even on the outcome. D2 has somewhat lower costs than D1, but its capital intensity is higher. See the shaded area in Tables 7.10 and 7.11. This is sufficient to make the profit rate of D2 lower than that of C at the ruling price of $100. According to neoclassical and Sraffian theory, D2 would not be chosen by any firm because C is more profitable, so that the former will remain the regulating capital. Table 7.112 contenders C and D2 at an initial ruling price of $10. However, from the point of view of real competition, the market price is not a given because the firm with the lower cost will drive the price down to the point where its own advantage is made clear. Table 7.12 illustrates the situation for a price of $84 at which both profit rates are lower than the general rate of 16%, but D2 now has the higher of the two. This is a perfectly general point which will be elaborated shortly. When costs differ, there is always a set of prices at which the lower cost firm has the higher profit rate. This does not mean that D2 has to drive the price down to that level. It has only to get the message across to its competitor that the future has arrived. With D2 as the new price leader, its price will have to rise back up to $101.30 to make its profit rate equal to the normal profit rate of 16%. At this new price, C would once again have the higher profit rate, 16.22%, but its scale would be shrinking in light of the fact that it had lost the cost advantage. Note that in both price-cutting scenarios the price falls at first as the new regulating capital shoulders the older one aside, and then rises to a level consistent with the new regulating rise of production. The price phases are different because price cutting to gain market share is different from price setting in response to industry demand and supply. In both cases, the new regulating capital is the one with the lower cost because competition is a selection process in which lower cost is the principal means to survival and growth. Foster, Haltiwanger, and Syverson 2005, 1. In the case of D1 the price of production falls relative to other prices, whereas in the case of D2 it rises. This latter outcome, we will see, is anathema to neoclassical and Sraffian economists. By implication, the standard approach would insist that a higher cost method can dominate so long as it has a lower price of production. The argument that C would not be viable because it has a higher cost seems similar to Harrod's claim that the MR equals MC point of maximum total profit would not be viable because it would represent a higher cost than the minimum point of the average cost curve, Harrod 1952, 150-151. Yet Harrod's neoclassical definition of cost includes normal profit, so his cost curve is really a price of production curve defined for all possible levels of output. What Harrod is really saying is that the output level which yields the lowest price of production will be chosen, which is not the same as saying that the method with the lowest operating cost at the minimum point of the average cost curve, defined in the business sense, will be chosen. Harrod's argument would in fact exclude method D2. 1. The feasible range of competitive prices. We now turn to the question of the feasible ranges of competitive prices, Shaikh 1999, 120-125. Let P equals unit price, UCS equals unit prime cost, materials and labor costs, unit capital, output ratio at normal capacity, unit fixed costs, depreciation, where the depreciation rate and unit average cost. For any plant in an industry with given input prices and wage rate the cost variables are given. Since it is an accounting identity that unit profit equals price minus unit costs, and since unit profit divided by unit capital is simply the rate of profit, R. This means that under given costs conditions the rate of profit on a given plant is a linear function of the selling price with slope, p-axis intersection UC, and r-axis intersection 0.34. 7.11. In the preceding tables both the new plants, D1, D2, have lower unit costs than C, so the former two intersect the p-axis at a points lower than that of C. But, so the D2 profit rate curve has a lower slope than D1 and that has a lower slope than C. With these particular values we also have, so that the corresponding curves intersect the r-axis at successively less negative values. Hence, as shown in figure 7.22, D1 retains its profit rate advantage over C at all prices below the initial ruling price of $100. On the other hand, while D2 starts out at a lower profit rate, it switches over to a higher one at prices below $85. As noted, the actual price need not fall to this level to impart the message that the other side has better cards. In real cost-cutting competition both D1 and D2 will dominate C. By contrast, the conventional notion of passive price competition says that C will dominate D2, which means that a higher cost method can be the ruling one. 2. Economy-wide implications of the choice of technique. Technical change takes place primarily through the adoption of new technologies, Salter 1969, 65. The discussion so far has been confined to a single industry with given input prices and money wages. We now turn to the implications for the economy as a whole. The standard price-taking argument derived from the theory of perfect competition claims that any new method of production will raise the profit rate corresponding to any given real wage. This is the point of view of all orthodox economists and almost all heterodox economists, Shaikh 1978, 1980d. The very notion of price-cutting real competition found in Marx, Andrews, and the business literature vitiates this claim. Money, wages, other prices, and the general rate of profit were previously assumed to be given to a firm in a single industry. But then a drop in the industry's selling price will lower the price of the real wage basket insofar as this industry's commodity enters directly or indirectly in the price of its components. It will also change the relative price of other commodities with respect to this one. Hence, it will change the profit rates in other industries. We must therefore consider what happens to relative prices once a new general rate of profit has been established at a given real wage. In other words, we are concerned with the pure effects of technical change on prices and profit. As before, I will illustrate the choice between a ruling method of production and a contender with lower costs. In scenario 1, the choice is between the ruling method and alternative 1. In scenario 2, the choice is between the ruling method and alternative 2. In either case, the alternatives have lower costs than the incumbent, but only in scenario 1 does the alternative also have higher profit rates. Hence, under the standard rules of choice of technique in which ruling prices are taken as given, only scenario 1 would result in a change in methods of production. Conversely, under the classical rule of price-cutting behavior, both scenarios would result in a change in technology. As constructed, alternative 1 is superior to alternative 2 since both have the same input structure but the latter has a larger fixed capital component. But the point here is to examine the choice between each alternative and incumbent, in order to bring out the salient differences between theories' competitive technical change in the simplest possible manner. Consider two goods, corn and iron, both of which enter as inputs in production of both commodities, into the wage basket of workers, and into fixed capital stocks, as inventories and machines. As before, Cn equals corn, Ir equals iron, and N equals the number of workers, and the depicted flows correspond to an 8-hour working day. I will illustrate the results using the Sraffian form of prices of production rather than the classical form. In the former, wages do not enter capital advanced, whereas in the latter they do. This is to make it clear that the real difference lies in the competing visions of competition. The initial physical flows are the same as those in Chapter 6, Table 6.10, but the prices are a bit different because of the exclusion of wages from capital advanced. We have already seen that the difference in outcomes between price-taking and price-cutting behavior arises from opposing movements of unit production costs and unit capital costs. But since the inventory component of capital costs also shows up in production costs, the real issue resides in the difference between circulating and fixed capital. Sheikh 1978, 242-246. The latter adds to the total stock of capital advanced and to depreciation. Total production flows consist of corn and iron used as inputs, wage goods, and depreciation, a fraction of fixed capital, while total capital stocks consist of inventories, equal in magnitude to inputs used up, and fixed capital. The sectoral wage baskets are derived from the same flows as in Table 6.5 of Chapter 6, a wage basket per worker of 4 Cn and 1 Ir applied to 10 workers in corn production and 5 in iron. Table 7.13 depicts the initial physical flows taken from Chapter 6 in which there is no fixed capital and hence no depreciation. Table 7.14 translates these flows into coefficient form by dividing each industry flows by the corresponding industry output shown in the last column. This allows us to calculate unit prices and the general rate of profit. 35 As in Chapter 6, prices are normalized to give money value of total output, sum of prices, of $875. Table 7.15 displays each sector's unit costs, capital costs, profit rate, and prices of production, operating cost plus profit calculated as the product of the profit rate and unit capital cost. We now consider two alternate methods of producing iron according to the coefficients listed in Table 7.16. Each of the alternatives uses 2 fewer workers and 25 Cn and 1 Ir less as inputs, and the first one uses 140 Cn and 8 Ir as fixed capital while the second uses 180 Cn and 12 Ir, which is a bit more. As noted, the point here to contrast standard and classical approaches to competitive pressures for new methods of production. Table 7.17 compares the operating costs and profits of the contenders with those of the incumbent at the pre-existing prices. Alternative 1 has a lower cost and a higher profit rate under pre-existing conditions, so both schools of thought would consider it to be superior to the existing method. Alternative 2 also has a lower cost than the incumbent, but has a lower rate of profit too. This is where a difference arises. Alternative 2 is superior to the incumbent in the price-cutting scenario but inferior to it the price-taking scenario. The preceding difference leads to yet another one. If Alternative 1 replaces the incumbent method of iron production at the same real wage, the general rate of profit will rise. The fact that Alternative 1 had a higher rate of profit than the general rate, i.e., 17.6% versus 16%, at the pre-existing prices means that its introduction adds a higher profit rate to the general pool, which in turn raises the overall general rate of profit from 16% to 16.5%. This is an example of the theoretical result known as the Okishio theorem. If a new method has a higher rate of profit at existing prices of production, its adoption will raise the general rate of profit. Okishio 1961. This is the same approach as in Samuelson and Sraffa. 36 Table 7.18 depicts the new situation which arises when iron Alternative 1 is adopted. The new ruling prices of production are based on the coefficients in the first section of Table 7.16. Note that at these new prices the new iron method, Alternative 1, still has a lower cost than the old one, $2.998/IR versus $3.393/IR, and is more profitable to boot, 16.5% versus 14.2%. The opposite result pertains if Alternative 2 replaces the pre-existing method of iron production at a given real wage. The general rate of profit falls from 16% to 15.2% as the lower profit rate of Alternative 2 is factored in. Table 7.19 shows the new prices of production for the coefficients corresponding to the second section of Table 7.16. Alternative 2 still has a lower cost than the old one, $3.067/IR versus $3.385/IR, and also has the lower profit rate, 15.2%, than the one the old method would earn at these new prices, 18.9%. But since it is still the lower cost method, Alternative 2 will continue to dominate the old method in real competition. In keeping with the traditional economics literature on the subject, all comparisons so far have been made in terms of ruling prices of production. But actual market prices are always different from these, and actual choices are always made in terms of actual and projected market prices. This implies that new methods will only be adopted if it is expected that their cost advantage is large enough to survive normal fluctuations in selling prices, wage rates, and the prices of inputs. At the level of the firm, technical change will only be viable if its benefits are robust. But at the level of an industry or a sector, such discrete switches may still be consistent with relatively small changes in average input-output coefficients. It is important to keep this difference in mind. 3 implications of the choice of technique for the time path of the general profit rate. Standard price-taking theory says that the higher profit method will be chosen even if it has a higher unit cost. Hence, it predicts that technical change will always raise the average rate of profit at a given real wage. As a corollary, the average rate of profit will fall only if real wages increase to the point where they reverse the unalloyed benefits of technical change. To put it differently, only an excessive rise in the real wage will produce a fall in the general rate of profit. So the problem can be linked back to excessive demands from workers, since capitalists would always prefer to hire extra workers at the lowest possible wage. Any fall in the rate of profit would therefore be due to a wage squeeze. This has long been the touchstone of Sraffian and almost all Marxian economists involved in this discussion. Sraffa 1960, 85-86, Okishio 1961, Steedman 1977, 124-129, Coors and Salvadori 1995, 402. The theory of real competition considers all, robustly, lower cost methods to be viable. If alternatives with higher and lower profit rates of alternatives were equally probable, technical change would not change the average rate of profit at any given real wage. Then any rise in the real wage would be excessive in the sense that it would lead to a fall in the general rate of profit. We would be in a world in which the profit rate would be solely an inverse function of the real wage despite ongoing technical change. Given that real wages do generally rise over time, one would then expect to observe a falling normal capacity rate of profit over time. This could be perfectly compatible with real wages rising more slowly than productivity, i.e., with declining real unit labor costs. In Marxian terms, this would correspond to a falling rate of profit with a rising rate of surplus value. On the other hand, if the two types of results were not equally probable, real competition could exhibit either rising or falling trends in the profit rate, or successive epochs of each, at given real wages. So the question becomes, what determines the probabilities of the two types of technical change? Note that this is specific to real competition, since under perfect competition technical change always raises the general rate of profit. The question was previously analyzed in an excellent paper by Park, 2001, utilizing a framework developed by Dumenil and Levy and Foley, DLF, Dumenil and Levy 1995b, 1999, Foley 1999, Foley and Michael 1999. Park, 2001, 103, finds that, when a constant real wage rate, or a low wage share, is assumed, Okishio's criterion does not induce a rising capital, labor ratio and a falling rate of profit, while Sheikh's criterion induces both, and, 2, when a high wage share is assumed, both criteria of technical choice induce a rising capital, labor ratio and a falling rate of profit. In what follows, I will address the same question within a modified version of the DLF framework, using the methodology first developed in Shaikh, 1999, 123 to 125. 37. This allows me to derive definite paths of the rate of profit over time. The path of the rate of profit depends on the interactions between two things: 1, the nature of innovation, that is, about the range of alternatives available to the firm at any moment of time, and, 2, the criterion for the adoption of a new method of production. The link between innovations and cost profitability is provided by equation 7.11, where now the cost margin on sales, and the capital margin, capital per unit money value of output. The cost margin is the sum of real unit labor costs and real material costs. In what follows, we will abstract from changes in real wages and relative prices, so changes only if labor requirements fall, labor productivity rises, and or real input requirements fall. Lower costs raise the potential rate of profit while higher capital margins lower it. This allows us to link any innovation possibility set to the corresponding cost margin, profit rate set through the relation 0.38. 7.12. In this light, we can recast the comparison between the incumbent iron production method and the two alternatives in Table 7.19 by dividing operating and capital costs by the going iron price of $3.837 and then taking the differences between the resulting margins of the alternatives and the incumbent. Then it is easy to see in Table 7.20 that alternative 1 is chosen under the assumption of perfect competition because it has the highest gain in the rate of profit, while alternative 2 is chosen under the assumption of real competition because it has the greatest reduction in unit costs. The simplest way to characterize the innovation possibility set is to assume that the distribution of is neutral in the sense that the possibilities span both positive and negative values of both variables in equal degree. This would describe a set whose boundary is roughly circular because all combinations are equally likely. Park 2001, 92-93. Figure 7.23 depicts such a set along with the real competition viability region defined by cost-reducing technical change, i.e., the shaded region 0. At time t, a particular combination appears on the horizon. If it falls in the viability region, it is adopted, and if not, the existing technique is retained. At time t+1 another possibility appears and is assessed, and so on. This process fills up the shaded viability region. Since the latter comprises a half circle, the long-run average result under real competition will be at the point shown there, which from equation 7.12 implies that. Thus, when technical possibilities are neutral in this sense, real competition yields a rising rate of profit at a given real wage, which is the same result yielded by the Ocasio theorem predicated on perfect competition. However, Marx argues that cost reduction comes at a price because there is an associated increase in capital costs, Chapter 8, Section I.2. In other words, there will be a negative correlation between and because lower operating costs will be associated with higher capital costs, Shaikh 1979, 1980d. Indeed, this is just what we found in the empirical analysis of CompuStat company data in Table 7.9, cost margins decline and capital margins rise with firm size, so that lower costs are associated with higher capital intensity. Therefore, the innovation possibility set will be skewed upward at negative and downward at positive, Foley 1999, Park 2001, as in Figure 7.24. Then it is easy to see that the shaded region representing the viability set for real competition will have an average value that is similarly skewed upward relative to the neutral set. When there is a negative trade-off between capital cost and operating cost, the long-run average outcome will imply. The impact on the path of the rate of profit can now easily be derived. For some positive constants A, let end, so that both variables change in the previously specified directions. 39 then. 7.13. In this expression, the term in the numerator is growing because implies. But the term in the denominator is growing faster because. So the faster growth of the denominator will predominate. Either the rate of profit will rise at first and then fall, or it will fall right away. 40. Notice that this will be true even if operating costs are falling faster than capital costs are rising, i.e., even if AB. The central reason for this is that operating costs are bounded between 0 and 1, while capital costs can in principle rise without limit. Figure 7.25 depicts the two possible paths of the rate of profit in real competition when lower costs are generally achieved through higher capital intensity, Shaikh 1984a, 1992a. These patterns are essentially the same as those derived via simulation in Park, 2001, Figure 7, Charts B and D, 102. It should be added that since the changes in key variables such as unit costs and capital intensity are small in any given year, any fall in the rate of profit would only manifest itself over a long period of time. Marx 1967 c. 239.41. The empirical issue was analyzed in Chapter 6 and Appendices 6.7 and 6.8 and the general patterns presented in Figures 6.2 and 6.5. Chapter 16 will address the implications for growth and for the crisis that unfolded in 2007. 8. Debates on perfect and imperfect competition. Theoretical views. This chapter is divided into a theoretical section analyzing various alternative views of competition ranging from classical to post-Keynesian economics, Section I, and an empirical section examining the empirical evidence on pricing and profitability, Section 2. Section I opens with the theory of competition in Smith and Ricardo, Section I.1, and in Marx, Section I.2. All three agree that competition tends to equalize wages rates and profit rates, so that market prices tend to gravitate around, but remain different from, natural prices, prices of production. Marx's analysis is the most sophisticated. He insists that the gravitation of market prices around prices of production is an anarchical movement. He also builds on Ricardo's notion of regulating capital, extending it from agriculture to all industry. Most important, he argues that competitive firms are active price setters and aggressive cost cutters, unlike the passive price-taking firms assumed in perfect competition, and that the creation of techniques with lower production costs generally requires greater investment in fixed capital per unit. These characteristics turn out to be crucial to his discussion of the choice of technique and the time path of the rate of profit. Post-classical economics generally retreated from the analysis of actual capitalism into the analysis of its idealized form, section I.3. Within the domain of competition, the price-setting and cost-cutting firm is replaced by a passive price taker, and the anarchical movement of market prices around prices of production is replaced by their exact equality within equilibrium as a state. It is here that we get the notion that competition prevails only if there is a multitude of small firms, each of which pursues its own myopic interest in disregard of the rest. From these foundations, in the midst of the long depression of 1873 to 1893, Jevons and Walras construct a story of a perfect market society, although Walras meant this to be a model for state-guided markets. This view dominates modern-day economics and is used to ground the claim that capitalism is socially optimal and economically efficient. Section I.4 argues that the theory of perfect competition is internally inconsistent. More precisely, that it requires irrational expectations. Given the traditional assumption that firms are exactly alike, it is obvious that any action undertaken by one of them must be undertaken by all. An increase of output by one will be attended by a similar increase by all others, so that market supply will expand significantly and the price will drop. But then it would be quite irrational for the perfectly competitive firm to expect that it can sell as much as it wants at any going price. Yet this irrational expectation is fundamental to the theory of perfect competition and to its macroeconomics. It follows that any theory of rational expectations cannot be grounded in the theory of perfect competition. Conversely, if firms are assumed to be sensible in their expectations, then the theory of perfect competition collapses. More generally, even mildly informed firms would have to recognize that they face downward sloping demand curves under competitive conditions. I argue that this understanding sheds an intriguing light on Sraffa's, 1926, critique of standard economics, on Keynes's treatment of the firm, and even on Paddington's attempt to get around this problem. Sections I.5 and I.6 take up the arguments in Schumpeter and the Austrian school, respectively. Schumpeter proclaims Walras's model of price-taking firms and maximizing agents to be the Magna Carta of economics, but then also says that its static nature is incompatible with the fact that new methods and new commodities are always being created. In the end, he proposes to extend the perfectly competitive model by allowing for perturbations. Innovations create temporary monopolistic profits while competition erodes them away. As the Austrian economist Dennis Müller points out, this perspective on competition has very little to say about any particular patterns of prices and profits. Austrian economics rejects the notion of perfect competition altogether, objecting to its underlying assumption of perfect knowledge, its vision of competition as a state rather than a process, and its depiction of firms as passive price takers rather than active innovators. The Austrian emphasis on competition as a process that bids away excess profits has many similarities to the classical theory of real competition. But it makes no distinction between regulating and non-regulating capitals, and its explicit assumption of rapid profit rate equalization is quite different from the turbulent equalization in real competition. Most important, it shares with neoclassical economics the claim that firms are servants of consumers and that union activity and government intervention are unwarranted intrusions into market processes. Sections I.7, I.8, and I.9. Examine the price theories of the monopoly capital, imperfect competition, and Keynescian and post-Keynesian schools, respectively. All make much of the fact that the scale of capitalist production and the centralization of its ownership has been rising over time. Given that they all implicitly or explicitly associate competition with perfect competition, this historical tendency is taken to imply that capitalism is increasingly characterized by monopoly power. Hilferding is the first to argue that by the end of the 19th century the concentration and centralization of capital had created a new stage of monopoly capitalism, but it was Lenin's seal of approval that makes this the official Marxist view. It is argued that because the reinvestment of the monopolists' profits in their own sectors would expand supply and drive down prices and profit, they are driven to export of capital to other sectors and/or to other nations. Sweezy, Barron, Mondale, Bellamy, Foster, and many others develop this line in various directions, emphasizing that it is more reality-based than theories of competition, which they typically conflate with perfect competition. Following Hilferding, Sweezy explicitly argues that it is useless to try to construct a theory of monopoly price because too many contingent factors enter into any particular pricing decision. On the other hand, Barron and Sweezy subsequently adopt Kalecki's monopoly markup price theory, which has become also the foundation for most of post-Keynesian economics. Within economic orthodoxy, the theory of imperfect competition is also driven by the attempt to make standard theory more realistic. This approach relaxes one or more of the assumptions of the theory of perfect competition, less than perfect knowledge, in order to focus on the uncertainty and indeterminacy of the future, non-negligible scale of production to justify the notion of barriers to entry, less than a very large number of consumers and firms to justify price taking, diminishing returns to justify flat cost curves, and the interactions of outcomes to justify consumption and production externalities. But the focus on profit maximization is generally retained, except that the condition is replaced by. Sraffa's 1926 article is the first salvo, followed up by Chamberlain and Robinson's treatments of imperfect competition. In the end, this effort was absorbed into standard theory, where it typically appears as a series of asides. Kalecki keeps refining his theory of price throughout his life, but the central themes are fairly clear: firms set prices, selling prices differ even for relatively homogeneous products, and lower cost firms charge lower prices. Yet these very same patterns can also be derived from the classical notion of real competition, Chapter 7. Then what is specific to Kalecki's formulation is the notion that price is set through a stable monopoly markup on costs, that the markup is somewhat constrained by the threat of price competition from rivals, and that long-run profit rates differ even across price leaders. These themes are repeated in the large and varied post-Keynesian literature. As in theories of monopoly capitalism and imperfect competition, competition is generally taken to be the same as perfect competition, safely interred in some distant past. Dude, 1987, 1995, provides an important exception in that he explicitly attempts to incorporate the profit rate equalizing impact of intersectoral capital mobility. Modern classical economics, section I.10, generally argues that competition has always played a central role in capitalist economies, and that market prices continue to be regulated by prices of production because profit rates continue to be roughly equalized across sectors. It is agreed that market prices gravitate around prices of production, so that the two are not the same. Nonetheless, the predominant approach is to treat the two as being close enough to justify treating them as equal. A second position insists that market prices fluctuate considerably during their gravitation processes, so that one cannot take the two as being the same. Actual decisions are then always taken in terms of fluctuating and uncertain market prices, for which prices of production only serve as references. A third position goes even further, arguing that one can dispense with competition, and hence with prices of production, altogether. The alternative is to treat prices and profit rates as random variables from the point of view of statistical mechanics. It is noted that this approach is perfectly consistent with the second position if the focus was on the deviations of prices and profit rates from their regulating centers. The final debate within modern classical economics involves the behavior of the firm. Almost all modern classical economists treat the competitive firm in the same manner as neoclassical theory, as a price taker. Those who assume that market prices are close to prices of production and that firms are price takers end up with a vision of competition, and a corresponding analysis of the choice of technique, which is conceptually linked to that of perfect competition. The weight here falls upon reswitching and similar phenomena. On the other side, there are those, including myself, who argue that competitive firms set prices and engage in price cutting, that competition is an antagonistic and destructive process, and that the choice of technique under these conditions yields distinctively different implications for the time path of the rate of profit. 1. Classical views. I. Smith. The central point of Smith's political economy is, as Schumpeter puts it, the understanding that the free interaction of individuals produces not chaos but an orderly pattern, Dobb 1973, 39. Competition is the central ordering mechanism because it makes market wages, rents, and profits generally gravitate around their respective natural levels. Where there are no insuperable obstacles, supply increases relative to demand when market variables are above their natural levels and decreases in the opposite case, which gives rise to a rough equalization of real wages, profit rates, and rental rates. The natural wage is this equalized rate, and natural profit and rents are those amounts that yield corresponding natural rates. The whole of the advantages and disadvantages of the different employments of labor and stock must, in the same neighborhood, be either perfectly equal or continually tending to equality. If in the same neighborhood, there was any employment evidently either more or less advantageous than the rest, so many people would crowd into it in the one case, and so many would desert it in the other, that its advantages would soon return to the level of other employments. This at least would be the case in a society where things were left to follow their natural course, where there was perfect liberty, and where every man was perfectly free both to choose what occupation he thought proper, and to change it as often as he thought proper. Every man's interest would prompt him to seek the advantageous, and to shun the disadvantageous employment. Pecuniary wages and profit, indeed, are everywhere in Europe extremely different according to the different employments of labor and stock. But this difference arises partly from certain circumstances in the employments themselves, which, either really, or at least in the imaginations of men, make up for a small pecuniary gain in some, and counterbalance a great one in others, and partly from the policy of Europe, which nowhere leaves things at perfect liberty. Smith 1973, 201-202. Since the market price of commodities encompasses market wages, profits, and rents, the reduction of these elements to their natural levels is the same thing as the reduction of market price to the natural price, 157-159. The actual price at which any commodity is commonly sold is called its market price. It may be either above or below or exactly the same with its natural price. The natural price is, as it were, the central price to which the prices of all commodities are continually gravitating. Different accidents may sometimes keep them suspended a good deal above it, and sometimes force them down even somewhat below it. But whatever the obstacles which hinder them from settling in the center of repose and continuance, they are constantly tending toward it. Smith 1973, 158, 160-161. How are we to understand the notion of gravitation in Smith? The conventional reading is that each market price settles down at its long-run equilibrium level, its center of repose and continuance. Such a reading is abetted by the fact that much of Smith's analysis is focused on the properties of natural wages, profits, and prices. But what Smith actually says is that while various factors keep market prices above or below natural prices, competition forces the former back toward, and even beyond, the latter. Market prices are continually gravitating around natural prices, Coors and Salvadori 1995, 5. This should be particularly obvious given that natural prices are themselves continually changing in the face of ongoing technological change and the varying distribution of the social product, Smith 1973, 165-166. When the quantity of any commodity falls short of the effectual demand, a competition will immediately begin among the buyers, and the market price will rise more or less above the natural price. Among competitors of equal wealth and luxury, the same deficiency will generally occasion a more or less eager competition. Hence the exorbitant price of the necessaries of life during a blockade of a town or a famine. When the quantity brought to market exceeds the effectual demand, it cannot all be sold at its natural price. The market price will sink more or less below the natural price. The same excess in the supply of perishables will occasion a much greater competition among sellers than in that of durable commodities. Smith 1973, 159. Finally, Smith emphatically distinguishes between cost and profit. Cost comprises the price of materials, and the wages of the workman, while profit is the difference between price and costs. 151. The fact that actual profit is turbulently regulated over the long run by natural profit does not justify treating profit as a cost. It is only much later that certain economists began to treat profit as a cost and natural price as a commodity's cost of production, which by now has become the conventional position. Dobb 1973, 46. To Ricardo. Ricardo's views on competition are similar to those in Smith. Competition equalizes wages, profit rates, and rents and enforces the gravitation of market prices around natural prices. Whilst every man is free to employ his capital where he pleases, he will naturally seek for it that employment which is most advantageous. He will naturally be dissatisfied with a profit of 10% or if by removing his capital he can obtain a profit of 15%. This restless desire on the part of all the employers of stock, to quit a less profitable for a more advantageous business, has a strong tendency to equalize the rate of profits of all, or to fix them in such proportions, as may in the estimation of the parties, compensate for any advantage which one may have, or may appear to have over the other. Ricardo 1951b, 88-89. However much the market price of labor may deviate from its natural price, it has, like commodities, a tendency to conform to it. 94. But such equalization processes must not be taken to mean that the market price is equal to the natural price. On the contrary, we must not be supposed to deny the accidental and temporary deviations of the actual or market price of commodities from their natural price. In the ordinary course of events, there is no commodity which is not subject to accidental and temporary variations of price. 88. It is then the desire, which every capitalist has, of diverting his funds from a less to a more profitable employment, that prevents the market price of commodities from continuing for any length of time either much above, or much below, their natural price. 91. Notice that Ricardo only says that market prices will not be much above, or much below, their natural price for any length of time. This is perfectly consistent with considerable deviations over shorter intervals. Even more so than Smith, Ricardo's primary focus is on the determination of natural wages, profits, rents, and prices. Like Smith, Ricardo makes a sharp distinction between materials, labor, and depreciation costs and the profit that is added onto these costs. This is particularly clear in his numerical examples from which he derives his famous 93% hypothesis about relative prices, Ricardo 1951b, 33-43, to which we will return in Chapter 9. One of Ricardo's great contributions to the theory of competition is the distinction between average and regulating conditions of production in his analysis of rent, that portion of the produce of the earth, which is paid to the landlord for the use of the original and indestructible powers of the soil, Ricardo 1951b, 67. Ricardo begins with the case in which fertile land is readily available. The best land, type B1, see Chapter 7, Section 4, Figure 7.2, will be cultivated first and its costs and capital requirements will determine the ruling natural price of agricultural goods, corn. At this stage, the best and only land in use will represent both the average and regulating conditions of production for corn. In the course of economic growth, the demand for corn will rise, which will raise the cultivation of land B1 until at some point all of it is fully utilized. Then the market price of corn will rise until it is high enough to cover the higher natural price associated with land of the next lower quality, type B2. Once the latter type of land is brought into use, the regulating conditions will have moved from B1 to B2 with a corresponding new higher center of gravity for market price. Since both types of land sell corn at the same price, and since the new price is higher than the natural price of land B1, producers on B1 will be earning profit which is greater than normal. This structural excess profit is what Ricardo calls rent, and he generally assumes that the owners of the land will be able to extract it entirely from the agricultural capitalist using the land. Even if the capitalist and the landlord are the same, one persona gets the normal profit and the other gets the rent. Ricardo assumes that over time this process extends to ever worse land, with ever higher, relative, prices of corn, 67 to 75. Thus, the gap between average and regulating conditions grows. Ricardo derives his theory of a long-run fall in the general rate of profit from this same process on the grounds that the ever-increasing share of rent in the total surplus diminishes the profit share, Ricardo 1951b, chs 6. 2 Marx. Marx's analysis of competition is much more complex than that of his predecessors but also more difficult to parse because of the unfinished nature of his work. Nonetheless, most of the essential points are clear. First of all, firms set the prices of the commodity they offer. Their owner must hang a ticket on them before their prices can be communicated to the outside world, Marx 1967a, 95. Second, firms constantly try to reduce their prices in order to gain an edge on their competitors. The very purpose of capital is to invest money to make more money. This is an intrinsically expansionary process, and it leads capitals to collide with one another within and between industries. From this point of view, competition, the action of the many capitals upon one another, Marx and Engels 1975, 97, is nothing other than the inner nature of capital, its essential character, appearing in and realized as the reciprocal interaction of many capitals with one another, the inner tendency as external necessity, Marx 1973, 414. These collisions are inherently antagonistic. Competition is the bellum omnium contra omnes, the war of all against all, Marx 1967a, 356. In its ongoing struggle, each individual capital strives to capture the largest possible share of the market and to supplant its competitors and exclude them from the market competition of capitals, Marx 1968, 484. Price cutting is founded upon cost reductions, so firms are compelled to constantly try to cut costs. Again, if one produces more cheaply and can sell more goods, thus possessing himself of a greater place in the market by selling below the current market price, or market value, he will do so, and will thereby begin a movement which gradually compels the others to introduce the cheaper mode of production, and one which reduces the socially necessary labor to a new, and lower, level. Marx 1967 c. 194. The battle of competition is fought by the cheapening of commodities. 626. Marx defines cost in the classical and business manner, as the sum of materials, depreciation, and labor costs. Neither profit nor interest enters into production cost, Marx 1967a, ch. 8.1. On the matter of profit, no capital is assured of any profit at all, let alone a normal profit implied by the average rate of profit. Indeed, losses are common and competition always ends in the ruin of many small capitalists, Marx 1967a, 626. By contrast, the rate of interest is a thing fixed daily in its general, at least local, validity, a thing which serves industrial and mercantile capitals even as a prerequisite and a factor in the calculation of their operation, Marx 1967 c. 368 to 369. The interest rate functions as a benchmark which partitions total profit into an interest equivalent representing the fruits of the ownership of capital as such, and a remainder called profit of enterprise which appears to the capitalist as the exclusive fruit of the functions which he performs with the capital, 374. Note that the interest equivalent is different from actual interest paid, which depends on the extent to which firms rely on borrowed funds, leverage. Competition between capitals in a single industry forces different producers of the same product to sell at a common price. On the other hand, capital also moves from one industry to another in search of higher profits, and this brings about the equalization of profit rates between industries. It therefore transforms the common selling price created by competition within an industry into the industry's price of production. What competition, first in a single sphere, achieves is a single market value and market price derived from the various individual values of commodities. And it is competition of capitals in different spheres, which first brings out the price of production equalizing the rates of profit in the different spheres. The latter process requires a higher development of capitalist production than the previous one. Marx 1967 c. 180. The movement of capitals is primarily caused by the level of market prices, which lift profits above the general average in one place and depress them below it in another. 208. Capital withdraws from a sphere with a low rate of profit and invades others, which yields a higher rate of profit. Through this incessant outflow and influx, it creates such a ratio of supply to demand that the average rate of profit in the various spheres of production becomes the same. 180, emphasis added. It is here that Marx makes a remark subsequently echoed in the full cost pricing hypotheses of Hall and Hitch and Andrews, Chapter 8, Section 6.1. Experience shows that if a branch of industry yields unusually high profits at one period, it makes very little profit, or even suffers losses, at another, so that in a certain cycle of years the average profit is much the same as in other branches. And capital soon learns to take this experience into account. 208. As soon as capitalist production reaches a certain level of development, the equalization of the different rates of profit in individual spheres to the general rate of profit no longer proceeds solely through the play of attraction and repulsion by which market prices attract and repel capital. After average prices, and their corresponding market prices, become stable for a time, it reaches the consciousness of the individual capitalists that this equalization balances definite differences, so that they include them in their mutual calculations. 209. The response of market demand to price is repeatedly invoked. In the case of demand, this moves in direction opposite to prices, swelling when prices fall, and vice versa. Marx 1967 c. 191. Once the tendency toward equal profit rates has become established, firms begin to incorporate their estimates of average long-run profits into the prices they set. But demand and supply continue to play a role. And, of course, what firms deem as normal is constantly revised in the light of changing general conditions. In the end, subjectively set market prices fluctuate ceaselessly around their objectively determined prices of production. There is never a state of affairs in which all profit rates are actually equal to some uniform rate of profit. The determination of market price by the price of production is not to be understood in the sense of the economists. The economists say that the average price of commodities is equal to the price of production, that is a law. The anarchical movement, in which rise is compensated by fall and fall by rise, which, looked at more closely, bring with them the most fearful devastations and, like earthquakes, cause bourgeois society to tremble to its foundations. It is solely in the course of these fluctuations that market prices are determined by the price of production. The total movement of this disorder is its order. Marx 1847, 174-175. Competition levels the rates of profit of the different spheres of production into an average rate of profit, through the continual transfer of capital from one sphere to another, in which for the moment, the profit happens to lie above the average. The fluctuations of profit caused by the cycle of fat and lean years succeeding one another in any given branch of industry must, however, receive due consideration. Marx 1967 c. 208. The oscillations of market prices, rising now over, sinking now under the natural price, depends on the fluctuations of supply and demand. The average periods during which the fluctuations of market prices compensate each other are different for different kinds of commodities, because with one kind it is easier to adapt supply to demand than with the other. Marx and Engels 1970, 208. All this involves a very complex movement in which, on the one hand, the market prices in each particular sphere, the relative prices of production of the different commodities, the position with regard to demand and supply within each individual sphere, and, on the other hand, competition among the capitalists in the different spheres, play a part, and, in addition, the speed of the equalization process, whether it is quicker or slower, depends on the particular organic composition of the different capitals, more fixed or circulating capital, for example, and on the particular nature of their commodities, that is, whether their nature as use values facilitates rapid withdrawal from the market and the diminution or increase of supply, in accordance with the level of the market prices. These are some of the reasons why the general rate of profit appears as a hazy mirage. Marx 1971, 464-465. The general rate of profit is never anything more than a tendency, a movement to equalize specific rates of profit. Marx 1967 c. 366. Regulating capital. Ricardo's analysis of differential rent founded the distinction between average and regulating conditions in agriculture. Marx adopts this theoretical innovation too and extends it to differential profitability in all industries. His own emphasis on ongoing technical change implies that persistent differences will exist among individual labor values and unit costs within any given industry. In volumes 1 and 2 of Capital, he generally abstracts from the implications of such differences, and in volume 3, he initially develops prices of production in this same manner, Marx 1967 c. ch. 9. But in the very next chapter, he turns to the question of effects of differences in the conditions of production within an industry. He begins from a situation in which average conditions regulate the market price and considers how supply from low, medium, and high efficiency producers might react to changes in demand. When all three conditions of production are able to adjust their respective rates of supply to the same degree, the average production condition continues to regulate the market price. However, this average itself may vary within certain limits depending on the weights of its three constituent types of production conditions. One extreme is a situation in which an increase in demand is ultimately regulated by the worst conditions of production. It is plausible that capacity utilization is inversely correlated with the efficiency of production. Then, if demand rises sufficiently, the bulk of the slack will be taken up at first by the best, then by the intermediate, and finally by the worst conditions of production. In this manner, the unit production costs of the least efficient producers may come to regulate the market price. The other extreme might arise if demand falls so much that the most efficient conditions of production dominate the average conditions and hence the market price, Marx 1967 c. ch. 10. If the supply is too small relative to demand, the market value is always regulated by the commodities produced under the least favorable circumstances and, if the supply is too large, always by the commodities produced under the most favorable conditions. 185. Regulating conditions come fully to the fore during his analysis of rent. Marx illustrates the issue by contrasting factories which derive their power from steam engines from those which derive it from natural waterfalls, 640. The latter have lower costs because their commodities are produced, or their capital operates, under exceptionally favorable conditions, i.e., under conditions which are more favorable than the average prevailing in this sphere, 641. But their price of production does not determine the market price because the power provided by the waterfall is not at the command of all capital in this sphere of production. As such, it does not belong to the general conditions of the sphere of production in question, nor to those conditions which may be generally established, 645, emphasis added. Hence, it is the price of production of capitals operating with the generally reproducible conditions, steam power, that becomes the regulating market price of production, 641. Marx spends the next 200 pages of Volume 3 analyzing the details of rent. These remarkably rich and insightful sections of his work are seldom mentioned in the Marxian literature, and even less understood. But the point is clear: regulating conditions must play a central role in the analysis of competition. Shaikh 1979, 3, 2008, 167. 2. Choice of technique. The fact that the battle of competition is fought by the cheapening of commodities and that lower cost methods beat out higher cost ones immediately leads to the question: does a cheaper method necessarily have a lower price of production? Adopting Marx's own treatment for the moment, production while price of production, where price of materials and depreciation per unit output, V equals unit labor costs, R is the general rate of profit, and C equals the price of total capital advanced per unit output. Marx measures these components in terms of prices proportional to labor values, i.e., direct prices, but such details do not matter to the general issue. Consider a potential new method with a lower cost, and a capital cost such that it also has a lower price of production. Alternately, the method may have lower costs but a capital cost sufficiently high enough to make its price of production higher. Finally, it might be that the new method has a higher cost but lower price of production. If competition selects methods with lower cost, then the first and the second will be viable, even though the latter has a higher price of production. On the other hand, if competition chooses the lower price of production, then the second will not be viable. The critical comparison is the one between the existing method and a new potential one with larger scale, lower cost but also a lower profit rate. Marx does not even introduce the notion of prices of production in Capital until Chapter 9 of Volume 3. As we well know, Engels assembled Volume 3 almost a dozen years after Marx's death from material in a first extremely incomplete draft in which there are numerous allusions to points which were to have been expanded upon later, without these promises always having been kept. Engels 1967, 2-3. Hence, we have relatively little material in Marx's writings that deal with the possible divergence between costs and price of production. What we do have, however, is the logic of Marx's argument. He is clear that price of production is different from cost, and that competition will select lower cost methods. He is also quite specific about the process: if one produces more cheaply and can sell more goods, by selling below the current market price, he will do so, and will thereby begin a movement which gradually compels the others to introduce the cheaper mode of production. Marx 1967 c. 194, emphasis added. So new entrants cut prices and thereby lower not only the profit rates of incumbents but also their own. 3 The first ones to make this move will compel the others to give in and eventually switch. This is a golden rule of competition: do unto others ere they do unto you. With this in mind, we turn to the one widely cited passage from the fragments in Volume 3 where Marx which appears to deal with such issues. No capitalist ever voluntarily introduces a new method of production, no matter how more productive it may be, and how much it may increase the rate of surplus value, so long as it reduces the rate of profit. Yet every such new method of production cheapens the commodities. Hence the capitalist sells them originally above their prices of production, or perhaps, above their value. He pockets the difference between their costs of production and the market prices of the same commodities produced at higher costs of production. Marx 1967 c. 264-265. What are we to make of the first two sentences? The new method cheapens the commodities, i.e., lowers their cost of production. Just a few chapters earlier he has told us that new entrants with lower costs will cut prices to gain market share, which means that they lower their own rate of profit. So while no capitalist would voluntarily lower his or her rate of profit, competition compels them to do so at every turn. Shaikh 1978, 245-246, 1979, 1980d, 81-82. The next sentence in the quoted paragraph says the capitalist sells them originally above their prices of production or perhaps, above their value. The two halves of the sentence say different things, selling above their prices of production is not the same thing as selling above their value. If new entrants cut prices below the existing market price, then they can only also sell the product above their own prices of production if the latter are lower than the ruling price of production. We have seen that lower cost methods may not satisfy this further requirement because they may have higher prices of production. On the other hand, methods with lower prices of production may have higher costs, in which case they would not cheapen the commodities. The only way to ensure both lower costs and lower prices of production is to treat normal profit as a cost, which Marx quite rightly rejects. The second half of the preceding sentence suggests that the new entrants sell their product perhaps above their value. Here we are on somewhat more secure ground because at the level of abstraction in Volume 3, costs are measured in prices proportional to labor values and the rate of surplus value, S/V, is assumed to be the same for all industries, so that a lower cost implies a lower labor value. It is therefore at least possible to have lower cost firms cut their prices, reduce their own rate of profit, and still originally sell their commodities above direct prices. Yet even this does not make much sense as general rule because, as Marx knew well, actual competitive tactics often involve price-cutting behavior which initially leads to low or even negative profits for the new entrants. In the end, the best that one can say is that the first part of the passage is quite consistent with Marx's general analysis of competition, but that the second part is not entirely consistent with his own treatment of prices of production. The third sentence then returns to the general argument by emphasizing that the key factor is a difference in costs. He pockets the difference between their costs of production and the market prices of the same commodities produced at higher costs of production. Why should we concern ourselves with such details? Because this issue is relevant to Marx's argument about the tendency of the general rate of profit to fall over time. It turns out that choosing methods with lower costs yields a very different trajectory for the general rate of profit than choosing methods with a lower price of production. Indeed, after discussing the choice of technique, Marx immediately goes on to say, competition makes the lower cost and lower value method general and subject to the general law. There follows a fall in the rate of profit, perhaps first in the sphere of production, and eventually it achieves a balance with the rest which is wholly independent of the will of the capitalist. Marx 1967 c. 265. We will see that choosing methods with lower prices of production will always raise the general rate of profit corresponding to a given real wage. On the other hand, choosing methods with lower costs may lower the profit rate depending on the relation between production costs and capital costs, and depending on the relation between unit costs and capital intensity. In the latter case, the focus shifts to the type of technical change. 3. Bias of technical change. This brings us to Marx's additional argument that lower production costs are generally associated with larger and more capital-intensive plants. Fixed capital contributes to production cost through annual depreciation, amortization, charges. If a machine with a useful life of 10 years costs $1 million, and if normal plant output is 10,000 units of output per year, then the average annual capital intensity is $100 per unit output and the annual depreciation charge is $10 per unit output. See Appendix 6.4 for a joint product treatment of depreciation. In modern terminology, a more capital-intensive plant would be competitively viable only if it lowered unit prime, materials and labor, costs more than it raised average fixed costs, so that average total costs fell. An analysis and comparison of the prices of commodities produced by handicrafts or manufacturers, and of the prices of the same commodities produced by machinery, shows generally, that, in the product of machinery, the value due to the instruments of labor, i.e., machines, relatively to the total value of the product, of a pound of yarn, for instance, increases. Marx 1967a, 390. The cheapness of commodities depends, cateris paribus, on the productiveness of labor, and this again on the scale of production. Therefore the larger capital beats the smaller. 626. These patterns are so familiar in actual practice that they have come to represent the normal form of technical change in detailed empirical studies and even in some management textbooks. Pratton 1971, 306-307, Weston and Brigham 1982, 145-147. Indeed, the implied negative correlation between production costs and both firm scale and capital intensity was strongly supported by the company-level data analyzed in Section 6.4 of Chapter 7 and summarized in Table 7.8. The last section of the previous chapter demonstrated that a trade-off between production costs and capital costs in the face of price and cost-cutting behavior leads to a downward trend in the general rate of profit even at a given real wage. From this point of view, a rising real wage is merely an exacerbating factor in an intrinsically falling rate of profit. This, I will argue, is the core of Marx's theory of a falling rate of profit. 3. The theory of perfect competition. Rise of the visions of perfect competition and perfect capitalism. Political economists before Smith understood that competition leads to the equalization of profit rates, i.e., to the regulation of market prices by prices of production. Smith's great contribution was to elevate competition to the level of a general organizing principle of economic society, McNulty 1967, 396. Ricardo and Marx built their own theoretical edifices on this foundation. From this came the notion of competition as real competition, always turbulent and occasionally earth-shaking. Post-classical economic orthodoxy turned from analyzing capitalism to gilding its image. The analysis of competition was one of many casualties in this changeover. The aggressive cost-cutting firm was remade into a passive price taker, and the market movement whose disorder is its order, Marx 1847, 174-175, emphasis added, was replaced by equilibrium as bliss. The early mathematical economists undertook this project in the name of analytical refinement, although their real service was something quite different. Cournot, 1838, was the first to reduce producer behavior to profit maximization and the first to solve the problem of how this might work by assuming that the individual producer can take the selling price as given, i.e., by assuming that the demand curve facing the firm is horizontal. To justify this, he had to assume that the contribution of each producer was negligible in the market, which he contended was a limiting situation as the number of rivals approached infinity, Stigler 1957, 5. This is the first step toward the modern quantity theory of competition with its attendant assumption of price-taking behavior. The consequences of the fatal error in this logic will be addressed in the next section. In the 1870s, advanced capitalism was hit by a general economic crisis characterized by recurrent recessions, crashes, and panics. Apparent recoveries failed again and again, leading to widespread gloom and feelings of tension, insecurity, and anxiety, throughout the period. Economic pessimism appeared to be deep-rooted and firmly entrenched. Businessmen, big and small, voiced their complaints about the short duration of recovery and the long periods of relapse, the commercial paralysis, the deplorable state of trade, the continuous distress, the dullness and disheartening monotony of the general market situation. With tiresome persistence they pointed to unprofitable business, with its detrimental effects on public welfare, and to the great risks they had to face in the struggle for survival. And, of course, anti-Semitism rose as the stock market fell. This woeful episode lasted so long that it became imprinted in historical memory as the Long Depression of 1873 to 1896, Rosenberg 1943, 59, 60, 64. What better a time could there be to foster a vision of perfect capitalism? Forge Evans, 1871, starts the process by defining competition in a perfect market as a situation in which all traders have perfect knowledge of the conditions of demand and supply, there is perfectly free competition, and implicitly a large number of sellers, Stigler 1957, 6. A decade later, in the depths of the 1873 depression, Edgeworth, 1881, published his list of requirements for perfect competition, which included large numbers of participants, infinitely divisible commodities, and unlimited self-seeking behavior, Stigler 1957, 7. But it fell to Leon Walras, 1877, to produce, in this same era, the most complete idealization of capitalism itself. Walras was strongly opposed to Marx, and his particular mathematical representation of freely competitive markets had a clear political agenda, Cirillo 1980, 297. 2. Walras and general equilibrium. Walras wove extant notions of perfect information and price-taking behavior into a static general equilibrium model, which still dominates orthodox micro and macroeconomics. 5. Preferences, technology, and initial stocks of capital goods and labor power were taken to be given. All agents were assumed to operate as traders in specific auction markets managed by all-seeing auctioneers. Trading began with an announced market price that elicited buy or sell offers for quantities of individual commodities and labor power, this price being in accordance with the assumed utility-maximizing behavior of individual participants. If the resulting quantity demanded in the given market price was not equal to the offered supply, the price would be appropriately raised or lowered. The change in price would in turn elicit a fresh round of buy and sell offers, until each market groped its way to a balance at some particular price. Of course, if some set of markets were not in balance, others would be affected by their continued tâtonnement, groping. In the end, the only possible state of rest was one in which all markets were simultaneously in balance general equilibrium, Hicks 1934, 342, Walker 1987, 854-861. The temporal dimension of Walras's story was a problem from the very start, because tâtonnement takes time. Hence, any actions undertaken by agents during the adjustment process would be based on disequilibrium prices and might lead to dark outcomes, Hicks 1934, 342-343. Walras got around this problem in the usual manner of mathematical economists. He simply assumed that agents would act only when their offers were accepted by the auctioneers, who in turn would grant their blessings only if all offers balanced in all markets. 6. Then there is no uncertainty, no speculation, no mistake, and no regret. Hence, no need, indeed no room, for money. No te preocups, Dios prevera. According to Walras, his model had been expressly designed, for the purpose of understanding economic reality, Walker 1987, 854, 860. In modern orthodox micro and macroeconomic analysis, it is still considered to be the best approach to a study of the nature of the complex interrelationships in a capitalist economy, and a valuable pedagogical and analytical tool, Can 1954, 324. Schumpeter lauds Walras's construction as the Magna Carta of economics, Can 1954, 324, celebrating its vision of how capitalism administers existing structures, Makowski and Ostroy 2001, 485. Others are somewhat less kind, arguing that it is essentially sterile of practical significance, seriously deficient as a description of actual capitalist economies, Can 1954, 324, and so radically unlike any past or present economy as to fail to be useful as even a highly abstract analysis of economic behavior, Walker 1987, 860. Walras, who considered himself a socialist, saw his model as a means of helping the policymaker understand the forces that were hindering the system from converging toward the ideal system of free competition, which to his mind was attainable in practice under the right conditions and under the proper guidance of the state, Cirillo 1980, 301-302. It is a particular historical irony that a self-proclaimed French socialist became the patron saint of Anglo-American supporters of corporate capitalism, Friedman 1955, 900, 908-909. 3. Walras and Marshall. Walras's general equilibrium approach was mostly unknown to the English-speaking world in the 19th century, and only appeared in English translation in 1954. It was Marshall's analysis that held sway there. Both Walras and Marshall had responded to Cournot's call to mathematize economics. Both began from the theory of exchange before they introduced production. According to Schumpeter, Marshall had even developed the core of a general equilibrium system. Marshall's initial treatment of competition was in the classical vein, and at this stage he expressly rejected the notion of perfect competition. Indeed, in the first two editions of the Principles, he assumed that firms face downward sloping demand curves. However, by the third, 1895, edition, he had switched over to horizontal demand curves and price-taking behavior, Stigler 1957, 9-10. In any case, Marshall's focus on partial equilibrium and particular markets was eventually trumped by Walras's analysis of general equilibrium, Hicks 1934, 338-339, 342-343, Kahn 1954, 323. For Walras and modern neoclassical economics. The essential elements of modern neoclassical economics are all present in Walras. First is the idealization of capitalism and of competition, its main engine, Makowski and Ostroy 2001, 479. Second is Walras's methodological individualism and economic subjectivism, in which the only economic explanation of a phenomenon is its reference back to individual acts of choice, Hicks 1934, 347-348. Third is his, and Jevons's, generalization of the principle of scarcity and of the concept of intensive diminishing returns from land and agriculture to all factors of production, including labor and capital, and all spheres of production, Coors 2006, 22. Fourth is the transformation of the term cost to include a normal profit rate, so that the equality between market price and cost in equilibrium is the equality of the former with the price of production, Hicks 1934, Coors and Salvadori 1995, 24. Fifth is the notion of dynamics as a moving equilibrium, which re-establishes itself automatically as soon as it is disturbed, Harrod 1956, 316. Sixth is the assumption that economic actions are only undertaken under equilibrium conditions because agents are pledged to act only when equilibrium has been achieved. Seventh is the corollary that full employment always obtains because actual employment only occurs in equilibrium, which is precisely when offers to work are matched by offers to hire at an equilibrium wage, Harrod 1956, 313. Finally, there is the notion that all agents are passive price takers. This last point requires some elaboration. The crucial role of price-taking behavior. Price-taking behavior is essential to the Walrasian story in several domains. During the tâtonnement process, individual agents are required to make decisions only about quantities, since they are assumed to take prices as given. This behavioral assumption is central to the derivation of individual demand and supply functions, and through them, to the definition of general equilibrium as a set of prices that equate quantity demanded and quantity supplied in all markets. For this to obtain, individual agents must take prices as given even when these prices are not equilibrium prices. It follows that individuals are not responsible for equilibrating markets, it is not an optimizing decision. Hence, one must invoke some anonymous market forces as the mechanism for price change when demands and supplies do not balance. This is why Walras needs to resort to a superagent, an exogenous, benevolent Walrasian auctioneer who adjusts prices until markets clear, Makowski and Ostroy 2001, 484. Price-taking behavior is also central to the marginalist foundations of the story, which portrays individuals as making optimal choices based on the relations between marginal utilities, marginal rates of substitution, and marginal rates of transformation. In this respect, passive price-taking behavior is a servant of marginalism and is central to the claim that the pursuit of self-interest leads to economic efficiency. 483. Critiques of the dominant Walrasian paradigm can be undertaken at the level of the theory of perfect competition, and at the level of the theory of general equilibrium, which rests on perfect competition. The former will be addressed here and the latter in chapters 12 and 13 in part 3 of this book. 6. Critiques of perfect competition. Neoclassical writers portray the development of perfect competition and general equilibrium as a movement toward greater analytical precision and rigor in which mathematics plays a decisive role. Stigler 1957, 5. But the capitalism they end up depicting is a parody, purged of all that is dark and destructive, its warlike competition reduced to a fairy ballet. Mathematics is not the problem here, but rather the use to which it is put. How can it be analytically rigorous to reduce human behavior to simple-minded utility maximizing, business behavior to passive profit maximizing, and the disaster-punctuated turbulence of competition to a blissful state of rest? It is one thing to analyze the properties of balance, as Marx does in his schemes of reproduction and Sraffa does in his pricing schemes. It is another to treat these balance conditions as actually existing states. We have already noted in preceding chapters of this book that mathematics can be used to formalize aspects of different visions, and subsequent chapters will provide more examples. But mathematics cannot rise above the level of the vision which it seeks, and frequently fails, to encapsulate. Neoclassical theory further claims that the pursuit of self-interest makes capitalism the ideal model of allocative perfection. Mikowski and Ostroy 2001, 480, 483. Unfortunately, the demonstration of this claim is made from the redoubt of the fantasy world of perfect competition and general equilibrium. Marx also emphasizes the historical superiority of capitalism. But in his case it arises from the relentless pressures of real competition which punish the weak and reward the strong. The cheap prices of commodities are the heavy artillery with which capitalism batters down all Chinese walls, with which it forces the barbarians' intensely obstinate hatred of foreigners to capitulate. It compels all nations, on pain of extinction, to adopt the bourgeois mode of production. It compels them to introduce what it calls civilization into their midst, i.e., to become bourgeois themselves. In one word, it creates a world after its own image. Marx and Engels 2005, 11. Critics have long pointed out that perfect competition contains very few of the elements of real competition. Mikowski and Ostroy 2001, 484. Hayek notes that so-called perfect competition is a hypothesized state characterized by the absence of all competitive activities. McNulty 1967, 399. Even Frank Knight, the great proponent of neoclassical theory, argues that perfect competition avoids any presumption of psychological competition, emulation, or rivalry, sharply unlike the contentious process of classical competition whose essence was the active effort to undersell one's rival in the market. McNulty 1967, 397-398. In perfect competition, firms take the market price as given. Then when demand and supply are unequal, the market is assumed to modify the price. But in the absence of a mythical auctioneer, there is no agent to undertake this adjustment. Hence the received theory of perfect competition contains no coherent explanation of price formation. Roberts 1987, 838. By contrast, in classical competition firms set prices and adjust them in the light of demand and supply. As Smith long ago noted, when supply exceeds demand, some part must be sold to those who are willing to pay less. And the market price will sink more or less below the natural price, according as the greatness of the excess increases more or less the competition of the sellers, or according as it happens to be more or less important to them to get immediately rid of the commodity. Smith 1973, 159. We have already noted that Marx and Andrews strongly concur on this point. 7. Externalities and the Coase theorem. Another criticism of perfect competition is that it fails to account for externalities. Within perfect competition, all agents are assumed to make their economic decisions without worrying what other agents are doing. A perfect market is therefore one in which humans do not interact directly. Then the effects of noise created by one person on the enjoyments of other persons presents a theoretical problem, as does the effect of pollution created by a given firm on the profits of other firms. The standard approach is to treat such interactions as goods in search of a market. It is the lack of market for externalities that causes problems. Varian 1993, 546. Markets being Pareto efficient in the absence of externalities, the ideal solution would be to give all agents property rights to their local space. If this could be accomplished, Pareto efficiency would supposedly be restored. The Coase theorem is a formalization of the notion that if property rights were completely defined and if there were zero transactions costs, the market outcome would efficiently internalize all externalities. Makowski and Ostroy 2001, 490. Where this is not practical, an alternate path would be to have other social institutions such as the legal system or government mimic the market mechanism to some degree and therefore achieve Pareto efficiency. 490. I have already commented in Chapter 3 on the impoverished theoretical foundations of standard theory. What is interesting here is that the whole treatment of so-called externalities is a classic example of Marx's notion of commodity fetishism. Human interactions are deemed to be perfect when they are entirely mediated by the things. Point 7. For perfect competition requires irrational expectations. I am the very model of a modern major general. I've information vegetable, animal, and mineral. I know the kings of England, and I quote the fights historical. From Marathon to Waterloo, in order categorical. I'm very well acquainted, too, with matters mathematical. I understand equations, both the simple and quadratical. About binomial theorem I'm teeming with a lot o' news. With many cheerful facts about the square of the hypotenuse. I'm very good at integral and differential calculus. I know the scientific names of beings animalculous. In short, in matters vegetable, animal, and mineral. I am the very model of a modern major general. Major General song from the Pirates of Penzance by W. S. Gilbert and Arthur Sullivan, 1879. Perfect knowledge contradicts perfect competition. The theory of perfect competition assumes that all firms are exactly the same and like modern major generals, that they have perfect knowledge of all relevant economic circumstances. Stigler 1957, 6, 11-12. These two assumptions turn out to contradict one another, so that price-taking behavior turns out to require that firms hold irrational expectations. On the other hand, even modestly informed expectations imply that firms cannot be price takers. Shaikh 1999, 120 and 25. One may think of the Walrasian parable as representing a particular, fictional, institutional framework that justifies price-taking behavior because there are auctioneers who set and adjust all prices. This is how Lang, 1938, and Lerner, 1944, posed the issue when they interpreted the Walrasian model as a model of socialism with central planners playing the role of the auctioneers. But in an actual capitalist market there is no wizard behind the curtain. How then can we justify price-taking behavior by firms in actual markets? From Cornott, 1838, onward, the traditional answer has been to posit that when firms within a given industry are all exactly alike and offer the same product at the same price, the effect on the market price of additional supply from any single firm gets smaller as the number of firms increases. At the limit this additional supply is supposed to have a negligible effect. Stigler 1957, 5-14. Each firm then is said to be justified in assuming that it can sell all that it wants in the market at any going price. Its individual demand curve is horizontal. This quantity theory of competition is the bedrock of the theory of perfect competition. The traditional argument actually involves a series of assumptions. All firms are alike, and all sell at the same price. When any of these identical firms makes a production decision, it does so in light of expected market demand, that is, in light of its perceived demand curve. The belief that the effects of its own supply on the market price is negligible implies that its perceived demand curve is infinitely elastic, i.e., horizontal, Nezhshi 1987, 535. And perfect knowledge ensures that its perceptions are, stochastically, correct. The difficulty is that the first and last assumptions contradict each other. If all firms are alike and are even moderately informed, they must know that they are alike. Then each individual firm must know that when it responds to some market signal, all other firms will do so in exactly the same manner at exactly the same time. Hence, each firm must know that when it increases production all others will do the same and the market price will fall. It follows that under the conditions of perfect competition each firm must know that it faces a downward sloping demand curve. It would therefore be completely irrational for any firm to assume that its demand curve is horizontal. The theory of perfect competition is internally inconsistent because it requires firms to hold irrational expectations. Conversely, if firms are assumed to be coherent in their expectations, then the theory of perfect competition collapses. An immediate implication is that the concept of rational expectations cannot be grounded in the theory of perfect competition. We will return to this point in part 3 of this book. 2. The failure of the quantity theory of competition. Price-taking behavior under perfect competition proposes that at some common market price P the firm will choose its output at the point where. Thus the marginal cost curve of a competitive firm is precisely its supply curve, Varian 1993, 366. Once the competitive firm understands that it faces a downward sloping demand curve, neoclassical profit maximizing behavior dictates that the optimal output Xi of the firm is at the point, not at. Then the marginal cost curve of an individual firm is not its supply schedule, and the market supply curve is not the sum of individual marginal cost curves. Indeed, since all firms are alike, the collective result would be an aggregate output determined by the condition. This is exactly the same condition as for a pure monopoly. It follows that coherent expectations imply that competition and monopoly give exactly the same market prices and outputs. The quantity theory of competition collapses. 3. The need for competitive firms to consider demand. These considerations lead to a further series of conclusions about the behavior of competitive firms. First, such firms must take the demand for their products into consideration. We will see in Chapter 13, Section 2, that this reinstates Keynes's notion that a competitive firm is demand-driven. 8 Second, they will generally face downward sloping demand curves, as originally assumed by Sraffa, 1926, 543, and Harrod, 1952, 144, 158 to 160. Marcuzzo, 2001, 86 to 88, says that Sraffa initially claimed that the market price set by firms facing downward sloping demand curves will be the same as that of a monopolist. Kahn objected to Sraffa's formulation on the grounds that imperfect competitive firms will take their competitors' actions into account, so that the slope of the anticipated demand curve facing each of them is less steep than that of a monopoly. My point is that Sraffa's formulation is exactly right when competitive firms do take the effects of their collective behavior into account. Third, we have already seen that downward sloping demand curves need not be derived from consumer utility maximizing nor linked to business profit maximizing. They can instead be derived from actual consumer behavior, see Chapter 3, and linked to the competitive price setting and cost-cutting behavior identified by classical and modern authors such as Andrews and Harrod, see Chapter 7, Section 6.1. 4. Keynes and Kalecki on macro implications. The fact that competitive firms must take demand into account sheds an intriguing light on Keynes's arguments in the general theory, GT. We know that Keynes based his arguments in the GT on the existence of atomistic competition. He was adamantly opposed to theories which derived persistent unemployment from rigid wages, or from monopolies, labor unions, minimum wage laws, or other institutional constraints on the utility maximizing behavior of individual transactors. The claim that the restoration of competition would take care of the unemployment problem was one of his pet hates, since he believed that even atomistic competition could result in persistent unemployment. Lejeunhufvud 1967, 403. Davidson, 2011, argues that Keynes's theory of effective demand does not require market imperfections, and Chrysler, 2002, 624-625, points out that even Kalecki's theory of effective demand was originally formulated on the assumption of free competition. In the GT, Keynes stresses that the amount of profit maximizing output and employment both in each individual firm and industry and in the aggregate depends on the amount of the proceeds which the entrepreneurs expect to receive from the corresponding output. Keynes 1964, 24. After the publication of the GT, he explicitly argued that individual firms try to forecast demand. Entrepreneurs have to forecast demand. They do not, as a rule, make wildly wrong forecasts of the equilibrium position. But, as the matter is very complex, they do not get it just right, and they endeavor to approximate to the true position by a method of trial and error. Contracting where they find that they are overshooting their market, expanding where the opposite occurs. It corresponds exactly to the higgling of the market by means of which buyers and sellers endeavor to discover the true position of supply and demand. Dude 1991-1992, 210. Keynes's exposition of his own micro-foundations is not completely consistent with his assumption that firms engage in demand-conscious behavior. In the GT, he sticks to the traditional first postulate of the classical theory of employment, in which profit-maximizing behavior implies that the real wage equals the marginal product of labor, i.e., Keynes 1964, 5, 17. This is derived from the familiar condition, which only holds if firms are assumed to be not conscious of demand because they believe that they can sell as much output as they choose to produce. Conversely, if he had been true to his own assumption that individual firms must take demand into account, then selling prices could no longer be taken as given and he would have had to throw over the first postulate. If he had retained the standard model of profit-maximizing behavior, the relevant condition would be MR equals MC, so that PMC in equilibrium as in imperfect competition, which he explicitly rejected. However, if he had instead adopted the classical notion that competitive production is determined by the minimum cost point, as Harrod did, 1952, 150-151, this problem would not have arisen. Keynes is on somewhat stronger ground in the case of households, since he explicitly rejects the second postulate derived from the conventional treatment of utility-maximizing behavior, 8-13. But even here his rationale is by no means clear. Clower 1965, 103-125. V. Paddington on macro implications. Paddington, 1989, the quintessential neoclassical macroeconomist, comes very close to admitting that the market experience will lead firms to consider demand while making supply decisions. Near the very end of his monumental work, he considers a situation in which a fall in demand leads to involuntary unemployment because prices and interest rates do not adjust enough to immediately restore full employment. Paddington 1989, 318. He reminds the reader that up to this point the analysis has proceeded on the assumption that firms believe that they will be able to sell all of their output at the prevailing market price. 319. In the face a drop in demand, he says, any plans based on this assumption will be invalidated, which must make firms drop their assumption of an unlimited market. 319, emphasis added. The demand limit of the market now suddenly enters into the firm's calculations, and in recognition of this, they reduce their planned production and employment, thus giving rise to involuntary unemployment among workers. 319-324. Paddington assumes that firms reduce their collective output to the point where they are able to sell it all. 321, which, of course, means that they are now suddenly possessed of an ability to correctly estimate the extent of market demand for their product. We end up in a situation in which output is equal to demand, but there is both unemployment and excess capacity. According to Paddington, the excess capacity would induce firms to lower prices in an attempt to increase their volume of sales, which means that firms are now also price setters. Sotto voce, we arrive at a classical vision of competitive behavior. When there is excess supply, firms lower their output to meet demand, and if there is excess capacity they lower prices to raise demand. Paddington claims that the latter response will lead us back to both full capacity and full employment, 323, which is precisely what Keynes and Kalecki deny. This discussion highlights the importance of the role of competition in macroeconomic analysis, to which we will return in part 3 of this book. 5. Schumpeter's views. Schumpeter's views are particularly striking. He lauds Walras's model, in which price-taking and maximizing behavior are central, as the Magna Carta of economic theory. But then he goes on to declare that its static nature is incompatible with the creative destruction inherent in the real process. The problem that is usually being visualized is how capitalism administers existing structures, whereas the relevant problem is how it creates and destroys them. As long as this is not recognized, the investigator does a meaningless job. As soon as it is recognized, his outlook on capitalist practice and its social results changes considerably. The first thing to go is the traditional conception of the modus operandi of competition. Economists are at long last emerging from the stage in which price competition was all they saw. But in capitalist reality, as distinguished from its textbook picture, it is not that kind of competition which counts, but the competition from the new commodity, the new technology, the new source of supply, the new type of organization, the largest scale unit of control, for instance, competition which commands a decisive cost or quality advantage and which strikes not at the margins of the profits and the outputs of the existing firms but at their foundations and at their very lives. This kind of competition is as much more effective than the other as a bombardment is in comparison with forcing a door, and so much more important that it becomes a matter of comparative indifference whether competition in the ordinary sense functions more or less promptly. The powerful lever that in the long run expands output and brings down prices is in any case made of other stuff. Schumpeter 1950, 1984, cited in Mikowski and Ostroy 2001, 485-486. Perfect competition implies free entry into every industry. If our economic world consisted of a number of established industries producing familiar commodities by established and substantially invariant methods, and if nothing happened except that additional men and additional savings combined to get up new firms of the existing type, then impediments to their entry into any industry they wish to enter would spell loss to the community. But perfectly free entry into a new field may make it impossible to enter at all. The introduction of new methods of production and new commodities is hardly conceivable with perfect and perfectly prompt competition from the start. And this means that the bulk of what we call economic progress is incompatible with it. Schumpeter 1950, 1104-1105, cited in Mikowski and Ostroy 2001, 486. This sounds almost like Marx, although it is hard to imagine Marx extolling Walras's vision of capitalism, or of socialism, for that matter. But then Schumpeter goes on to say, as a matter of fact, perfect competition is and always has been temporarily suspended whenever anything new is being introduced automatically or by measures devised for the purpose, even in otherwise perfectly competitive conditions, emphasis added. So in the end Schumpeter does not reject perfect competition, he merely repairs it by allowing for perturbations due to bursts of innovations. These create temporary monopolistic profits for the innovators, but competition from imitators then drives the excess profits back to zero. Another round of innovations restarts the process, and so on. Point 9. Schumpeter's extension tells us very little about the expected patterns of prices and profit rates, so that his perspective remains just that, a perspective on the nature of competition rather than a model of the competitive process. Müller 1990, 3.10. 6. Austrian views. Hayek. Although Schumpeter was from Austria, he was closer to the Walrasian school than to the Austrian school of Hayek, von Mises, Kürtner, and Müller. For Hayek, Competition is essentially a process of the formation of opinion. By spreading information, it creates that unity and coherence of the economic system which we presuppose when we think of it as one market. It creates the views people have about what is best and cheapest, and it is because of it that people know at least as much about possibilities and opportunities as they in fact do. It is thus a process which involves a continuous change in the data and whose significance must therefore be completely missed by any theory which treats these data as constant. Hayek 1948, 106, High 2001, 355. Hayek rejects the notion of perfect competition as a useful depiction of actual competition, or even a valid benchmark from which business behavior may be constructively assessed. Perfect competition is a static fiction predicated on invalid assumptions, whereas actual competition is a dynamic process whose essential characteristics are assumed away by the assumptions underlying static analysis. Hayek 1948, 94, High 2001, 343. The standard assumption of perfect knowledge is pernicious because nothing is solved when we assume everybody to know everything. When the real problem is rather how it can be brought about that as much of the available knowledge as possible is used. The answer lies in asking what institutional arrangements are necessary in order that the unknown persons who have knowledge specially suited to a particular task are most likely to be attracted to that task. High 2001, 343 to 344. In the case of business, this means institutions that encourage and reward entrepreneurs. In the case of consumers, this means activities such as advertising and other informational functions of markets. 343 to 345. At any particular time, there will generally be only one producer who can manufacture a given article at the lowest cost and who may in fact sell below the cost of his next successful competitor, but who, while still trying to extend his market, will often be overtaken by somebody else, who in turn will be prevented from capturing the whole market by yet another, and so on. Hayek 1948, 102, cited in High 2001, 351. This is a fully competitive sequence of events that cannot be reduced to the lifeless state represented by perfect competition. 2. Von Mises. Von Mises's angle is somewhat different. His central point is that all social systems engage in some form of social competition. In a totalitarian system, social competition manifests itself in the endeavors of people to court the favor of those in power. In the market economy, competition manifests itself in the facts that the sellers must outdo one another by offering better or cheaper goods and services, and that the buyers must outdo one another by offering higher prices. High 2001, 381. In a market society, it is consumers who rule. Their buying and abstention from buying is instrumental in determining each individual's social position. Their supremacy is not impaired by any privileges granted to the individual's co-producers. 275. Hence, the existence of trade barriers, privileges, cartels, government monopolies, and labor unions is merely a datum of economic history. 279. 3. Kürtner, like Schumpeter, emphasizes the critical role of the entrepreneur in the Austrian vision of competition. The neoclassical vision of competitive equilibrium grounded in perfect knowledge is completely incompatible with entrepreneurial activity, since the latter is predicated on the opportunities afforded by disequilibrium and imperfect knowledge. In equilibrium there is no room for the entrepreneur. When the decisions of all market participants dovetail completely, so that each plan correctly assumes the corresponding plans of the other participants and no possibility exists for any altered plans that would be simultaneously preferred by the relevant participants, there is nothing left for the entrepreneur to do. Makowski and Ostroy 2001, 486. 4. Mueller's great contribution has been to focus on the empirical relevance of the central proposition of the theory of perfect competition. The law of one price assumes that all homogeneous products sell at the same price, and free entry and exit is assumed to result in all firms having the most efficient technology. Since firms are alike and sell their product at the same price, all firms within a given industry will have the same profit rate in the short run. In the long run, profit rates will also be equalized across industries. Hence, in the long run, all firms, regardless of the industry in which they are located, will have the same rate of profit. This provides Mueller with his null hypothesis: company profit rates will all converge to some common rate of profit in the long run. It follows that the existence of persistent differences in long-run profit rates would be prima facie evidence of non-competitive conditions, which is precisely what he finds. Mueller 1986, 1-12, 31-33, 130. We will return to other aspects of his work later in this chapter during the discussion of the empirical evidence associated with oligopoly theory. V. General assessment of Austrian economics. Economists in the Austrian tradition firmly reject the theory of perfect competition. They object to the underlying assumption of perfect knowledge, Makowski and Ostroy 2001, 480. They object to the vision of competition as a situation rather than as a process, and to the depiction of firms as placid price takers, which leaves no room for the more entrepreneurial aspects of economic behavior. Kertner 2001, 357-358, Makowski and Ostroy 2001, 483. In place of the neoclassical notion of equilibrium as a state of rest, they emphasize that a competitive process is one in which the forces of entry are strongly and rapidly attracted to excess profits, and in which they rapidly bid these profits away. The crucial assumption in the Austrian theory of competition is that markets are stable and quick. Jaroski 1990, 28. I have already argued in Chapter 7, Section 6.5, that the generalized Austrian model of competition shares many features with the classical theory of real competition. But there are also significant differences. Austrian economics makes no distinction between regulating and non-regulating capitals. The Austrian assumption of rapid profit rate equalization is quite different from profit rate equalization over turbulent cycles of fat and lean years. The Austrian vision also shares several central features with the neoclassical one. Firms are viewed as servants of consumers, union activity and government intervention are generally viewed as unwarranted intrusions into market processes, and, of course, there is no hint of class or class conflict. It is difficult to imagine an Austrian economist issuing Adam Smith's forever relevant warning against masters who collude everywhere to hold down wages and raise prices, landlords who reap where they have never sown, and traders whose general interest is to deceive and oppress the public. Smith 1937, ch. 6, 151-153, 232, 358-359. 7. Marxian monopoly capitalism theory. The Marxian monopoly capitalism school builds on Marx's argument that the scale and capital intensity of production and the centralization of ownership increase as capitalism develops. According to this school, this process leads to a growing monopolization of capital, so that at some point in the late 19th century monopoly supersedes competition and ushers in a new stage of capitalism. With competition no longer dominant, its objective laws of prices and profit rates give way to power-driven outcomes. Hence, Marx's argument about the concentration and centralization of capital is said to ultimately negate his own analysis, the competitive laws of value. Hilferding was the first to advance this view, but it was Lenin's imprimatur that made it central to Marxist discourse. Sweezy 1981, 258, 298, Hilferding 1985, 228, 235. Hilferding argues that the rising scale and capital intensity of production makes it more difficult for capital to enter and to leave certain sectors, which impedes the mobility of capital needed to bring about equalization of profit rates. He emphasizes that under competitive conditions both large and small-scale sectors would have profit rates below the average rate, the former because the difficulty of writing off large-scale investments causes firms to hang on even when profit rates are low, the latter because the ease of entry in small-scale sectors tends to drive down the profit rate. But big capitals have the means to suppress competition and raise their rate of profit through cartels, combines, consortiums, mergers, and vertical integration. These capitals are also most closely linked to big banks that provide them with the credit needed to make large-scale investments, and it is in the interest of these banks to enhance the monopoly power of their clients. In the end, the big banks end up controlling even the monopoly industries they finance, which is why Hilferding calls this the phase of finance capital. Sweezy 1981, 258, 298, Hilferding 1985, 228, 235. Cartelized industries are said to achieve higher profit rates by raising prices and limiting the growth of supply. But according to Hilferding, we cannot say exactly how their prices are set or their supply is curtailed because such actions depend on a host of subjective factors. What we can say is that the need for cartels to limit the growth of their own supply in the face of their exceptionally large profits, makes the export of capital an urgent matter. Hilferding 1985, 233-234, Zonensane 1990, 19-20. Lenin was strongly influenced by Hilferding and based his own theory of imperialism on the enhanced need for capital exports in the monopoly stage. Baron and Sweezy also laud Hilferding and make it their project to extend his line of argument in the 20th century. They note that due to influence of Hilferding and Lenin, it has become a widely accepted tenet of Marxist theory that by the end of the 19th century the concentration and centralization of capital had proceeded to the point of transforming capitalism from its competitive stage, upon which Marx had focused attention, to a new stage of finance capitalism, imperialism, or monopoly capitalism. Sweezy 1981, 60. They also point to the subsequent influence of Kalecki and Steindl, to whom we will return, in advancing this line of argument. Zonensane 1990, 3. Sweezy accepts Hilferding's claim that rising scale, capital intensity, and centralization of capital led away from free competition toward monopolies. Sweezy 1942, 254. But he argues that the dominance of big banks in the early stages was merely a passing phase. The important point, according to Sweezy, is the rise of monopoly, which is why he prefers the term monopoly capital over Hilferding's finance capital, 266-269. Nonetheless, Hilferding's central point is deemed correct. The objective laws of competition are superseded by contingent outcomes based on various degrees of monopoly power. 258. Monopolists have the power to limit supply and hence to raise price, but it is useless to search for a precise theory of monopoly price because too many diverse factors enter into the determination of a given monopoly price to permit the construction of a precise theory. 270-271. In the end, monopolists gain higher profits at the expense of the competitive sector, which triggers the rise of monopolies in the latter so that monopolization spreads. 273. At a purely abstract level, a uniform degree of monopoly could conceivably bring about roughly equal profit rates. But monopoly is always unequally spread, so in practice we get a hierarchy of profit rates that are highest in the most monopolized, large-scale, sectors and lowest in the most competitive, small-scale, ones. Sweezy 1942, 273-274, 1981, 302. Monopolies slow down the expansion of their productive capacity in order to maintain their higher rates of profit. Sweezy 1981, 302, so that capital crowds into more competitive areas. Sweezy 1942, 285. They also enhance the labor-saving bias of capitalist technical change. Other things being equal, the level of income and employment under monopoly capitalism is lower than it would be in a more competitive environment. Sweezy 1981, 285, 302. On a world scale, monopoly prevents the direct equalization of profits rates between nations. But then capitalists in low-profit countries will export capital to higher-profit countries, so that rates of profit will now tend towards a single level, allowing as always for the necessary risk premiums. 291-292. It has to be said that this aspect of Sweezy's analysis of the effects of monopoly is contradictory. He tells us that within any country the export of capital from high-profit monopolistic sectors to competitive sectors will drive down profit rates in the latter. 285. Yet between countries, the export of capital from high-profit countries to low-profit ones is supposed to equalize profit rates. 293. Mondale also argues that the growing size of enterprises leads to a transition from competitive to monopoly capitalism at the end of the 19th century, Mondale 1968, 2:400. Monopolies aim above all to safeguard and increase the rate of profit by controlling the free flow of capital and eliminating competition, 2:419. Still, if the difference between the rate of profit in monopolistic and competitive sectors gets to the point where the latter are faced with ruin, then they are forced to try to break into the former. These attempts bring about a revival of competition, which brings the profit rates in the two sectors closer together, 2:424. At the same time, monopolies are periodically at war with each other, although this is seldom carried on through price cuts, 2:435. In the end, the age of freely competitive capital gives way to the stage monopoly capital in the advanced countries in which a few firms completely dominate successive markets. Banking capital increasingly merges with industrial capital into finance capital. A few very large financial groups dominate the economy of each capitalist country. These giant monopolies divide the world markets of key commodities between themselves, and the imperialist powers divided the globe into colonial empires or semi-colonial spheres of influence. Mondale 1975, 62-65, 595. All branches of the Marxian monopoly capitalism school share the central premise that competition declines as firms become larger, more varied, and fewer in number. This is the foundation for their arguments. Yet it is solely within the theory of perfect competition that an industry is deemed fully competitive only when its firms are infinitesimal price takers, identical in cost structure and infinite in number. No such requirement exists within the classical theory of real competition, in which firms are always price setters and larger scale is the imminent means of reducing costs in the competitive battle. Chapter 7, Section V. Coming from a somewhat different angle, Andrews and Brunner also explicitly reject the idea that the size of a firm is an index of its lack of competitiveness and that the degree of competition within an industry is inversely related to the number of firms. Brunner 1952b, 741. It is striking how greatly the school depends on the conventional notion of competition as its foil, and how little knowledge it displays about its own supposed point of departure. Marx's theory of competition, Zonensane 1990, 6, 21-22. A recent statement from the Marxian monopoly capitalism school makes these foundations explicit. It begins by claiming that the neoclassical theory of competition, as expressed by none other than Milton Friedman, is the paradigmatic notion of competition in economics. Competition is explicitly identified with the large number and small size of firms, in which the typical business unit has no significant control over price, output, investment, as in neoclassical economic notions of perfect and pure competition, which is common to all economics. This is the principal meaning of competition in economics. Foster, McChesney, and Jonna 2011. Point 11. On the other hand, as Friedman states, monopoly can be said to exist when firms have significant monopoly power, able to affect price, output, investment, and other factors in markets in which they operate, and thus achieve monopolistic returns. Such firms are more likely to be in rival-rouse oligopolistic relations with other firms. Hence, monopoly, ironically, comes closer, as Friedman stressed, to the ordinary concept of competition. Foster, McChesney, and Jonna 2011. The authors might have added, had they known, that their own notion of monopoly also comes closer to Marx's notion of competition with its implacably rival-rouse firms. The difference, of course, is that in Marx's view it is precisely these price-setting, cost-cutting, scale-expanding, and market-contesting firms that promulgate the laws of competition. A signal reason for the school's opposition to the notion of competition is that the economic defense of capitalism is premised on the ubiquity of competitive markets, providing for the rational allocation of scarce resources and justifying the existing distribution of incomes. The political defense of capitalism is that economic power is diffuse and cannot be aggregated in such a manner as to have undue influence over the democratic state. Both of these core claims for capitalism are demolished if monopoly, rather than competition, is the rule. Foster, McChesney, and Jonna 2011. While their goal is admirable, their aim is not true. Once again they merely reveal the extent of their dependence on the neoclassical theory of perfect competition. In Marx, real competition brings about a constant fluctuation whose disorder is its order, an anarchical movement, in which rise is compensated by fall and fall by rise, which bring with them the most fearful devastations and, like earthquakes, cause bourgeois society to tremble to its foundations. Marx 1847, 174-175. And, of course, all of this takes place in the context of a society in which the means of production are concentrated in hands of a ruling class. This is hardly a story of universal optimality and diffuse economic power. Finally, there is the standard claim that the case established by Marx in Capital is based on 19th-century market conditions, while the Hilferding, Lenin, Sweezy case is grounded in a reality-based social science which recognizes the tendency towards monopolization in the capitalist economy. This is a characteristic displacement in Marxian monopoly capitalism theory, and in post-Keynesian economics, as we see next, in which competition is viewed as applicable to a fictitious 19th-century era but not thereafter. Schumpeter already noted in 1947 that this claim involves the creation of an entirely imaginary golden age of perfect competition that at some time somehow metamorphosed itself into the monopolistic stage, whereas it is quite clear that perfect competition has at no time been any more of a reality than it is at present. Schumpeter 1969, 40. The vision of competition to which the Marxian monopoly capitalism school pledges its allegiance was never valid, not then and not now, Dumenil and Levy 1994, 21, and this fact seems to have escaped them entirely. At a positive level, the theory of monopoly pricing offered by the school is of two sorts. There are the explicit statements by Hilferding and Sweezy that monopoly pricing is based on a diverse set of factors, so that no reasonably general laws of monopoly price have been discovered because none exist, Sweezy 1942, 271. On the other hand, there is Baron and Sweezy's own subsequent argument, Baron and Sweezy 1966, that one can develop a theory of monopoly price based on an essentially Marxist, or neo-Marxist, approach. By adopting Michael Kalecki's concept of degree of monopoly, the power of a firm to impose a price markup on prime production costs, Foster, McChesney, and Jonna 2011. Kalecki's monopoly markup theory is also the foundation of much of post-Keynesian economics. We will turn to this shortly. But first we need to trace the revolt against the theory of perfect competition which arose from within orthodox economics itself, that is, the theory of imperfect competition. 8. Rise of theories of imperfect competition. In real competition, demand plays a central role in the calculations of price setting and cost-cutting firms. In perfect competition, firms are price takers who supposedly have no need to consider demand. One would have thought that the many theoretical and empirical deficiencies of the theory of perfect competition would have led to a search for a better theory of competition such as that initiated by Andrews, 1964. It did not. Instead, within the Marxist tradition it led to theories of monopoly capital, and within the orthodox tradition it led to theories of monopolistic, oligopolistic, and otherwise imperfect competition. For a while, it seemed as if these approaches would finally dislodge perfect competition. But by the beginning of the post-war period, perfect competition had regained the throne, Solfidis 2009, 43. From perfect to imperfect competition. The theory of imperfect competition is derived from, and dependent upon, the theory of perfect competition. In what follows, I will concentrate on general theories of pricing and profits. Therefore, evolutionary economics, game theory, and related approaches will not be addressed here. Evolutionary models generally utilize simulation techniques to generate patterns similar to some observed ones, but they seldom address the intertemporal patterns of profitability for individual firms and industries. Mueller 1990, 4. Instead, they typically focus on intra- and inter-industry patterns of cost differences, market shares, rates of innovation, and so on. Mazzucato 2000. Game theory most often draws on the Walrasian paradigm and the theory of perfect competition, which it seeks to enrich by relaxing certain assumptions about individual behavior and institutional influence. Bowles 2004, Prologue, ch. 1. Imperfect competition also proceeds by relaxing one or more of the assumptions of the theory of perfect competition: perfect knowledge, maximizing behavior of consumers and firms, perfect mobility of labor and capital, perfect entry and exit, large number of consumers and firms, to justify price taking, diminishing returns at some point so that the average cost curve is U-shaped, and no consumption or production externalities. But here the explicit focus is on the implications for prices and profitability. 2. Sraffa's early critique of the theory of the firm. Sraffa's 1926 article was the first to make an impact on the received theory. He begins by pointing out that diminishing returns, rising costs, cannot exist in the long run because over this horizon any fixed factor can always be duplicated. On the other hand, increasing returns, unlimited falling costs, are incompatible with neoclassical equilibrium. Hence, the only consistent long-run production condition is constant costs in which MC equals AC constant. In the long run, the assumed horizontal demand curve must pass through the minimum point of the AC curve. Since the latter is flat, the demand curve P must run along the AC, and hence the MC curve. Hence, P equals MC along the whole MC curve. This means that the profit maximizing condition P equals MC is compatible with all scales of production. The scale of production is indeterminate. Sraffa 1926, 539 to 541. Sraffa goes on to argue that everyday experience shows that most producers operate under conditions of increasing returns, diminishing costs, so that the limit to their production does not lie in their costs of production. Rather, it lies in the fact that each firm faces an individual descending demand curve and hence has to reduce its selling price in order to sell a larger quantity. 543. Since a downward sloping demand curve for a given firm seems to require that it has a partial monopoly in its particular market. 545 to 547. Sraffa concludes that we must abandon the path of free competition and turn in the opposite direction, namely, toward monopoly. 542. 3. Chamberlain and Robinson. Chamberlain took this path in his 1927 dissertation, subsequently published as The Theory of Monopolistic Competition, Chamberlain 1933. Robinson did the same, explicitly crediting Sraffa as her inspiration, in her book entitled The Economics of Imperfect Competition, Robinson 1933. These are the classic works of the monopolistic competition revolution of the 1930s, and they arrived at essentially the same model of firm behavior. Both operated with the standard U-shaped cost curve, in which normal profit is built into average cost, and assumed short-run profit maximizing as the goal of the firm. Robinson explicitly introduced marginal revenue and marginal cost curves in order to specify the short-run profit maximizing point of production. This, as we noted in the discussion of Harrod in Chapter 7, implies price-setting behavior by the firm. Chamberlain did not think much of marginal analysis, arguing instead that firms set prices and adjust them through trial and error to a point where short-run profits are at a maximum. Both authors assumed that if price was greater than average cost in the short run, which implies excess profit, since average cost includes normal profit, then new entry would lower the demand curve of the average firm until its profit maximizing price fell to the point where it was tangent to the average cost curve. At this point P equals AC, so there would be no excess profits. Sulfatus 2009, 33-38. This was the situation depicted previously in the middle panel of figure 7.9 in the comparison of long-run equilibria in perfect competition, monopolistic competition, and Harrod's revised monopolistic competition. For the neoclassical counterattack. Beginning in the Great Depression of 1929, imputations of monopoly power became a justification for government intervention in order to counter supposed departures from competition. Sulfatus 2009, 33. Therein lay an intrinsic problem. From the start, competition was taken as synonymous with perfect competition. The economic consequences of some putative imperfection were therefore measured relative to the corresponding perfect outcomes. In this way, the theory of perfect competition became the practical benchmark for evaluating market outcomes and, informing economists and policy makers about the rationale and likely limits of government intervention. Sulfatus 2009, 43. Imperfect competition theory was joined to perfect competition theory from the very start. Perfectionists such as Stigler and Friedman 12 led the counterattack, objecting to the perceived hostility of imperfectionists toward the free market, to their tendency to escape from the very hard thinking necessary to secure a satisfactory and useful theory of perfect competition, their ad hoc construction of particular models for particular cases, and to the fact that their theory was not integrated into any specific macroeconomics. Sulfatus 2009, 41-43. In the end, what the rebels had sought to overthrow ended up being elevated to new heights. In most contemporary textbooks, imperfect competition is reduced to a whisper. 13. 9. Kalecki and post-Keynesian views. I. Kalecki's price theory. Kalecki initially posed his theory of effective demand in terms of free competition, 14, but soon came to reject this starting point on the grounds that free competition was merely a handy model which had never been applicable to any actual capitalist economy. He believed instead that competition was always very imperfect. Chrysler 2002, 624-625. Kalecki's conflation of actual competition with perfect competition is a striking indication of the hegemony of the perfectionist approach. Kalecki distinguishes between raw material prices and manufacturing prices. Raw material prices are demand determined because industry supply is relatively inelastic in the short run. On the other hand, manufacturing prices are cost determined because the sector is imperfectly competitive and firms typically carry excess capacity so that output can easily respond to demand. Kalecki's pricing theory focuses on these latter prices, although the specific form of his pricing equation changes throughout his life. Chrysler 1988, 11, 108-109, 128. Kalecki's theory of price reflects his engineering side. 15. He observes that firms set prices, that the prices of even a relatively homogeneous product vary from seller to seller, and that lower-cost firms charge lower prices. I argued in Chapter 7 that these phenomena are also implied by the classical notion of price competition. If competition within an industry led to an exact equalization of selling prices in the face of cost differences among firms, there would indeed be no relation between the prices of individual firms and their costs. However, once we allow for the fact that higher cost firms may only partially respond to price cuts initiated by lower cost ones, we would expect a positive correlation between selling prices and production costs. Since technical change is an ongoing process, one would also expect to find that real competition within an industry generates a persistent price spectrum linked to the cost spectrum. This is exactly what was depicted in Chapter 7, Table 7.6, and found in Empirical Studies, Foster, Haltiwanger, and Syverson 2005, 1. As illustrated in Figure 7.6 of Chapter 7, this type of intra-industrial price dispersion is quite consistent with long-run inter-industry profit rate equalization among regulating capitals. Kalecki's 1938 theory of price revolves around the Lerner index. This measure of monopoly power derives from the theory of perfect competition, in which price-taking and profit-maximizing behavior implies that, i.e., that by interpreting as a monopoly markup determined by the degree of concentration, the relation of transport costs to price, the degree of standardization of price, the organization of commodity exchange, and so on, Chrysler 1988, 111, Kalecki derives an early pricing equation, 110. In 1939 to 1940, he attempts to define pure imperfect competition in terms of profit-maximizing firms and a short-run equilibrium condition which is equivalent to MR equals MC, and in his 1939 to 1940 and 1941 papers, he tries to make further use of the tools of orthodox microeconomic analysis, but ends up abandoning these efforts, 117 to 121. It is only later, in 1943, 1954, and 1971 that he develops the Kaleckian approximation that prime costs AVC are constant, so that MC equals AVC is also constant, 121. Selling price is then said to depend on the markup over prime costs, state of market imperfections and oligopoly, and the average price, degree of competition, 122 to 125. In Kalecki's own notation, this yields the now familiar equation for the price of the ith firm in terms of its prime cost UI, a monopoly power parameter which determines the firm's price response to its prime costs, and a competitive threat parameter which determines the firm's price response to the average price of its competitors, p. 123.16. By implication, the average price must itself follow the same rule. Where price of the average firm. Kalecki's theory of the monopoly markup has three significant problems. By definition, the unit market price is the sum of unit material and labor costs, prime cost, as well as unit depreciation, where is the depreciation rate and kappa is the actual capital, output ratio, and unit profit, where R is the observed rate of profit. Hence, the empirical markup will reflect the ratio of gross profit to unit prime costs. 17. The first problem is that, except in periods of exceptionally negative profits, the empirical markup will be greater than 1. Therefore, the Kaleckian literature has had to add the restrictions and to make the theoretical markup, Chrysler 1988, 123. Second, if the theory is to make sense, the monopoly markup must be greater than the competitive markup, that is, where is the competitive markup, is the competitive profit rate, and the capital, output ratio at normal capacity utilization. Hence, only a persistently positive excess markup can be taken as potential evidence of an industry's monopoly power. This is, of course, the classical criterion for monopoly. So it is incorrect to treat the whole markup as an index of monopoly power, as Kalecki generally does, Kalecki 1968, 12-20, which is Weikalder, Heiser, Edwards, Silos-Labeni, Eichner, and Lee split the markup into two parts corresponding to normal, or minimum, profits, and a part for profits due to barriers to entry, Eichner and Kriegel 1975, 1306, Lee 1999, 120-121, 162, 175. Finally, the relevant profit rate R** is the normal capacity rate of return on regulating capitals, not on the average of all capitals at the observed rate of capacity utilization. And here, we have already observed that regulating profit rates are indeed equalized in the turbulent manner expected from the classical theory of competition, Chapter 7, Section 6.5. Since Kaleckian theory treats all positive profit margins as monopoly markups, it will mistakenly conclude that even firms with sub-competitive margins have some degree of monopoly power. These will be relevant issues in Section 3 in the discussion of the empirical evidence on competition and monopoly. 2. Post-Keynesian price theory. The literature on post-Keynesian price theory is very large and encompasses the works of eminent economists such as Godley, Taylor, Eichner, Kriegel, Lee, Dude, and Lavoie. Eichner and Kriegel 1975, Blecker 2011, 216 to 217. It is acknowledged that post-Keynesian theory originates in the theory of perfect competition, which it seeks to modify in order to make it more realistic. Downward and Lee 2001, 465, Lavoie 2006, 20-22. As it stands today, post-Keynesian theory is notably eclectic. Some decry this as a lack of coherence, while others celebrate it as an indication of pluralism, of methods and theories. Downward and Lee 2001, 472, Lavoie 2006, 18-20. One defining element is that all post-Keynesian models rely on cost-plus pricing, Lavoie 2006, 44. Most authors take costs to mean average variable costs, AVC, but others refer to full costs, AC, defined at normal capacity utilization, i.e., normal costs. Kenyon 1978, 40-43. Godley and Cripps 1983, 187, 191, 214, Lee 1986, 400, 404, Steindl 1993, 121, Lavoie 2006, 44-46. Many follow Kalecki's view that markups depend on monopoly power, degree of concentration, risk of new entry and even the resistance of workers, class struggle. Eichner and Kriegel 1975, 1305-1309, Scott 1989, 46-60, Shapiro 2000, 990. But others follow Steindl, Lanzelotti, Woods, and Eichner in arguing that markups are based on target rates of return geared to the finance required by a firm's desired rate of growth. Lavoie 2006, 46-48, 50-51, Godley and Lavoie 2007, 264-265, 272-276. Still others argue that the proper post-Keynesian theory of price is cost-based but not cost-determined because both markups and the exact allocation of costs are highly contingent and can change with the requirements and opportunities of the enterprise. Shapiro and Sawyer 2003, 356. The relevant factors are quite complex and involve forward-looking and strategic behavior, so that even if they can be identified, their levels cannot be predicted. From this point of view, the resulting theory of price is conceptually determinate but hard to specify. Shapiro and Sawyer 2003, 364. It will be noted that this is really a reprise of the argument advanced much earlier by Hilferding and Sweezy of the Marxian monopoly capitalism school that the diversity of factors that enter into monopoly pricing decisions make it useless to search for a precise theory of monopoly price. Sweezy 1942, 270-271, Hilferding 1985, 233-234. It is useful at this point to focus on the relation of various forms of post-Keynesian price theory to the classical theory of competitive prices. In Kalecki, every firm sets its own price according to its own chosen markup. Hence, prices do not respond to market demand and supply and are not equalized across firms, profit rates are not equalized across industries, and there is no notion of a normal rate of capacity utilization. It is recognized that different firms have different costs, but there is no concept of regulating capital. Versions of post-Keynesian theory which rely on normal cost pricing come closest to the classical notion of prices of production, except, of course, that profit rates are not equalized across oligopolistic industries. Kenyon 1978, 34, 39, 40-43. Andrews and the OERG are touchstones here because they refer to actual business practices, normal cost pricing, target rates of return, differences in technology between firms, and the distinction between price leaders and price followers. Lee 1999, 103-105, 200 to 210, 408 to 409, Rothschild 2000, F215, Lavoie 2006, 35. To post-Keynesian authors, the central difference between competitive and markup pricing is that oligopolistic firms set prices. Thus, Lavoie, 2006, 46 to 48, views classical prices of production as idealized versions of post-Keynesian prices in which all target rates of return just happen to be equal and all capacity utilization rates just happen to be normal. But it could be equally well argued that Lavoie does not account for the real process through which markups are adjusted in the face of long-run market pressures. It is Dude, 1987, who addresses this issue. In his paper, he accepts the validity of the classical arguments that industry concentration does not signal monopoly, and that profit rates tend to get equalized through the tendency of financial capital to seek the highest rate of return even in an economy with large firms, Dude 1987, 62. At the same time, he retains the notion that firms set prices through given markups. Then equal rates of profit can only be obtained by having capacity utilization rates adjust in exactly the right manner. Glick and Campbell 1995, 125 to 131. 18 It was immediately pointed out by critics that Dude's argument implies that business investment does not respond to persistent differences between actual and normal rates of capacity utilization, and that firms are assumed to not respond to new entry by lowering prices to protect their market share, both assumptions being in direct contradiction to well-documented business behavior. Dumenil and Levy 1995a, 139, Glick and Campbell 1995, 132. If these assumptions are abandoned, then under the influence of capital flows triggered by profit rate and capacity utilization discrepancies, short-run prices will gravitate around classical prices of production. Dumenil and Levy 1995a, 140. There is no necessary conflict between short-run and long-run adjustments, both of which are always in force, but operating at different speeds. Shaikh 1991, 351 to 353, Dumenil and Levy 1995a, 140. In response, Dude concedes that firms will change their behavior when they find that the capacity utilization rate is not what they desire, but insists that rather than having some precise target for a desired level of capacity utilization, they have instead a range of acceptable levels within which there will be no investment response. Dude 1995, 151. This is correct in a purely formal sense, since in real life all variables will have some range within they are effectively the same. No classical economist would expect accelerated entry into an industry merely because a regulating profit rate was a fraction higher than normal, or the closure of a business merely because its utilization rate was a fraction below normal. But in the real world of turbulent capitalist dynamics, industries are always expanding or contracting precisely because these limited ranges are being contravened. In addition, the actual range of unresponsiveness varies from firm to firm and industry to industry according to the degree of uncertainty in the market and the cost of a new plant. In Chapter 7, Section V, I noted that in real competition industries with higher initial investment costs will be more sticky on both entry and exit, so that firms already in these industries will tend to carry a higher range of reserve capacity. It is only by implicit reference to the fictitious calm of perfect competition that one can turn threshold effects into portents of monopoly power. Finally, it is useful to recall that at the industry and aggregate level, average rates of capacity utilizations and investment are the mean values of the corresponding distributions, so that the averages may be linked in a smooth, nonlinear manner even if the individual firms operate within ranges. This is a characteristic factor in the emergent properties of aggregates, Chapter 3, Section 4. Several further points are relevant here. First of all, in real competition firms always set prices. It is only in the theory of perfect competition, to which post-Keynesian authors almost always orient themselves, that price setting is a symptom of monopoly power, see Chapter 7. Second, prices set in the classical manner do respond to changes in demand and supply, albeit not in the market clearing manner depicted in perfect competition. Hence, the characteristic opposition between fixed prices and market clearing prices, Shapiro 2990, is a false one, rooted in its fixation on neoclassical theory. Third, even the best post-Keynesian representation of Andrews, Lee 1999, 103-105, fails to account for his tremulous argument that over the long run the price leader's profit margin will adjust so as to yield a normal rate of profit, see Chapter 7, Section 6.1. Fourth, and most crucial, this adjustment process is driven by the ongoing battle of competition, by the tactics and strategy of price-setting and cost-cutting firms in the face of shifting advantages and disadvantages created by their own interactions. Fifth, the existence of actual capacity utilization rates that differ sufficiently from normal rates, the latter defined by the lowest average cost after allowance for reserve capacity, will trigger profit-driven accelerations or decelerations in industry capacity. Except in times of crisis, this will keep industry capacity utilization rates fluctuating within their normal range. In the end, two central claims separate the price theory of real competition from that of post-Keynesian theory: turbulent equalization of long-run rates of return of the price leaders, and turbulent fluctuations of actual capacity utilization rates around normal rates. 10 Modern classical views. Modern classical economics argues that competition has always played a central role in the regulation of capitalist economies, that profit rates continue to be equalized across sectors, and that market prices continue to be regulated by prices of production. General agreement exists that market prices gravitate around, rather than settle at, prices of production. Indeed, gravitation was the normal concept of equilibration in economics up to the 1920s, Coors and Salvadori 1995, 19-20. Hence, while it is important to study the properties of prices of production, it must be recognized that all actual decisions are made in terms of market prices. Prices of production never exist as such, they are invisible centers of gravity whose influence is manifest only in the perpetual over- and undershooting of market prices. Basic positions on the relation of market prices to prices of production. There are three basic positions on the relation of market prices to prices of production. The predominant one is that market prices are equal to, or at least quite close to, prices of production. Sraffa, 1969, and Steedman, 1977, 13 and 11, operate directly in terms of prices of production with no reference to market prices on the implicit assumption that the two are the same. This has been the methodology of orthodox economics from the time of Walras, Coors and Salvadori 1995, 23, 32-35, and has been adopted by most of the modern classical literature beginning with Sraffa's own contribution, Sraffa 1960, ch. 12, 81-87. Milgate, 1982, 30, argues that the competitive tendency towards uniformity of profit rates is all that is required for the application of long-period normal conditions as the object of analysis. But this is not correct, because even when market prices gravitate around prices of production, their average absolute deviation could be substantial. This is why, in their classic text, Coors and Salvadori are careful to state that their own use of the standard methodology is based on the explicit assumption that market prices are sufficiently close to prices of production so that the long period may be taken an actual state of capitalist economies, Coors and Salvadori 1995, 20. As previously noted, this assumption, and the implicit further one that the profit rate equalization process is rapid, is necessary to derive their position from Ricardo's statement that market prices will not be much above, or much below, their natural price. For any length of time, Ricardo 1951b, 88-89. The second position argues that the market prices fluctuate considerably during their gravitation processes, so that prices of production are reference points, not actual entities, Garignani 1976, Roncaglia 1977, Shaikh 1977, 116, 1978, 233 to 234, Eatwell 1981, Semler 1984, 10, Foley 1986, 93, Franke 1988, 260, Duminil and Levy 1990, 265, 275, Mueller 1986, 8, 1990, 1-3, Botwinick 1993, ch5, Shaikh 1998b. This is akin to Marx's notion that market prices are regulated by prices of production over cycles of fat and lean years, and the equalization of profit rates is never anything more than a tendency. Marx 1847, 174 to 175, 1967 c. 208, 1971, 464 to 465. Actual firms always operate in terms of fluctuating and uncertain market prices. It follows that all economic decisions should be robust in the sense that they continue to be valid for normal ranges of prices, wages, profit rates, and incomes. Marginality goes out the window under these circumstances, because decisions made at the margin are simply too fragile. Moreover, issues such as the choice of technique are then better treated via the stochastic methodology pioneered by Duminil and Levy and Foley, DLF, Duminil and Levy 1995b, 1999, Foley 1999, Foley and Michael 1999, utilized at the end of Chapter 7, Section 7. A third position emerges from the classical debate on the relation of total, direct and indirect, labor times, Marxian labor values, to prices of production and market prices. For Ricardo and Marx, the theoretical argument goes in the following order: total labor times rightward arrow prices of production which are systematically different from them rightward arrow market prices which gravitate around prices of production. 19 One would therefore expect that the distance between prices of production and market prices would be smaller than that between total labor times and market prices. We will see in Chapter 10 that while market prices are close to both prices of production and labor times, they appear to be somewhat closer to total labor times. This finding has generated two types of reactions. Farjoun and Mockover, 1983, reject the notion of competition because selling prices of a given good are not equalized in a given industry and profit rates are not equalized across industries. As summarized in Section 4 of Chapter 7, I argued that the classical real competition has quite different expectations. Selling prices within an industry are only approximately equalized and may differ systematically between high-cost and low-cost producers, and only the profit rates of regulating capitals are turbulently equalized across industries. But, of course, Farjoun and Mockover, like Hilferding, Chamberlain, Robinson, Early, Harrod, Kalecki, Sweezy, Barron, Steindl, and most post-Keynesians, are basing themselves on the neoclassical notion of perfect competition. Farjoun and Mockover 1983, 52-53, point 20. The confrontation with actual patterns then leads them to abandon not only perfect competition but also competition altogether. In its place, they propose that one should approach such issues in terms of statistical mechanics, in which both prices and profit rates are treated as random variables, and the pertinent concept of equilibrium is stochastic equilibrium, that is, a stable distribution of prices and profit rates. Farjoun and Mockover 1983, 39-40, 47-49. Having abandoned profit rate equalization and hence prices of production, the relevant connection becomes that between labor values and market prices. It is a pity that they remain trapped within the neoclassical vision of competition because this drives them to reject any notion of price or profit rate arbitrage. From the point of view of real competition, their whole argument is easily reconfigured in terms of deviations of selling prices and profit rates from those the price leader, i.e., the regulating capital. Then one would have both a theory of the distribution and a theory of the central tendency. Chapter 17, 2. Flaskell takes a much more nuanced path but ends up in much the same place. While he spends a considerable amount of time analyzing the properties of prices of production, Flaskell 2010, Part 2, chs 8-12, he is concerned about their theoretical relevance because their stability is far from clear. He also has concerns about their empirical relevance because authors working in the neo-Ricardian tradition have produced little evidence that prices of production are point attractors of market prices and that uniform profitability is a tendency in capitalism in its earlier or later phases. Flaskell 2010, 8. He concludes that prices of production may be irrelevant to the actual choice of technique under capitalism because they may not be close to market prices. Flaskell 2010, 7, x, and that in any case in the real world of large-scale plant and equipment and joint production one does not find profit rate equalization at disaggregated or aggregated levels. Flaskell 2010, 225. These considerations ultimately lead him to follow Farjoun and Mockover, 1983, in rejecting the intermediate concept of prices of production in favor of a direct connection between labor values and market prices. Flaskell 2010, 225-226. 2. Price taking versus price setting. The second major issue has to do with the behavior of the firm. In the neoclassical theory of perfect competition, the firm is assumed to be a price taker. Then observed price setting behavior is taken to be an indication of imperfections within competition. We have seen in the preceding 3 sections of this chapter that this misunderstanding is common to orthodox theories of imperfect competition, Marxian theories of monopoly capital and post-Keynesian theories of oligopoly power. Almost all modern classical economists also treat the competitive firm in the same manner, on the grounds that this is the generally accepted analysis which has been normally conducted on the implicit assumption of something like perfect competition. Armstrong and Glynn 1980, 69. Those who assume both long-period equilibrium as a state of existence and price-taking behavior by firms end up with a version of competition which is indistinguishable from that of perfect competition. Their critique must then focus either on possible internal contradictions such as reswitching, see Chapter 9, or macroeconomic issues such as the attempt merge a classical understanding of competition with a Keynesian or Kalekian analysis of aggregate demand, Serrano 1995. The latter will be addressed in chapters 12 and 13 in part 3 of this book. On the other side within the modern classical school, there are those, myself included, who argue that competitive firms set prices and engage in price cutting, and that competition is an antagonistic and destructive process akin to war. Shaikh 1977, 116, 1978, 233-234, 1980d, Semler 1984, 43, Dumenil and Levy 1993, 76-77, Brenner 1998, 25. The implications of this have already been addressed in depth in the present and preceding chapters. 3. Firm size and the degree of competition. Finally, the modern classical school argues that the increasing scale of firms actually intensifies real competition. This argument is quite consistent with Marx's views on the historical development of the form's competition. Clifton, 1977, 145-150, 1983, 29-32, 36, argues that the rise of large corporations enhances the mobility of capital because such entities have a greater overview of the various applications of capital and a lesser attachment to any one division of their operations. The head office of a giant corporation expresses the point of view of capital in general when it ruthlessly dispatches geographical and product divisions if their rate of profit proves inadequate. With the invention of the large corporation, capital had finally freed itself from the capitalist. Clifton 1983, 35. 2. Empirical evidence on competition and monopoly. 1. Introduction. The empirical debate about monopoly and competition is dominated by the notion that competition is the same thing as perfect competition. Evidence against the latter is then taken as confirmation of oligopoly and monopoly power. As noted in the preceding discussion, this stratagem is common to all theories of imperfect competition, whether they be orthodox, Marxian monopoly, or post-Keynesian. Yet the theory of real competition is quite distinct from any of these. Therefore, before we proceed to the empirical evidence, it is useful to compare the theoretical expectations of all three theories, as extracted from Chapter 7, Table 7.3, and from Section I of this chapter. Data sources and methods are described as we proceed in this section, and data used for charts and tables appear in Appendix 8.1. The theory of perfect competition portrays competition within an industry in terms of a very large number of very small firms that are identical in scale and cost structure, all facing the same horizontal demand curve. These firms are assumed to be passive with respect to price and technology, both of which they take as given. The uniform price in turn is assumed to be supremely responsive to market demand and supply, in keeping with its character as an index of scarcity. Semler 1984, 56. Since firms are assumed to be identical, they all have the same profit margins and profit rates, up to an independent and identically distributed, IID, random variable. Given that there is no interfirm variation in any of these variables, there can be no correlation between the profitability and scale of firms. Imperfect competition theory approaches the real world from this standpoint and discovers that the empirical picture looks very different from perfect competition. Instead of rejecting the latter as a model of competition, it concludes that the modern world is not competitive. The theory of perfect competition thereby remains as its benchmark and ideal, and is defended as such, in order to make negative sense of the facts. Hence, industries in which the number of firms is not very large, the entry scale is not very small, prices are not very flexible, prices and costs are not uniform, and firm-level demand curves are downward sloping, are deemed uncompetitive. Similarly, the existence of price setting and price leadership by firms is taken to be an indication of their monopoly power, the degree of which is generally linked to the scale of their capital stock, output, and/or capital intensity. By contrast, in real competition, the intensity of the competitive struggle does not depend on the number of firms, their scale, or the industry concentration ratio. Price setting, cost cutting, and variations in technology are intrinsic to competition. Market prices for a given product are expected to differ within limits, and to respond to supply and demand through periodic adjustments rather than smooth flexibility. Lee 1999, 209. 222 text and N 223. As indicated in Chapter 7, Section 6.2, and Table 7.6, newer firms tend to have larger scale and lower costs, and tend to make room for themselves by cutting prices. Older firms react as best as they can, but do not always fully match newer prices. Hence, in real competition one would expect to find a positive correlation between selling prices and unit costs, and a negative one between the latter two and firm scale and capital intensity. Once we allow for such price-cutting behavior, profit margins and profit rates can be the same or even lower for larger firms, precisely what most studies find. Chapter 7, Table 7.9. Competition between industries presents a similar set of contrasts. Perfect competition assumes that all firms are alike, so that each firm within a given industry is a regulating capital with a profit rate equal to its industry average. In this idealized world, firms can sell all that they choose to produce, their demand curve being horizontal, and have no need to hold reserve capacity. Competition between industries equalizes regulating profit rates in different industries, which implies that all firms, regardless of their industrial location, will have the same profit rate even though different industries produce different products under different technical conditions. Since the profit rate is the ratio of the profit margin to capital intensity, equalized profit rates will imply higher profit margins in industries with higher capital intensities. Within the theory of perfect competition, a crucial test is whether rates of any sample of firms fluctuate around a common long-run level. Mueller 1986, 13. Persistent differences in firm-level profit rates can then be taken as evidence of imperfect competition, as can reserve capacity and the correlation of excess Profit margins with scale or capital intensity 21, Mueller 1986, 9-12, 31-33, 130. In the theory of real competition, none of these patterns is problematic. What matters in the end is whether profit rates are equalized across regulating capitals in different industries. Table 8.1 summarizes the expectations of the various opposing viewpoints. Two traditional indicators of oligopoly and monopoly power. Perfect competition within an industry requires a large number of identical tiny firms, each with a tiny market share. Hence, from the very start the conventional empirical investigation of oligopoly and monopoly has focused on the number of firms, on their scale and capital intensity, and/or on the unevenness of market shares within a given industry. Hilferding was the first to achieve fame on this route, but many others have followed in his footsteps, or at least reinvented his path, since then. In perfect competition, each firm has the same vanishingly small market share. Therefore the concentration ratio of a perfectly competitive industry, defined as the market share of the top 4, CR4, or top 8 firms, CR8, will be close to 0.22. Similarly, given that perfect competition requires that all firms are identical, tiny, and sell exactly the same product, actual characteristics of firms such as entry scale of output or capital, cost differences, and/or product differentiation come to be viewed as barriers to entry. Semler 1984, 106-108, Muda 2010, 31-32. The central quest of theories of imperfect competition is to demonstrate that some mixture of these measures is associated with outcomes deemed to be non-competitive. Given that more efficient firms tend to be larger and more capital-intensive, it is not surprising that concentration ratios are highly correlated with so-called barriers to entry. Semler 1984, 97. The question is, do industries with high concentration ratios and higher entry requirements have higher than normal profits? Evidence on actual collusion which leads to higher profit rates for the colluders is a different question which will be addressed at the end. 3. Price rigidity and monopoly power. Since perfectly competitive prices are supposed to respond rapidly to market conditions, actual pricing behavior was the first to fall under suspicion. In 1934, the institutionalist economist Gardner Means created the term administered prices to refer to prices that failed to live up to the neoclassical ideal. Lee 1999, 56, Rothschild 2000, f. 215. Means was careful to note that while supposedly monopolized industries had administered prices, so too did many very competitive industries. Clifton 1983, 24, Semler 1984, 90. Rufus Tucker was subsequently appointed by the 20th Century Fund to investigate the claim that price-setting behavior and infrequent price changes were indications of monopoly power. Tucker's detailed empirical studies found that profit rates were lower for larger businesses, a common finding previously discussed in Chapter 7, Section 6.4, which contradicted the notion that larger firms set prices in order to raise their profit rate above the average. He also found that prices which changed frequently and those which changed infrequently had both existed in the American economy since the 1830s, long prior to the rise of large-scale businesses. Tucker came to the conclusion that administered prices were compatible with competitive conditions, that active competition existed when two or more industrial enterprises were trying to make sales to the same group of buyers. That the degree of competition was not measured by numbers or size of competitors, but primarily by the variability of market shares and profit rates among the competing enterprises over time, and that big businesses were extremely competitive even though they were members of concentrated industries and administered their prices to the market. Lee 1999, 71-73. Unlike the imperfectionists, Tucker quite correctly perceived that the difficulty of reconciling real business behavior with orthodox economic expectations lay in the notion of perfect competition itself, which he regarded as virtual nonsense generated by the itching imaginations of uninformed and inexperienced armchair theorizers. Lee 1999, 73 and 77, quoting Tucker. Eichner, 1973, 1187, presents data on the average price of concentrated and competitive industries, reproduced in Figure 8.1, as evidence of the effect of price setting due to oligopoly power. But this does not provide any evidence that the smoother prices of the concentrated industries are associated with a higher level of profitability or a higher trend rate of growth. We know that concentration measures are highly correlated with entry scale and capital intensity, so that Eichner's concentrated industries most likely represent those with high entry costs. But it has already been argued that in real competition, industries with higher entry and exit costs will have smoother prices because they will be more likely to absorb fluctuations in demand via changes in the utilization of existing capacity, Stigler 1963, 70, rather than through changes in price, Chapter 7, Table 7.3, last entry. Hence, Eichner's data is consistent with the effects of higher entry cost within the context of real competition. Semler, 1984, 92-93, Table 3.1, summarizes the results of 6 major studies of price flexibility in relation to costs and concentration, covering 18 time periods in the 1950s and 1960s. All the coefficients for the concentration ratio are quite small, most are negative, which contradicts the monopoly power hypothesis, most are not statistically significant in any case, and of the 3 that have statistically significant coefficients for all costs and concentration, 1 has a negative coefficient for the latter, Semler 1984, 93-94. Somewhat better results obtained by focusing on a sufficiently high concentration ratio, a procedure to which we will examine in more detail in the next section. According to the administered price hypothesis, high concentration should inhibit price falls in recessions, so the relative price increases, and should equally inhibit price increases in an expansion, so relative price should fall. Hence, the coefficient should be significant and positive in a recession, and significant and negative in an expansion, Semler 1984, 91, 94. But even here, the results are inconclusive. In the study by Weston et al. 1974, shown in Semler, 1984, 95, Table 3.2, the first contraction, July 1957 to April 1958, shows a positive relation between relative price increases and concentration, the second, January 1960 to January 1961, shows a negative relation, and the third, November 1969 to November 1970, shows essentially no relation. Figure 8.2 depicts this pattern. For profitability and monopoly power. In the theory of perfect competition, average cost is defined to include an allowance for a profit sufficient to ensure a normal rate of return, and long-run equilibrium is defined as the point at which price equals average cost at the minimum value of the latter. This long-run equilibrium price is the price of production, the corresponding profit rate is the normal, uniform, rate of profit, and the profit margin is the normal profit margin. Alternately, excess profit rates and margins are equal to 0 in long-run equilibrium. An important difference between rates and margins arises at this juncture. If excess profit rates are 0, then actual profit rates will be equal, so that they will be uncorrelated with industry capital intensity. On the other hand, if excess profit margins are 0, then actual profit margins will be inversely correlated with capital intensity. Since so-called concentration ratios are known to be highly correlated with capital intensity, Schurer 1980, 279, Schmalensky 1989, 993, competitive equilibrium implies that actual profit rates will be uncorrelated with concentration ratios, while actual profit margins will be positively correlated with concentration ratios. From this point of view, it is possible to view positive correlations between actual profit rates and concentration ratios as evidence of monopoly power, but it is not possible to view a similar correlation concerning actual profit margins in this manner. Only excess profit margins are appropriate here. Mueller 1990, 5. The structure performance literature often glosses over the distinction between actual and excess profit margins, Schmalensky 1989, 960-965. For this reason, in what follows I will discuss profit rate and profit margin studies separately. Point 23. 5. Empirical evidence on profit rates and monopoly power. Bain tried to show that persistent excess profit rates were associated with monopoly power. Since his available data was in terms of rates of profit on equity, that is, actual profit gross relative to net worth, assets, liabilities, he implicitly assumed that different industries have the same ratio of liabilities to assets, i.e., the same degree of financial leverage. Point 24. His central hypothesis was that in the long run concentrated industries have significantly higher profit rates. Bain 1951, 294-296. He carefully constructed a sample of profit rates on equity, ROE, and 8 firm concentration ratios, CR8, for 42 industries comprising 335 firms over 1936 to 1940, 310. Figure 8.3 plots the period averages for ROE versus CR8, which he presents in his table I, 309, 312. His central difficulty is immediately apparent: there is no evidence of a positive correlation between concentration and profitability. For instance, a simple linear regression of ROE versus CR8 yields and. Although Bain himself did not undertake this, a regression in which the dependent variable CR8 appears in quadratic form yields a somewhat better U-shaped fit within. Such a curve implies that increasing concentration initially lowers profitability, so that only after some critical upper level does concentration lead to higher profitability. As calculated from the coefficients of this regression, this critical level would be 0.25. Bain arrives at the same argument in a different manner. He first groups the CR8 data into deciles as depicted in Figure 8.4 based on the subsequent corrections, Dumsets 1973b, 12, to the data originally listed in his Table 2, Bain 1951, 313. He still finds a very weak positive linear relation, the corrected data yields, which he rightly dismisses because the fit is obviously so poor that the inference of a rectilinear or other simple relationship of concentration to profits is not warranted. He notes that even in the group data the relation seems U-shaped. Low concentration is associated with high ROE, 4 firms, medium concentration with low ROE, 16 firms, and high concentration once again with high ROE, 22 firms, 313. Moreover, in the corrected data, the average ROE of the low concentration industries is 12.2%, the first 3 enclosed points in Figure 8.4, while that of the high concentration industries is 13.2%, the last 3 enclosed points. Despite this, Bain says, the positive conclusion which does emerge is that there is a rather distinct break in average profit rate showing at the 70% concentration line, and that there is a statistically significant difference in the average of industry average profit rates above and below this line. In the selected sample, the simple average of 22 industry average profit rates for industries wherein 70% or more of value product was controlled by 8 firms was 12.1%, for 20 industries below the 70% line it was 6.9%. 26. Applying the Fisher-Z test 5 to this dichotomy, with the individual industry average profit rate as the unit observation, we find less than a 0.1% chance that this difference could be accounted for by random factors. A tentative conclusion is thus that industries with an 8-firm concentration ratio above 70% tended, in 1936 to 40 at least, to have significantly higher average profits rates than those with a ratio below 70%. The evidence available does not seem to warrant other than this dichotomous distinction. 314. Bain is careful to point out that his conclusion is sensitive to the procedure by which the firms and industries were selected. For instance, if he reinstates 34 industries which were originally excluded because their data was for less than 3 firms, then for CR870 it is 10.6%, so the difference is not statistically significant. 315, 316, Table 3. As he says, the notion of critical concentration ratio is a very provisional and tentative hypothesis for further testing. 324. Not surprisingly, the original hypothesis was subsequently modified to say that a combination of concentration and barriers to entry, scale, capital requirements, product differentiation, and cost differences was necessary to produce higher profit rates. Bain 1956, 201. Mann broadens and extends Bain's data and claims to find that industries with both high concentration, CR 870, and high barriers to entry have a higher average profit rate on equity. Mann 1966, 299-300, Tables 1-2. But Mann's own data show that the set of all industries, concentrated and unconcentrated, with high barriers to entry has exactly the same profit rate as the set of concentrated industries, 299, Table 2, as seen in Table 8.2. Contrary to the Bain hypothesis, the key variable seems to be barriers to entry, not concentration. We know that concentration ratios and so-called barriers to entry are highly correlated. Chmielewski 1989, 978, 993. From the point of view of real competition, industries with high entry and exit costs will have more stable prices and profit rates. Recall the discussion Eichner's data in section 2.3 of this chapter, but not higher profit rates in the long run. This is precisely what Stigler 1963, 68, Table 17, shows in his challenge to the oligopoly interpretation of the data. He calculates profit rates on assets, the theoretically appropriate measure, for concentrated and unconcentrated industries for 1939 to 1956, as displayed in Figure 8.5. We see that while concentrated industries do indeed display less variation, Stigler 1963, 70, both sets of profit rates move together and their average levels are the same, 7.1% for concentrated, 6.9% for unconcentrated. Brosen, 1971, 502, takes the competition school's argument one step further. He shows that when the Bain, Stigler, and Mann samples are broadened and the time periods extended, then in each given sample the average profit rate of concentrated industries converges to the overall mean. Schurer 1980, 278, see Table 8.3. This is precisely the expectation of the theory of real competition. Finally, Domsetz, 1973b, Table 4, 19, examines data for profit rates by degree of concentration, CR4, for 1963 and 1969. As shown in Figure 8.6, he finds that while there is a weak positive relationship between profitability and concentration in the first year, there is a weak negative relation in the second. Once again, this lack of temporal correlation between concentration and profit rates is expected in real competition. The preceding examples are illustrative of the fact that cross-section studies of industry profit rates do not reveal any stable correlation with concentration. In the vast body of literature generated by the investigation of such claims, differences among accounting rates of return are too small to justify claims of monopoly power, and any observed correlation between concentration and profitability is weak statistically, unstable over time and space, and vanishes in many multivariate studies. On the other hand, persistent profit rate differences do exist and do not seem to be explained by risk. Chmielewski 1989, 970-973. This issue was previously addressed in Chapter 7, Section 6.5, in the discussion of the work of Mueller, 1986, 1993, who has repeatedly found that average rates of profit do not gravitate around a common mean. However, as shown in that same section, incremental rates of profit do just that. 6. Empirical evidence on profit margins and monopoly power. Profit margins are a different matter. A supposedly robust result in the literature is that price-cost margins are positively correlated with concentration ratios, although many of the correlations are weak and deviant results can be found. Schurer 1980, 278 to 279. Domsetz, 1973a, has argued that higher profit margins reflect the greater efficiency, lower costs, of larger firms. Schurer 1980, 280 to 282, 284. Modern empirical studies have failed to find conclusive support for either the market power or the efficiency hypotheses because the two key explanatory variables, concentration and firm size, are highly correlated. Lee and Mahmood 2009, 352. From the point of view of the theory of real competition, there are two different issues involved in the case of profit margins. Within an industry with a more or less common selling price, firms with lower costs would have higher profit margins. Since larger firms tend to have lower costs, one would expect a positive correlation between market share and profit margins. In the more dynamic situation in which new lower-cost firms are constantly cutting prices to make room for themselves and older firms only partially match these price cuts, one would still expect to find a positive, albeit weaker, correlation between price, cost margins and market share. See Chapter 7, Section 6.2, Table 7.6. Indeed, Peltzman, 1977, showed via simulation that if firms that made cost-reducing innovations gained higher profits and higher market shares, one would find that increasing concentration was associated with decreasing unit costs. Schurer 1980, 289. Between industries, one would expect roughly equal profit rates for regulating capitals. The profit rate is the ratio of profit per unit sales and capital per unit sales, capital intensity, so one would expect a positive correlation between regulating price, cost margins 27 and capital intensity. Since capital intensity, entry scale, and concentration tend to be positively correlated, Schmalency 1989, 978, one would expect a positive correlation between regulating price, cost margins and concentration, and most likely a similar but weaker correlation between average price, cost margins and concentration. It follows that positive correlations between actual profit margins and concentration cannot be taken as evidence of monopoly power, since they are direct consequences of competitive conditions. What would be needed is a study of excess profit margins, i.e., ones higher than competitive ones. Given that competitive margins of firms would be determined by their size, market share, and capital intensity, one way to approach the issue would be to see what further explanatory power concentration ratios add to the story. Unfortunately, for this hypothesis, it is a stylized fact that the coefficient of concentration is generally negative or insignificant in regressions including market share. Schmalency 1989, 984. Hence, it is not surprising that a recent paper concludes that despite decades of research, the cross-sectional variation in the profit margin, across industries remains poorly understood. Although most agree that a handful of results have become conventional truths in industrial organization, the field does not know what to make of them. Peltzman 1991, 213. Instead, economists have generally abandoned inter-industry research to focus on what Bresnahan, 1989, calls important idiosyncrasies of individual industries. Gisser and Sauer 2000, 229. One interesting exception to this trend is a simulation by Gisser and Sauer, 2000, 235 to 243. Each industry is assumed to have two classes of firms, competitive price takers and a group of price leaders. The leaders are alternatively modeled as competitive price takers like the rest of the firms, as price setters who are competitive among themselves, or as colluders who act as a shared monopoly. Gisser and Sauer use estimates of demand elasticities from studies in the literature to provide a range for their simulations along with a large range of supply elasticities, and they compare the distributions of the regression coefficient between profit margin and concentration ratios with the ranges in the empirical evidence. The competitive, Bertrand, model yields regression coefficients whose median is much lower than the observed ones. The collusive model generates regression coefficients whose median is far higher than the range of the empirical evidence, but the Cournot model of competitive price leaders is just right. It yields the same range and median as observed data even when individual price leaders have different market shares. These comparisons suggest that it is extremely difficult to support collusive theories of firm behavior at the aggregate level where most profits concentration studies have been employed. The literature's empirical estimates fall within the range predicted by our model when leading firms behave as Cournot competitors. This finding based on the magnitude of the profits concentration correlation is in stark contrast to the original interpretation of Bain and his followers. By the same token, these results show that neither measurement issues nor dynamic adjustment stories are required to reconcile the existence of this correlation with non-monopolistic behavior. The authors see this result as entirely compatible with the benchmark model of oligopoly, 244. But, of course, it is also entirely compatible with real competition, the sole difference being that the profit rates of the price leaders in each industry, the regulating capitals, would also be turbulently equalized with the profit rate of all price leaders, see Chapter 7, Section V. 7. Collusion and profitability. The argument that competition is the dominant mechanism even in modern capitalism does not exclude the possibility of true monopoly power or collusion. Indeed, the initial impetus for the concentration hypothesis was the sense that concentrated industries facilitate collusion, leading to supernormal profits, Gisser and Sauer 2230. But while this hypothesis did not stand the test of time, it is quite possible to study instances of collusion directly. Working from a data set that encompasses hundreds of international cartels extending back to the 18th century, and considering practices which were legal then but are illegal now, Bolotova, 2009 324-325, concludes that cartels are successful in raising market prices, and many of them manage to do this for a relatively long period of time. The results suggest that the average gain from price fixing is approximately 20% of selling price. Cartels acting illegally manage to attain the same level of overcharges as legal cartels. And in the sample of modern international cartels, the median overcharge corresponding to this group is approximately 28% of selling price, Bolotova 2009, 338. The effect on the profit rate is not obvious, since a rise in selling price will generally lead to a fall in sales volume. Indeed, if concentration does actually lead to greater collusion, then we can say that collusion does not raise the profit rate, although it may make it somewhat less volatile, Stigler 1963, 70. On the other hand, less volatility is also a feature of real competition in industries with higher fixed costs, Chapter 7, Table 7.3. 9. Competition and inter-industrial relative prices. Introduction. The classical theory of relative prices is a highly structured argument. The average market price of a sector fluctuates around the regulating price of production. New regulating capitals with their lower unit costs make room for themselves in the market by cutting prices, and existing capitals respond by lowering their own prices enough to at least slow down the inevitable erosion of their market shares. Hence, at any one moment there is always a spectrum of selling prices correlated with the corresponding spectrum of costs, Chapter 7. Relative sectoral prices then drift up or down primarily in response to the corresponding drift in relative sectoral costs. The classical economists further argue that the temporal paths of actual relative costs and hence of actual relative prices are dominated by relative total labor requirements. The total labor productivity of a given sector, total output per unit labor, is the inverse of its total labor requirement. Technical change is therefore the major driver of relative prices over time, with relative prices tending to decline in sectors whose relative productivities rise, for a given quality of product, see Appendix 6.5, Section 3.1, on quality adjustment. Ricardo was the first to establish that relative prices of production differ in a systematic manner from relative total labor times. Yet he also famously argued that these differences are quite limited, being on the order of 7%. Given his understanding that actual prices gravitate around prices of production, this implies that actual prices are also likely to be fairly close to total labor times. Marx is adamant on the importance of the systematic difference between prices of production and total skill-adjusted labor times, labor values, but demurs on the issue of their average size. Nonetheless, like Smith and Ricardo before him, he is clear that temporal changes in relative prices of production, and hence by implication in relative market prices, are driven by changes in relative total labor times, labor values. No matter how the prices are regulated, the law of value dominates price movements with reductions or increases in required labor time making prices of production fall or rise. It is in this sense that Ricardo, who doubtlessly realized that his prices of production deviated from the value of commodities, says that the inquiry to which I wish to draw the reader's attention relates to the effect of the variations in the relative values of commodities, and not in their absolute value. Marx 1967 c. 179. So we have to contend with two classical propositions, a cross-sectional hypothesis that the systematic deviations of prices of production from total labor times are relatively small, and a time series hypothesis that the movements in relative prices of production are dominated by the movements in the underlying total labor times. Given that market prices gravitate around prices of production, similar patterns with somewhat larger deviations would be expected for actual prices. It should be said that the time series hypothesis does not require the cross-section one, for even if cross-sectional deviations were fairly large, the two sets could move together if the differences remained stable over time. Unlike most modern authors, the classicals were not content with merely describing algebraic properties, they were concerned first of all with the meaning and underlying structure of relative prices. For this reason, they always began with competitive exchange in order to explain the classical foundation for the analysis of prices of production, section 9. All arguments illustrated in this chapter are developed more formally in the appendices. 2. Simple commodity production. Prices of production are competitive relative prices generated by three essential outcomes: selling prices equalized across sellers, chapter 7, labor incomes equalized across workers, and profit rate equalized across regulating capitals, all equalizations being turbulent. For the classical economists, the equalization of labor incomes is distinct from that of profit rates because the explanation of profit is prior to the equalization of profit rates, chapter 6. The classical tradition therefore examines the equalization of labor income first, moves on to the sources of profit, and only then considers the equalization of profit rates. This analytical path helps uncover a fundamental link between prices and total labor times. To see how and why, we begin with the case of self-employed producers who purchase their inputs and sell their product in competitive markets, and migrate from one occupation to another in search of higher incomes. Despite Smith's unfortunate projection of such relations onto some prehistoric rude and early state, Marx makes it clear that this is an analytical starting point that allows us to distinguish between the general attributes of commodity production and the particular ones of capitalist commodity production, section 11. We will see that starting this way makes it clear that deviations of relative prices of production from relative total labor times do not arise, per se, from the existence of capitalist relations of production, the existence of positive profits, or even the equalization of profit rates. Rather, they are specifically tied to intersectoral differences among vertically integrated capital, labor ratios in the face of equalized profit rates. This understanding, which we see is already implicit in Smith, will provide us with a means of analyzing the potential magnitudes of such deviations. If all producers are self-employed, the difference between the selling price of their product and their input costs, materials and depreciation, is their personal income, which translates into some particular hourly income. It is not wage income because they do not work for others. Activities with higher hourly incomes will attract entrants more rapidly than those with lower hourly incomes until supply begins to outstrip demand in the former and drive down selling prices, while the opposite occurs in activities with lower incomes. This process will tend to establish particular market prices that equalize hourly incomes for direct labor, that is, market prices in which the difference between selling price and costs is proportional to the direct labor in that activity. But since input costs are themselves the market prices of commodities that enter into production, i.e., the market prices of the products of indirect labor, equal incomes per labor hour will imply that the corresponding price of a commodity will be proportional to the total, direct and indirect, labor time required to produce it, the constant of proportionality being the equalized income per hour. In other words, in simple commodity production, relative competitive prices will be equal to total labor times, labor values. The first step is to calculate direct, indirect, and total labor times per unit output 1, which are listed in the first set of rows in Table 9.1. These unit total labor times can then be used to calculate actual sectoral flows of indirect labor time, example in the corn sector, direct labor time, 80 HRS in corn production, and total labor time, the sum of the previous two. Simple commodity production encompasses markets, competition, labor, means of production, raw materials, machines, and the mobility of labor, but not capital or profit because all the producers are self-employed. As shown in Table 9.2, at some arbitrary set of market prices with price set, we would get unequal money incomes per hour in the two sectors. Conversely, if the mobility of labor equalizes incomes per hour, then the resulting prices will be with price set D, so that relative prices are equal to relative total labor times and each sector's absolute competitive price is equal to its total labor times multiplied by the equalized hourly income, Y. In other words, Table 9.2 simple commodity production with arbitrary market prices. Note: it is only after this point that Smith brings capitalists into the picture. In the simple case of commodity production, the producers are also the owners of their own means of production, which are not capital since they are not used to make profit. Hence, the rise of capitalist relations implies a separation between producers and the owners of means of production, the former now functioning as wage labor and the latter as their capitalist employers whose means of production now function as capital. Marx 1963, ch. 3, 74-80, Smith 1973, 151. Under these new analytical conditions, what was previously the net income of the self-employed producers resolves itself into two parts, of which one pays their wages and the other the profits of their employers. Thus, the whole produce of labor does not always belong to the laborer. He must in most cases share it with the owner of stock. Smith therefore presents profit as a deduction from the value which workmen add to the materials. He goes on to note that under competitive conditions in which both wage rates and profit rates are equalized, the sectoral wage bill will be proportional to the quantity of labor employed and sectoral profit will be proportional to the value of capital employed. As Smith says, this implies that the amount of profit is regulated by quite different principles from the amount of the wage bill. Smith 1973, 150-153.2. If wage rates are equalized, the hourly wage will be a fraction of the previous income per hour, so that the wage bill in each sector will proportional to the labor employed in it. As long as profits absorb the remainder, there will be no reason for relative prices to deviate from relative labor times. So we can already say that neither the existence of capitalist relations of production nor the existence of positive profits causes competitive prices to deviate from proportionality to total labor times. Furthermore, if capital-labor ratios are the same in each sector, then even the equalization of profit rates cannot be the cause of any such deviations. Hence, production price, labor time deviations originate solely from the interaction of profit rate equalization with differences in sectoral capital-labor ratios, the latter being traceable to differences in the proportions of inputs per hour of labor in the two sectors, 6.25 cn, 0.30 IR in corn production versus 4.50 cn, 0.15 IR in iron production, Srafa 1960, 12 to 13. Prices of production will now be, previously price set C in Chapter 6, whose ratio in this particular example is merely 4.3% different from relative total labor times. At these prices, the daily real wage basket per worker of 4 CN, 1 IR translates into a daily money wage $7.075 and an hourly wage, 8 HRS per day, of 88 cents. In Table 9.4, the net income resulting from these prices is split into the wage bill at this wage rate, leaving profit as the residual. This implies a rate of profit of 13.8% in each sector. Note: we now know that the deviations of relative prices of production from relative total labor times do not arise from competition, from private property in the means of production, from equalization of labor incomes, from capitalist relations of production and the attendant existence of profits, not even from the equalization of profit rates. Rather, they arise solely from sectoral variations among capital, labor ratios in the face of profit rate equalization. I have already addressed the puzzles and apparent mysteries associated with this latter combination in Chapter 6. In Table 9.4 of the present chapter, a different puzzle arises. The 28.1% lower capital, labor ratio in iron translates into an iron/corn relative price which is only 4.3% lower than the corresponding ratio of total labor times a roughly seven-fold damping. What are the factors involved in the mapping of variations in capital, labor ratios into variations in price, labor time ratios? Is damping a normal feature of this mapping? Once again, it is Smith who provides the path to an answer which is so general that it applies to any sort of prices, competitive, monopoly, and market. I call this the fundamental equation of price. 3. The fundamental equation of price, Adam Smith's derivation. One fundamental equation applies to all prices. The following argument applies to any prices, including market prices, Shaikh 1984b, 64 to 71. Since a sector's total profit is the residual between sales and costs, labor, materials, and depreciation, we can always express total sales as the sum of costs and profit. This is an accounting identity. Then if we divide each component by total output, X, we can write the equivalent identity that unit price is the sum of unit costs and unit profits. Let P, ULC, M, A, be the per unit price, unit labor costs, where W equals the wage rate and 1 equals labor required per unit output, profit per unit output, P/X, and input costs, unit materials and depreciation, respectively, of some given commodity. Then by definition, where, however, the unit input cost, A, is itself the price of the sector's bundle of materials plus unit depreciation costs on some corresponding bundle of capital goods used in the production of the input bundle. The unit input cost may in turn be decomposed into unit labor costs, profits, and the unit input costs of the original input bundle. This analytical decomposition can then be repeated on the input costs of the input bundle itself, and so on, with the residual term in nth stage of the decomposition always being a fraction of its predecessor and thus vanishing in the limit. Thus, we can formalize Adam Smith's decomposition of prices as: in what follows, I will use the term, vertically, integrated to denote the sums of direct and indirect components of any variable. Then integrated unit labor cost, which is the sum of all the direct and indirect unit labor costs by, and integrated unit profit is the sum direct and indirect unit profits by, where W equals the average wage over vertical integration and the integrated profit/wage ratio. Because this is derived from an accounting identity, it applies to any price whatsoever. It follows that for any two industries I and J, respectively, we can always express their relative prices as in equation 9.5. 2. The fundamental equation for relative price. When applied to prices of production, equation 9.5 becomes the foundation for Ricardo's cross-sectional hypothesis. Relative prices of production will be close to relative integrated unit labor costs if the deviation term is small. The same equation also gives rise to a time series expression in which the percentage change, denoted by the symbol, in relative production prices equals the percentage change in relative integrated unit labor costs plus the percentage change in the deviation term. This reasoning carries over to market prices to the extent to which they gravitate around production prices. We can now see Marx's point, which is that the changes in relative prices will be driven by changes in vertically integrated unit labor costs if the intersectoral distribution of profit-wage ratios is stable, that is, if individual sectoral ratios tend to move up and down together so that the change in the ratio tends to be small. This does not require that the level of be small, as in Ricardo's cross-sectional hypothesis. The fundamental equation of price shows that the relative price of any two commodities depends on only two multiplicative terms, relative integrated unit labor costs and relative integrated profit-wage ratios. The second term is dimensionless, since profit-wage ratios $/$ are dimensionless. But the first term has units, where X represents the gross output of an industry, so we cannot take the logs of both sides to derive a log-linear relation because logarithms can only be defined for dimensionless numbers, Frulich 2010a, Mata, Massa, Gubskia, and Knoll 2010. We will return to the implications of this shortly. For now, it is important to note that each sector's integrated profit-wage ratio is an average of its own profit-wage ratio and of all those sectors which are directly or indirectly connected to it through its input requirements. Integrated profit-wage ratios would therefore be expected to be much more similar to each other than are direct ones, that is, their dispersion would be expected to be much smaller, Shaikh 1984b, 71-79. From this point of view, one may view the term as a disturbance term around the relative integrated unit labor cost ratio. In the case of simple commodity production with equalized labor incomes, there is no profit in any sector, so that for all I, J, and relative prices are exactly equal to relative total labor times as in Table 9.3. But market prices may differ from competitive prices even in simple commodity production, in which case some sectors will have incomes above the competitive level and others below it as in Table 9.2, in which case 0.3. More generally, if the deviation term happens to close to 1, then from the fundamental equation we know that relative prices are essentially determined by relative integrated unit labor costs. To see how this might work, it is useful to note that post-war profit-wage ratios in advanced countries range from 25% to 30%, see Table 9.5. Suppose there are two sectors in which the integrated profit-wage ratio in the second, 0.40, is 100% higher than in the first, 0.20. Given the fact that integrated ratios are themselves averages of direct ratios, such a large dispersion is likely to be an exception, not the rule. Nonetheless, even in this case, the disturbance term would be. This says that even a 100% difference in integrated profit-wage ratios would induce only a 16.7% difference in relative prices from corresponding relative integrated unit labor costs, a six-fold damping. 3. Damping effects of vertical integration. Given the highly connected inter-industrial structure of modern economies, it is not surprising to find that vertical integration dramatically reduces the dispersion of profit-wage ratios. Consider the 65-order U.S. input-output table for 1998. Table 9.6 shows that while vertical integration has almost no effect on the mean profit-wage ratio, as is to be expected, it reduces the standard deviation and hence the coefficient of variation, the ratio of the standard deviation to the mean, by 2/3. The extent of damping due to vertical integration turns out to be similar in all available years. For a set of, say, 65 industries, we can compare each industry price to the average of all industries, P, which will give us a vector of 65 deviation terms. The variability and average size of the deviation terms are indicators of the degree to which price levels are not proportional to total unit labor costs, while for the rate of change of relative prices it is that matters. But before we consider the empirical evidence, we must first address the theoretical issues involved in measuring the relation between two vectors. For measuring the distance between relative prices and their regulators, we can compare two vectors in terms of their distance or in terms of their covariation as in regression analysis. The key point is that changes in units, say from prices and labor times per ton to those per kilograms, and changes in scale, say from prices per unit output pi to total sales, can affect the measure of the relation between vectors. One numerical example of effects of changes in units. It is useful to illustrate the issues through a simple numerical example. Consider three industries with prices, wages, integrated unit labor requirements and unit labor costs, deviation terms, and gross outputs, respectively. The upper panel of Table 9.7 depicts the initial values of all the variables. Suppose we now change the unit of output for each good in such a way as to make integrated labor time per new unit of output. For instance, the output of Industry 1 is tons of commodity 1, and its integrated labor time is. Now we redefine output to bales, there being 2.56 bales/ton. Then, as depicted in the first row of the lower panel, the new output of Industry 1 is bales. The original price was $2/ton, so now it will be $2/ton, 2.56 bales/ton, equals $0.78/bale. The same effect operates on any variable which is measured per unit output, such as 6 equals HRS/ton, and each of them will be effectively divided by 2.56. It should be evident that this riscaling procedure amounts to dividing the original pi, 6, vulsi by the original 6 while multiplying the original output xi by the same number. The shaded columns depict the changed variables. For this reason, the ratios and the totals are not affected, they are unit independent. Two deficiencies of regression analysis for cross-sectional analysis. The effects of a change of units on a regression depend on whether the variables involved are in the same or in different units. It is an axiom of dimensional analysis that all equations must have the same unit on both sides. Frulich 2010a, 3, Mata, Massa, Gubskia, and Knoll 2010, 67. In the fundamental equation of price, the profit-wage ratio is dimensionless and P and have the same units, $/X. Hence, any changes in currency units or in individual industry outputs will leave the relation between P and Vulc unchanged because it affects both of them in the same manner. But the integrated labor requirement VHRS/Xi has different units from the other two, so a change in units can alter the relationship between V and P, Vulc. In their original units shown in the upper panel of Table 9.7, pi and 6 are highly positively correlated with a correlation coefficient of 0.977. When the units are changed to those depicted in the lower panel, see the shaded areas, pi continues to vary across industries, but since 6 no longer does, the variables are now entirely uncorrelated. In contrast, regressions among are unaffected because the totals are unaffected by a change in units. This leads to the following issue of interpretation. In original units, the regression of yields R2 equals 0.936 while that of yields, so it seems as if gross outputs xi only add a little bit of explanatory power to the already formidable relation between pi and 6. But in the transformed units that render all, the regression of on yields while that of on continues to yield R2 equals 0.963, so that now it seems as if gross outputs xi add all the explanatory power. The same results obtain in log-log regressions if we convert the same variables to dimensionless forms, such as in order to take their logs, logs being only defined in terms of dimensionless variables, Frulich 2010a, 5. Using levels or logs, under one set of units gross output seems to contribute very little additional explanatory, while under another set they seems to contribute all of the explanatory power. Shaikh 1998a, 233, Diaz and Osuna 2009, 438, Frulich 2010a, 8. This is relevant because empirical calculations from input, Output tables only provide estimates of the ratios which we must then multiply by observed total money gross outputs to create the totals. Hence, the results of cross-sectional regression analysis can be affected by a change of units if the variables are in different units, and do not permit us to separate out the contributions of unit variables from those of corresponding gross outputs when we use totals, Diaz and Osuna 2009. We will see shortly that regressions can still be appropriate in time series analysis. 3. Defining the appropriate measure of deviations. A further problem in cross-sectional comparisons arises from the fact that even the totals are affected by changes in scale that arise from choices of numeraries. For instance, we can rescale prices and labor times by dividing them by their respective total sums to get. This has the virtue that the redefined industry totals, and so on, are dimensionless and can be used in log-log regressions. But then neither the new totals prices, nor the ratios are invariant to such changes in scale, i.e., to division by some scalar mu. Fortunately, there are a variety of measures of the distance between any two variables that are unaffected by changes in units and or changes in scale. An example is the angle between any two vectors, which can be calculated directly from the empirically estimated ratios without having to scale them to total levels as in regression analysis, Steedman and Tompkins 1998, 392, Frulich 2010a, 6. Steedman and Tompkins have proposed the coefficient of variation CV equals 10 as a distance measure, while Mariolis has proposed using the Euclidean distance, Steedman and Tompkins 1998, Frulich 2010a, 6, Mariolis and Socles 2010. All of these distance measures make use of the size of a vector. For a vector q, its size can be defined as a positive number, scalar, satisfying certain basic properties, Luttpal 1996, 101. Two common size measures are the norm, which is the sum of the absolute values of the elements of a vector, a Minkowski norm width, and the norm, which is the square root of the sum of the squares of the elements, Luttpal 1996, 103. A vector with all positive elements such as has a mean so that normalizing the elements g by removes any influence of scale. With this, the two preceding distance measures can be expressed as CV and delta E are similar in certain respects, since both are derived from the square root of a sum of squares of deviations and both are unweighted. However, they behave quite differently as the angle between any two vectors increases. When two vectors are parallel equals 0, and so that. But as two vectors approach orthogonality, and so, whereas. Thus, CV gets increasing large relative to the Euclidean distance as two vectors get further apart. The secret to the unit and scale independence of the two preceding measures is made clear in equations 9.9 and 9.10. They both operate in terms of the normalized vector. Recall that is a scalar, which is both unit independent and scale free. However, because both measures depend on the unweighted sum of squared deviations, a small industry with a large deviation may have an undue effect on the overall measure. This leads us to consider the construction of an alternate measure also based on normalized vectors. Three qualities seem desirable: it should be invariant to general changes in units and to the scaling of the vectors, it should be weighted so that large deviations in small industries do not have an undue effect on the average, and it should possess some sensible properties and an intuitive meaning. One measure possessing the requisite properties can be traced directly back to Marx. We begin by dividing the vectors by their norms to get normalized vectors, and since the ratio has positive elements, we can define the norms the sum of prices in the sense of Marx, where the average wage, and the sum of labor values in the sense of Marx, Marx 1967 c. ch. 9, 154 to 160. With this, we can define the normalized ratio chi and the normalized percentage deviation as where the monetary equivalent of total labor time, the ith sector relative wage and direct prices, prices proportional to integrated unit labor costs. The term chi has a simple and familiar interpretation. Consider the competitive case in which all wages and profit rates are equal. Then N price proportional to labor value, so represents the percentage deviation of the ith price of production from the corresponding price proportional to labor value. The more general expression in equation 9.12 then allows for the effects of wage differentials. Since is the percentage difference between normalized price and bulk vectors, its simple average would be a unit-independent and scale-free measure of the distance between pi and. But a weighted average using weights would be better because it would take sectoral size into account. In constructing the weights, the prices pi could be observed market prices, prices of production, direct prices, or monopoly prices. The quantities she could in turn be observed outputs or reference outputs such as those associated with Sraffian or Marxian standard commodities. Different sets of prices or quantities would have some impact on the final measure through their secondary influence on weights, but at a practical level this effect is small. With this in mind, we can construct a classical distance measure. Lastly, it will be noted that the delta C measure is the norm of the vector whose elements depend only on the normalized ratios. As such, it is independent of the scaling of the vectors. How then can it also be written in the form of equation 9.12, in which direct prices are defined as proportional to integrated labor times through the monetary equivalent of total labor time? The answer is that mu is endogenous in the sense that it depends on the type of prices being considered. If we are considering market prices, then mu is the observed monetary equivalent of total labor time defined as the sum of market prices to the sum of total labor times. But when we consider prices of production, the choice of the numeraire will require a particular mu corresponding to some of these prices with this numeraire. We will see in the next section that Sraffa chooses what he calls the standard commodity as the numeraire, which is equivalent to fixing the sum of prices of the standard net output vector to equal the sum of the integrated labor times of this same net output vector at all rates of profit. This in turn implies that the ratio of the sum of prices of production of observed outputs to the corresponding sum of total labor times will vary with the rate of profit, that is, the mu corresponding to prices of production will itself be a function of the rate of profit, for it follows that earlier measures such as the percentage mean absolute weighted deviation which fixed mu in terms of the sum of market prices, Ochoa 1984, Shaikh 1984b, Ochoa 1989, are equivalent to the classical distance measure in the case of market prices but not in the case of prices of production, table 9.9. However, at an empirical level such differences turn out to be very small, tables 9.9 to 9.12. V. Evidence on market prices in relation to direct prices. 1. Cross-sectional evidence. Figures 9.1 and 9.2 compare each of 65 industry normalized total market prices to the corresponding total direct prices, using log scales for both. Normalization reduces each price set to unit length, since it divides the original price vectors by their respective norms. This gives both sets the same mean, so we can use a dotted 45-degree line in the graph as a visual reference. It is not a fitted regression line. The two sets are obviously highly correlated, alpha not statistically significant, and highly significant, and. However, as discussed in the preceding section, within cross-sectional analysis a statistical regression does not permit us to separate out the contribution of unit prices from those of total quantities. Hence, we focus instead on the three previously discussed unit and scale invariant measures of the distance between prices and bulks. The normalized measures of the ratios are equivalent to price, direct price ratios, where direct prices are defined as proportional to integrated total labor times through the endogenous scalar mu whose value depends on the type of prices being considered. In the case of market prices, mu is the ratio of the sum of total market prices to the sum of total integrated labor times. This is exactly the procedure in previous studies, Ochoa 1984, Shaikh 1984b, Ochoa 1989, which means that in the case of market prices their percentage mean average weighted deviation measure, %MAWD, is the same as the scale-free classical measure, delta C. However, in the case of prices of production at the observed rate of profit, the cited studies retain the market price mu rather than adjusting it to reflect prices of production, so in principle the earlier measures do not coincide with the classical distance measure. Steedman and Tompkins, 1998, are right to point out that the earlier measures such as %MAWD5 are not generally scale-free, but they miss the point that such measures can easily be made scale-free through an appropriate definition of the money content of total labor time. Moreover, as in my data, their preferred CV and delta measures are about 1/3 higher than the absolute value ones, 384. In this section, I will display the earlier %MAWD measure alongside the three scale-free measures, CV, delta E. The preceding results can be viewed as a validation of the market price version of Ricardo's cross-sectional hypothesis that the disturbance termage in equation 9.5 is not far from 1. Over the half-century from 1947 to 1998, market prices encompassing all non-competitive and disequilibrium factors only differ from direct prices by about 15% according to the two mean absolute deviation measures, and by about 18% by the two root mean square measures, the latter two being characteristically higher in actual data. The important point here is that the visual impressions conveyed by figures 9.1 and 9.2 are confirmed. In cross-section data, actual market prices are remarkably close to direct prices. 2 time series evidence. The Ricardian time series hypothesis is that the rate of change term in equation 9.6 is small. The first interesting point is that in time series comparisons regression analysis now becomes feasible. This is because we are comparing normalized ratios across 2 time periods. Unlike cross-sectional analysis, outputs play no direct role here. We then face 2 questions. First, what is the correlation between direct price ratios across 2 different periods, and how does this correlation vary with the length of the time period? This amounts to ascertaining the extent of the correlation between the static disturbance terms over some time interval. Second, what is the average size of percentage changes in direct price ratios over time, and how does this vary with the chosen length of the interval? This amounts to measuring the size of the dynamic disturbance term. Figure 9.2 compares in 1972 to successive earlier years, beginning with 1967 and moving back until 1947. The associated correlation and distance measures are presented in Table 9.10, along with similar comparisons between 1967 and preceding periods, 1963 and preceding periods, and so on. We can see that the price ratios are highly correlated after 5 years, 1972 to 1967, and even after 9 years, 1972 to 1963, less so after 14 years, 1972 to 1958, and much less so after 25 years, 1972 to 1947. Table 9.10 indicates that even a 9-year interval depicted in the shaded area, roughly the classical decennial cycle, is remarkably robust. 6. Adjusted S range from 0.82 to 0.87, the mean average deviations measure delta C range from 4% to 6% and the root mean square deviation measures CV and delta range from 7% to 8%. All of these are within the interval hypothesized by Ricardo. 3. The Schwarz-Putty tests of the Ricardian time series hypothesis. The Ricardian time series hypothesis can be approached in yet another manner. In the 1960s, the eminent U.S. mathematician and computer scientist Jacob Schwarz, 1961-43, conducted a remarkably simple and elegant test. Given that any set of relative prices can be expressed as where, we would expect that structural factors summarized in relative integrated labor times do not change very much in the short run. On the other hand, over the short but turbulent period from the peak to the trough of a business cycle, which is usually less than a year, there are large movements in industry outputs, wages, and profits. Hence, peak-to-trough movements provide excellent conditions for tests of the sensitivity of relative prices to wages and profits, which was precisely Ricardo's concern. Petrovic 1987, 197, 200. Schwartz examined relative price movements over 4 business cycles from 1919 to 1938, including the Great Depression. He found that sectoral outputs vary from 30% to 60%, and housing contracts and wages by 40%. Yet the average variation in relative sectoral prices is merely 7.33%. Table 9.11 displays Schwartz's results. Pudi, 2007, extends Schwartz's test to 31 U.S. business cycles over 1856 to 1969, with sectoral prices taken relative to the wholesale price index. He uses not only NBER economy-wide business cycle peaks and troughs but also local peaks and troughs in the vicinity of NBER dates. Since his data span encompasses the Great Depression, estimates of quantity and price variations were made with and without that catastrophic event. The average output variation dropped significantly when the Great Depression was excluded, but relative prices were only modestly affected. Adjusting for seasonal variations turned out to have little effect. As shown in Table 9.12, Pudi's results strongly support Schwartz's original findings. Quantities vary by 22.2% over 31 NBER dated cycles while they vary by 30.6% over individual industry cycles. On the other hand, despite the turbulence associated in going from peaks to troughs of business cycles including the Great Depression, relative market prices vary on average by only 8.45% over NBER dates and 9.22% over local ones. Considering that market prices would be expected to vary more than prices of production, these results provide striking support for the Ricardian hypothesis formulated almost 2 centuries ago. But, of course, the classicals were intimately familiar with the behavior of actual markets. 6 prices of production, direct prices, and market prices. 1 Theoretical issues. Since market prices gravitate around, regulating, prices of production, the heart of the matter lies in the analysis of the latter. Ricardo and Marx long ago demonstrated that the difference between prices of production and integrated labor times depended on the distribution between wages and profit. So the question becomes, how exactly do prices of production vary with the distribution between the wages and profits? Sraffa provides an extraordinarily elegant and insightful treatment of this issue. Recall from Chapter 6, Section 3.3, that the general rule for measuring economic profits requires that the same prices be applied to inputs and outputs. Then prices of production form a system of simultaneous equations. For reasons of comparability, I will follow Sraffa's procedure of leaving out wages from total capital advanced and working initially with circulating capital only. See Appendix 6.4 of Chapter 6 on an alternative treatment of fixed capital, but I will follow Leontief's notation for input, output matrices and vectors. See Appendix 6.1. Let ij equals the input of the ith commodity into industry J, so that the cost of this ith input into the production of commodity J, let equals the direct labor required per unit output in industry J, so that the direct unit labor costs. Sraffa abstracts from fixed capital at this stage and assumes that all circulating capital turns over in one period, so that the stock of capital advanced to pay for materials is the same thing as the flow of input costs. Then from the accounting identity that costs plus profit equals price applied to, say, industry 1, unit labor costs at a common wage plus the sum of unit materials costs plus profit on capital advanced at normal rate of profit equals the commodity's unit price. With this we can write the following general system, illustrated here for the case of 3 commodities, as 9.14. The general price system will have n commodities, in the illustration, but variables, n prices, W and R. If we choose some particular price or price combination as the numerator so that all other prices and the wage rate are expressed in terms of it, we are left with a system of n equations in unknown consisting of n, 1 relative prices, a real wage, and the profit rate R. Sraffa points out that picking a particular real wage, which amounts to removing it as an unknown, will then determine relative prices and the rate of profit. Sraffa 1960, 11. He also shows that picking successively higher real wages will result in successively lower profit rates, regardless of which commodity is chosen as the numeraire. Since this inverse relation holds for the real wage expressed in terms of any given commodity as numeraire, it also holds for the real wage defined in the conventional sense as the money wage relative to the price of some bundle of consumption goods, and for the wage share defined as the money wage relative to net national income per unit labor, i.e., relative to the price of the net product per unit labor. In this way, Sraffa generalizes the classical proposition that the real wage and the profit rate move in opposite directions, so that a fall in former is beneficial to the latter. Sraffa 1960, 40. This leaves the equally important question of how relative prices respond to changes in distribution. Consider equation 9.16, at a real wage or wage share which yields R equals 0. Then the integrated profit, wage ratio will be 0 in each industry, and relative price will be exactly equal to relative integrated labor times. At some lower real wage the corresponding rate of profit will be positive. However, if all industries had the same integrated capital, labor ratio, then relative prices would still equal relative labor times. Hence, the key to the movements of relative prices of production consequent on a change in real wages lies in the inequality of the proportions in which labor and means of production are employed in the various industries. Sraffa 1960, 12. In turn, if proportions are not equal across industries, then relative prices must change as the distribution changes. 13. The relation to the classical approach outlined in section 2 of this chapter is obvious. Now a further classical difficulty arises. If relative prices are changing, how much of the change arises from the price of the commodity being considered and how much from the price of the numeraire? This indeterminacy complicates the study of the price movements which accompany a change in distribution. It is impossible to tell of any particular price fluctuation whether it arises from the peculiarities of the commodity which is being measured or from those of the measuring standard. Sraffa 1960, 18. Still, if we could find a single or composite commodity whose price was under no necessity to change as distribution changes, 16, it would serve as the ideal numeraire for distributional questions because it would ensure that changes in the relative price of some particular commodity in response to changes in WR arise solely from its own properties. So we are led to consider why any commodity's price would have to change as distribution changes. Consider a fall in the equalized wage from W2 and a corresponding rise in the equalized profit rate from R2. In all industries, the fall in the wage would create higher profits at the existing prices. Suppose there was some standard industry whose capital, labor ratio was such that the higher amount of profit derived from the wage reduction was just sufficient to earn this industry the new competitive profit rate. Then its existing price need not change in order to achieve this rate. But the prices of other industries with different capital, labor ratios would need to change to maintain equal profit rates, and insofar as these price changes affected the money value of the means of production of the standard industry, the latter's price would also have to change in order to maintain the competitive rate in the face of its changed capital stock. The one exception would be if the means of production of this standard industry, and the means of production of its means of production, and so on in Smithian sequence, all happen to be themselves produced by composite industries with the same standard capital, labor ratio throughout. This kind of recurrence would be a necessary feature of any industry whose commodity price is to serve as a distribution invariant numeraire. Only then would the money value of its aggregate means of production remain unchanged relative to its price, so that changes in the real wage will directly result in a competitive profit rate without any need for a change in its price. Sraffa 1960, 12-16. Sraffa shows that one can always construct a unique composite standard industry which has this recurrence property and whose price would therefore be invariant to changes in distribution. Choosing this price as the numeraire would make the inverse relation between the real wage and the profit rate directly visible within the walls of the standard industry. Indeed, under Sraffa's assumption that wages are not part of capital advanced, this inverse relation would be linear. 7. With this commodity taken as numeraire, W now represents the wage share in net product of the standard industry. At the upper end of the distribution spectrum, wages would absorb the whole of the money value of the standard product per worker so that the wage share end. At the other end, profit would absorb the whole value of net output so end. Here is the maximum rate of profit, which turns out also to be the recurrent net output, capital ratio of the standard industry, SRAFA 1960, 17. More remarkably, SRAFA demonstrates that simply appending the linear wage, profit relation as an additional equation in a price of production system is equivalent to choosing the price of the standard net output per worker as the ideal numeraire without the need of defining its composition, since with no other unit can the proportionality rule be fulfilled, SRAFA 1960, 31. With this in hand, we can add the wage-profit relation in equation 9.15 to the price system in equation 9.14, and return to our original question about the paths of individual commodity prices in the face of a changing distribution of wages to profit, secure in the knowledge that each commodity's price path now depends solely from its own characteristics. Under conditions of equalized wage and profit rates, the fundamental price relation in equation 9.4 reduces to where W, R are now the same in every industry. Appending to this in order to make the standard commodity the chosen numeraire gives, which leads to where the integrated output, capital ratio in industry I and the integrated output, capital ratio in the standard industry, which by construction is invariant to distribution. This is a remarkable formulation because it tells us that an industry's standard price departs from its integrated labor time solely in accordance to the manner in which the industry's integrated output, capital ratio varies relative to the constant, standard output, capital ratio R. It also tells us that at standard prices are equal to integrated labor times, Marx's labor values. In which case the industry integrated output, capital ratio is evaluated solely in terms of integrated labor times and represents the vertically integrated equivalent of Marx's labor materialized composition of capital 8 at the other extreme of the th price in equation 9.16, reduces to, in which case all industries have the same output, capital ratio equal to that of the standard industry, SRAFA 1960, 16 to 17.9. Moreover, since the standard output, capital ratio does not vary with distribution, its value is the same as that determined at R equals 0, at which point standard prices equal integrated labor times. So R is simply the standard industry's labor value composition in the sense of Marx. We then know that as R varies, at R equals 0 the crucial term starts out at the industry-specific ratio, which is the integrated value composition of the particular industry relative the standard one, and at it ends up at the common ratio. Unfortunately, knowledge of the initial and final points of does not tell us exactly how these ratios traverse their respective paths from one point to another. This is important because the paths of individual standard prices would either change smoothly or have wiggles according to how their corresponding integrated capital intensity ratios vary with distribution. A related issue has to do with the path of the real wage defined in terms of some representative bundle of consumption goods, or the wage share defined in terms of net outputs per worker in the actual economy. Even if individual standard prices exhibited wiggles, the price of a broad bundle of goods is likely to vary smoothly with the profit rate because individual price wiggles tend to cancel out. Then the wage so defined would be the ratio of a linear term and a smooth composite price. With both numerator and denominator expressed in terms of the same standard numeraire, the numeraire itself cancels out. The ratio is what it is, regardless of the numeraire. But going through the root of a standard numeraire allows us to understand why it is what it is, because we are able to decompose the variations in any ratio such or into components that vary around an unchanging center. We will see that this becomes very important in the debates around the switching and reswitching of techniques. 2. Numerical example. It is useful at this point to consider a numerical application of the three-industry system in equation 9.14, in which the wage rate W is specified as in equation 9.15. It is convenient to collect all the input coefficients ij in matrix and the direct labor requirements per unit output in vector so as to indicate their numerical values. Then for any given W in the range, we can solve the equations and derive the corresponding profit rate R and 3 standard prices. As noted, when these standard prices equal integrated labor times Vj and as R increases to the maximum R, these prices follow paths dictated by the paths of their critical ratios. See also Appendix 9.1. Since all prices start from Vj at, it is convenient to work with price, labor time ratios, which all start from 1 at and then move along the paths depicted in Figure 9.7 as R/R approaches 1. The first panel in Figure 9.3 shows that in this numerical example the critical ratios all follow near linear paths, and the second panel shows the same for the corresponding individual standard price, labor time ratios. We will see in Section 7 that linearity in the critical ratios implies linearity in standard prices. In Figure 9.3, the price, labor time percentage deviations, price, value deviations in marks, for industries 1 to 3 go from 0 at, and at. The corresponding distance measures are displayed in the third chart. Note that in this example, at the observed profit share, Table 9.6, represented by the dotted vertical line, all three distance measures fall in the Ricardian range R.10, so Ricardo would be right to say that on average prices of production tend to be close to integrated labor times. On the other hand, Marx is equally right to say that individual deviations can be substantial and therefore should not be ignored. Are linear standard prices realistic? They are certainly characteristic of canonical theoretical models such as Marx's schemes of reproduction and the Samuelson-Garagnani model, see Section X. On the other hand, Sraffa argues that in general relative prices can rise and fall several times as the rate of profit increases, Sraffa 1960, 14-15. This implies that the individual standard prices are not likely to be near linear, for if they were, the corresponding price ratios would not exhibit wiggles. I will return to this issue shortly. But first, in theoretical discussions I have always found it helpful to consider the empirical evidence. 7. Evidence on prices of production as functions of the rate of profit in relation to direct prices and market prices. Theoretical models of prices of production frequently begin with only circulating capital before moving on to the implications of fixed capital. I will follow this path with the empirical evidence because it allows us to assess the impact of introducing fixed capital into empirical estimates. Any proper test of the relation between theoretical prices and actual market prices should include fixed capital and depreciation because market prices already embody both. 1. Circulating capital model. Figure 9.4 presents the key evidence from United States 1998 data on the paths of individual industry integrated output, capital ratios relative to the output, capital ratio of the standard industry. It is clear that individual output, capital ratios generally follow very smooth near linear paths. However, 4 out of the 65 industries do exhibit somewhat more complex movements in the highest range of R/R. Figure 9.5 focuses on these: oil and gas extraction, broadcasting and telecommunications, funds, trusts, and other financial vehicles, and food services and drinking places. The first chart within Figure 9.5 covers the whole, 0,1, range of, and we see that even in these exceptional industries the integrated ratios move very smoothly for most part, with all turbulence confined to the range. The second chart zooms in on the upper range of, and we see that these ratios can indeed switch directions as Sraffa implicitly suggests. But these switches are confined to the very small range of less of their final values, which is 1 for all industries. From a theoretical vantage point, they could be viewed as a vindication of Sraffa's argument. At a practical level, such variations are less than the probable measurement errors in the data. 2. Implications of linear output, capital ratios. If individual integrated output, capital ratios were exact linear functions of R, then 9.19. This is a linear function passing through the two requisite endpoints, at, we get the labor value composition of the JTH industry, and at, we get, which is the labor value composition of the standard industry. The corresponding standard prices of individual commodities would then also be exact linear functions. To show this, we rewrite the preceding expression as and combine this with equation 9.17 to get the price-labor-time ratio as a linear function of 9.20. It was shown in figure 9.4 that the empirical ratios in the circulating capital case are very close to linear but not exactly so. Thus, the corresponding calculated standard prices in figure 9.6 also turn out to be near linear, with only a few closer to quadratic. Of the 65 industry standard prices, only 4 exhibit a single reversal in direction of price value deviations, and these are precisely the 4 industries whose output capital ratios were shown in figure 9.5 to reverse directions at very high standard profit shares, more than double the observed profit share of 0.33. Figure 9.6 displays the general patterns, which are generic to US tables for both newly available BEA input, output data covering 1997 to 2009 and earlier data for 1947 to 1973, Shaikh 1998a. Figure 9.7 focuses on the 4 industries that exhibit changes in direction. It turns out that all of them have standard prices which remain close to labor times throughout, within 10%, and all reversals only occur at very high profit shares well outside observed ranges. The foregoing individual industry patterns immediately imply that the aggregate wage-profit curve will be a ratio of 2 linear functions of the profit rate. As noted in section 6, we can measure the real wage or the wage share depending on whether we deflate the standard wage by the price of a bundle of consumption goods or by the price of the bundle of net outputs per worker in the actual economy. In either case, if individual standard prices are near linear, the price of either bundle of goods will be almost exactly linear. Then the real wage or the wage share will be a smooth curve, a rectangular hyperbola, the ratio of a linear standard wage and a linear composite standard price. Figure 9.8 displays the calculated wage share in the U.S. economy in 1998 as a function of the rate of profit, along with the standard wage share, W. The preceding expectations are fully realized. 3. Fixed capital model. We now incorporate fixed capital into the calculation procedure so that costs include depreciation and capital advanced consists of the fixed capital stock, appendices 9.1 and 9.2. The introduction of fixed capital has the remarkable effect of making integrated output, capital ratios and hence standard prices effectively linear, Shaikh 1998a. Figure 9.9 displays the paths of relative industry integrated output, capital ratios relative to the standard one, and figure 9.10 the paths of standard industry prices, while figure 9.11 focuses on ratios and prices of the same 4 industries that in the circulating capital case displayed direction switching. It is immediately evident that all variables straighten up their axes under the impress of fixed capital. These patterns match those in Shaikh 1998a, 93, 2012a, 238 to 242, and are generic to all 5 US tables for which I was able to construct fixed capital matrices. The wage share curve for the 1998 fixed capital model is depicted in figure 9.12 along with the linear standard wage curve. While the empirical wage share curve in the circulating capital model is concave to the origin, figure 9.8, in the fixed capital model it is convex. In both cases, the wage share curve is the ratio of the standard wage curve, which is exactly linear by construction, and the essentially linear price of net output, so in both cases the actual wage share is a rectangular hyperbola. But in the case of circulating capital, the average integrated output, capital ratio measured in terms of integrated labor times, i.e., AT, is higher than the corresponding standard ratio R, while for fixed capital the reverse is true. Given the linearity of aggregates such as net output or worker consumption bundles, we can deduce the shape of the wage-profit curve from that simple rule. 8 empirical distance measures. For each of our 3 basic measures, we can calculate the distance between prices of production and integrated labor times as a function of the rate of profit. Figure 9.13 displays them first for the empirical circulating capital model in the United States in 1998 and then for the empirical fixed capital model. Log scales are used for both axes because this brings out a remarkable property of the data. In both circulating and fixed capital models, the log-log paths of all distance measures start out as straight lines with a unitary slope, although the slope of the circulating capital measures rises somewhat at the end while the slope of the fixed capital measures falls. It turns out that this too was hypothesized by Ricardo. In his analysis of prices of production, he hypothesizes that a 1% change in the profit rate will induce a roughly 1% change in relative prices of production. In other words, relative prices will have a unitary elasticity with respect to the profit rate. It is on this basis that he concludes relative prices would not vary more than 7%, given that since capitalists would never tolerate an increase in real wages which would decrease their profit rate more than that. Ricardo 1951b, 36, Petrovic 1987, 197. Upon consideration, we can see that near unitary elasticities must be related to the near linearity of standard prices. Suppose standard prices were exactly linear as in equation 9.20. Then we can write 9.21. This tells us that the percentage price, labor deviation of a linear standard price is proportional to the percentage deviation of its integrated labor value composition of capital from the labor value composition of the standard industry. Then the elasticity of the percentage price, labor deviation with respect to would be exactly 1,11, although the direction of the change depends on the sign of the capital intensity deviation. Distance measures essentially operate on size, without the sign, of the deviations, and obviously these will also yield a unitary elasticity if prices were exactly linear. Because the sizes are positive, we can take logs to get, which is a straight line with a slope of 1. Of course, actual prices are not perfectly linear. The circulating capital model yields prices with slightly more curvature, figures 9.4 to 9.6, than the fixed capital one, figures 9.9 to 9.10, and in general prices tend to be a bit more curved at high R/R. Hence, we would expect distance measures to have elasticities that are initially close to 1 but depart from that as R/R approaches 1. This is exactly what we find for distance measure elasticities displayed in figure 9.14. In the case of circulating capital, the elasticities of all three measures rise, while in the fixed capital case they all fall. What is particularly interesting is that in this data at the observed the circulating capital model yields elasticities of around 1.1 for all three measures, while in the fixed capital model at the corresponding observed, we get elasticities of around 0.90. Since R does not change under given conditions of production, the fixed capital model implies that a 10% change in the profit rate would change the distance between the price of production and labor time by about 9%, which is essentially what Ricardo claimed. All years yield essentially the same results. Except for Jacob Schwartz, 1961, and Petrovic 1987, most mathematical economists have not bothered to investigate this aspect of the theory. 9. Empirical evidence on prices of production at the observed rate of profit in relation to direct and market prices. The preceding analysis focuses on the empirical properties of prices of production as the profit rate varied from its theoretical range of 0 to R. We now consider the empirical relations between prices of production at the observed rate of profit and direct and market prices, first at the cross-sectional level and then over time. 1. Cross-sectional evidence. At any moment of time, there are actual labor times and market prices and an observed rate of profit with a corresponding calculated set of prices of production. For the United States in 1998, the observed in the circulating capital model and 0.172 in the fixed capital one, Appendix 9.2. Figure 9.15 displays the relation between prices of production and direct prices for the circulating capital in model in 1998 and for fixed capital models in 1998 and 1972. Table 9.13 lists the three scale-free distance measures for 1947 to 1998, as well as an earlier one, %MAWD, which is not scale-free but is nonetheless very similar in magnitude. The classical measure M yields a distance of 13%, %MAWD is actually higher at 15%, while the two root mean square measures yield 18%. To resolving the puzzle of the distance of market prices from production and direct prices. We now turn to the question of the distance between market price and direct prices. Given that the former fluctuate around the latter and that the latter in turn deviate systematically from direct prices, it has generally been assumed that the market, direct price distance will be greater than the production, direct price one, Zachariah 2006, Flaskell 2010, 225 to 226, Frulich 2010b, 11. This view seems to arise from the algebraic fact that the difference between market price, PM, and direct price can be decomposed into the sum of the difference between production price and direct price plus the difference between market price and production price. But algebraic decompositions do not carry over to distance measures. Suppose, and that in two successive instances market prices takes the values 91 and 88. Table 9.15 shows that despite the identity linking the variables, it is perfectly possible that the sum of the absolute percentage deviations, or of their squares, of market price from direct price will be lower than the corresponding sum involving prices of production and direct prices. Indeed, this is a general possibility for all distance measures. Point 12. With this in mind, Table 9.16 brings together the relevant 1947 to 1998 distance measures for all three sets of price deviations in Tables 9.9 to 9.11. We see that the market price, direct price distance is higher than the production, price distance in terms of the classical measure, which is the conventional expectation. Yet the former is roughly equal to the latter in terms of CV and delta E, which is contrary to expectations. Market prices appear closer to direct prices, which seems to contradict the classical hypothesis that production prices deviate from direct prices and market prices fluctuate around production prices. Table 9.16 1947 to 1998 average distances between market prices, prices of production at the observed rate of profit, and direct prices, fixed capital model, U.S. economy. It could be that such patterns are really due to errors in estimation of direct prices or more likely in production prices, particularly since input-output data only yields average prices of production rather than regulating ones. But the deeper problem is that the classical hypothesis does not translate into the conventional expectation. This point can be illustrated by generating market prices in the three-sector numerical example of Section 6. Suppose that each sector's market price fluctuates randomly around its price of production. Then we can write market prices as 9.22, where is a random variable with a mean of 1, i.e., has a zero mean, and is a function of time, since it will fluctuate even at any given profit rate. Since market prices fluctuate around prices of production, and that the latter are functions of the rate of profit, it follows that market prices are functions of the rate of profit through their relation to prices of production and functions of time through the time-varying error. Second, since prices of production deviate systematically from direct prices, market prices will also do so, albeit in a turbulent manner. The first panel in Figure 9.17 displays the market price, direct price ratio of each sector as solid lines along with corresponding prices of production, direct price ratios as dotted lines, while the second panel plots the Euclidean distance of market prices from direct prices alongside that of prices of production from direct prices. Near prices of production are essentially equal to direct prices, so the error term dominates market prices. But as r/r approaches 1 and prices of production move away from direct prices, the market price, direct price distance is increasingly dominated by the structural deviations of production prices from direct prices. Thus, after some point the two distances are similar, and there are even instances when the market price, direct price distance is smaller than the production price, direct price distance. 3. Time series evidence. In section V, we examine the cross-sectional and temporal relations of observed market prices to calculated direct prices in terms of Ricardo's cross-sectional and time series hypotheses. But Ricardo's own hypotheses involve the relation of production prices to direct prices. As just indicated in Table 9.16, these yield an average distance of 13% for the classical measure and 18% for the other two. Here we consider the corresponding time series relations. Regression analysis is now feasible because we are comparing normalized ratios across two successive time periods. Figure 9.18 displays comparisons between production price, direct price ratios in 1972 in successive comparisons to earlier periods ranging from 1967 to 1947. The associated correlation and distance measures are presented in Table 9.17. The patterns are quite similar to those for market prices in Table 9.10 except that the correlations are higher and the distances smaller between successive periods. In this sense, prices of production are indeed closer than market prices to direct prices. Once again, the 4 to 5 year interval yields the highest correlation and the lowest distance, although the results for a 9-year interval are also well within the Ricardian range, adjusted R2 around 0.90, mean average deviations between 2% and 5% and root mean square deviations between 5% and 9%. Marx is therefore quite right to say that the law of value dominates price movements with reductions or increases in required labor time making prices of production fall or rise, Marx 1967 c. 179. X wage, profit curves, 1947 to 1998. Actual wage, profit curves in any given year were defined in terms of the share of the wage in the production, price value of net output per worker. In order to compare these across time, it is necessary to adjust for changes in real net output per worker over time. If we think of the money value of net output per worker, Y, as the product of its price index, P, and its quantity index, year, the wage share at a given rate of profit becomes. Then the desired real wage curve in terms of some reference year's net output per worker year 0 is 9.23. In other words, we can create real wage curves by multiplying each year's actual wage share by a productivity index. Figure 9.19 displays the real wage curves for 1947 to 1998 generated by the fixed capital model, each plotted against its own range of profit rates determined by its own maximum profit rate. Several features are striking. First, all curves have the same slightly convex shape, near linear but not quite as much as in Krell, 1977, 306, Figure 9, and Ochoa, 1989, 424, Figure 1. Second, one can distinguish the strong influence of productivity growth due to technical change, which shifts the wage axis intercept upward in each year. Third, as shown in Table 9.18, the curves nonetheless intersect because the capacity-adjusted maximum rate of profit falls from 1947 to 1972 and then essentially stabilizes. The path of the input-output maximum rate of profit here is similar to that of the NEPA corporate maximum rate of profit in the comparable period as shown in Chapter 6, Section 8, Figure 6.2. It should be noted that these are observed curves in different years, not alternative methods in a given year. I will return to the implications of these curves in Section 11 in the context of the discussion of reswitching and its relation to the neoclassical distribution theory. Finally, Table 9.19 compares observed output, capital ratios to the standard ratio, R, with both sets adjusted for capacity utilization by the same annual index, so that their ratios are unaffected by this adjustment. The two sets essentially remain within 10% of each other. In light of the analysis in Chapter 6, Appendix 6.5.4, this implies that we can treat the time trend in the observed capacity-output ratio as a good index of the direction of technical change. But here, it is important to correct for central deficiencies in conventional capital stock measures, Chapter 6, Section 8. 11. Origins and developments of the classical theory of relative price. 1. Classical origins. It all begins with the incomparable Adam Smith. He distinguishes income-driven competition from profit-driven competition in order to establish that, in the absence of profit, income-driven competition gives rise to equal incomes per commodity producer and prices proportional to integrated labor times. This allows him to establish that neither the subsequent analytical division of net value added into wages and profit nor even the equalization of profit rates need cause competitive prices to depart from proportionality to labor times. It is only the further existence of differences in capital, labor ratios which requires a modification in the preceding price rule, Smith 1973, 150 to 153.13 in almost the same breath. 153 to 157, Smith argues that the price of any commodity can always be broken down into integrated wages, profits, and rents as elaborated in Section 3 of this chapter. This is the logic behind the fundamental equation of price, Shaikh 1984b, 65 to 71.14. Ricardo is the first to illustrate the calculation of integrated labor times through his elegant and insightful numerical examples. He demonstrates that relative prices of production differ in a systematic manner from relative integrated labor times solely due to differences in industry capital, labor ratios and turnover times. He also shows that a rise in the real wage will lead to a general fall in the rate of profit. This leads to his famous hypothesis that relative production prices are not much influenced by changes in distribution because the opposing movements in wages and profits tend to offset one another. He concludes that temporal changes in relative prices are essentially regulated by changes in relative integrated labor times, Ricardo 1951b, ch. 1. What takes Ricardo a single chapter to set out takes Marx 3 volumes. Even so, the main steps on the issue of the magnitude of value are similar, albeit embedded within a much broader and deeper analysis of the forms of value, the origin and significance of money, the social implications of generalized exchange, and above all, the social and class origins of profit. In his critical commentary called Theories of Surplus Value, which was written as a rough draft of Volume 4 of Capital shortly before the publication of Volume 1, Marx specifically lauds Smith's treatment of prices and profit and credits him with discovering surplus value. Adam Smith quite correctly takes as his starting point the commodity and the exchange of commodities, and thus the producers initially confront each other only as possessors of commodities, seller of commodities, buyers of commodities under condition which lead to the equality between relative competitive prices equal and relative labor values, Marx 1963, ch. 3. Following Smith's analytical steps, Marx remarks that capitalist production begins from the moment when the conditions of labor belong to one class, and another class has at its disposal only labor power. This separation of labor from the conditions of labor is the precondition of capitalist production, Marx 1963, 78. But the law of exchange in proportion to the labor time contained in them is in no way upset by the proportions in which the producers divide the products, or rather their value. If part of A goes to the landowner, another to the capitalist, and a third part of the laborer, no matter what the share of each may be, this does not alter the fact that A itself exchanges with B according to its value, 74. In this case the value, that is, the quantity of labor which the workmen add to the material, falls into two parts. One pays their wages, the other part forms the profit of the capitalist. Adam Smith has thereby himself refuted the idea that the circumstance under which the whole of the product of his labor no longer belongs to the laborer, that he is obliged to share it or its value with the owner of capital, in itself invalidates the law that the proportion in which commodities exchange for each other is determined by the quantity of labor time materialized in them, 79 to 80. This establishes that industrial profit is perfectly compatible with the sale of commodities at their labor values. It does not originate from the sale of the commodity above its value, it is not profit on alienation, 79. Indeed, on the contrary, Smith traces the profit of the capitalist precisely to the fact that he has not paid for a part of the labor added to the commodity, and it is from this that his profit on the sale of the commodity arises. Thereby he has recognized the true origin of surplus value, 79 to 80. Moreover, since he explicitly includes rent of land, taxes, and interest as part of the deduction from value added, 82 to 84, Adam Smith conceives surplus value, that is, surplus labor, the excess of labor performed and realized in the commodity over and above the paid labor, the labor which has received its equivalent in the wages as the general category, 82. Marx viewed Smith's simple commodity production as an analytical device. It is Engels who attempts to extend it back in historical time, Dobb 1973, 146, 147 and 142, Meek 1975, 180 to 181. Indeed, in his contribution to the Critique of Political Economy published prior to Theories of Surplus Value, Marx speaks of the pre-Smithian rude and early state as a projection onto a paradise lost of the bourgeoisie, where people did not confront one another as capitalists, wage laborers, landowners, tenant farmers, usurers, and so on, but simply as persons who produced commodities and exchanged them, Marx 1970, 59. Volume 1 of Capital also follows Smith's path by starting with general issues of the structure, exchange, money, and the division of labor before proceeding to the question of profit. Only then does Marx indicate that he wants to show that profit on production does not originate in unequal exchange, that is, to show that profit on production is not the same as profit on alienation, Marx 1967a, ch. 5, so that the conversion of money into capital has to be explained on the basis of the laws that regulate the exchange of commodities, in such a way that the starting point is the exchange of equivalents, 166. Like Ricardo before him, Marx knew perfectly well that average prices do not directly coincide with the values of commodities, 166 and 1, and his own demonstration of that phenomenon in Volume 3 of Capital had already been worked out well before these words in Volume 1 were penned, Engels 1967, 3. But he had to explain profit before he could show how the equalization of profit rates created systematic differences between prices of production, and hence average market prices, and labor values. Being Marx, he arrives at the latter juncture in Volume 3 a mere 1,340 pages later, Marx 1967 ch. 9. Not surprisingly, this long journey has led even careful scholars to mistakenly conclude that Marx assumed a uniform organic composition of capital in all lines of production. In order to avoid the famous transformation problem that appears only in the third volume, Bottery 1969, 537. Marx also praises Ricardo. Despite the fact that Ricardo's investigations are concerned exclusively with the magnitude of value, he is at least aware that, the full development of the law of value presupposes a society in which large-scale industrial production and free competition obtain, in other words modern bourgeois society, Marx 1970, 60. In this domain David Ricardo, unlike Adam Smith, neatly sets forth the determination of the value of commodities by labor time, and demonstrates that this law governs even those bourgeois relations of production which apparently contradict it most decisively, 60. Ricardo does this with theoretical acumen and gives classical political economy its final shape, 61. In Marx's own view, the central point made by Ricardo was that despite the necessary difference in magnitudes between production prices and labor values, the law of value dominates price movements with reductions or increases in required labor time making prices of production fall or rise, Marx 1967 c. 179. Two modern theoretical developments. Sraffa. Sraffa's extraordinary production of commodities by means of commodities, Sraffa 1960, revived the classical analysis of relative prices. Since I have elaborated on this work in the text of this chapter and in appendices 6.1 to 6.4 of chapter 6 and in appendix 9.1 of the present chapter, I will restrict myself to only a few additional comments here. Sraffa says that he is taking up the standpoint of old classical economists from Adam Smith to Ricardo, which seeks to analyze such properties of an economic system as do not depend on changes in the scale of production or in the proportions of factors, Sraffa 1960, v. which, of course, does not prevent him from considering alternative sets of proportions. In this light, he first examines a system in which labor consumption is given in physical terms and there is no surplus. He argues that in this case there exists a unique set of exchange values which, if adopted by the market, restores the original distribution of the products and makes it possible for the process to be repeated. 3. This cryptic statement is best understood in terms set out previously in the present book: when there is no surplus, aggregate profit is necessarily zero. Then different sets of prices will generate different profits and profit rates in individual industries, Chapter 6, Tables 6.8 to 6.11, of which only one set will generate equal rates, all of which must then, of course, be equal to zero. That set of equal profit rate prices, as Sraffa subsequently shows, will be proportional to integrated labor times, 12. So what Sraffa means here by prices that make it possible for the process to be repeated is labor values interpreted as zero profit prices of production. It has to be said that this is a most peculiar interpretation of labor values, given the great lengths to which Smith, Ricardo, and Marx went in order to establish that labor values are consistent with a wide range of profit rates according to differences in sectoral capital, labor ratios. In effect, the concept of price in Sraffa is restricted to the price of production. He subsequently makes this clear when he says that such classical terms as necessary price, natural price, or price of production would also meet the case, in the present context, which contains no reference to market prices. 9. Sraffa also introduces profit in a non-classical manner, linking it to the emergence of a surplus due to a change in technology. In moving from the initial no surplus case to the positive surplus one, the salient factor is that one sector's output increases, leaving all other quantities unchanged. 1960, 4, 6. Contrast this to the approach in Smith and Marx, in which a surplus comes about under specific social conditions when the wage rate is reduced below value added per worker, i.e., when surplus labor is performed. This last point is particularly dear to Marx, with his emphasis on the relation of surplus labor to the length of the working day and to class struggle over conditions of production, see chapters 4 and 6, both of which disappear from view in Sraffa. Sraffa adopts the classical treatment of labor as being either uniform in quality or to have been previously reduced to equivalent differences in quantity, and of a uniform wage for quality-adjusted labor. 10. On the other hand, Sraffa provides no explanation for his abandonment of the classical economist's idea of a wage advanced from capital in order to adopt the assumption that the wage is paid post factum as a share of the annual product. 10. It only later becomes apparent that this assumption serves to make the standard wage profit curve linear. 22. This is an algebraic move, rather than an analytical one, and would require that workers possess a sufficient stock of funds to survive to the end of the whole period of production and sale. On other fronts, Sraffa introduces an important distinction between basic and non-basic goods. His treatment of the standard commodity is brilliantly insightful, and his analysis of the relations between output price and the prices of means of production is path-breaking. 1960, chs 3-5. His reduction of price to quantities of dated labor is reminiscent of Smith's procedure, although in Sraffa's case it is restricted to standard prices of production. 34-35. Finally, there is the famous section about the possibility of reswitching between two different sets of industry methods of production, techniques, which sparked the Cambridge Capital debates, Roncaglia 1991, 191. As I argue in section 7 of this chapter and in appendix 9.1, Sraffa is quite right to emphasize that feedback effects can alter the ratio of prices of inputs to outputs. But at an empirical level this feedback is far simpler than he indicates, because these ratios are themselves essentially linear functions of the rate of profit. Then aggregate wage, profit curves tend to be near linear, which undermines his implicit claim that reswitching is a general property. 2 Sraffian branches. Sraffa's little book was subtitled Prelude to a Critique of Economic Theory. The critique in question could have been interpreted in the manner of Marx's A Contribution to the Critique of Political Economy, as a statement of a foundation for a distinctly different mode of analysis. This is how Pacinity, Garignani, and Silos Labani have proceeded in their respective attempts to reconstruct Ricardian, Marxian, and Smithian analysis, Roncaglia 1991, 198-212. I certainly fall within this methodological camp. But the bulk of the Sraffian literature goes in a different direction by emphasizing reswitching and reverse capital deepening as a means of bringing to the fore all the logical difficulties inherent in the notion of capital usually employed by standard theory, Ciotti and Ditta 2008, 9, on the claim that the criticism of the notion of capital had to be based on the exclusively logical reasons in order to be effective and persuasive. The focus is then shifted to the internal consistency of the neoclassical concept of capital required by the marginal productivity theory of distribution, Ciotti and Ditta 2008, 10-11. In order to accomplish this, the bulk of the Sraffian tradition chose to adopt most of the central propositions of neoclassical theory, including timeless production, perfect competition, equilibrium outcomes, and optimal choice. The irrelevance of these constructs to capitalist reality therefore had to be played down, Ciotti and Ditta 2008, 5, 11. This emphasis on a negative criticism of neoclassical theory practically squeezed down almost the entire Sraffian contribution, into one single item and from one single perspective only, viz. The notion of capital and its conundrum from a strictly logical point of view, Ciotti and Ditta 2008, 10. 3. Debate on the theory of relative prices. Chapter 7 discussed the widespread tendency among heterodox economists to conflate the theory of competition with the theory of perfect competition, and Chapter 8 analyzed the corresponding empirical literature on profits and pricing. Here I will concentrate on the treatment of relative prices within the classical tradition. Early Sraffians made it seem as if complex movements in relative prices were perfectly normal, Robinson 1970, 30. Scaffold initially argued that the reswitching debate has made it obvious that prices are in general complicated functions of the rate of profit, Scaffold 1976, 21. Indeed, systems in which variations of a price vector in function of the rate of profit result in a complicated twisted curve were labeled regular systems that are the rule from a mathematical point of view, 26, emphasis added. Conversely, systems that did not exhibit such behavior were deemed mathematically irregular. Scaffold was careful to say that there is no economic reason why real systems should not be regular or why irregular systems should exist in reality. Irregularity is only a fluke, 26-27, emphasis added. It is to Scaffold's great credit as a scientist that he changed his mind in the face of a growing body of empirical evidence that irregular was normal and regular was definitely not. The idea of prices as twisted curves leads directly to two related possibilities, the reswitching of techniques and the possibility of capital reversal, Roncaglia 1991, 190. Consider an economy with n industries, each of which is using a particular method of production. This set of methods of production has been called an economy-wide technique, and under the further assumption of exactly equal wages and profit rates we can characterize any technique by its wage-profit curve. Now suppose that a new method becomes available in some particular industry, say iron. On certain standard assumptions, the individual capitalist's choice of method of production can be reduced to a choice of technique, if we assume that capitalists always choose the method of production with the higher rate of profit at given prices, as is typically assumed in the theory of perfect competition and in the Sraffian literature. This will be equivalent to saying that the chosen technique will be the one with the highest profit rate at the going wage, or the higher real wage at the going profit. Then if we imagine that there are very many alternative methods of production in each of the n industries, there will a wage-profit curve corresponding to each possible combination. For any given profit rate, there will be one which is the highest, and as we consider different profit rates we will trace out the frontier, envelope, of the set of all wage, profit curves. However, I have argued at some length that real competition involves price-cutting behavior, and that real technical choice involves betting on lower-cost methods in the face of turbulent conditions and uncertain prospects. For this reason I adopted an entirely different approach to the choice of technique, Chapter 7, particularly Section 7. Among its implications are that individual changes will be lumpy because capitalists will only make robust choices, i.e., only if the cost differential is great enough to compensate for the risk of change, that technical change can reduce the profit rate at a given real wage, and that the system as a whole will not generally be on the wage, profit frontier. But Sraffian economics shares the neoclassical assumption that all choices are smooth and costless, that all new methods raise the profit rate at any given real wage, and that competitive capitalism is always on this frontier. Steedman 1977, 106, 127. The debate between the Sraffians and the neoclassicals has been about the particular shape of this frontier on the grounds that this is central to the neoclassical theory of distribution between wages and profits and to the theory of automatic full employment. For the neoclassical theory of distribution and employment. On the matter of distribution, neoclassical theory wishes to show that at an aggregate level what a social class gets is, under natural law, what it contributes to the general output of society. Clark 1891, 313. At microeconomic level, the causation is the other way around, since a neoclassical firm takes the real wage as given and adjusts its marginal product of labor to the real wage in order to maximize profit. The macroeconomic task is to show that causal order is reversed at the aggregate level. This where the concept of an aggregate production function comes into the picture. A common starting point for the neoclassical perspective on capital is a one-commodity Samuelson/Solow/Swan aggregate production function model, where the one produced good, Q, can be consumed directly or stockpiled for use as a capital good, K. With the usual assumptions, like exogenously given resources and technology, constant returns to scale, diminishing marginal productivity and competitive equilibrium, this simple model exhibits what Samuelson, 1962, called three key parables. 1. The real return on capital is determined by the technical properties of the diminishing marginal productivity of capital. 2. A greater quantity of capital leads to a lower marginal product of additional capital and thus to a lower rate of profit. And the same inverse, monotonic relation with the rate of profit also holds for the capital/output ratio and sustainable levels of consumption per head. 3. The distribution of income between laborers and capitalists is explained by relative factor scarcity/supplies and marginal products. The price of capital services, the rate of profit, is determined by the relative scarcity and marginal productivity of aggregate capital, and the price of labor services, the wage rate, is determined by the relative scarcity and marginal productivity of labor, L. The three parables of this one commodity model depend on a physical conception of capital, and labor, for their one-way causation changes in factor quantities cause inverse changes in factor prices, allowing powerful, unambiguous predictions like Parable 2. Parable 2 claims that a greater quantity of capital, other things including the quantity of labor and output being equal, would lead to a lower marginal product of capital and hence to a lower rate of profit. This requires that a higher capital-labor ratio be associated with a lower rate of profit along the optimal choice frontier. Sraffians concentrate on this point by arguing that in a world of heterogeneous goods a reverse association, a factor reversal was at least logically possible. The strategy was to consider all possible methods of production in all industries as a giant book of blueprints, pick one method for each industry and calculate the resulting aggregate wage, profit curve, repeat this for all possible combinations of methods, and construct the wage, profit frontier, the outer envelope of all possible wage curves. As noted, in order to concentrate on a purely internal critique, the Sraffians chose to accept the neoclassical notions of competition, optimal choice, and costless and timeless switches of techniques. Shortly after Sraffa's book, in response to criticism from Robinson, 1961, Samuelson showed how the neoclassical parable might be resituated on Sraffian terrain. Beginning from the national accounting identity that real value added per worker, year, is equal to the real wage per worker, WR, plus real profit per worker, where R equals the profit rate on capital, KR equals KR/L equals real capital per worker, we can express this wage, profit curve as. Suppose this curve was linear in WRR space. Then the WR axis intercept, year, and the slope, KR, would have to be constant, i.e., independent of WR, R. The R-axis intercept defined at WR equals 0 would be. Now consider a second curve with a higher productivity of labor, year, and lower productivity of capital. In that case, the two curves would have to intersect at some point, as shown in the first chart in figure 9.20. Since the two curves would have the same wage and profit rate at the switch point at which they cross, the difference in their net outputs per worker would equal the difference in their capital-labor ratios, so that the incremental product of capital would be equal to the profit rate. In the present case, the wage-profit frontier would be the heavy line, shown for visual clarity to be slightly separated from the underlying curves. Then as R increased, the frontier capital-labor ratio would initially correspond to a higher capital-labor ratio of technique A until the switch point, after which it would correspond to lower ratio of technique B. Hence, along the wage-profit rate frontier, there would be an inverse relation between the capital-labor ratio and the profit rate, as in parable 2, a greater relative quantity of capital appears to lead to a lower rate of return, as depicted in the second chart of figure 9.20. The same association also plays a crucial role in the neoclassical theory of employment. In the face of a given endowment of capital, unemployment would lower the real wage and raise the profit rate. At each step, firms would rapidly and costlessly switch to new appropriate technologies along the frontier with successively lower capital-labor ratios. Neoclassical theory assumes that individual capitals are always fully utilized and that aggregate capital is given in some distribution invariant sense, so that switches involve different quantities of employed labor. Then the employment offered by the given capital endowment would successively rise until in the end full employment would be restored. Roncaglia 1991, 190. Samuelson further supposed that there exist an infinite number of intersecting linear curves. Then the switch points get closer and closer together, and in the limit the incremental product of capital becomes its marginal product. At the same time, the inverse association between higher profit rates and lower capital-labor ratios approaches a smooth curve. Figure 9.21 depicts the situation with a large number of intersecting linear curves. Samuelson's surrogate production function turned out to have some striking properties. For one thing, the assumed linear wage-profit curves only obtain if all industries within a given technique have the same capital-labor ratio, i.e., if there are equal organic compositions of capital in the sense of Marx. But then the simple labor theory of value holds because relative prices of production equal relative labor values, Garignani 1970. Moreover, the assumption that techniques always intersect requires those with higher labor productivities to have lower output capital ratios. 15 This is reminiscent of Marx's thesis about the general drift of technical change, see Chapter 7, Section 8, which has come to be known as Marx-biased technical change. All of this was rather too much for Samuelson, who promptly abandoned his construct in the face of a chorus of criticisms, Vicinity 1969, Garignani 1970. It is important to recognize that even if prices are proportional to labor values and technical change is largely capital biased, the equality between the pseudo-marginal product and the profit rate in equation 9.25 does not imply that the former causes the latter. On the contrary, since this equality obtains at any switch point between two techniques, it is perfectly compatible with the classical causation from a socially determined real wage to the rate of profit to the associated pseudo-marginal product, Badawi 1969. Yet if one is to reach back to the classicals, there is hardly any reason to retain perfect competition, optimal choice, and costless switching of techniques. Robinson, 1975, for example, proclaimed reswitching unimportant because she rejected the whole framework within which this debate had been conducted. But most Sraffians chose to remain within the orthodox paradigm in order to further their internal critique. And here, their weapon of choice was capital reversal and reswitching. Suppose that individual wage, profit curves were significantly nonlinear, as depicted in the first chart in figure 9.22. Then two curves might intersect twice, and the frontier capital-labor ratio might not be well behaved in the neoclassical sense. Instead of just falling as the rate of profit rose, it might fall and rise and then fall again as depicted in the second chart. 16 Faced with such logical possibilities, it was thought that neoclassicals would have to concede the inadequacy of their theories of distribution and automatic full employment. 40 years later, it is evident that no such thing occurred. On the contrary, the internal critique led to no significant or radical change of the paradigm characterizing the then dominant economic theory, Chiotti and Dida 2008, 9. 3. Modern empirical evidence. The theoretical possibilities of twisted price curves and reswitching between techniques inevitably led to questions about their empirical relevance. It is interesting that even in the theoretical literature numerical examples have tended to yield small average deviations. Ricardo's numerical examples yield 10%, while Marx's famous transformation tables yield a typical deviation of 12%, although individual deviations range from a low of plus 2.2% to a high of plus 85%. The famous Bortkowicz's example criticizing the incompleteness of Marx's transformation procedures yield a typical deviation of 10%, Shaikh 1984b, 64-65. Even Steedman's, 1977, 38-45, example, which was designed to demonstrate the utter inadequacy of Marx's transformation procedure, yields an average scale-free distance, CV, between Sraffa prices and Marx's transformed prices of 1.6%, 17. The important point here is that if average absolute deviations are modest, then sign differences would tend to cancel out in the case of most aggregate bundles. Since an actual wage, profit curve can always be expressed as the ratio of the linear standard wage curve and an aggregate numeraire in terms of standard prices, the actual wage curve would tend to be near linear, which would tend to preclude reswitching as an empirical phenomenon. Thus, the average size of price, labor time deviations is intimately related to the probability of reswitching. The earliest empirical evidence on actual market patterns can be found in the appendix to Leontief's, 1953, famous paradox article. There he presents data on each of 192 sectors' direct and integrated labor and capital requirements, from which one can construct the corresponding capital-labor ratios. The CV of the direct capital ratios is 1.14 while that of integrated ratios is 0.60, which represents a damping of almost 50%. His data also includes integrated labor time, market price ratios. Multiplying these by industry gross outputs valued at market prices gives industry total labor times, and comparing the two yields a typical deviation on the order of 20%, Shaikh 1984b, 74-76. As previously noted, the mathematician Jacob Schwartz, 1961, 43, showed that relative prices change by a mere 7% despite large changes in outputs from the peak to the trough of business cycles, Shaikh 1984b, 77-79. We saw in section V of this chapter that Pudi, 2007, found much the same over a greatly extended sample. Marzi and Veri, 1977, present evidence from 25 order input-output tables for the Italian economy in 1959 and 1967 from which we get average deviations between prices of production and integrated labor times of 17%, 19% and an R2 equals 0.915 for temporal changes in relative prices in relation to changes in relative labor times, where a correlation is a legitimate measure, 72. At the same time, Krell, 1977, 305 to 311, finds that in a fixed capital model for Germany for 1958, 1960, 1962, and 1964 the wage, profit curves are near linear, convex but only slightly curved. In his path-breaking studies Ochoa, 1984, 128, 143, 151, 162, 205, 214, Ochoa 1989, 420 to 424 and tables 1 to 3, finds that in the United States, market price, direct price deviations average about 12%, Sraffian prices of production in a fixed capital model deviate from direct prices by about 15%, that changes in all three sets are highly correlated over time, and that wage, profit curves are convex but near linear. Petrovic, 1987, 197, 200, takes up the Ricardian hypothesis that production prices have a unitary elasticity with respect to the profit rate. See section 8 of this chapter on further numerical evidence. He finds that in a fixed capital model for Yugoslavia in 1976 and 1978, 32 out of 47 sectors fulfill this rule, while another 10 to 12 depending on the year fulfill a 2% rule instead, 203 to 204. Chilcote, 1997, 274 to 276, studies the United States and 9 other OECD countries, and finds that in a fixed capital model the mean absolute weighted deviation, %MAWD, between market prices and direct prices was 10%, 16% and that rates of change of market price and prices of production were highly correlated with those of direct prices. A host of other studies have found similar results in a variety of countries, Petrovic 1987, Buenenfeld 1988, Coxhot and Cottrell, 1997, 1998, Solfatis and Monnier TIS 2002, Coxhot and Cottrell 2005, Zachariah 2006, Solfatis and Monnier TIS 2007, Solfatis 2008, Coxhot 2009, Fröhlich 2010a, 1, 2010b. In an earlier work, Shaikh 1998a, 231 to 232, I took up the issue of individual standard prices. I showed that these can be decomposed into the sum of three terms, a Ricardian term equal to integrated labor times only, an integrated equivalent of Marx's price, value deviations which depends only R/R and the percentage deviations of each sector's own integrated industry organic composition relative to the standard one, R, and the Wicksell, Sraffa effect consisting of the feedback of price, labor time deviations on input and capital costs. Using OCOA's US input-output database for 1947 to 1972 and scaling the sum of prices through standard gross outputs, at the observed profit rate, production price, direct price deviation averaged 4.4%, production price, market price deviations averaged 8.2%, and market price, direct price deviations averaged 9.2%, 234, Table 15.1. The small production price, direct price deviation meant that the Ricardian component accounted for 95.6% of production prices, and it turned out that the integrated version of Marx's transformed values accounted for 98%, 237. This left the much ballyhooed Wicksell, Sraffa effect to account for the remaining 2%. I also found that individual standard prices were essentially linear functions of the rate of profit over the full range of the profit rate. I pointed out that this was not because production prices remained close to direct prices, since individual sectors displayed considerable deviations. Indeed, if one left out fixed capital, individual prices became somewhat curved, albeit without wiggles. This suggested that something about the structure of fixed capital matrices enhanced the linearity of standard prices, 244. In a subsequent paper, I returned to the issue of the paths of price curves. According to Sraffa, Srafa 1960, 12-15, the potential complexity of individual production prices was rooted in the movements of output price relative to the price of inputs. The movements of output, capital ratios were the key. Shaikh 2012a, 89-90. Srafa shows that each industry's output, capital ratio begins at R equals 0 from the industry's integrated organic composition in the sense of Marx and ends up equal to the standard organic composition at R equals R. I found that in a circulating capital model applied to US input-output data beginning in 1998, the resulting paths were near linear. In 1998, only 4 sectors out of 65 exhibited a reversal of direction, and that only once in very small magnitudes at points near the maximum profit rate and far away from any observed rates of profit. 94. I showed that exactly linear output, capital paths implied linear standard prices equal to integrated transformed values in the sense of Marx, that is, to an exactly zero wick cell. Srafa effect, Shaikh 2012a, 92. Hence, the near linearity of the observed output, capital ratios was the source of the near linearity in observed standard prices even in a circulating capital model. The present chapter has incorporated this mode of analysis and extended these results. The weight of accumulating evidence, Petrie 2012, 380, on the shape of empirical wage, profit curves began to undermine the Srafian confidence in the complexity of price curves and the probability of reswitching. Early on, Vicinity was willing to state that in most cases the direction of deviations of production prices from integrated labor times was determined by the capital intensities of the industries. Vicinity 1977, 84. Nonetheless, he responded to the evidence that empirical wage, profit curves were near linear, Krell 1977, by arguing that this proves nothing for or against reswitching because the latter involves the shape of alternative techniques whose shapes have not been observed. Vicinity 1979, 639. Krell's, 1979, rejoinder was that his 1960 and 1962 curves are close enough in time to the 1964 curve to be treated as representing the set of known technologies in 1964, so that they did indeed provide some evidence on the empirical probability of reswitching. But then he immediately reverts to the internalist position that neoclassical theory in general and production functions in particular have to be discarded because numerical examples show the logical possibility of reswitching. It seems to me that this elides the central distinction between possibility and probability, because if all observed curves are near linear, then it is highly likely that unobserved curves are the same, in which case the probability of reswitching is small. The empirical evidence presented by Ochoa, 1989, and Buenenfeld, 1988, prompts Steedman, 1997, 284, to undertake an interesting theoretical investigation of how much relative prices can change as the rate of profit changes. Because the extent of such sensitivity is, of importance in determining the probability of reswitching, the likely magnitude of the errors involved in approximating production by Marxian values, etc. 18. He shows that production prices must all lie inside the convex polyhedral cone defined by the columns of the matrix of integrated capital requirements per unit output. Unfortunately, more precise results only obtain for special forms of the underlying matrices, 286 to 289. Hahn and Scaffold, 2006, take up the issue of unobserved techniques by constructing techniques from all possible combinations of 32 input-output tables from the OECD over a span of years. They begin by reiterating the distinction between reswitching, the reappearance of a particular technique somewhere else on the wage-profit frontier, and reverse capital deepening, a higher capital-labor ratio associated with a higher rate of profit. The former implies the latter, but not vice versa. Both are contrary to neoclassical expectations. 740. They find only one envelope, which involves reswitching, while reverse capital deepening is only observed in about 3.65% of tested cases. Abstract, 737. They conclude that these results could be used to support either side of the debate. For the Sraffians, this confirms that reswitching is possible, which suffices to destroy the legitimacy of the conception of capital as a single factor of production of variable form. No possibility is thereby left of basing a general approach to value and distribution on that conception. Petrie 2012, 404. On the other hand, for neoclassicals, the fact that these phenomena are so rare provides support for Solo's argument that while an aggregate production function is a relation that does not exist at the theoretical level, it is nonetheless convenient for macroeconometric modeling. The current state of play with respect to the estimation and use of aggregate production functions is best described as determined ambivalence. We all do it, and we all do it with a bad conscience. One or more aggregate production functions are an essential part of every complete macroeconometric model. It seems inevitable. There seems no practical alternative. Yet, Anwar thinks there is such a thing as a true aggregate production function. Using an estimate of a relation that does not exist is bound to make one uncomfortable. Solo 1987, 15. Regrettably, the discomfort that Solo feels does not seem to be shared by the very large number of orthodox and heterodox authors who use aggregate production functions without a flicker of conscience. In the end, we may say that there is determined ambivalence on both sides of the Cambridge capital controversy. The Sraffian side now concedes that reswitching is empirically rare, but continues to hold to the position that the mere existence of reswitching is sufficient to overthrow the central macroeconomic propositions of neoclassical theory. The neoclassical side now admits that aggregate production parables cannot be rigorously defined, but continues to hold that they are good empirical approximations to the true relations. What gets lost in all of this is that both sides remain within a framework defined by perfect competition, equilibrium prices, optimal choices, and costless and timeless moves from one technique to another. It should be obvious that I reject this common ground. 12 Summary and implications of the classical theory of relative prices. The classic theory of relative prices begins from market prices that fluctuate turbulently around moving prices of production, acting as invisible centers of gravities of the former. Prices of production never exist as such, and all actual decisions are made in terms of market prices by heterogeneous actors with heterogeneous speculations about the future. A technique is evaluated on the basis of its lower cost of production because this is what facilitates the price-cutting behavior, which is the sine qua non of real competition. If a new method of production is close to an existing one, the mere uncertainty in future outcomes may be sufficient to inhibit its adoption. These considerations put the choice of technique off the wage-profit frontier, Chapter 7, Section 7. The second key point is that production prices within a given technique are the product of two structural factors: integrated unit labor times that link a given industry to the production network in which it is situated, and integrated capital intensities that distinguish a particular industry from the standard. What is important here is that the integrated capital intensity of a given industry is a weighted average of its own intensity and those of all the industries that enter directly or indirectly into the means of production of this industry. The considerable damping created by vertical integration, Table 9.6, accounts for the fact that direct prices and prices of production at the observed rate of profit are fairly close to market prices and to each other. In this regard, it was shown in Section 4 that in addition to traditional unweighted root mean square type distance measures such as the coefficient of variation, CV, and the Euclidean distance, delta E, it is possible to develop a weighted absolute value-based distance measure, delta C, which is equally unit-independent and scale-free and has the simple interpretation of representing the average percentage deviation between any two sets of prices. This latter measure was shown to have direct classical roots. All three distance measures have been presented in the text, but here I will concentrate on the classical scale-free measure, delta C. On this metric, the distance between market prices and direct prices is about 15%, that between prices of production at the observed rate of profit and integrated labor times is about 13%, while that between market prices and production prices at the observed rate of profit is once again about 15%, Table 9.14. The fact that market prices are just as close to direct prices as they are to prices of production seems to be a puzzle, given that market prices fluctuate around prices of production while the latter deviate systematically from direct prices. Indeed, we can algebraically decompose the market, direct price difference into the sum of the production, direct price distance and the market, production price 1. However, algebraic decompositions do not carry over to distance measures, as illustrated in the numerical example in Table 9.15 and in a three-sector model in which market prices are modeled as random fluctuations around SRAFA prices of production, the latter varying with the profit rate in the usual manner. It then becomes apparent that despite the fact that market prices fluctuate randomly around prices of production, as the profit rate varies, there are many points at which the distance between market prices and direct prices is on the same order, or even lower than, the distance between production price and direct price, figure 9.17. Temporal changes in normalized market, production, and direct prices are similarly close. In this case, since we are working with percentage deviations between sets of prices, units, and scaling factors cancel out. This means we can use statistical regressions in addition to distance measures to test the temporal version of classical hypotheses. The highest correlation and lowest distances occur over the smallest available time interval, which is 4 to 5 years. But even after an interval of 9 years, the relation between changes in market prices and changes in direct prices is extremely robust, and CV, Table 9.10. An alternate procedure for testing the sensitivity of relative prices to changes in distribution and market conditions measures their change from peaks to troughs of successive business cycles. Here too the average variation is between 7% and 8%, which is very much in the range of Ricardo's famous hypothesis, Tables 9.11 and 9.12. Comparisons of changes in prices of production at observed rates of profit and direct prices yield similar results, within the fixed capital model even over a 9-year interval, and the average CV, Table 9.14. Finally, I examine the empirical properties of individual SRAFA standard prices and find these to be mildly curvilinear within a circulating capital model but entirely linear within a fixed capital one. In both cases, the corresponding wage, profit curves are near linear, figure 9.8, 9.12. SRAFA tells us that the potential complexity of individual production prices originates in the complex movements of industry output, capital ratios, Shaikh 2012a, 89-90. But at an empirical level in the United States these ratios are near linear, which is precisely why standard prices and wage, profit curves are near linear. Then for all practical purposes SRAFA's standard prices are integrated versions of Marx's transformed values. If standard prices were linear throughout, the elasticity of distance between production and direct prices with respect to changes in the profit rate would be 1. At the empirical level, the elasticities are on the order of 1.1, that is, 10% different from the linear case, at observed rates of profit, figure 9.14. This is essentially what Ricardo hypothesized in his famous 7% argument, Ricardo 1951b, 36, Petrovic 1987, 197. The results in this chapter provide strong support for the classical theory of relative prices. The near linearity of standard production prices greatly simplifies the analysis of the effects of changes in distribution and in technology, and their empirical strength gives them considerable practical value. They are consistent with the, slightly, curvilinear wage, profit curves we observe, so they do not exclude the logical possibility of reswitching or capital reversals, although they do imply that such occurrences will be rare. Such matters are of little relevance at the aggregate level because individual differences wash out when commodities are aggregated, so that for empirical purposes money and labor value aggregates are likely to be virtually indistinguishable, Shaikh 1984b, 58. Indeed, SRAFA himself makes this point when in his notes he says that the propositions of Marx are based on the assumption that the composition of any large aggregate of commodities, wages, profits, constant capital, consists of a random selection, so that the ratio between their aggregates, rate of surplus value, rate of profit, is approximately the same whether measured at values or at the prices of production corresponding to any rate of surplus value. This is obviously true. 19, Bellofiore 2001, 369, quoting from Sraffa's notes. On the other side, I and others have emphasized that the apparent empirical support for aggregate production functions can be explained by the fact that aggregate output, labor, and capital are tied together by the accounting identity regardless of the underlying microeconomic relations. Chapter 3, Section 2.2. Linear standard prices would provide a different foundation for an aggregate pseudo-production function through the near linearity of wage, profit curves, even though the underlying assumption of fixed production coefficients within each technique is entirely at odds with neoclassical microeconomics. In any case, aggregate output, Y, and capital, K, are price magnitude at all times, and given the properties of individual standard prices, Y and K will be linear functions of the profit rate within any given technique. Even if one accepts the assumption that the wage, profit frontier is the appropriate tool for the choice of technique, which I do not, the equality of the pseudo-marginal product and the profit rate at each switch point does not imply that quantity of money value of capital determines the profit rate. Indeed, as Sraffa and others have made perfectly clear, the money value of capital requires a separate theory of the wage rate or the profit rate to complete the story. The classical causation taken up in Chapter 14 goes from individual wage struggles on the shop floor to the general rate of profit. Nor does near linearity of wage, profit curves necessarily reinstate the neoclassical theory of full employment. The neoclassical claim is that flexible real wages automatically lead to full employment. But Marx's argument that capitalism creates and maintains a persistent pool of unemployed labor also depends on flexible real wages, as demonstrated in Goodwin's path-breaking formalization of this mechanism, Goodwin 1967, Marx 1967b, ch 25, Shaikh 2003a. The macroeconomic aspects of this argument are taken up in chapters 13 to 14 within Part 3 of this book. There remains the fascinating issue of the factors that account for linear standard prices at the empirical level. It can be shown that exactly linear standard prices obtain if the subdominant eigenvalues of the vertically integrated capital coefficients matrix H are all zero, Appendix 9.1. One possible explanation derives from the theory of random matrices. While experimenting with equilibrium computations using randomly generated matrices, Brody, 1997, noticed that the speed of convergence toward equilibrium increased with matrix size. Since the relative size of the second eigenvalue with respect to the first determines the convergence speed, Brody conjectured that this relative size tended to fall as a random matrix got larger. While this does not appear to hold for observed input-output matrices, Mariolis and Solfidis 2012, Table 1, 6, Bedard and Chatiman, 2001, proved that in a random matrix with independently and identically distributed entries the speed of convergence increases with the size of the matrix because the relative size of all subdominant eigenvalues tends to zero as the matrix size approaches infinity. Scaffold, 2010, then showed that zero subdominant eigenvalues imply linear wage curves. The random matrix hypothesis can be interpreted to say that as an input-output matrix A gets larger, all column elements become like random variables drawn from the same population. Then expected values of their means would all be the same. Notice that this can only apply to the money forms of input-output matrices whose elements are dimensionless because each entry represents the money value of an input relative to the money value of the industry output. Matrices in physical form will not do because each element is in different units, example tons of steel used in the production of one machine versus packs of flour used in one loaf bread, etc. Since the column average of the input coefficients is simply the industry's capital-output ratio, a purely random A would imply that capital-output ratios would tend toward equality as we move toward ever more disaggregated matrices. However, since labor coefficients would still differ across sectors, the capital, labor ratios would still be unequal so that prices of production would still deviate from direct prices. The random matrix hypothesis explains why standard prices would be essentially linear, just as they are in Marx's transformation procedure. Scaffold states that more recent work on random matrices has shown that the subdominant eigenvalues will go to zero even if each column, each set of industry technology coefficients, has its own mean. It turns out that the subdominant eigenvalues tend to zero not only for random matrices with a common mean for all elements of the matrix, but it suffices given the other assumptions that each column has its own mean. Scaffold 2010, 20. My own calculations raise a further issue. When one moves from an empirical circulating capital model to a fixed capital one, there is a remarkable straightening effect on standard prices. Compare figures 9.6 and 9.10. Inspection of investment and fixed capital matrices reveals the striking fact that only a relatively small number of commodities serve as capital goods. In the 1998 investment and capital matrices, fully 38 of the 65 rows, 58%, are exactly zero because these commodities are not capital goods. We know then that we'll also have 38 zero rows and hence 38 exactly zero subdominant eigenvalues. This, as can be imagined, has a powerful effect on reducing the relative size of the average subdominant eigenvalue, which is the crucial factor in linearity of standard prices. Then even the linearity of standard prices turns out to be structural, rooted precisely in the real difference between capital goods and other commodities. One can well imagine that the relative number of non-capital goods, that is, the percentage of zero rows, will rise as the matrix gets more detailed, which would be an alternate link between matrix size and the predominance of very small subdominant eigenvalues. These considerations raise the interesting question of what constitutes a representative small model of the economy. In their search for logical possibilities of price complexity, Sraffians have long produced examples of small matrices in which wage-profit curves display sufficient complexity to produce reswitching. I would argue that we should proceed in the opposite manner, from the observed patterns to representative models. In this light, the smallest representative model would be a three-sector model with three functionally distinct commodities, one material input, basic good, that entered into all production, one consumption good, and one capital good, machine. Then the input-output matrix A would have two zero rows corresponding to the consumption and capital goods, since neither of these enter into production as inputs, and the capital goods matrix K would also have two zero rows, corresponding in this case to the material input and the consumption good, neither of which function as capital goods. It is easy to show that such a system will have linear standard prices because both the subdominant eigenvalues of will be zero. The informed reader will immediately recognize that Marx long ago developed such a model in his schemes of reproduction, Marx 1967b, chs 20-21. 10. Competition, finance, and interest rates. Introduction. 1. Interest rates. The interest rate is the price of finance. In capitalism, the provision of finance is undertaken by financial businesses seeking to make as much profit as they can. Competition from other financial capitals then causes the profit rate of the regulating financial capitals to gravitate around the general rate of profit. It is therefore natural to view the competitive interest rate as the price of production of finance, Panico 1988. This implies that the interest rate will be linked to the profit rate in the same manner as any other competitive price. For non-financial firms, the interest rate is the benchmark for the return on capital left passively in the bank rather than being actively invested in risky capitalist enterprise. Hence, it is the excess of the profit rate over the interest rate that regulates the growth of capital. In Keynes, this is the difference between the marginal efficiency of investment and the interest rate. In Marx it is called profit of enterprise. I will call this the net rate of profit. 2. Net rate of profit. In the present chapter, I will focus on the competitive determination of the interest rate. The impact of the interest rate on the growth of capital, on inflation, and so on will be addressed in Chapter 15 in Part 3 of this book. We know, of course, that the rise of central banking has gone hand in hand with the manipulation of interest rates and exchange rates, the latter to be addressed in the next chapter, in order to move them away from their market levels. The ease or difficulty of such projects depends on distance between their desired and market levels, which is why we need to understand where the market would have taken them in the first place. 3. Term structure. At an abstract level, we speak of the interest rate. At a more concrete level, we must also account for the term structure of interest rates, i.e., for the fact that long-term rates are generally higher than short-term rates. This too can be derived from the classical theory of profit rate equalization by combining it with Hick's argument that term structure of interest rates arises from the costs of financial intermediation. 4. Orthodox and heterodox theories of the interest rate. The striking thing about neoclassical and Keynesian theories of interest rates is that they treat the provision of finance as if it were a non-capitalist activity with neither operating costs nor capital advanced. Once costs and capital have been abolished from the picture, there is no possibility of a production price in finance. Then we can only anchor the interest rate in preference structures and expectations. Panico's path-breaking work recovers the classical analysis of the bank interest rate as a cost-based competitive price, based on the fact that bank capital participates in the equalization of profit rates. Panico 1983, 179-183. Some post-Keynesians also treat bank interest rates as markups on banking costs, except, of course, their emphasis is on monopoly power. 1. But others abandon any notion of market determination, arguing instead that the interest rate is purely conventional. Rogers 1989, 268. 5. Bond prices. The theory of interest rates leads naturally to the theory of bond prices because a bond is a promise to pay back a loan with interest. Harrod 1969, 179. Francis 1993, 289. Modern bonds are also transferable, so that their original and subsequent buyers can generally resell them on the bond market. Consols are bonds that promise to pay a periodic fixed sum, coupon, covering both principal and interest in perpetuity. These arose when the Bank of England, like the British Empire, was considered eternal. Like Ozymandias, both have ceased to exist. Nonetheless, consols remain popular in textbooks because of the simple fact that the lifetime interest rate on a consol equals its coupon divided by its price. At the other extreme, zero-coupon bonds are sold at a discount to their face value, say sold at $900 for a redeemable face value of $1,000, the difference being a prepaid quantity of interest. Zeros also have simple analytical properties which make them popular in textbooks. In between consols and zeros lies a multitude of other bonds. PAR bonds are sold at face value, $100 by convention, and pay coupons for an interval until they are redeemed. O'Brien 1991, 27. These appear in the more advanced sections of textbooks in order to introduce us to the wonders of compound interest. In actual practice, the universe of bonds is a diverse combination of the basic types, and even one firm can have several types of bonds. Riley and Wright 2000, 157. Bonds can be held to maturity, in which case the holder receives sum of periodic payments corresponding to the interest rate promised in the bond. This is the aspect of concern to many households and institutions. But to the professional investor who buys and sells bonds for profit, what matters is the one-period rate of return on a bond, which is the sum of its coupon, if any, and its price change, relative to its initial price. From the professional point of view, conventional yield measures such as yield to maturity and yield to call offer little insight into the potential return of a bond. Fabozzi 2000a, 75. In what follows, I will focus on the two basic types of bonds, zeros and consols, the latter being proxies for long bonds, to show that once we have a theory of term interest rates, we also have the corresponding theory of bond prices and rates of return. 6. Equity prices. An equity, a stock, is an ownership share in a corporation. While a bond is a definite promise to make interest payments to its buyers, An equity embodies only a promise to try to make profits for the shareholder, Weston and Brigham 1982, 314. The rate of return on an equity over a period is the sum of its dividend payments and its price appreciation, capital gains, relative to the price of the equity at the beginning of the period. From the classical point of view, the equity return will be equalized to the general rate of profit on new investment. Since the latter depends on the profits of industry, we can see why practitioners generally link equity prices to corporate earnings per share. We will see that profit rate arbitrage implies a specific link in this regard. 7. Financial arbitrage. Neoclassical and Sraffian theories of fixed capital assume that the competitive prices of older capitals adjust so as to make their rate of return equal to that on new capitals. Hence, all capitals, regardless of their vintages, should have the same profit rate as the average. I have argued on theoretical grounds against this conception of the valuation of capital, Chapter 6, Appendix 6.4. Moreover, neither business nor national accounts value individual capitals in the prescribed manner, so the observed average rate of profit is very different from the rate of return on new investment, which is the appropriate competitive rate, Chapter 7, Section 4. Intersectoral capital flows, i.e., new investments, target regulating capitals in each industry, and competition equalizes their rates of return. Average rates of profit are a mixture of rates of return on new and older vintages of capital, the latter being dependent on the manner in which costs rise and profit margins fall as individual capital goods age. This raises a second important issue internal to the financial sector itself: the distinction between the profit rates of financial firms and the rate of return on financial instruments such as bonds and equities. Firms involved in buying and selling financial instruments derive their profits from explicit or implicit fees to banks from their interest rates on loans and so on. The firms all strive to make profit, and their rates of return are ultimately regulated by competition. In all cases, one of the activities of such firms is to try to take advantage of discrepancies in rates of return in various arenas. For instance, speculators borrow in markets with lower interest rates in the hope of lending in markets with higher rates. Dealers buy securities for their own account and hope to resell them quickly at a higher price. At a hoped for profit, Ritter, Silber, and Udall 2000, 256. Such actions serve to eliminate discrepancies, i.e., to equalize interest rates among lenders and equalize rates of return among financial assets. However, they do more than that, because if the rate of return on financial speculation is systematically greater than that in industrial activities, capital will flow at an accelerated rate into finance. While this may initially raise asset prices and speculative profits, further expanding the discrepancy between speculative and industrial profit rates, at some point the bubble bursts and speculative profits collapse. George Soros's theory of reflectivity, which emerges from his considerable experience in the world of finance, provides a framework for analyzing such events. He advances three general theses: 1. Expectations affect actual prices, 2. Actual prices can affect fundamentals, and 3. Expectations are in turn influenced by the behavior of actual prices and fundamental prices. The end result is a process in which actual prices oscillate turbulently around their gravitational values. Expectations can induce extended disequilibrium cycles in which a boom eventually gives way to a bust. Soros 2009, 50-75, 105-106. Since expectations can affect fundamentals, the gravitational centers may themselves be path-dependent. Arthur 1994, David 2001, Point 3. Hence, the future is not a stochastic reflection of the past, so that the overall system is non-ergodic. Davidson 1991, Point 4. The existence of extended disequilibrium processes invalidates the efficient market hypothesis, while the dependence of fundamentals on actual outcomes invalidates the notion of rational expectations. Soros 2009, 58, 216-222. Lastly, it is important to recognize that while expectations can influence actual outcomes, they cannot simply create a reality which validates them. 40 to 44. On the contrary, gravitational centers such as the general rate of profit continue to act as regulators of actual outcomes, which is precisely why booms eventually give way to busts. So we have two distinctions to keep in mind, those between the profit rates on average versus new capitals, and those between the profit rates of financial firms versus the rate of return on financial speculation. The key point is that competition equalizes the rate of return on new capitals, regardless of their application. The equalization process is always turbulent, but it is especially so in the case of speculative activities in which bubbles can attend the toil and trouble. This will prove to be important in the discussions of the efficient market hypothesis as well as Shiller's counter-hypothesis of persistent irrational exuberance, Section 8. Finally, the notion of stock market arbitrage is perfectly compatible with the fact that the equity market contains different types of investors whose investment criteria range from the personal to the professional. What is important for arbitrage is that there exists a set of investors motivated by differences in rates of return between competing applications of capital. It is this set that tops off each investment market, thereby maintaining the turbulent equality between rates of return. 2. Competition and interest rates. Competition within an industry leads to roughly similar prices for a given type of commodity. Competition between industries leads to production prices that yield roughly similar profit rates for the regulating capitals of each industry. The same processes operate for the interest rate. Competition within the financial sector equalizes interest rates for a given type of instrument, and competition across sectors establishes a level of the interest rate that yields a normal rate of profit for the financial regulating capitals. In this regard, it is useful to begin with the oldest financial instrument, which is a bank loan. 5. 1. Competition and the banking sector. Consider a set of banks that compete to attract demand deposits and to offer loans. Demand deposits earn no interest because they are essentially as liquid as cash. But they are generally safer than cash, and more convenient for certain types of payments. Banks therefore compete by offering banking conveniences in order to attract and retain depositors. Moore 1988, Hicks 1989, 55-56. On the lending side, banks compete to offer loans to businesses and households, and competition equalizes the interest rates on loans offered by various banks. This is the first moment of competition as it appears in the banking sector, and it gives rise to a common loan rate of interest which must be less than the general rate of profit if business borrowing is to be sustainable. Hicks 1965, 285, Marx 1967 c. 378-379. 2. Profit rate of enterprise, R.I. The condition in equation, 10.1, can be read as the requirement that the difference between the money rate of profit and the money rate of interest rate, R.I., must be positive in order for firms to be viable. The money rate of profit is pure number when it is measured as the ratio of profit adjusted for current costs over capital expressed in current costs, Appendix 6.2.2. Sraffa, 1960, 32-33, links the profit rate to the money rate of interest, since it too is a pure number. For any current cost capital stock K, the current profit is and the corresponding potential current interest flow is. The difference between the two flows is profit of enterprise, the gauge of how active capitalist initiative compares to passive investment. It follows that the profit rate of enterprise is. The loan interest rate directly regulates capitalist accumulation through its role as the benchmark against which the general rate of profit can be measured. But it also determines the bank rate of profit itself. Bank revenue consists of interest receipts on loans, where the total stock of loans, and bank profit PB is the difference between bank revenue and operating costs. Bank capital advanced is the sum of its operating cash and financial assets, which is essentially bank reserves and bank current cost fixed capital KBF, and the average banking rate of profit is the ratio of bank profits to bank capital, Panico 1983, 182. Right away we once again encounter the distinction between the rate of profit on average banking capital and that on new capital. Total bank interest revenue is the sum of interest payments arising from present and past loans, just as total bank capital is the sum of newer and older vintage. If interest rates were all variable rates, then the average interest rate would equal that on new loans. At the other extreme, if they were all fixed, then the average and current interest rates would diverge on account of the effects of loan vintages. In either case, average and regulating profit rates would differ due to the further effects of capital vintages. The upshot is that when discussing the equalization of bank profit rates, we must operate in terms of the current interest rate on new loans and the current profitability of new banking capitals. With this caveat in mind, bank profit and capital are. The bank profit rate is the ratio of bank profits to banking capital. Since banks make their profits primarily by issuing loans, there is a strong incentive for them to maximize the ratio of their loans to deposits, minimize the ratio of deposits to loans, subject to the need to maintain adequate reserves in order to ensure their credibility. This need is inherent to banking, whether or not it is monitored by the state. See Chapter 5, Section 2. A loan is initially recorded as a deposit in the issuing bank, but as the proceeds of the loan are spent, deposits and reserves flow from the issuing bank to other banks in the area, in the region, in the nation, and in the world. Hence, individual banks have always been forced to maintain prudent ratios between loans, deposits, and reserves long before the state stepped in to establish required minimum ratios. The ratio of reserves to deposits is a measure of the safety of deposits, while the ratio of deposits to loans is a traditional measure of bank liquidity. Ritter and Silber 1986, 128-129. If we abstract from banking costs and fixed capital for the moment, then bank profits are equal to bank revenues and bank capital advanced is equal to reserves, so that the banking rate of profit reduces to where the reserve-to-loan ratio. A lower reserve-to-loan ratio enhances a bank's profitability but also increases the risk of its failure. Even under the restraining hand of government regulation, the balance point is often manifested through bank failures, the manner in which the invisible hand winnows out losers. In any case, for given desired reserve and deposit-to-loan ratios, bank profitability is driven by the interest rate. In the competition among banks, some banks will fare better than others. Of these, the ones operating under generally reproducible conditions will become the regulating capitals of the banking sector. According to the second moment of competition, intersectoral capital flows will turbulently equalize the profit rates of regulating capitals in banking with those of regulating capitals in other sectors, i.e., with the general regulating rate of profit. In order to bring out the parallels with other economic theories, I will abstract for the moment from the regulating/non-regulating distinction so that I may speak of the normal rate of profit, R. The key point is that profit rate equalization reverses the causation between the profit rate and the interest rate, because a normal profit rate in banking determines the normal interest rate. To see this, we impose the profit rate equalization condition RB equals R, where R is the general rate of profit, on equation 10.5, to gives us the long-run competitive rate of interest. 3. Relation of the interest rate to the price level and the profit rate. The foregoing is the simplest expression of the interest rate as the price of provision, the financial analog of commodity prices of production. It tells us that when we abstract from bank operating costs and bank fixed capital, the competitive interest rate is proportional to the normal regulating rate of profit. This is essentially how Smith, Ricardo, and Mill viewed the matter, Panico 1983, 167. Note that the proportionality factor is the reserve-to-loan ratio, which can vary over time as its components change. For banks to be economically viable as providers of credit, they must lend out as great a multiple of their deposits as possible so that, at the same time maintaining as low a reserve-to-deposit ratio as possible so that it follows that for regulating banks, which ensures that the equilibrium competitive interest rate will be less than the profit rate as in equation 10.1. Hence, at this level of abstraction, the bank profit rate of enterprise would be structurally determined and would itself be proportional to the profit rate and would increase with the latter, Other things being equal. In orthodox economics, I would be interpreted as a risk premium on active investment, but in the classical account this difference is a structural factor. It is also a multiplicative factor, since equation 10.6 implies that, where because we can, of course, introduce risk into the classical story, as a factor causing a persistent difference between the rates of profit of any two sectors. But this would require there are indeed differences in risk, measured by, say, the respective volatilities of real and financial incremental rates of return. We will see in figures 10.1 and 10.11 that there is no empirical basis for such an assumption. At this level of abstraction, the interest rate appears to have a natural level determined solely by structural factors and the profit rate. The result changes once we bring bank operating costs and fixed capital back into the picture. One of the peculiarities of a financial intermediary is that its output is a money quantity, which in the case of banks is the total quantity of new loans. Hence, the physical output coefficients of the bank are physical input quantities per dollar of loan. 0.6 Then at normal capacity operations, doubling the volume of bank loans will require roughly double the inputs of quantity of paper, computers, office space, and labor time. In what follows, I will represent these various inputs as real magnitudes, i.e., as nominal costs divided by the price index. A more detailed physical output representation which gives the same results is presented at the end in section 7 of this chapter. Let represents real costs per deposits, real costs per loans, net of service charges, and real fixed capital per loan at normal capacity. If P is an index number of the price level, the corresponding nominal costs become. For the moment, we are only considering demand deposits which normally do not pay interest rates. Then the normal capacity bank profit rate can be expressed as in the most abstract case, a rise in the interest rate will raise the bank rate of profit, other things being equal. But now a rise in the price level will lower the bank profit rate by raising operating costs and the costs of fixed capital. This latter point becomes significant when we consider the longer run over which the bank rate of profit is equalized with the general rate at the normal rate of capacity utilization. The loan rate of interest then functions as the nominal price of production of the banking sector, Panico 1988, 186-190, determined by the general rate of profit and the general price level as it operates through bank operating and capital costs. To see this, we impose the profit rate equalization condition on equation 10.7, to get the competitive loan rate of interest, I, in terms of the general rate of profit, R, the price level, P, and various output coefficients relevant to banking. The previous abstract formulation in equation 10.6 implied that the interest rate would have a natural level determined by the normal profit rate. The more concrete formulation in equation 10.8 shows that this is not so because the interest rate also depends on the general price level, so that there would be a different long-run interest rate for each different price level. 0.7 Feasible interest rates would still have to be below the profit rate, equation 10.1, and the normal profit rate of enterprise would still be positive and increase with the profit rate. But now an increase in the price level would raise the normal interest rate and lower the profit rate of enterprise. 0.8 That itself is proof that money matters for real outcomes. The connection between interest rates and the price level provides a direct explanation for the empirical association known as Gibson's paradox, and even generates a more specific hypothesis that interest rates will generally rise less than the price level when banking sector real costs are falling or when the general rate of profit is falling. Unlike standard theory, there is no distinction here between the theory of the term structure and theory of the level of interest rates rate, Conard 1959, 288-289, 298. In my argument, the competitive equalization of profit rates will be shown to determine both level and the normal, upward shape of the yield curve. Risk plays a role, but only through the associated costs to banks. The ideas advanced in this section resolve an apparent contradiction within Marx's theory of interest rates. Marx vehemently opposed the notion of a natural interest rate proportional to the general rate of profit, as in Smith and Ricardo, Shaikh per 1995, 444. He was quite familiar with Tooke's empirical finding that interest rate varied with the price level and therefore was not structurally tied to the profit rate. At the same time, the logic of Marx's own argument implies that intersectoral competition would equalize the bank rate of profit with the general rate and therefore link the interest rate to the profit rate. Panico 1988, 87-88, Ito and Lipovitz's 1999, 70, 95-96. His fragmentary published writings on the subject do not reconcile these two aspects, so subsequent writers on Marx have had to choose one or the other. See section 7 below. However, we can now see that the two aspects can be reconciled since both the Smithian, Ricardian link to the profit rate and the Tooke, Gibson link to the price level can be derived from the equalization of profit rates. 4 implications of the classical theory of the interest rate. Equation 10.8 tells us that the competitive nominal interest rate, and hence the corresponding market rate, will be positively correlated with the price level. In his 1838 History of Prices, Tooke and Newmarch, 1928, observed that the interest rate and the price level tend to move together. Panico 323, 439, Ito and Lipovitz's, 29. Marx was familiar with this evidence and specifically cites Tooke on interest rates, Marx 1967 ch. 23, 370. Gibson, 1923, rediscovered the same pattern almost a century after Tooke, and Keynes says that the association between the interest rate and the price level is one of the most completely established empirical facts in the whole field of quantitative economics, Keynes 1976, 2:198. Nonetheless, Keynes calls this Gibson's paradox because it contradicts the standard monetary hypothesis that interest rates should move with the rate of change in prices, that is, with the actual or expected inflation rate instead of the price level, McCulloch 1982, 47-49. 3 other implications can be derived here. Given that the nominal interest rate is the price of finance, the relative price of finance I/P is a function of the profit rate and real banking costs. Second, if either of the latter two falls over time, the nominal interest rate will fall relative to the price level. Finally, we know that there are periods on which central banks have explicitly intervened to change the trend of the interest rate. For instance, in the United States during the Greenspan era the T-bill rate fell from 14.03% in 1981 to 4.74% in 2006 and now stands at 0.1%. In order to distinguish the effects of policy from those of the invisible hand, we must first have a theory of the competitive level itself as provided in 10.8. There can be policy without theory, but there can be no theory of policy without theory. I return to this issue in section 7, figures 10.6 to 10.8. 5. A structural theory of the yield curve. As a general rule, it pays financial institutions to match maturities of assets, loans, and liabilities, deposits, because this minimizes the risk associated with interest rate changes. Lutz 1968, 225, Ritter, Silber, and Udall 2000, 212. Since demand deposits can be withdrawn at will, banks or bank divisions that fund their loans through demand deposits will be best at making short-term loans. We may think of these as banks that take in 0-period deposits and issue 1-period loans at the 1-period interest rate, I. Now suppose that there is a market for 2-period loans, which could be supplied by another bank or division. In banks taking in 0-period deposits, 2-period loans would require a longer commitment of funds than 1-period loans and would therefore require larger reserve and deposit-to-loan ratios. They would also entail higher risk due to the greater uncertainty associated with a longer time horizon. 9. In the short run, both 1-period and 2-period interest rates would be determined by the demand and supplies for the respective types of loans, and in general the profit rates of the two types of banks would differ. But over the longer run, competition would ensure that the normal capacity profits rates would be roughly equalized. In terms of equation, 10.8, the higher costs associated with two-period loans would require that they be offered at a higher interest rate in order to achieve the same profit rate as one-period loans. In other words, the yield curve 10 would normally be upward sloping on structural grounds. Note that the requisite condition for this term structure is that both banking operations have the same rate of profit. The further equalization of this common banking sector profit rate with the general rate of profit will change the level, but not the term structure, of interest rates. We therefore arrive at a dual result. The level of the short-term interest rate is determined by the equalization between the bank sector profit rate and the general rate of profit, and the term structure of interest rates is determined by the equalization of profit rates among banks. We can take the argument one step further by noting that part of the higher costs of two-period loans can be defrayed by matching the maturities of deposits and loans, Ritter, Silber, and Udall 2000, 212. A bank that funds two-period loans by taking in time deposits will have the advantage in two-period loans because it will have lower costs than a bank, or division, based on demand deposits. Arbitrage will then ensure that the rate of interest it offers on one-period time deposits is the same as the rate of interest on one-period loans, i. In the phraseology of Hicks, the out rate on two-period loans, I2, will now also depend on the in rate on one-period time deposits, Hicks 1965, 284-290. The equalization of profit rates within the banking sector, between the two types of banks, will determine the upward slope of the yield curve, while the equalization of profit rates between the financial and real sectors will determine the level of this curve. As in the case of short-term loans, if businesses are to undertake two-period loans, the interest rate must be less than the general rate of profit. If we define the desired two-period deposit-to-loan ratio as, the two-period long-term rate of interest will be determined as in equation 10.9, in which the one-period interest rate is the in rate appearing through the unit cost of time deposits, and the two-period rate is the out rate. The analysis can obviously be extended to encompass a whole spectrum of interest rates in which the yield curve is normally upward sloping insofar as costs are generally higher for longer term, i.e., less liquid, bank assets. Keep in mind that this only applies to normal interest rates determined by profit rate equalization. In the short run, market rates will be determined by the supplies and demands for the various types of loans, so that the yield curve can have a variety of shapes. Notice also that the two-period interest rate now depends on the one-period interest rate, since the latter is part of the input cost of this division. Non-financial enterprises are different in this regard, because their production inputs do not include deposits of various time dimensions. Banks and non-financial enterprises both use the interest rate as a benchmark for their profit rates of enterprise and both disperse some portion of their total profits as interest on their particular loans. But only banks also have deposits as inputs, Appendix 6.7.4. To summarize the argument so far, the classical theory of the interest rate has five main implications. In the short run, monetary interest rates of various terms will be determined by the demand and supplies of various types of loans and deposits, and will vary due to cyclical and conjunctural factors, including sharp changes in risk. Hence, in the short run, the yield curve can take a variety of possible shapes. However, over the medium run, the equalization of profit rates among various banking operations will generate the shape of the yield curve, which will normally be upward sloping. This provides us with a structural determination of the yield curve, as opposed to the standard psychological determinations arising from expectations and/or liquidity preference. Over the longer run, the equalization of the bank profit rate with the general rate of profit will determine the level of the whole spectrum of bank interest rates, i.e., the level of the bank yield curve. Longer-term rates of interest will also shift upward if the base rate, I*, rises, making it appear as if interest rates are set by banks by means of monopoly power markups on the base rate, Moore 1988, 258, Fontana 2003, 9, 14, despite the fact that both the base rate and longer-term rates are determined entirely through competition. Lastly, risk is already incorporated into the costs of different term loans, so there is no need to incorporate a further risk premium. On the whole, interest rates will be determined by the general rate of profit, the general price level, and various particular costs associated with the maturity and risk of the loans being offered. The next section extends the reach of the classical argument, first to equities and then to bonds, deriving distinctly different patterns for the two. Arbitrage among bank loans and equivalent bonds will equalize the yields on both instruments at a level below the rate of profit, for otherwise businesses would not be able to borrow. Because bond yields are directly, and inversely, tied to bond prices, this process will also determine the bond rate of return at a level which will generally be below the general rate of profit. There is no further room, so to speak, for speculators to also equalize the bond rate of return with the profit rate on real investment. On the other hand, since dividends and equity prices are independent variables, there is room for the equalization of the equity rate of return, the dividend yield plus the rate of change of the equity price, with the profit rate. The immediate consequence of these differences is that the equity rate of return will be systematically higher than the bond rate of return. This well-known and long-standing empirical pattern has so mystified standard economic theory that it has been officially labeled the equity premium puzzle, Murrah and Prescott 1985, Murrah 2003. Yet it follows quite naturally from the classical approach. 3. Competition and the stock market. The equity rate of return is calculated in the same way as that of a bond. It is the sum of the dividend paid and the change in equity price, capital gains, relative to the initial equity price. Like bonds, some stocks pay dividends and others do not. This is where the similarity ends. Bonds are a promise to pay interest and their yield to maturity is the fulfillment of their pledge. The type of bond does not matter, since interest rate arbitrage will ensure that an end-period discount, zero coupon, bond will offer the same yield as end-period coupon bond. In the case of an equity, there is no commitment to pay any sum or to match any yield. Indeed, the standard theorem on this matter states that the split between dividends and retained earnings is entirely irrelevant to the equilibrium money value of a firm's total equity or to its cost of funds, Miller and Modigliani 1961. Firms decide on their dividend and reinvestment policy and the market decides on their equity prices. These prices, along with the particular dividend/reinvestment policy adopted, determine the equity's rate of return. And just as arbitrage equalizes interest rates across financial products, it equalized rates of return across equities and between the equities market and the real sector. The rate of return on an equity, REQ, over a period is the sum of capital gains or losses, and its dividend payments, DVT, relative to its initial price. In the case of a bond, its yield to maturity is equalized with the corresponding interest rate, and this process determines the long-run price of the bond and hence its long-run rate of return. It follows that the bond rate of return cannot also be equalized with the general rate of profit. On the other hand, the long-run price level of equities is determined by the equalization between the stock market and real rates of return and the dividend per share, in which case the dividend yield, dividend/price, is not equalized with any interest rate. Indeed, the equality of the two rates then determines the path of equilibrium stock prices consistent with current dividend policy. Notice that if there are no dividends, the rate of return in the stock market will be comprised solely of capital gains, so that the corresponding real equity prices must keep rising at the same rate as the real rate of return. Needless to say, this does not imply that all corporations, whether they provide dividends or not, are competitively successful. Because an equity is valid for the life of a firm, equity yields have been compared to variable coupon long bonds, Lutz 1968, 300. But the coupon of a bond is only one means to ensure that the bond can live up to its promised lifetime yield. In the case of an equity, there is no such promise or pressure. Individual equity owners may well regard dividend flows differently from changes in equity prices, but in the arbitrage market all that matters is the overall rate of return, net of trading costs. Hence, new capital will flow more rapidly into the purchase of equities with higher expected rates of return, and less rapidly into the others. These flows will top off the effects of individual portfolio choices and equalizes, risk-adjusted, rates of return among equities. And since new capital can equally well flow into other sectors, this same process will also equalize rates of return between the equity market and the commodity sector. The contrasting results for bond and equity markets are summarized in equations 10.2 to 10.13. For competition and the bond market. A bond is a financial instrument sold at time t for some price, in return for which the holder will receive a final payment of the bond's face value FB at the end of its bond's life and possibly some periodic payment, coupon, CPT over its lifetime. A coupon bond can sell above, at, or even below its face value because the regular coupon payments constitute a stream of interest flows over and above its purchase price. A consol is a coupon bond with no maturity date, so that it pays only a coupon into perpetuity, having no face value since it is never redeemed. 11 Consols are conceptually useful because they are the limiting case of a long bond. At the other extreme, a zero coupon has no coupon payment, so the buyer only gets back the face value at the bond's time of maturity. Therefore zeros must sell below their face value, the difference between the purchase price and the face value constituting a lump sum interest payment. 12a1 period 0 is equivalent to a time deposit, since the purchase of such a bond locks up the money until the end of the period, at which time the payment of its face value returns a sum greater than its purchase price. 13 Given a zero's current price, its interest rate is determined by the degree to which this price falls below the bond's face value. Both consols and 1 period zeros have simple algebraic properties, which is why they are so analytically beloved. Conard 1959, Lutz 1968, Paddington 1989. Given the market price of a bond, the money rate of interest, yield to maturity, on any bond is defined as the constant rate which makes discounted present value of the payment stream equal to the observed market price of the bond. As Schiller notes, the restriction to a constant rate is not necessary. Schiller 1981, 430, 2001, 260 and 24. In any case, for our purposes, it is sufficient to consider the standard treatment of the two polar cases of a 1 period zero and a long bond of 20 years or more whose yield is approximately given by the formula for a consol, Mishkin 1992, 78, 83. Then for any given face value and observed bond prices, the interest rates on these two types of bonds are defined below. In general, a rise in the bond price lowers the implicit interest rate. It is important to note that the size and path of the coupon plays no significant role in bond arbitrage. This is obvious in the case of zero coupon bonds of different maturities. But it holds equally well for any sort of coupon bonds. In the case of bonds, competition equalizes the yield to maturity, the interest rate, on instruments of the same risk, maturity, and payment dates, even if they have different coupons. Payments. 14 Coupon payments are generally set at the time of issue for a variety of reasons exogenous to the arbitrage process. 15 This means that the prices of equivalent coupon bonds will offset differences in coupon payments in just such a way as to generate a common yield. 16 In contrast to the yield of a bond over its lifetime, the 1 period rate of return on a bond is defined as the sum of its coupon payment and capital gain or loss, change in bond price, in the period, relative to its initial price. For a zero coupon, and, while for a long bond with given coupon 0.17 then rates of return are directly linked to the corresponding interest rates, so determining one determines the other. We are now ready to integrate bonds into the theory of interest rates. Arbitrage between equivalent bond and bank loans will equate their rates of interest. Hence, a 1 period bond will have the same interest rate as a 1 period loan, and a long bond will have the same interest rate as a long loan, so that bond interest rates will have the same properties as bank interest rates, they will be less than the profit rate. Equation 10.1, they will rise with the profit rate, and they will rise with the price level and the base loan rate, which is itself determined by profit rate equalization. But if bank interest rates determine the bond yields as in equations 10.18 and 10.19, they also determine bond rates of return through equations 10.16 and 10.17. The rate of return on a zero coupon will be directly equal to the short-term bank rate of interest, so that at the other end, the long bond return will be less than, equal to, or greater than the long bank rate of interest according to whether these interest rates are rising, bond prices falling, stable, or falling, bond prices rising. Point 18. Since interest rates are generally lower than the profit rate, the foregoing considerations suggest that long bond rates of return will also generally be lower than the profit rate, though they may equal or even exceed the latter under certain conditions. This is exactly what we find at an empirical level. Section 6. V. Summary of the classical theory of finance. The classical theory of finance is founded on four major propositions. First, in order for accumulation to proceed, the money interest rate must be less than the money profit rate. Equation 10.1. Second, the regulating profit rate of the banking sector is equalized with the general rate, so that the rate of interest on bank loans represents the price of production of the banking sector. Equation 10.8. The third proposition is that bond yields are equalized with equivalent bank loan rates of interest. This in turn determines the bond rate of return at a level which is generally different from the general rate of return. Equations 10.16, 10.19. Given that the stock market rate of return is equalized to the general rate, as shown in equation 10.11, the equity price is determined by dividend policy, which need not make the dividend yield equal to any interest rate. Many familiar results in standard finance theory can be derived as special cases that obtain when variables are assumed to be constant, stationary, over time. Equation 10.8 tells us that the bank rates of interest, I, will be constant over time if the price level, P, and the profit rate, R, are constant and if real costs do not change, so that real wages are constant and there also is no technical change. Since the bond yield is equalized to the bank rate of interest, equation 10.19, then the bond interest rates, IB, will also be constant, in which case bond prices, PB, will be constant if coupon rates, C, are constant over time. Equation 10.15. This in turn implies that the bond rate of return, RB, will be constant. Equation 10.16. Finally, equation 10.11 tells us that in the presence of a constant profit rate, equity prices will also be constant if the dividend per share, DV, is constant, in which case the equity rate of return, REQ, will equal the dividend yield, equation, which will be in turn equalized through arbitrage with the profit rate. Equation 10.12.19. Equation 10.20 summarizes this very special set of conditions. All of the preceding conditions are textbook standard. Their peculiar character becomes evident as soon as one looks at actual empirical patterns, so the empirical analysis in the next section will not rely on them. Yet even under these special conditions, as long as the normal rate of interest is lower than the normal profit rate, that is, equation 10.1, then the bond return will be lower than the profit rate, and since the equity rate of return is equalized to the profit rate, the normal equity rate will be greater than the normal bond return. An equity premium is a fundamental consequence of the classical theory of interest rates even at the most abstract level. Finally, the condition for stationary stock prices in 10.20 can be inverted to write as. Now consider Tobin's Q, which is the ratio of the equity value of the corporate sector to its capital stock, K. Let total shares outstanding, the total value of outstanding equity, and earnings per share. Then in which case standard requirement that in equilibrium implies that dividends per share equal earnings per share, i.e., that all profits are paid out. The crucial move in standard theory is to abolish all discrepancies between bond and equity markets by replacing the key classical assumption that the interest rate be less than the profit rate with the assumption that the two be equal in a perfectly riskless world. Lutz 1968, 226-227. It must be said that since capitalism actively disrupts all that it encounters, the assumption of an unchanging riskless world amounts to assuming away capitalism itself. In any case, equations 10.20, 10.22, then yield the familiar result that the interest rate is equal to the rate of return in all markets, and equation 10.23 implies that the stock price is thereby equal to the present value of an infinite stream of dividend payments discounted by the constant interest rate, profit rate, and given the equality of dividends and earnings when Tobin's Q equals 1, it also implies that the equity price equals the ratio of earnings per share to the interest rate, i.e., the equity price is the discounted present value of earnings treated as an infinite stream. The latter assumption is the basis of a widely used Fed model of stock market valuation, Bronson 2007. It is well known that most practitioners focus on earnings, not dividends. Elton, Gruber, Brown, and Getzman 2003, 450-459. The expression in equation 10.26 looks just like the standard discounted cash flow (DCF) model, but it is not the same. The classical result represents the current outcome of actual turbulent profit rate equalization in the very special case of constant stock prices, dividends, and profit rates. The profit rate equalization is in turn the unintended outcome of the actions undertaken by individual firms to increase their profits, actions undertaken on the basis of differing expectations, many of which will prove to be incorrect. Fishing is not the same thing as catching. The neoclassical result derives from the assumption that some representative investor subjectively and correctly estimates the price of a stock as the present value of a constant expected dividend stream discounted over an infinite horizon by means of a constant expected interest rate. The first step in this chain is to assume that a single representative agent estimates the correct stock price as the discounted present value of the expected cash flows. Then over one holding period this investor would define the correct price as discounted value of the dividend expected to be paid at the end of the period plus the discounted value of expected price of the stock when it is sold at the end. Of course, this calculation requires a prior estimate of the future price of the stock, which according to the assumed behavior would depend on the expected dividends, stock price, and interest rates 2 periods ahead. Substituting this into the current stock price estimate in equation 10.28 yields, which, however, requires a prior estimate of stock price 3 periods ahead, and so on. In the end, the very notion of valuation by means of discounted cash flows requires the lonely representative agent to forecast both dividends and discount rates into the indefinite future. Elton et al. 2003, 446. In the general case, both of these variables would vary in time in complicated ways. Hence, in order to make the expression tractable, the academic literature has focused on what it admits is the unlikely special case of a constant discount rate, Campbell 1991, 158. If, in addition, the expected dividend payment is also taken to be constant for all of time, the expression reduces to the familiar DCF model of equation 10.26, Shaikh 1998b, Elton et al. 2003, 444-448. Alternately, again in the interest of tractability rather than realism, if we assume that dividends grow at a constant rate, g, less than the discount rate, here the interest rate, we get the Gordon model of stock prices, Elton et al. 2003, 447-448. In all such, the assumption of a single representative agent is necessary in order for there to be a single estimated price. Moreover, this agent must also be able to predict the future for all time in order for the estimated price to be the actual price. Such notions were previously addressed in Chapter 3, Section 2. 6. Empirical evidence. In order to facilitate comparisons to other theories, I have not dwelt upon the distinction between the general, regulating, rate of profit and the profit rate on regulating capitals proxied by the incremental rate of profit, Chapter 6, Section 8, Chapter 7, Section 6.5. 1. Equalization of bank regulating rate of profit. Classical theory proposes that the regulating profit rate of the banking sector, like that of every other sector, is equalized with the general rate of profit. This was previously addressed in Chapter 7, Section 4.5, where the bank regulating rate was part of the general set of industries examined. It was shown there while average rates of profit do not generally equalize, figures 7.15 and 7.16, regulating rates do, figures 7.17 and 7.18. Figure 10.1 extracts the bank incremental rate of return from Appendix 7.2 and shows that it is indeed subject to turbulent equalization relative to all private industry. 20. 2. Equalization of bank loan rate with corporate bond yield. The second proposition is that the bank loan rate of interest is equalized with the bond yield for equivalent term loans. The intrinsic relation between the bank prime rate, the interest rate offered to good business customers, and the AAA corporate bond yield, the interest rate paid by highly rated corporations on their borrowing in the bond market, is evident in Figure 10.2. Sources and methods and data tables are in Appendices 10.1 and 10.2. 3. Equalization of interest rates of similar financial assets. Competition within any industry equalizes the selling prices of similar products, up to transportation costs and quality differences. In the case of finance, this means that similar interest rates will be equalized, up to premia related to difference in quality, risk. For instance, when permitted, banks can bolster their reserves by borrowing from the government at the discount window or by borrowing from other banks on the overnight federal funds market or by enticing depositors into making short-term time deposits such as certificates of deposit, CDs. At the long end, lenders can either buy high-grade government municipal bonds or corporate AAA bonds. Before the current crisis, the former used to have a lower return but also a lower perceived risk. Figure 10.3 displays these 5 sets of interest rates from 1940 to 2011. We can see that interest rates tend to move together, that the longer rates are generally higher than the short ones as would be expected with a normally upward sloped yield curve, but that sometimes this ranking is reversed. Turbulence is a normal feature of market processes. 4. Interest rates do not reflect fixed markups on the base rate. A common claim in the post-Keynesian literature is that the base interest rate is determined by the state and the other rates through stable monopoly markups set by banks. Moore 1988, 258, Fontana 2003, 9, 14. Figure 10.4 looks at the ratios of the 4 types of interest rates to the discount rate. Even when the sample is restricted to the normal times prior to the world crisis broke of 2007, it is immediately apparent that the notion of stable, or indeed stationary, bank markups is not tenable. 5. Profit rate and the interest rate. Figure 10.5 looks at the prime rate of interest, which is the rate offered by banks to their good business customers, in relation to the average profit rate of the business sector, previously derived in Appendix 6.7.2 and calculated in Appendix 6.8a.3. We see that the interest rate is indeed normally lower than the profit rate, as expected at a theoretical level. Given that the average profit rate is an amalgam of strong and weak firms and new and older plants, a borrowing rate higher than the average profit rate implies accelerated business failures and plant closings. If this were to persist, the demand for business loans would collapse, which would force the interest rate back down. But the rule only applies to the medium term, not to every single year. Indeed, it is in fact violated for 14 years in the latter part of the Great Stagflation of 1967 to 1982, when a rapidly rising price level drove up the interest rate until monetary policy forced the latter to fall thereafter. Section 6. 6. Interest rates and prices. Tooke and Gibson long ago documented that market interest rates move with the price level. Figure 10.6 shows that from 1857 to 2011, the long bond yield index generally moved in the same direction as the producer price index, with the exceptions of a brief period from 1861 to 1863, a somewhat longer one from 1932 to 1947 from the depths of the Great Depression to the end of World War II, and the famous policy-induced fall in the interest rate from 1982 to 2007 engineered by Alan Greenspan and sustained by Ben Bernanke. I will argue in the penultimate chapter of this book that this latter intervention fueled the real boom from 1982 to 2007 and the financial bubble that accompanied it, setting the stage for the eventual collapse of both. These events remind us of two important and related facts, that under modern fiat money the interest rate, like the exchange rate, can be directed far away from the fundamentals, and that there are consequences to doing so. Figure 10.7 tracks the relative price of finance, I/P, both variables now being indexed to 1947 as the base year. As a relative price of provision, this would be expected to essentially reflect the real cost of finance as in equation 10.8. From 1857 to 1927 this ratio is relatively stable even through the Great Depression of 1873 to 1893, and its subsequent modest downward trend into the early 1920s is consistent with rapid innovations in finance. The main departures from the general rule are in the Great Depression and the Great Stagflation where interest rates fall while prices rise. The market connection is broken when Greenspan takes the helm at the Federal Reserve and his successors turn the exceptions into the rule. In this new era, the price level continues to rise whereas the interest rate is steadily reduced through active monetary policy. Gibson's finding of a positive relation between the nominal interest rate and the price level contradicted standard theory. Irving Fisher claimed that expected real rate of interest, the difference between the money rate and the expected rate of inflation, would equal the rate of return in the real, i.e., non-financial, sector, which in turn is expected to be constant. McCulloch 1982, 47-49, Sayaka and Nardazai 1996, 34. On the further hypothesis that expectations are generally correct, the actual real interest rate, the difference between the nominal interest rate, and the actual rate of change of prices should be stable over time. Fisher explained Gibson's finding that the interest rate and the price level were positively correlated by claiming that when prices were rising people would expect the rate of inflation to rise, i.e., they would expect prices to accelerate, in which case the nominal interest rate would rise to keep the expected real interest rate stable. The trouble with this solution was that expectations were unobserved. So Fisher further hypothesized that one could proxy expected inflation through lagged values of past inflation. In order to get a requisitely high correlation between nominal inflation rates and past price changes, he was forced to rely on lags from 20 to 28 years, Coore 2002, 4. Keynes was distinctly unimpressed and dismissed Fisher's attempt to rescue standard theory as an evasive maneuver, Fongimi 2005, 621. Post-Keynesians abandon market determination altogether, resorting instead to the hypothesis that the base level of interest rates is exogenously determined by the monetary authorities, Moore 1988. Nonetheless, Fisher's hypothesis still dominates standard theory and has generated a huge and growing econometric literature, Coore 2002. Figure 10.8 plots the actual long bond real interest rate along with its HP filtered value, parameter equals 3, which is not stable over any meaningful time period. Indeed, it is highly volatile even over decades, a fact that flies in the face of the basic assumptions of standard theory about the rationality of agents and the efficiency of markets. The filtered value, which is often taken to represent the long-run trend of a variable, falls from 10% in 1874 to 3% in 1917, rises to 8.3% by 1928, and falls again to 4.6% in 1946, and so on. On the classical argument, the interest rate will be correlated with the price level, not its rate of change, and relative price of finance, I/P, will be a function of real banking costs and the general rate of profit, Equation 10.8, and Figure 10.7. The preceding sections of this chapter derive two important results from my argument. Bond rates of return will not be equalized to the regulating profit rate because bond yields are equalized to the corresponding bank interest rates. Equation 10.12. Conversely, equity yields are not equalized with bond yields because equity rates of return are equalized with the regulating rate of profit. Equation 10.13. This implies that the bond rate of return will tend to be below the equity rate of return. Equation 10.22. A much discussed fact which has come to be known as the equity premium puzzle. Figure 10.9 shows that the dividend yield on equities is generally very different from the long bond yield, which was shown to be equalized with the bank prime rate. Point 21. Figure 10.10 displays 1926 to 2010 average annual stock market and corporate and government bond rates of return, which are generally quite different. Ibbotson 2004, 30 to 31, Table 2 to 2. These are nominal rates, but subtracting a common rate of inflation from each to make them into real rates would obviously not change the evident difference between the three sets. Table 10.1 shows that the average returns of corporate and government long bond were half of equity returns of large companies. Small companies had even higher returns but also as higher risk. Neoclassical finance theory predicts that equity and bond returns will be equal up to a risk premium. Its puzzle consists of the fact that no plausible explanation is available within its framework for a 100% risk premium between equities and bonds. Large company stocks. Long-term corporate bonds. Long-term government bonds. This brings us to the general prediction of classical theory that the equity rate of return in equation 10.10 will be turbulently equalized to the rate of return on new corporate investment, the latter being proxied by the corporate incremental rate of profit and the NEPA approximation. Since all three rates include lagged variables, they must be made current, which is equivalent to calculating them in real terms. Chapter 6, Section 8. As it turns out, the respective nominal rates are all close, as are the current rates. For consistency with the theory, I will focus on the latter. The first panel in Figure 10.11 compares the current stock market and the adjusted rates over 1947 to 2011, and the second panel the current stock market and NEPA rates. In the first case, the means are 9.83% and 9.5%, and the coefficients of variation 1.71 and 1.39, respectively, so the slightly higher mean in the stock market rate is associated with a slightly higher volatility. In comparison to the current equity rate, the NEPA approximation, which has the great virtue of being very easy to compute, has a somewhat lower mean, 9.83% versus 8.49%, and essentially the same coefficient of variation, 1.71 versus 1.68%. The equalization of the equity market rate of return with the corporate rate is naturally turbulent, and certainly includes intervals of extended differences. For instance, in Figure 10.11 the equity rate remains substantially above the corporate rate from 1996 to 2001, which is the period of the information technology .com bubble. Still, given the close correspondence between the levels and coefficients of variation of the two rates, there is little basis for Shiller's claim that the stock market return is characterized by excess volatility due to the irrational exuberance of investors. 1989, 726 to 728. Shiller arrives at his excess volatility conclusion because he takes the ruling efficient market hypothesis, IMH, as the benchmark. Standard theory says that the price of an equity is the present value of its dividend stream determined by a constant rate of discount. Equation 10.31. The assumption that the discount rate is constant through time corresponds to an efficient market's assumption that expected returns on the market are constant through time, that there are no good or bad times to enter the stock market in terms of predictable returns. Some more sophisticated versions of the efficient markets hypothesis allow the discount rate to vary over time, but these versions imply that the returns on the stock market are forecastable. The simple present value computed here is relevant to the most popular, and most important, version of the efficient markets model. Shiller 2001, 260 and 24.22. On this basis, Shiller sets the constant discount rate, equal to the historical geometric average real monthly return on the market from January 1871 to June 1999, or 0.6% a month, 260 and 24.23. According to standard theory, the calculated discounted present value represents the true fundamental value of the stock market in that year. With the constant discount rate required by the IMH, the fundamental value is inevitably smooth while the actual stock price is jumping around a great deal. Shiller 2001, 185 to 186, 187, figure 9.1. Since the fundamental value already incorporates the future movements of dividends, it seems obvious to Shiller that these big stock market movements were not in fact justified by what actually happened to dividends later. 187. The IMH clearly fails. The problem is not that the stock market is subject to occasional bubbles, 233, but rather that so much of the volatility of stock prices is not justified by the behavior represented in the dividend discount model. 187, figure 9.1, 2014, 14, figure 12. In his various attempts to calculate the true value of stock prices, Shiller uses a constant discount rate equal to the mean dividend divided by the mean price averaged over 1870 to 1979, Shiller 1981, 424, to the historical geometric average real monthly return on the market from January 1871 to June 1999, or 0.6% a month, Shiller 2001, 260 and 24, and finally to a constant real discount rate R equals 7.6% per annum, equal to the historical average real stock market return on the market since 1871. Shiller 2014, 10. The excess volatility problem obtains in all cases. The underlying difficulty becomes immediately evident if we turn the problem around. Shiller himself says that the efficient markets assumption is that expected returns on the market are constant through time, that there are no good or bad times to enter the stock market in terms of predictable returns. Shiller 2001, 260 and 24. This is exactly the problem, for if we compare the volatile actual stock market rate to any constant such as Shiller's most recent discount rate 7.6% or even to the time-varying average rate of profit, the stock market rate always exhibits considerable excess volatility. In figure 10.12 the average rate of profit falls from over 16% to below 6%, whereas Shiller's discount rate is constant at 7.6%. But the far greater volatility of the stock market rate of return makes both of them seem stable, and closer than they actually are, by comparison. The close correspondence between the equity return and the incremental rate of profit in figure 10.11 and the lack of correspondence between the former and the constant discount rate or even the average rate of profit in figure 10.12 makes it clear that the problem lies in the specific hypothesis about the regulator of the stock market, Shaikh 1998b. Shiller's methodology leads to another important issue. If the stock market rate is regulated by any external rate, RT, the level of the long-run stock price must satisfy the relation from equation 10.11 for the path of the warranted real stock price that would obtain if the actual stock market rate of return was equal to the actual time-varying corporate rate of return on new investment in each year. The trouble is that we cannot calculate the level of the warranted price without some further assumptions. 10.31. Shiller, 1981, 425, chooses to set the endpoint of his irrational stock price equal to the averaged trend real price over the sample. This is equivalent to assuming that over the long run the actual price mean reverts around the price. The classical argument also hypothesizes that the actual price is mean reverting, subject to shocks, around the warranted price, but in this case the external regulating rate for the stock market is the observed incremental rate of the return in the corporate sector, so we can check directly for periods of close correspondence between the actual and regulating rates. One possibility would be to use an ARDL or unobserved component model to estimate a long-run relation between the two rates and use that to extract the level of warranted stock price. Alternately, since the two real rates have the same mean over the whole period 1948 to 2011, Table 10.2, that we use that as our normalizing time interval. 24. This would determine the warranted price level in essentially the same manner as Schiller, so that the sole difference in result arises from the specific rates assumed to regulate the stock market return, the incremental rate of profit in the classical case, and a constant discount rate in the Ehm case. The first panel in Figure 10.13 compares the actual real stock price to the estimated rational price 25, whose smoothness is the source of Schiller's concerns about the Ehm. The second panel in Figure 10.13 displays the actual real stock price alongside the classical warranted rate. Here we see the long swing turbulent equalization consistent with classical theory and particularly with Soros's notion of reflexivity, which is itself a critique of the Ehm. Soros 2009, 50-75, 105-106. The long boom of the Golden Age era of the 1950s and 1960s, followed by the long downturn during the Great Stagflation on the 1970s and 1980s, when the stock market fell sharply in real terms, the dot-com bubble from the mid-1990s to the mid-2000s, and the sharp but temporary drop of both actual and warranted real prices at the onset of the global crisis, followed by their rapid recovery despite rampant unemployment across the world. This last phase is a tribute to the earnest efforts of monetary authorities to keep big corporations and financial markets happy at any cost. Rather than boosting credit to the real economy, unconventional monetary policies have mostly lifted the wealth of the very rich, the main beneficiaries of asset reflation. But now reflation may be creating asset price bubbles, and the hope that macroprudential policies will prevent them from bursting is so far just that, a leap of faith. Rubini 2014. 7. A critical survey of interest rate theories. 1. Interest rate theories have two dimensions. Interest rate theories have two dimensions: 1. A theory of the interest rate, and 2. A theory of the term structure of interest rates. I have argued in this chapter that both aspects can be derived from the same unifying principle. Competition within the financial sector leads to arbitrage among bonds and bank loans of comparable types, and this serves to equalize interest rates, while competition between financial and non-financial capitals equalizes their regulating rates of return. The combination of the two principles yields a theory of the level and structure of interest rates, bond prices, and stock prices. In what follows I will start with the first dimension, which is the theory of a single interest rate. Two types of linkages between the interest rate and the profit rate exist here. Top-down theories tie the interest rate to the rate of return on new investment, the latter being determined by the socially determined real wage as in classical theory, or by the full employment real wage as in neoclassical theory. Lutz 1968, 226-227, 289, 300. On the other hand, bottom-up theories begin from an interest rate determined by liquidity preference, convention, or state intervention and determine the profit rate through this. Moore 1988, 258, 261, Rogers 1989, Pivoti 1991, 26-27, 128-129, 26. Sraffa generally follows the top-down approach in his exposition, but then switches to the bottom-up one when he makes a passing remark that the rate of profit may be determined by the interest rate set by the bank or the stock exchange. Sraffa 1960. 33.27. 2. Smith, Ricardo, and Mill. Smith estimates that in Great Britain the customary interest rate is roughly half of the profit rate, although he is careful to state that in the short run the proportion which the usual market rate ought to bear to the ordinary rate of clear profit necessarily varies as profit rises or falls, and that the proportion between interest and clear profit might not be the same in countries where the ordinary rate of profit was either a good deal lower or a good deal higher. Smith 1937, 200. Ricardo too says that the free market rate of interest is ultimately regulated by the rate of profits which can be made by the employment of capital. Ricardo 1951b, 363, although in the short term the market rate is also affected by changes in the quantity of money, the price level, and the balance between demand and supply for commodities and for funds. Unfortunately, in all countries, from mistaken notions of policy, the state has interfered to prevent a fair and free market rate of interest. Hence, one cannot necessarily use the path of the observed interest rate to estimate the path of the profit rate, 296 to 297, 363 to 364. Indeed, even when market rates are free, there are considerable intervals during which a low rate of interest is compatible with a high rate of profit. Ricardo 1951 to 1973, 7:199, cited in Panico 1988, 1919. Mill generally abides by the classical dictum that there is a natural rate of interest that is determined by the profit rate and that regulates the market rate, Ayakper 1995, 444. But he seeks to moderate the confidence with which inferences are frequently drawn with respect to the rate of profit from evidence regarding the rate of interest, and to show that although the rate of profit is one of the elements which combine to determine the rate of interest, the latter is also acted upon by causes peculiar to itself, and may either rise or fall, both temporarily and permanently while the general rate of profits remains unchanged. Mill 1968, Essay 4, on Profits and Interest, 90 to 119. Hence, it is erroneous to assume that the proportion of the interest rate to the profit rate, which few attempts have been made to define, can be taken to be constant over time. It follows that we cannot judge the level and trend of the rate of profit through data on the interest rate, 106 to 107. Mill emphasizes that the gap between the rate of profit and the rate of interest determines the wages of superintendents, from which it follows that the interest rate must be less than the profit rate to make capitalist activity worthwhile, 107 to 109. Finally, he notes that banks are profit-making enterprises and competition makes their profit rate equal to the general rate of profit, which produces some further anomalies in the rate of interest, 114. That Mill tries somewhat unsuccessfully to resolve. 28. This last step is crucial because the equalization of the bank profit rate with the general rate of profit provides a direct link between the interest rate as the price of bank loans and the profit rate. The problem for Mill is one of reconciling this linkage with his own argument that the ratio of the two is not generally stable. 3. Marx argues that the rate of interest is generally lower than the rate of profit, except perhaps in certain phases of the business cycle, Ito and Lipovitz's 1999, 70-71. But beyond that point, his arguments contain notable ambiguities. In Theories of Surplus Value, which was written in 1861-1863 in preparation for the 3 volumes of Capital, he speaks in a classical vein about the two variables. The rate of interest, the market price of money, is fixed in the money market by competition between buyer and seller, by demand and supply, like the price of any other commodity. Marx 1971, Addenda, 509. Conceptually, a general rate of interest corresponds naturally to the general rate of profit, 461, and in this regard it is very remarkable that economists like John Stuart Mill, who cling to the forms of interest and industrial profit in order to convert industrial profit into wages for superintendents of labor, admit along with Smith, Ricardo, and all other economists worth mentioning, that the average rate of interest is determined by the average rate of profit, 505, emphasis added. This leads him to a formulation linking the interest rate and the profit rate. If the rate of profit is given, then the relative level of the rate of interest depends on the ratio in which profit is divided between interest and industrial profit. If the ratio of this division is given, then the absolute level of the rate of interest, that is, the ratio of interest to capital, depends on the rate of profit, 471. From 1863 to 1867, 4 years after Theories of Surplus Value, Marx completed Volume 1 for publication and prepared a first draft of Volumes 2 to 3, Engels 1967, 3 to 4. His draft of Volume 3 includes Part 4, in which he discusses merchant capital comprised of commercial, wholesale/retail, and money-dealing capital, Marx 1967 c. 267, 301, 323. He points out that although neither of these participate in production, both make profit and both enter into the equalization of profit rates, 279, 285, 322. In this part, he reduces the capital of money dealers to their reserves and assumes that they make their money by charging fees for their activities, Panico 1988, 181. One would think that the very next part of Volume 3, Part V, which is explicitly concerned with interest, profit, and profit of enterprise, the excess of the profit rate over the interest rate, would build upon this foundation. Indeed, in the middle of Part V, Marx mentions banks and links their profit rate to the difference between the interest rate at which they borrow and the interest rate they charge on loans, Marx 1967 c. ch 25, 402-403, Panico 1988, 182. This distinction between in and out rates of interest, in the sense of Hicks, is already a nascent theory of the term structure previously mentioned in the remark that the rate of interest itself varies in accordance with the different classes of securities, and in accordance with the length of time for which the money is borrowed, Marx 1967 c. 365. This is all consistent with his prior discussion in Theories of Surplus Value and Part 4 of Volume 3. The natural extension would have been to address the impact of the equalization of banking profit rates on interest rates. Yet this question is not addressed at all in a section ostensibly devoted to the analysis of the relations between interest and profit. Nor is it addressed in any other part of Capital. On the contrary, except for the aforementioned aside on interest rates and banking profits, the vast bulk of Part V is focused on the claim that the interest rate is not determined by profit rate equalization. Point 29. It is important to recognize that Part V was not part of Marx's draft of Volume 3 of Capital. Engels is careful to tell us that just as Marx was preparing to write this section, he was overtaken by serious attacks of illness. Here, then, was no finished draft, but only the beginning of an elaboration, often just a disorderly mass of notes, comments, and extracts. After Marx's death, Engels says that he tried and failed 3 times to fill out what he thought would be Marx's argument before finally giving up and settling for as orderly an arrangement of available matter as possible, Engels 1967, 3-4, point 30. Hence, the interest rate section of Volume 3 was actually constructed by Engels. We do not know the dates of the different manuscripts involved, how much of their material would have been carried over into the first draft of Volume 3, or how their arguments would have been reconciled with prior ones in this same volume or in Theories of Surplus Value. In any case, this section has Marx insisting that the average rate of interest prevailing in a certain country, as distinct from the continually fluctuating market rates, cannot be determined by any law. In this sphere there is no such thing as a natural rate of interest in the sense in which economists speak of a natural rate of profit and a natural rate of wages. There is no good reason why average conditions of competition, the balance between lender and borrower, should give the lender an interest rate of 3, 4, 5%, etc., or else a certain percentage of the gross profits, say 20% or 50%, on his capital. Wherever it is competition as such which determines anything, the determination is accidental, purely empirical, and only pedantry or fantasy would seek to represent this accident as a necessity. Customs, juristic tradition, etc., have as much to do with determining the average rate of interest as competition itself, in so far as it exists not merely as an average, but rather as actual magnitude. It follows from the aforesaid that there is no such thing as a natural rate of interest. Marx 1967 c. 362-364. Marx goes on to explain why competition alone cannot determine the relation between the interest rate and the profit rate. If we inquire further as to why the limits of a mean rate of interest cannot be deduced from general laws, We find the answer lies simply in the nature of interest. It is merely a part of the average profit. The same capital appears in two roles as loanable capital in the lender's hands and as industrial, or commercial, capital in the hands of the functioning capitalist. But it functions just once, and produces profit just once. In the production process itself, the nature of capital as loanable capital plays no role. 364. This explanation would have been particularly odd if he had written it as part of his final draft, because in Part 4 he himself argued that money-dealing capitals do participate in profit rate equalization even though neither of them plays any direct role in the production process. If we approach the issue from the point of view that Marx adopts in this section, the share of interest in profit can be written as from which it follows that the relation between the interest rate and the profit rate is mediated by the share of interest to profit and the ratio of bank debt to capital, leverage. Marx is quite right to say that except for the requirement that the interest rate be less than the profit rate, no general law can be deduced for the share of interest in profit and the degree of business leverage. Custom, juristic traditions, and institutions will surely play an important role here. So if we abstract from the costs of money dealing and banking, the interest rate can only depend on the factors that determine the supply and demand for funds. Then there is no good reason why average conditions of competition, the balance between lender and borrower, should produce particular interest/profit or leverage ratios. But the very same thing could also be said of any commodity price if one were to abstract from its costs of production, as neoclassical economics routinely does in its initial representation of capitalism as a system of pure exchange. If there is no operating costs and no capital invested, commodity prices could only depend on supply and demand. Yet Marx and the classicals emphasize that prices of production regulate market prices precisely because production does entail costs and does require capital. What is most striking is that the section assembled by Engels, through no fault of his own, does not build on Marx's prior argument that money-dealing capitals, including banks, have costs, are driven by profits, and participate in the equalization of profit rates. Panico 1988, 61. Three further points are relevant here. It may seem tempting to try to reconcile the apparent division in Marx's writing by assuming that the base interest rate is conjuncturally determined while longer-term out rates are determined by banking costs and profits. This is the approach adopted by Hicks, 1989, 106-107, in response to similar problems in Keynes's theory of interest rates. I would argue that this is an inconsistent hybrid, since it abstracts from costs of money dealers in the short-term money market while relying on the costs of money dealers offering longer-term rates. This is why my own argument treats the base rate itself as a price of production. Second, Marx was aware of Tooke's finding that the interest rate is also related to the price level, which implied that there could not be a fixed Smithian proportion between the interest rate and the profit rate. Indeed, as Marx knew, Ricardo and Mill also struggled with the discrepancy between Smithian proportionality and the empirical evidence. This difficulty is also resolved once we account for the fact that interest rates depend on the costs of financial provision and hence on the general price level, equation 10.7. Finally, even when the interest rate is a function of the rate of profit and the price level, Marx is still correct to say that the ratio can vary across countries and through of time because the degree of leverage, the profit rate, and the price level can vary. To put it differently, the determination of the interest rate by the profit rate does not imply that there is a natural rate of interest, so Marx is correct to reject the latter. 4 Neoclassical and Keynesian theories of the level of interest rates. Arbitrage equalizes rates of return. The secret to neoclassical and Keynesian theories of interest rates is that they abstract from the costs of money dealers. Thus, while long-run commodity prices depend on costs of production, long-run interest rates must be explained in some other manner. The starting point is the notion that arbitrage equalizes the one-period rate of return on financial assets of all duration 31 so that all such rates of return are essentially equivalent. This arbitrage process is carried out by speculators, since most other participants will be concerned with the safer yields to maturity of the different financial assets, Lutz 1968, 257. However, as previously noted in equation 10.16, the rate of return of a 1-period zero coupon, discount, bond such as a T-bill is equal to its interest rate, yield to maturity. Arbitrage therefore equates the whole constellation of rates of return to a single interest rate, so that we are entitled to refer to the interest rate, Conard 1959, 288 to 289, 298. Finally, as previously indicated in equation 10.17, 1-period rates of return are generally different from yields to maturity, so the equalization of the former implies that while interest rates are equal across equivalent financial assets but not across different types, Altman and McKinney 1986, 12 to 24. 2 further issues, interest rate levels and term structure. 2 issues then arise. The equalization of rates of return on financial assets is not sufficient to determine their common level, so the standard approach requires a theory of the interest rate. And since the equalization of rates of return does not imply equalization of interest rates, this approach also requires a theory of the term structure. 3. Neoclassical theory of the level of interest rates. On the first issue, neoclassical theory equates the interest rate, the common rate of return on financial assets, to the profit rate in the real sector, Lutz 1968, 226 to 227. Indeed, Lutz explicitly identifies the real sector rate as the marginal rate of return on new investment and says that in static equilibrium the interest rate is equal to this real sector rate corresponding to full employment equilibrium, 289, 300, Panico 1988, 3. 4. Keynesian and Hickschian theories of the level of interest rates. On the Keynesian side, there is considerable disagreement on the theory of the interest rate. Keynes himself argues that because arbitrage equalizes 1-period rates of return, all assets are equivalent, equally liquid with respect to one another, and equally illiquid with respect to money. In this case, the only real choice is between holding money for its liquidity and investing in financial assets, each of whose equilibrium return will be the interest rate. The liquidity benefit of money will be compared against the returns from investing in financial assets, and the higher the interest rate the smaller will be the desired money balances. This is said to determine a demand for money which falls with the interest rate. At any given supply of money and level of output, the interest rate is determined in the money market at the level which would equate the demand and supply of money, Modigliani 1951, 199 to 200, Harrod 1969, 182. The liquidity money, LM, supply link between money and interest leads directly to Hick's famous IS-LM formulation, Moore 1988, 248. Any given interest rate from the LM loop leads to a particular level of investment demand, since investment depends on the difference between the rate of return on investment and the interest rate, i.e., on level of the profit rate of enterprise, which through the multiplier determines a level of output sufficient to make savings equal to investment. The interest rate would be influenced by the effect of output on the demand for money, while output would be influenced by the effect of the interest rate on investment. Under standard assumptions, both the interest rate and the output level would be uniquely determined. Finally, the traditional reading of Keynes is that the interest rate determines the rate of return on investment, the marginal efficiency of investment, although there is dispute around this point also. Moore 1988, 261, Panico 1988, 146 to 156. 32 As inventor of the IS-LM framework, Hicks certainly starts out in Keynesian fashion. He subsequently moves on to consider the term structure of interest rates as a question of in and out rates of financial intermediaries, Hicks 1965, ch. 23. I will address this shortly. But only later does he close the loop by arguing that this whole structure depends on a base rate, the rate on bank deposits, which is determined by the interaction between the needs of banks for reserves and the liquidity preferences of money holders. The base rate is the kingpin of the system, Hicks 1989, 106-107. Nothing in these arguments seemed to imply that these private market operations would ensure full employment. The Keynesian version left it to the visible hand of the state to correct any deficiencies in the workings of the invisible hand by shifting the IS curve through fiscal policy and or the LM curve through monetary policy to achieve appropriate levels of output and employment. Ritter, Silber, and Udall 2000, ch. 25. This was, of course, unacceptable to the neoclassicals, and it was not long before they were able to suitably modify the IS-LM story to ensure automatic full employment. If there was unemployment, money wages would fall, and this would lower the price level. Consumer real incomes would be unchanged, so the real demand for money on the LM side would be the same. Aggregate profits would be unchanged, lower sales being offset by lower costs, so investment demand would be unchanged. But the existing money supply would be enhanced by a fall in prices, since it would now represent a greater quantity of potential real wealth. Hence, the real money supply rises and interest rates must fall on the LM side so as to induce people to hold this larger, real, amount of money. The fall in the interest rate with unchanged profitability would raise the profit of enterprise, which would raise investment and hence raise output and employment on the IS side. This would continue until full employment is achieved. Thus, what started out as Keynes's attempt to explain how free markets can give rise to persistent unemployment ended up as the standard explanation of how free markets lead to full employment. Ritter, Silber, and Udall 2000, 503-505. Keynesians who stayed with the IS-LM framework were inevitably forced to rely on the argument that market imperfections such as sticky wages and prices would make any progress toward full employment quite slow, so that it made social sense to speed up the process through state-induced injections of aggregate demand. In addition, it was argued that money demand might become progressively less responsive as the interest fell, so when the latter was sufficiently low, any further increases in the real money supply would have little effect. 469-472. Many generations of macroeconomists were trained in this fashion. I will return to such issues in Part 3 of this book. V. Post-Keynesian theories of the level of the interest rate. The neoclassical takeover of the IS-LM framework forced Keynes's followers in a variety of directions. Ray argues that liquidity preference theory is an essential element of the post-Keynesian approach. Ray 1990, 156. Panico, 1988, 103, argues that Keynes's theory of liquidity preference does not determine the average interest rate. It only describes the market mechanisms which make this rate assert itself. In Panico's interpretation, Keynes ends up with the theory of the historical conventional character of the determination of this rate that ultimately depends on what the common opinion in the market expects it to be. 128. He points out that this is comparable to Marx's argument, at least to the version in the part of Volume 3 of Capital constructed by Engels, 47, 141. In a similar vein, Rogers, 1989, 268, argues that the long-term interest rate is the linchpin of the system, since it determines the level of investment and hence, through the multiplier, the level of output and employment. But once it is understood that the interest rate is expectational, subjective, psychic, indeterminate, then investment and output are equally conditional, then there is no mechanism in a capitalist economy which relates the rate of interest to the full employment level of output. 270. Alternately, Moore, 1988, 246, argues that Keynes's difficulties with interest rate theory could have been resolved if he had only recognized that central banks set interest rates rather than the quantity of the money supply. The standard LM mechanism relies on the interaction between a demand for money balances, hoards, which falls with the interest rate, and a fixed supply of money determined by state. Then for any given level of output, only a particular interest rate will match money demand to money supply. The notion of a given money supply is predicated on the argument that the state provides some money directly to households and businesses and provides the rest indirectly through its supply of reserves to the banking sector. The latter determine the maximum amount of loans that banks can offer before they hit mandatory reserve requirements. Loans create deposits, and deposits require reserves. In the neoclassical argument, it is the confrontation between this state-induced money supply and private money demand that determines the interest rate. Ritter, Silber, and Udall 2000, 21-22. If instead the state tries to fix the interest rate, it must accommodate the reserve needs of banks in order to adjust the supply of money to the demand for money at the desired interest rate. Lavoie, 2006, 57-59, and Ray, 1990, 187, confirm that this is now the consensus view in post-Keynesian economics. This, of course, sidesteps the question of what determines the rate of interest when the central bank rate follows the market rate 33 or when central banks have not yet come into existence. 5 Neoclassical and Keynesian theories of the term structure of interest rates. Neoclassical theory has great difficulty providing a foundation for the term structure of interest rates. Arbitrage is supposed to equalize one-period rates of return across all financial assets, so there is no reason why their maturity should matter in that dimension. Moreover, in the standard neoclassical world with stable bond prices and no risks, rates of return are the same as interest rates, equations, 10.14, 10.17, so that arbitrage also equalizes the latter. Then there can be no term structure return. Lutz 1968, 219, Ritter and Silber 1986, 453-454. We cannot appeal to liquidity differences among financial assets to ground a yield curve because under the assumed conditions of perfect certainty and correct expectations, all maturities have equal liquidity, since all can be sold at predictable prices and the rates of return over given time periods are equal. The shape of the yield curve in this case cannot reflect the degree of liquidity of different terms of securities. Conard 1959, 326. The same problem arises with reference to risk. There should be no reason why longer-term bonds would be riskier as speculative assets if all assets are re-evaluated one period at a time, and there is no reason why the risk of a default one period from now should be any different for a short bond than a long bond. Nor does liquidity preference help. The Keynesian premise is that the uncertainty in financial flows makes holding money necessary, while the neoclassical premise is that all financial assets have the same one period ahead rate of return known with certainty, or at least with the same degree of uncertainty. Hicks 1965, 284. While this may provide a basis for a trade-off between money and financial assets in general, it does not change that fact that return arbitrage makes all financial assets equally liquid. Note that if rates of return are equalized across financial assets, yields may indeed differ, but there is no reason why longer-term assets should have higher yields. Consider the case of equal returns on a one-period zero and a long bond, as depicted in equations 10.16 and 10.17. This is obviously compatible with long rates being higher, equal to, or lower than short ones. The same point applies to the standard expectations approach to asset prices. Lutz, Conard, Hicks, Modigliani 1951, 200. Suppose that the representative agent can buy a one-year T-bill today at 8% and, correctly, expects that this rate will rise to 10% next year. Then this entity can either buy a one-year T-bill today and again next year for an average return of about 9%, or a two-year T-bill now. On the neoclassical argument, a two-year security would have the same average return as two sequential one-year bills, i.e., about 9%. In this case, the longer security would have a higher yield. Conversely, if the short-term interest rate were expected to fall next year, the longer security would have a lower yield. Ritter, Silber, and Udall 2000, 77-78. On the expectations hypothesis, the current yield on a long asset is a multiplicative average of the expected path of short rates. There is no reason, therefore, For the upwardly sloping yield curve which is most often observed, 75. The expectations hypothesis also implies that short and long rates can move in opposite directions, while in practice they tend to move together, figure 10.4. One solution is to assume that the uncertainty on expected short rates rises with the length of time into the future, in which case the near-term movements in short rates will dominate movements in long rates. While this might make both sets of rates move together, it would still not generate an upward sloping yield curve. Conard 1959, 312-313. The last possibility relies on the fact that the price of a longer bond is more volatile than that of a shorter one in the face of a given change in yields to maturity, so that longer bonds generate greater capital gains or greater capital losses. Assuming that the representative investor is risk-averse, one would expect generally higher yields for longer-term assets. This is generally known as the liquidity premium modification of the expectations approach, although it is really a risk premium modification. Ritter, Silber, and Udall 2000, 60, 79. The preceding argument is based on the notion that the yields on longer-term assets are geometric averages of the yields on the short-term rate. But since arbitrage renders all assets alike, there is no reason why the argument could not be reversed to instead derive the path of short-term rates from the expected path of long-term rates. Ford and Stark 1967, 17. Then if the latter are linked to the profit rate, the expectations approach would imply that the paths of all interest rates were driven by the expected path of the profit rate. Finally, all the standard expectations theories have the intractable difficulty of being built upon the assumption that the market has a uniform view of expected rates. Diverse expectations, of no matter what degree, are ruled out ex hypothesi. Dodds and Ford 1992, 178. Luckett, 1959, long ago pointed out that it is not the individual's expectations of the future path of the short-term rate that matters, but rather the individual's expectations of the market's expectations. Lutz, 1968, 218, admits that if we follow this reasoning then we must give up the expectations theory. And so we should.